approach to trading futures today, and a healthy reminder to protect your downside. Also worth mentioning, Anthony is a fellow podcaster who hosts the Futures Radio Show, which you can listen to at futuresradioshow.com. So check that out. He does a really great job. Okay, let's get straight to it. Here is my interview with Anthony Crudele.
I think one of the things that I really want to talk about is just really sustaining success and how I think that how the markets have changed. And I just feel like the ability to be able to stay in business is actually harder than getting to a point of becoming what some people would call a success, like actually making money. I think that it's actually, for me, it was harder to be able to know that once I learned something that worked, that when it didn't work, that I had to change into something else. And just the way that I approached my day-to-day operations just were so dramatic. And I mean, one of the also things I think that was pretty interesting about myself that I think would probably catch some attention is that basically I was kind of like what high-frequency trading was before high-frequency trading. I mean, I was so active at the time, at the inception of the E-mini, that I would be, a lot of times I was 5 or 10% of the total volume in the S&P futures in the mini. And I've been able to, I saw it trade from 10,000 contracts today to what it was. I remember looking up at the board sometimes and being like, I traded like 5,000, 6,000, 7,000 contracts, and they only traded like 100,000. So I would be like, at that point in time, when it became to 1 million contracts, I was never that great of a percentage, obviously. But I have done like 30,000 minis in a day, which is probably, I don't think most people, I definitely know I have some friends that have done that, but I've traded 500 lots, 1,000 lot S&Ps. It's like, I think that understanding how I was able to do that is a big part of it. And like how I've went from that to what I'm like 1 to 5 trades a day, maybe even sometimes only a week. I'm like a completely different trader. And it's just because they took what I was good at. And then basically, so I sat down in a meeting. I was actually, so my clearing firm, at the time, they had like talked to other people. They were recognizing I was doing really well, and I was actually sat down in a room with a couple of pit traders, and these guys were offering to give us like a substantial amount of money. They were like starting a group, and they wanted to basically learn how we scalped, and we did this. This was like in the mid 2000s. And basically, we were all doing extremely well at the time. Everybody in there was $1 million earner, and it was kind of like, we looked at them like, yeah, okay, sure. It was we kind of like laughed it off, like, whatever, like, we're going to teach you what we do. It's just impossible, right? And then what I felt like, what I didn't recognize at that time was that was happening. You know what I mean? It was like the weirdest thing, because about 3, 4, 5 years later, like around 2009, I noticed all of a sudden, I'm like, well, wouldn't you know? It just was like a different feeling, I was able to, what I was able to do one day to the next day was just not carrying over. It was just like, it was like almost like a light switch, but it probably was happening and I didn't even recognize it. You know what I'm saying? Like I was like fighting it and losing money and giving back a large portion of the money that I made. And it was like until I was getting to the point to where I basically had to just stop myself from losing any more of the money that took me a lot of work to make. Then I had to like basically, all of a sudden like start learning all over again in some weird way, like I had to stop myself. So I feel like that's more or less like my story. That's why I have strong relationships with CME. I was one of the youngest members of the Merc. I started doing, media for them when I was in, my late 20s, and it's probably very few people that were doing that, and just because I was a mini trader. And then I think the other thing I like to talk about is like, we just did this, we talked about this on our podcast. And I think that, for you have, you got a really strong reach. You got a really good audience. I think that a lot of people, like on Twitter, just they think that the bigger followers are like the people that are the bigger traders, when it's like really that's just not the case. I feel like that's a total misconception of the industry. It's one of kind of like my pet peeves with it is just like, I feel that having people can be misled easily. you don't know who you're dealing with. You know what I mean? It's like you don't know who the people are. And I think that for trading and for traders, like one of the points I want to make about that is like you have to kind of be who you are. You know what I mean? I learned from watching other people, but don't be like blindly following what other people are doing and think that that's going to take you to the promised land. I feel like because there's just so much noise out there now that it's like, you could think someone's really popular. And then really, it's like I've seen people come out and claim to be who they are. I spent 20 years in the trading floor. I never heard of these people. I mean, I don't know who they are. But they say that they came from the Board of Trade, the Merc. I've never heard of them, and it's like I know everybody there. If I went there right now, I'd know everyone that was there, and I spent all these years. But it's like, so there's a lot of, I think that one of the things I want to talk about to people is like, hey, man, learn from these people, whether or not you know what they do your own thing. Like, don't be so convinced that, like I took grains of salt from what people taught me and put it into play. So those are some of the things that like, I just, like the involvement, like current trading, like I've had so many people ask me these questions or say, well, this guy says this on Twitter and you should do that. And I just feel like it's like, yo, man, like, how do you know what he knows? It's a weird thing. You know what I'm saying? Just a couple of things like that. I just find that to be something I don't know how we touch base about that, but I just feel like I want people to understand that it's like, hey, man, if I could do it, then you could do it in whatever way you're doing it. You don't have to like blindly, like I feel like a lot of people just blindly follow stuff.
For sure.
You know what I'm saying?
For sure. Yeah. Okay, we'll make sure to cover all of that during the episode. So, I mean, let's just roll into it if you're ready to go.
Rock and roll, man.
Okay, so Anthony, I mean, tell us about why you decided to get into trading. Take us back to when you were, I think you were around about 21 years old at the time when you decided to get into it. What was your motive? Why'd you come to trading?
Well, actually, I started when I was 18 years old, not trading, but that's when I got into the business. And it was by accident. And literally by accident, I was actually in a car accident. I was in a head-on collision right out of high school. Broke my femur, just all around bad. Had to have multiple surgeries on it. And at the time, I was really just unsure of what I was going to do with my future. I was looking at possibly going to college. I really didn't. I was kind of undecided. I was thinking maybe business school, something along those lines. And this car accident just kind of derailed me from all of those things. I was going to have multiple surgeries over the next 6 months. And the doctor was like, you know what, really, you're not going anywhere. You're going to need to rehab. So what I did was I enrolled in, basically college, like, what do you call it? Like COD was College of DuPage, actually, in Illinois. I took one class and I had to get a job. And at the time I was like, okay, what am I going to do? The doctor's like, you need to build up strength in your leg. I was like, okay. So I looked in the paper and I found a job as a runner. And I went to the trading floor, 18 years old. And I figured, I could do like a couple of classes at night till I get, my footing, and then just try and figure out what I was gonna do. Well, it turned out once I got on the trading floor, I never even made it through my first class. I literally just paid for it and never ended up going. I think I maybe went to it once or twice. And then once I got on the trading floor for the first time, I'm like, this is it. I'm just gonna somehow figure out a way to, make this happen. And that's how I got into it. And, really I started as a runner. I was in the meat pits, which some people may not know what that is. It's live cattle. I worked in all the different meats where we actually had pork bellies back then. And then I became a clerk in the Eurodollar options after about 6 months of being a runner. And I spent about a year in the Eurodollar options, which was very interesting. I thought it was a really interesting learning experience, but it was not really my speed. I just felt like it was slower. The traders it just wasn't the action. And I remember I used to take breaks and go downstairs and look at the S&P pit. And I'm like, okay, this is where I want to be. I mean, at this time, it was like 1995, 1996. The S&P was rocking, man. And it was just like, that's where you wanted to be. I mean, the Euros were busy too, but I was in the option side of it. And I was just like, I want to go down there. Actually met a friend in the break room, got an opportunity to be a trade checker. Now, some people probably don't know what a trade checker is. Well, clerk, first of all, going back to what a clerk was basically what I did was I took orders from brokers on the desks and gave orders to brokers in the pit to then they gave the orders, they put the orders out in the open market and traded with traders or other brokers. But a trade checker in the S&P, what I did there was I worked for what was called locals. A lot of people know them as locals on Twitter or what have you. I worked for individual traders, and I had about 5 great guys, and they each paid me individually. And what I did was I'd go up to their coat, I'd pull the card out of their pocket, I'd take what was called a dupe, which is a duplicate, like you actually wrote onto the card. And then when you took the card, you had like a piece of paper that you pulled off, and then you'd put that dupe in your hand, and then you take that card, you time stamp it, and then you take that card and then you'd put it and turn it into the runner, and then they would go in and they would punch that in. So what I would do is I would take the trade and I would check it with the other locals or other brokers, clerks, trade checkers, and I would just be like, hey, Galt VXD, I sold you a 5 at 2.5, and they'd be like, check good. And I checked their trades to make sure that they were accurate, that they were doing in the pit. And while I was doing that, I would also do their money. So I would know how many ticks they were up or down, and I would tell them their position. You're long how many, short how many. And I know today that sounds so crazy to think with computers. The minute you put position on, you know how much you've made every tick, and you know exactly what your position is. Well, back then they would do, they'd sell 17, buy 6, they buy 3. They know that they sold 17 and just bought back 9. They'd be like, where am I at? I'd be like, you're still short 8. And then they bid on 8. I mean, so it was like, actually, you were very involved with the role of your trader. And that's really kind of how I started to learn how to trade, through their eyes and seeing what they were doing. And then later I would kind of pick their brain and ask them, why do you do this? What were you doing? And I basically took bits and pieces of what they were saying. And I would ultimately, was just like kind of like building my arsenal per se of what all of my good traders were doing, and to eventually, get myself in a position to do it. So I saved up some money. I was 20 years old at that time. I put in the paperwork to become a member, and I became a member when I turned 21 years old, which was a really interesting experience. I'm sure we're going to dive deeper into that.
No doubt. So just one question before we move on any further. When you purchased when you leased a seat on the floor of the exchange, how much did that cost at the time? Because I had Peter Tuchman on, who's a broker on the NYSE. I can't remember what episode it was a while back. And he said that the cost to lease a seat on the floor of the exchange sort of varied between a few $1,000s up to $1 million and upwards, depending on different times. How much was it when you signed on?
Well, the seat, I don't know how much the seats cost because I couldn't afford to buy one at the time, but the leases, my seat lease, I believe my first seat lease was around $3,000, maybe a little bit more than that. And then they slowly came down from there. Now, mind you, I only had a $25,000 account. It was every single dollar I had was in that trading account. And I was looking at the end of each month, I was looking at, a substantial loss if I just broke even. So there was a lot of pressure to make money, to say the least.
Sure. Okay, so what was it like for you being one of the youngest members on the floor? I mean, did you struggle to get respect, or were most pretty encouraging? Like, what was the vibe like?
Well, it's funny you say that. Yeah, I mean, because it was really a combination of both. It was more, hey, patting you on the back and giving you respect before you got into the pit. And then once I got into the pit, it was like, I felt like Rodney Dangerfield. I got no respect. It was really not easy. And to be honest with you, I could barely even get into the pit at the time because there were so many traders in there. I was, I'm just about 6 feet tall. At the time, maybe I was like 170 pounds. So I was basically, skin and bones walking in there. And there's a lot of ex-athletes and people in there. And I was just getting muscled around. I couldn't even put my hands up to trade. It was really unbelievable. So when I was in the pit, I pretty much got no respect. It was very much a political game. I mean, that's why you see a lot of these companies now talk about top steps, because it really was like that. I mean, the higher you were in the pit, and I was never able to actually stand on the step. I stood on the ground. The top step guys were closest to the brokers, so it was just like, they were like closest to the water per se. So they got most of the trade. So I really didn't get any respect. I really didn't get any trades. I mean, my first trade, I remember I went in, I stood in the pit, I waited for the open to pass about 30-40 minutes so I could actually get in there, and it was with another local. I sold him two big S&Ps. It won 5 ticks against me. I was so nervous. I bought them right back from the same guy because I was just so scared. I just wanted someone to trade with me, and so I lost 10 ticks. on my first trade. And like I said, you would think, hey, you're a new guy, maybe help me scratch the trade, because he probably could have. They didn't. So, like I said, it was probably more of like, hey, congratulations, Anthony, good for you. And then once you got in the pit, it was like, they could care less.
Okay. So what was your mindset like going into trading? What were your expectations and beliefs that you had when initially starting out? I imagine that, like, having spent a few years working for some of these other traders who were very active on the floor, that you were quite realistic in what to expect from trading. Was that the case?
Oh, my expectations were high. I mean, let's face it, I was 21 years old. I was parking in the CME parking lot. I wasn't parking on P1. What P1 is, those of you that were part of the Merc all know what that was. It was the floor basically where you got out, of your car. They valeted, and you were right by the elevator. You were at the closest exit to get into the Merc, and that's where like all the top guys were. So that was like the goal, to park on P1. You go on P1, and that was where every car was. It was the top guys in the business. So I had expectations of, like, I'm going to be parking on P1. I mean, the one mentor who I had, who worked with me the closest, the whole time I worked for him, I mean, he was always a multi-million-dollar a year earner. I had expectations that I could do that as well. So I really saw dollar signs. And I just felt that, there was pretty much, hey, I'm a member at 21, I'm going to be rich. I mean, that's ultimately what my mindset was going into it. I really didn't think about the hard work at that time. And it's not because I wasn't a hard worker. It's just because I saw everybody else making money. And I felt that I was prepared for it, but it was like the farthest thing from the truth.
Okay. So when did you start to realize that was the furthest thing from the truth? When did it kind of hit home?
Well, 6 months later, I had no money. My account was empty, and I couldn't re-sign my seat lease. I remember that I had, within 2 months to go, it was about 6 weeks before my final seat lease had to be paid. I just pretty much knew I was done, because if I lost another dollar, I wasn't going to be able to pay the seat lease, and I had no way of coming up with the money to pay the seat lease. So it was basically like 6 months later, I'm done. I mean, that's just where it was. So at that point, I was like, okay, now what? And I had to have the conversation with one of my mentors. I said to him, I'm like, listen, I'm broke, man. I don't know what to tell you. And he's just like, well, you did good by us. He was just a really good guy, and he offered to give me $25,000. He's like, I'm going to help you get back on your feet here. And you better take this more seriously. Not that I wasn't taking it seriously before, but it was just like, man, it was 6 months. I blew through 25 grand. And to me, at the time, I mean, to anybody, I mean, that's a lot of money. And 6 months later, it's gone. And I can just remember my parents going, I told you to buy real estate. It's just like, you're bailing all these things. And I'm just going, no, I can do this. So at that moment, I think because I had run out of money, and I had really, I couldn't even survive. So I was, basically having to go back and work in the pit when I wasn't trading, that it was like, okay, eye opener, figure this out. Otherwise, man, you're done.
Okay. So walk us through maybe like the next year on from there, when you sort of got that injection of extra capital.
So really from there is when I think kind of the trajectory changed for me, because I went from trying to be a pit trader to realizing I wasn't going to be able to be a pit trader successfully. And at that point, I used to stand outside the pit and I'd watch the open. And like I said, it was so busy that standing outside the pit was the only thing I could do in the mornings, because if I stood in the pit, it was just like, there was just no way I was going to get any trades. So what we used to call the Globex guys. Some people know what that is. Some people don't. Well, Globex was the original, basically, electronic trading platform for CME, and that was overnight. And we called them the Globex guys because at the time they had just started a product called the E-mini S&P, which I'm sure everybody's pretty familiar with now. So at the time, they had come to me and said, "Hey, Anthony, we see you're standing out here. Why don't you come and try this? This is called the E-mini S&P." And it's looking back at it, it was so barbaric to think even how it was kind of like launched. And the way it was is they had a 13-inch screen, and there was maybe two of them on the trading floor. And you went in there, they gave you a login, and you logged in. And then there it was, the E-mini S&P. I mean, I don't even think it was trading 10,000 contracts when I first logged in a day. It was barely doing anything. And the bid and offer was probably 50 cents to a buck wide. And it was tucked away in a little corner of the floor of the Merc. And basically, when I had told my mentor that this is what I was trading, he was kind of like, why? I mean, like what is that? I mean, are you kidding me? And everyone booed and hissed and told me I was out of my mind for trading that. And ultimately, at that point, I started studying charts. I started taking the philosophy of pit traders and putting them into, electronic trading, trying to basically build my, like I talked about earlier, my arsenal of what I was learning from these other traders, and I started trying to figure out how I could apply that to computer trading. And from there, I started just having these ideas, and I just started seeing the market just so differently when I could actually see it, as opposed to in the pit, whereas I couldn't see price action. I couldn't see anything. And I just always felt lost. I was just in there and just the world was spinning around me. So that account lasted me about a year, but I didn't really lose money. I just got expensed out. And then I went through 25,000 again, which was okay, I survived. I took a couple of checks. I worked in the pit. Now I'm a year and a half in, and I feel hey man, I'm ready to go. This has got to be it. And I just hit a soft patch again, and I just couldn't make money. I had to make sure I paid for my seat leases. And next thing you know, I'm back knocking on the door going, I'm out of money again.
Right. Okay.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved. Now, so has the way traders operate within them. Trade the Pool.
So just so I understood that right, you ran through this second $25,000 that was given to you by one of your mentors on the floor.
Yep.
And that was lost due to mainly because of expenses and operating costs. Is that right?
Yeah, really I basically broke even trading, and I lost the money over my seat lease had dropped dramatically. I'd actually had made money that year trading, and it wasn't much. But it was enough to pay expenses. I took some money out. I was giving him back maybe a couple $100s at a time, but I had to survive and eat. And so it was just basically I was able to live off of it. But then towards the end of that year, I hit a soft patch, and it just was, I was just kind of exactly. I just got expensed out, just life expenses, trading expenses. It was just kind of it was it. It was out of capital.
Right. So I mean, you're kind of back to square one again in some ways. Where did you turn from there? How'd you get refunded from that point on?
Well, I went to him because now I owe him $25,000. So at the time you're going, okay, my family didn't have the kind of money to just, write me a check for 25 grand again. So ultimately what did I do? I went back to him. I figured at this point, I told him, he had known that it was coming to an end as well. And he's like, listen, I'm going to give you $25,000 more and we'll see how it goes. Okay. And he's like, that's it. You're done. I can't do any more for you. Obviously, at that point, I was like, okay, great. I'm thinking to myself, well, okay, let's do this. And well, lo and behold, I went back in. I started off really well. I started paying him back. And all of a sudden, his market started getting really busy, and I got clipped again. And now this time, instead of getting expensed out, I basically, crapped out again. So now I'm down to blowing through that money. And I was towards the end of a 6-month lease again, and I'm going, well, this is a problem. I'm out of business again. I mean, I literally at that point was going through like massive anxiety, going, I just cannot believe this is happening to me again. This is incredible. At this point in time now, I've already like developed my own indicator. I've developed like a style. I felt I was doing really well. I actually had a couple days where I was making, in the thousands of dollars, which prior to that was really not happening for me. And then ultimately, I stepped out a little bit and I got clipped. I mean, there was no other way to say it. I just lost, I just blew up. And, I just remember him kind of flipping out on me and be like, what are you doing? You're losing too much. And it was just like, I felt it was there at my fingertips to just take it down. And, it just didn't happen, So at that point, it started to get, where I was just like, what do I do?
Yeah. So just to back up a little bit, why do you think it was that this guy who was mentoring you at the time, why did he give you $50,000? I mean, that's pretty generous. I mean, most people wouldn't feel comfortable doing that. Why do you think it was that he gave you that money?
He said it was a mitzvah. He was a Jewish guy. We had become really close friends. He said to me, those were his exact words. He's like, this is a mitzvah. I mean, this was also 17 years ago. I believe that was the exact saying that he used. But I remember, and he's like, he basically felt that by helping me, it was good karma. And, he had kids. I was good with his kids. I was friends with them. We had a good relationship. And I worked so closely with him that I think that he was looking at me as like, he was trying to help me. I mean, he was doing good by this, and after I had lost the 25,000, I remember, I know that seems like a lot of money, and you're looking at a guy who probably on a monthly basis, I mean, to put it into some perspective, was, he was 500,000 a month, 300,000 to 500,000 a month earner. So not to say that he's just giving money away, and not that I was disrespecting the 25,000. That's not what I mean. But it was like, for the time, it's like it was a bubble at the Merc, and at the time, I think that it made sense. Let's put it that way, because they were making so much money. It was still very busy that he looked at it as like 50 grand. I can deal with this. Originally when we had also talked to 25,000, I remember sitting down with him and the firm owner was like, maybe you should give him 50. Markets are busy. So he was like, I'll give him 25 to see how this goes. So it was somewhat set up like that. But after that final 25, after I had went through it, at that point, he's like, listen, you're going to have to just, figure this out.
Okay. So, I mean, you've pretty much burnt through 75 grand at this point. I mean, where was your head at during this time? Because, I mean, you're still, from what I presume, in your, mid-20s, young 20s. Where was your head at? Were you ever inclined to just sort of throw in the towel and move on to something else? Or were you still keen to just keep pouring money into this until it actually finally worked for you?
Well, first of all, I was not willing to accept that I couldn't do it, because I compare it to, like, I started playing golf in my 30s, and I look back at it. I find it a lot like golf. And anybody that's played a sport or done something to where, similar to golf, where you have this moment of success where, like, you see the vision that you can do it. Like, I believed that I can do it, and I felt that I had, grown in just that short amount of time to having a really solid plan. I created my own indicator. I had, I felt really strong mindset and rules. I felt like I had all the tools and the willingness to put myself out there and do it. But, now let's talk about the downsides, what I was feeling. It was massive anxiety. I had a girlfriend who's now my wife, who would watch me go through this. I didn't leave. I didn't go out because I didn't have any money. So basically 21 to 23 for me was I did nothing. A lot of kids were going to college and, partying, having fun. I didn't do that. I stayed home. I went home. And, it was funny at the time. I was watching the show Sopranos, and some of you probably know it, some of you probably don't. But, it was funny. I used to watch it on Sunday nights. I remember Tony would have the anxiety, and he'd blow into the paper bag, and he'd stand there, and he would look like he was going to fall over. And I'm like, man, that's exactly how I feel. I literally was suffering from anxiety because of the pressure that I felt on myself. I was sick that I was out of my 25,000. I'll now owe him 50 grand, which I'm just like, you got to be kidding me. I owe this guy $50,000. It's like, who knows how long it's going to take for me to pay him back if I go back to working, So I was just like, my parents are saying maybe you should get a job, and you're just like, all these things going through my mind. But to tell you the truth, I just sat back and I just said, okay, I looked myself in the mirror and was like, well, who do you want to be? I mean, is this what it is? Is this how it ends? And it's just unacceptable to me. I mean, people that know me on a personal level know that I'm a fighter like that, and I won't stop until I get it right. And I think that's what I learned so much about myself. And that takes me kind of to where the next, how all of a sudden things turned around for me. So we can get into that next if you'd want.
Yeah, absolutely. I'd love to hear about that. So, I mean, tell us a little bit about what was your turning point as a trader.
So that was really it. I think that I had to see, you had to have a time period where once you were done paying your seat lease, and if you didn't continue to sign your seat lease, that you were going to lose your seat. Now, at the time, there was no seats available. So it's like, if I didn't get money right away to be able to go in and get a seat lease, there was no way I was even going to be able to trade. And then I was going to have to possibly go through, like, pay this extra fee to get back in membership. So it was basically panic mode for me at that point. What do I do to get back in? And, once again, I had a little bit of time because I had to leave just enough money in there again to pay my seat lease. And it was just, and I was looking at this going, well, where do I go? Parents wasn't an option. My aunt Flo, she was like a grandmother to me. She was someone who I just, I shared a lot with her. She was, we were very close. And I went to her and I said, look, hey, mom and dad can't do this for me. I've went through this amount of money. I know it's probably the worst investment you're ever going to make. She had just retired. I'm like, but Aunt, listen to me. I need 10 grand. I need 10 grand because if I don't get this money and I don't go back, it's over for me. I really don't know what I was going to do. And I just remember just being just like, I felt so vulnerable, but yet so ready to do this in the same moment that it was like, I knew it was a total gamble. I know that she knew that too, but luckily you have family that believes in you and can give you that opportunity. So she goes to the bank with me because I needed it basically that day. I waited till the last minute to ask her because at that moment it was just like, I didn't want to do it. It made me sick thinking I had to do it, but I did it. And from that point I went in. And I just had like this burst of energy, and I remember my first day back. Now I was actually pretty lucky too, that when I had come back in. So now I had to go to my clearing firm, and this is what's some of the beauties of being on the trading floor is that you have good people and people. Like the business has become so not personal like it used to be. But I knew I had so many clearing member friends that I could go to and say, hey, whatever. I got 10 grand. Like I went to my clearing firm, to whom which I owed a great deal to this day for letting me come back in for $10,000. And I said, look, I'm going to trade the E-mini S&P. I'm going to trade it. This is how much I'm going to risk per day. I sat down with the two owners at the firm, and they were like, they looked at me, they looked at each other, and they said, we'll let you do it. Don't screw it up. And they said it in a little bit different of a way, right? Here's me walking out of the office going, okay, I mean, this is it. I remember getting it, going back in there, and at the time, I was still clerking in the pit with my trading jacket on for my brother, who actually took all my old guys. I was helping him. He was giving me an extra guy just so I could make ends meet to survive. And ultimately, I was trading the opens. I started making a little bit of money here and there. So all of a sudden, boom, bang, bing. I mean, long story short, 6 months later, I was able to buy a seat. Seats were $220,000. I didn't have all of it, but I gave my aunt her 10 grand back. I gave Louis his 50 grand back. This is in 6 months, which I look back at it, I still think it's incredible that I feel so lucky and blessed that it happened. But I just started catching on. And next thing you know, I had the ability to put down almost half for a seat. A friend of mine had to give me a little bit of extra money so I could leave some money in my trading account. And I went to the firm. They lent me the other half, and I bought a seat for 220 grand. And away I went. I had, I just started. It just like all of a sudden I just got dialed in. And I know that we're going to talk more about that, but that's ultimately, in a nutshell, what happened. So it just turned around just like that.
Okay, so what did you change? Like, why did it all of a sudden things start clicking for you? Were you doing anything different? Like, was there anything noticeably or significantly different that you were implementing?
My risk management. I became extremely efficient at managing risk. And how did I do that? Well, what I started to figure out was, okay, start my position small, if it starts to go my way, I would potentially add. If it started to go back against me, I would scratch. I basically would always start my position at 25 to, maybe 35% of what I was going to sell. So let's just say I was going to sell 3. I'd sell 1, then I'd sell 1, then I'd sell 1. Before I would just sell 3, and then I'd buy 3. So what I started to do was basically get in small at my initial area, and then I would be quick to add, quick to cover, and I started to be able to massage my areas, basically was what I was doing. So if I wanted to sell one or buy one at a specific level, I'd buy one. I'd watch it sit there a little bit. Then I'd buy another one. Then I'd buy another one. Then I'd go my way. Then I'd sell one. And it would sit there. And then I would sell another one out. And then I'd keep one. And I'd work that. So what I started to do was, once I started getting really comfortable doing that, I started with 2. Then I went to 4. Then I went to 6. And I started testing myself when I was up money. So what I started to do was, when I was up money, I would start to press a little. I'd press a little bit. And then the next day I'd press a little bit more. I'd be up 800, I'd risk 300, go up 500. I'd be up 900, I'd risk 400, I'd go up 500. I'd be up 600, I'd risk 100, I'd go up 500. I'd always try to go up $500. Then one day you hit them for 1,200 and you're like, I got $700 of risk now. So what I would do was, now my downside was only $500 a day. So if I hit that 500, I'm done. But when I started getting up more than 500, I'd play with that money, and I started to press. And then I'd press a little bit more. So then all of a sudden I'd trade a little bit bigger. So when I was hot, I'd be pressing. When I was cold, if I started off my first trade was a loser, it would only be on a third of my position. So when I was finally getting into a full position, it'd already be partially my way. So I learned how to scratch or get out of a portion of that position. And I would always constantly keep myself small, get back small. And I did that, and I was able to escalate that rather quickly. I would say within, I don't remember exactly, but let's just call it within 2 months. I went from trading, I typically traded under 5 lots majority of that time prior to that. And I went from like 10,000, I remember it was like 20 something thousand, just by trading like between 4 and 6 lots. I was just basically making 500 to 700 in a day over about a month and a half. And I remember getting my account just over 20 grand. And I was like, okay. And remember, I wasn't taking money out because I was working on the floor, was finally able to build it. So what I started to do was I started just up my size a little bit. So I remember within that span now, I had worked my way up. I did my first 50 lot. And I remember my first 50 lot. And it was just like, I bought 5. I bought 5 more. Then I bought 10 more. And these are all within a couple of ticks. Then I went 1 tick my way again. And then I bought 20. And I was like, okay, now I'm long 40. And then I bought 10 more. I remember seeing it long 50. I'm like, if this thing doesn't go my way 1 tick right away, I'm going to turn around and sell it. And one tick my way, 2 ticks against me, boom, I turned around and sold 50. And I was like, okay, wasn't so bad. I did it. I felt like a sense of like, I can do this. I can trade 50 lots. I didn't go right back into it, but I continued to test the limits to see how I would feel. So I started like playing with my emotions. Okay, 50. Then all of a sudden when I had 50 on, 10 felt more comfortable, more controllable. And that's how I slowly built it up. And, eventually I was able to build it up to some real size. And, but that's how it started. And I always say to people, it's like I was kind of high frequency before high frequency trading, because that's how I would trade. I'd look at my statement and we would kind of laugh. Like I go into the area, and at the time, I mean, think about this, they didn't email statements, so I had to pick them up in the bin, and all you had to do was look in the bin, and then you knew who Deli's statement was because it was the biggest one, because I would trade like every price. Now I had a lot of commissions, and that was definitely affecting me, but I was winning more frequently. So and at the time, I had, like I said, I was still leasing a seat, so the costs weren't that high, but they definitely were a factor. But the bigger I got, the less factor that they became.
Okay, very interesting. So I know, I'm not sure over what time period, but you grew that account up to, 7 figures and beyond. What happened from that point on? I believe somewhere between where we're at now to that point, you hit another rough patch where things sort of started to turn south again for you. Can you run us through that a little bit and tell us a little bit about what happened?
Well, I actually went on a very long stretch of doing well. I mean, I did very well for years. I was actually, able to clear $1 million in a year. Probably, I would say within a few years, I had several 6-figure years, and then I had surpassed $1 million in a year as well. And I was rocking and rolling, and then it basically it got to I ended up getting to a point where, and it's interesting, my worst quarter. The worst quarter of my career, the worst year of my career, was the best start of any quarter or any month that I had ever had, which was insane to think that way. But it was the first week of the year, and I had made $200,000 that week. And I remember looking back at it and going, I mean, I just made, I made well over $1 million the prior year. I'm going, I'm making $2, $3, $4 million this year. I'm there, man. Got money in the bank. I'm not even 30 yet. I'm thinking to myself, that's it. I got this. Bam. I dropped like $500,000 the next probably, 2-3 months. I kind of try to blur it out, but yeah. And it just, that to me was a rude awakening, because at that moment I was like, okay. And I remember one of my trader friends coming up to me. Who's a good friend of mine. He's like, don't chase it, man. He's like, you chase it, you can be chasing it all year. He's like, come back in, go back to what you do. And to be honest with you, I never recovered the whole year. I ended up losing that year. And it was like, it's incredible to think that rough patch really kind of also set the tone for kind of how I became a trader later in my career, because that was the moment kind of where things started to change, I think, in the industry as well, where, the games started to change a little bit. Like I said, I was trading so much and so actively that kind of style was now not working as well. I moved the book in the S&P in my earlier days. I mean, there'd be 100 on the bid, I'd take the whole 100 out. I mean, it was, there was 200 at the bid, I'd take the whole 200 out, and they would react off of what I was doing. I was probably more of a market maker than I was, anything, because basically, and a lot of times my orders, that were bigger than the bid and offer on the book. So I was able to kind of also, as I would put an order in, the market would move off of what I was doing. And then suddenly, like I said, I had a really good stretch. And then I remember I had one vacation. I had bought another home, which was now my third home. And I remember everyone was like, slow down, man. Listen, you're doing great. I'm driving an ML63 AMG. I'm thinking to myself, there's just, come on. And ego definitely got in the way for me. And then I got brought back in really quick. Because my expenses now were just high for just everything, lifestyle expenses. And, I think that, what ultimately, at this point, I'm trying to figure out what, where we go from here, like kind of what my life was like at that point was just kind of like the game was changing and I was not adapting to the game. That's the point I'm trying to get at. It was like all of a sudden I felt like I was at my pinnacle. Like if things were only going to explode for me, but then all of a sudden the game was changing and I was just kind of ignoring the fact that the market was changing, and I was trying to force my will upon what was working for me on the market, and the market just kept taking. And then I couldn't get back to where I was. I just kept fighting it. I'd have good stretches, then I'd give it back again. I'd have good stretches, then I'd give it back again. And I was just like what's happening here? And I think that was another turning point in my career where I'm like, hey, maybe what I'm doing isn't going to work forever. like, okay, wake up call here. So that was that moment.
So I know we're going to jump forward a few years now and probably skip a little bit of your story out, but what's your style of trading like today? I mean, obviously you're no longer trading in the pit and you're now behind a screen. What's your style of trading like today? What's it sort of developed into, and what are the kind of opportunities that you seek to take advantage of today?
Oh, now I'm 1 to 5 trades a day, maybe a week. I've went from super high frequency to super low frequency. And that took me, I think after that moment I just talked about, where it still troubles me to talk about it because I'm pissed at myself for not recognizing change, even though I felt it was happening because I was doing the same things. But it's like the definition of insanity is doing the same thing over and over again and is expecting a different result. And basically that's what I was driving myself insane, thinking that what had got me to where I was going to continue over. So I sat back, fortunate enough to be able to, in a financial position to be able to sit back and say, okay, figure this out. And what I started to do was basically, I was going back and analyzing my trades. Like, where am I going wrong? And I started to realize that the over trading I used to do was not working. So it was the days I traded more, I was losing more, or it was costing me more. The days I was trading less, I was more efficient. So I started to recognize that efficiency had to change, and no longer the high frequency type person that I was going to work. So I had the same indicator and I had the same basically style, but what I started to do was I started to learn about something called confirmation that I think really helped me slow the pace down. I started focusing more on preparation. I started focusing more on, okay, you need more than one reason to trade. And that all of a sudden created patience for me. And I realized that I could focus my energy on an area where there was more confirmation instead of trying to feel out every area and see if the market was just going to pay me. So that was the big transition. So preparation became a bigger part. And I would spend more time preparing. What levels are important to me? Why is this level important to me? And I would work my way back, weekly, daily, 60-minute, and then I'd look at my 1-minute charts intraday to execute. And then I would say 1 minute had to have confirmation coinciding with a 60-minute or a daily, and then that's how it would trigger a trade. So at that point, now I'm like going, and here's me basically with my hand on the mouse going, I want to trade. I couldn't but yet it didn't reach what I wanted it to reach. So that was like that next. It's like I had to relearn who I was. I mean, it was just but because I had my own indicator that I believed in, I had seen it work, and I had the experience of knowing that I've seen other people change, and by seeing it throughout the years of watching great pit traders, that I'm like, okay, this is what it is. So now either make the change, otherwise you're never going to get to where you want. And that's how I slowly started turning things around.
Now that's really interesting. So I'd like to get a little bit more technical about what are these kind of 1 to 5 trades that you're watching for, that you're seeking to take advantage of during any given week, and more about what levels you define to be important. Like, how do you determine what are important levels to watch for and that sort of thing?
Well, okay. So what I do is, I have an indicator I created. I call it Beacon. But what I look at is, I believe that bigger picture trend is going to obviously supersede short-term trade decisions. So what I started to look at was what's happening on my bigger picture indicator. And I would say, okay, how do I determine a level? Well, we have a strategy or an indicator that we use that determines levels. So what I look for is not only in the market that I'm trading that level, I look for it to see what market is correlating with or against us that's hitting a level at the same time we are. For example, let's just say you're comparing. Well, let's make it easy first. Let's say I'm comparing S&P, Dow, and NASDAQ. Every morning I put up 3 60-minute charts of those markets. And I look to see where they are relative to the same indicator. So whether you're using my indicator or you're using your own indicator, that's entirely, doesn't matter, right? Because it's like if I'm looking at a 10-day moving average, I want to see where everybody is on a 10-day moving average. Is the NASDAQ stronger? Is the NASDAQ weaker? And where's the S&P Dow come into play? If they're all hitting the 10-day moving average at the same time, well, guess what? That's telling me that the reaction when the indices work together is going to be a stronger reaction. If one's way above and one's well below, and I look at us in the S&P, which I primarily trade, and we're sitting there getting pushed and pulled in these different directions, I then know that we could probably be choppy and we're going to get pushed and pulled, and maybe the NASDAQ leads for a little bit, and then maybe it's the Dow. You could do the same thing for currencies. I look at the dollar. What's the dollar doing? Sometimes the dollar moves against gold. A lot of times it moves against euro. So what I do is I take the same exact indicator that I'm going to use on the dollar, and I compare it to the gold. So I don't compare a chart to see what the pattern looks like. Because to me, a pattern in the past was what had happened, but where they are, what the indicator now shows you where they are at this point, where are they on a relative basis? That's how I more determine correlation. So the pattern could be, because correlations work till they don't. So it's like, if I say, oh, look at this, it's correlating perfectly with or against it, I can't really mark it against it. So when they're both at an area, for example, let's just say the dollar rallies and the dollar just hit, a 38 back fib or whatever. And I did that same exact fib from a recent high or low in the gold, and they're hitting 38 back to the downside or something like that. I'm trying to give you an example of saying that I'm comparing them by using the same indicator in the same time period, and one is correlating, one is going down, the other one's going up, but they're hitting them at the same time. I know that at that moment, if there's going to be a reaction, it should happen at that moment. If they're not hitting things at the same time, whether they're correlating with or against each other, there is going to be a less reactive moment in the market. So you're going to see slippage. So when I see things that are lining up that way, I come into my trading day and now go, okay, now I look at my short-term charts and go, aha, I got a buy set up on my 1 minute. Gold and the dollar's hitting resistance the same time gold is hitting support. That's a trade I will go in and put risk on, because at that moment, what's happening outside of the market I'm trading is helping my market. So, and I compare them all in the same time frames. This way, I have the ability to, like I said, match everything equally. So does that make sense? Am I getting across my point of how I do that?
Yeah. No, this is good. So I'd like to ask you a little bit more about the indicator that you use. You also said right at the beginning that you were using, or you developed your own indicator while you were still trading on the pit. Is this the same indicator, the beacon, that you use today?
Absolutely. It's the exact same indicator. I have really almost made no tweaks, probably in the last 10 years. I don't think I've really made much tweaks to it. And it's basically a roadmap of support and resistance lines that I believe is a forward-thinking indicator. See, I learned that when I was developing indicators, way back when, it was basically I was looking at all the indicators and saying, they're only telling me what happened. They never tell me what they think can happen. And I just felt that to be so weird. I'm like, why is everything saying this is what happened? So when you look back at everything you look at on your chart, it's like, this is what's happened. And I would say, great, but what do you think could happen? So what I started to do was I started to put together a couple of ideas. And I said, when I hired a programmer, and I said, if this happens in the market, I want to know what happens after I see this happen. And they'd be like, okay, and they go in and they program it. Like, okay, well, that's interesting. Well, I did that trial by error. And I looked at a couple of other things, a couple of other of existing indicators to kind of just, get a feel of how they had worked, and, just trying to figure out how I can create something that went forward from what just happened and gave me a visual because I'm a very visual person. So I like to see what support resistance could be, and I like them to be dynamic. I hate coming into a day and saying, okay, this is support, this is resistance, and just assume I'm going to trade off of that. What I like to do is, I like that for my planning, but planning and trading doesn't always work that way. It's not like planning a vacation. Hey, we're planning, we're going to leave, we're going to go on the plane, we're going to do this. Well, guess what? All of a sudden you might be going to a different airport, or you might be going by train one day, or you might be doing something differently. You have to adapt as to how you're going to get there. So what I did was I started putting it on short-term indicators to confirm that the longer-term indication was supported. So what I wanted to do was to say, hey, in my preparation, this is a level to watch. So when it came to it, I'm not just going, I'm buying them or I'm selling them and just work a stop and hope it worked. Because to me, that's not trading. That's just saying, hey, this is a level, go trade it, figure it out. What I wanted to do was to be able to say, when it gets there, do you agree with the longer term or do you disagree? Right? I look at with anything you do in life, right? If you're going to do something, and I don't know if anybody's married out there. I mean, I know a lot of guys are married or women that are listening to this. And I'm married. I know when I ask my wife a question and she agrees with me, well, that answer makes it a lot easier to move forward with what I'm doing. So that's confirmation for me. If my wife says, nah, I'm not sure about that, then I question what I'm doing. So we don't just say we're going to do something. We discuss it, we have a confirmation, and then we do it. Or we don't do it. So that's why I like to overlay short-term charts over 60-minute charts to say, do you confirm, do you agree with what my preparation was? And if it doesn't, then I don't have to trade it. And if it does, then I do it, and I believe in it, and I go after it.
Got it. Okay. So do you use any other indicators in combination with the beacon?
Yes, I use MACD. I tweaked that a little bit as well, and I use stochastic. I like divergence because divergence, see, a lot of people will go, oh, well, divergence. But divergence, what I like about divergence is it doesn't help you pick the low, and it doesn't help you pick the high. It helps you on retests. So when you're retesting areas, see, I'm a big believer that I don't like to be the first one in, because I've learned in my experience, every time I'm the first one in, I'm usually the first one to get out and I miss the big move. So when I'm the second one in, or the third one in on the retest, that's when I really step in and pound them. Because that's when I'm like, nobody believes in it anymore, and that's when I have the strongest belief. And so divergence helps me look at the market and say, on a retest, do you believe it? Is it agreeing with me? And if it's not, then maybe I trade it smaller. If divergence is there, then I say yes, and I agree with it. So that's really all I use besides my indicator.
Okay. So obviously the beacon indicator has been incredibly helpful for you. Would you suggest that perhaps other traders give some thought to maybe developing indicators to like visually help them, even if they don't use them as maybe like a standalone system on their own, but just something that they can actually visualize and actually see? Is that something you'd suggest other traders at least give a little thought to?
100%. Why sit back and allow yourself to, be mediocre when you can be great? That's the way I look at it. I look at it and go, why am I going to sit there? If I'm not making money with these indicators, why am I going to sit there and just assume that these indicators are going to work for me? And I also say, let's just say I'm no programmer. So I would say, obviously, and if you can get a programmer, you have an idea, you write it up, you work with them, great. If you can't, you don't have the money, and you still want to do it, tweak your indicators. Tweak the ones that you have. Look at them in different ways. Look and see what happens after these situations. And capitalize on fewer situations as opposed to multiple situations. I mean, one of my pet peeves is like people look at, oh, did you see the rising wedge, the uptrend, the head and shoulders? It's like, man, there's no way I could capitalize on all of those. I like to capitalize on a few things that I see. So it's like, look at the indicators at work. If you find it, so a lot of people will say, well, I love when people will tell me, well, these indicators I have, they work. Right? And I always say, okay, well, great. Or how are you doing with them? And they say, well, I'm not there yet, but I know I can get there. Well, that's great. But how are you approaching it? Like, see, I'm a firm believer in And everyone goes, I want to get consistency. Well, how do you get consistency? Well, you get consistency by consistently doing the trades that you want to do. You don't get consistent by buying an uptrend one day, selling a downtrend the next day, buying a fib the next day, not doing the fib the next day. So it's like if you're going to trade 38 back, or if you're going to do, if you're going to trade trend lines, or if you're going to do this, if you're going to do that, be consistent with your trades, because then you will master that look and you will be able to, trade that look. So it's not really, I don't look at it as having to create an indicator. I think if you have, the willingness to do that, great. I'm all for it. If you don't, I don't think that it's a bad thing to be able to look at indicators and develop your interpretation on how to trade those indicators.
Mm-hmm. Okay. No, that's a really great answer, Anthony. So let's wind this down. I've got one last question for you, and that's pretty much, do you have any final words or anything you'd like to pass on to other traders listening? I know, you've obviously been through quite a roller coaster journey yourself. Are there any lessons you'd like to pass on that might be helpful to anyone listening to this podcast right now?
I think the most important thing for traders to really understand is loss. I think it's the hardest thing. I think that people come into this, like myself, with expectations to make money. And I know from a lot of your guests, because I've listened to your shows in the past, which are great, by the way, I think that a lot of good traders will say this. But the one thing that I believe is most important is understanding how to manage your risk. That's what changed my life. That's how I changed everything. And having a set of rules that are like instincts to you, not having a set of rules that you have to look at on a piece of paper. Like, I'm a firm believer that, especially in the futures markets, you can't be going back and you have too many things in your head, you're going to struggle. Learn how to manage your risk. Understand that loss is part of the business, and you will be able to heal from your loss. I come in every day and I know how much I'm going to risk per day. I know what I'm going to risk per trade. I know how much I'm going to risk per month. And at that point, the worst thing that happened is, guess what? I lose that risk. So I already know it going into it. So that it clears through everything. It helps me focus on what I'm doing, and it helps you focus on what's important, the market. I've had so many young traders come to me, and the one thing that they just can't get past is when they say, well, what should I be focusing on, Anthony? And I'm like, protecting the downside. I said, you need to learn how to lose before you could win. And people literally look at me and they think I'm crazy by saying, learn how to lose before you can win, because nobody comes into trading with the mindset that I need to learn how to lose. It just doesn't even sound right, because nobody wants to. But when you go into it with that mindset, something changes. At least it did for me. That when I came in knowing that my number one goal was to manage risk, keep a very small, instinctual set of trading rules, I was able to free up all of the emotion and go after the market.
Very well said, and a nice way to take us out. I mean, like, a lot of the things you said there are so true, but they're also very counterintuitive to what you'd expect, as a trader. So anyway, Anthony, where can listeners go to find out more about you?
Well, two places, futuresradioshow.com. I host a podcast where we talk about the markets on a week-to-week basis, what's happening in the industry. We'll talk about anything from technicals to fundamentals, about what's happening that week in the market. So you can go to futuresradioshow.com. That's free for all traders. And also beacontrader.com. That is my membership site where traders can come in and take a trial, hear me on the mic. I'm on the mic Monday through Thursday. I talk for an hour every morning about what my outlook is for the futures markets, and we talk about S&P, NASDAQ, Dow, gold, euro. I'll talk a little bit of treasuries, and lately I've been talking about the yen.
Okay. And you're also on Twitter as well, I believe.
Yes, Twitter, at Anthony Crudele. And probably no one knows how to spell my last name, but it's Crudele. Everyone always spells it Delli. But yeah, at Anthony Crudele on Twitter.
Awesome, awesome. Good stuff. Well, it's been an absolute blast having you on, Anthony. I've really enjoyed our conversation. So thank you very much. And I'll put all those links you mentioned in the show notes at chatwithtraders.com as well. So yeah, once again, I really appreciate you coming on, man. Thank you very much.
Thank you for having me, Aaron. And I just want to say before I let you go, you're doing an excellent job here. I really am a fan of what you are doing. And I think that all traders should definitely listen to your podcast. And I appreciate that.
Oh, that's awesome, man. Very cool. Very cool to hear. So thanks for the kind words.
You got it, man. Talk to you.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Welcome to another episode, team. And I want to say, just real quick, thanks to everyone who has been tweeting about the podcast over the past few weeks. It's been really awesome to go back and forth with many of you, so thanks heaps. And if you're not following me on Twitter, you can do so at Chat with Traders. Now, our guest for this week's episode is Alan Farley, who took his first trades in the late 80s. Alan is an active swing trader, and most of his positions take place in the US equity market, although he occasionally trades index futures and currencies too. In 2001, Alan released his first book, The Master Swing Trader, which might just be the best-selling book on the subject. He's also a regular contributor to The Street and Investopedia, having written hundreds of articles over the years. Some of the subjects you'll hear about in just a moment include the unusual way in which Alan got a well-rounded education of financial markets, some of the big lessons that shaped him into the trader he is now, in particular, the concept of convergence and divergence, plus we talk about the dynamics that generate price movement and heaps more too. Anyway, here it is. I'm Aaron Fifield, and this is my conversation with Alan Farley. So how's your day been? What's going on?
I had a nice day. I had to ask you a question. Do you know Chris Shea?
Chris Shea? No, it doesn't ring a bell. Why is that?
He's a quote unquote a trading coach in Brisbane. I was in Brisbane in 2005. I did a program for Davin Clark up in Coolum somewhere, and then we went down to Sydney. And Chris Shea was like his partner at the time. They were trying to start some business.
Right. Is he still trading today? Do you know?
Chris, I don't know. I don't think he was ever a trader. He was more trying to do the Mark Douglas thing, you know?
Oh, okay. Yeah, like more of the psychology kind of mindset aspect of it. Yeah, right.
Yeah, and Davin and I had a good time, and, I've seen him since. But that was my trip. They paid for me. It was nice. They paid for me, and I spent 10 days in Australia, and I did did some work for them, so I got paid for that as well. So it was kind of cool.
Good stuff. Have you been back since then?
No, nobody's invited me. It's sad, but true.
All right. Well, when I have the big Chat with Traders conference, I'll fly over.
Sure, anytime.
Awesome.
I'm waiting.
So, it's really cool to be speaking with you, Alan. Jeff Davis actually recommended that I try and get you on for an interview. Do you know Jeff?
Yeah. I don't know where I know half these people from, but I've known Jeff for about somewhere between 5 and 10 years. And so you just start communicating with him. My identity and connections have changed so many times that I don't know where people know me from, but I've known him from somewhere. Maybe I met him at like trade shows back in the 1990s.
Okay.
You know, but Jeff's a really good guy. He's really smart too.
Yeah.
And I like him because he teaches me a lot of stuff about very, very short-term things.
Yeah. No, he was awesome. He was really, really cool. We got a lot of great feedback from his interview a couple of weeks back. And when I was doing a little bit of poking around on the internet, doing a little bit of prep for this interview, I noticed there's you've done a hell of a lot of writing, especially for like Investopedia, The Street, and those types of sites. How long have you been doing that for?
I started writing for The Street in 2001. In fact, the reason I started working for The Street, and it was after my book came out. I wrote 2 books. I wrote Master Swing Trader in 2000, and I wrote the Master Swing Trader Toolkit in 2009. So when I wrote the Master Swing Trader, it did really well. That was like December 2000, and things really started to move for me. I actually got back. I took 2001 off because I didn't know how to trade and write at the same time. A problem I've since solved. So I just took off the year and wrote that book. And so I was getting back into trading, and the book was doing really well. And then 9/11 came along, and TheStreet.com lost 2 people in the World Trade Center.
Oh,
and
wow.
They needed to replace him. And I'm one of the people they called. I had Jim Cramer was on the phone. This is like 4 days after 9/11. Jim Cramer's on the phone with a guy I knew from another site from, it was called TradingMarkets.com. I wrote for them for like 6 months. And they asked me to write for them and also to do a newsletter. And I stopped writing a daily column for them in 2012, but the newsletter, which I started in 2002, I've been doing for 14 years now. And that thing that's like an Energizer bunny. It just goes on, keeps on ticking and ticking and ticking. And so I got to thank you for that. And then after I stopped writing that stuff for The Street, I started writing. Investopedia asked me to do some work for them about 2 years ago, and that's just blossomed. They let me do my thing there, which is write stock analysis after stock analysis and commodity analysis, which is what I love to do. I can whip that stuff out real fast, and it helps me. That's my research at the same time. I trade the same stuff I'm looking at for somebody else most of the time. For sure.
No, that's really cool. All right, Alan. Well, probably the first thing I'd like to ask you about, and where we'd like to start, is how you first got into trading. I think you were in your early 30s when you first came to trading. What got you into this?
Well, I think I was actually a little bit late because my son was born in 1987, and I never had any money management skills. I never owned any stock. I never took any financial courses in college. I did none of that. I had a strong major in math at that time, so I always had a good mathematical background. And after our first child was born, my wife and I were talking. I said, "Well, I need to learn how to invest." This is like, you're right. I mean, I'm a pretty old dad, so I was probably maybe 35, 36 at the time, and so I started from scratch. And the first things that I came across, and I think it was he was born in, it's so funny, he's born in October 87. The October crash happened 2 weeks after he was born. So, I mean, his timing was pretty spectacular, and that got my interest as well. And I started going to the library on weekends, and I did mostly value line charts. One of the first things I discovered is that how much more I like technical analysis than fundamental analysis. Fundamental analysis, I felt like, okay, I'm not an accountant, I'm going to have to do this my way. And so I started down the TA path, and I learned most of the stuff I learned early on was from going to Barnes & Noble and just sitting there on Saturday and Sunday, picking in their business section, picking up TA books, which are horrendously expensive back then, and sitting there and reading for 3 or 4 hours. And I did that for months. And started. And then I started to get into some trading, and it was almost the same time. I did a little bit, say between 88 and 91, 92. But when CompuServe, when E-Trade went to CompuServe, which I was thinking 93, and that was the first portal where you could sort of do more than one trade every 3 months. I'd been on CompuServe already, and I also hooked up not only with E-Trade, but I also hooked up with the Investors Forum at CompuServe, which was sort of a precursor to America Online. And now back in the day, this is in 93, there were no sort of like disclaimers for the internet, because the internet didn't really, it existed, but it didn't have the World Wide Web for its base. So CompuServe had a proprietary interface. Nobody thought twice about talking to each other. And in this Investors Forum were currency traders, Merrill Lynch traders, underwriters, VPs, everybody in this environment. in which they could talk freely. They didn't feel like they were sharing trade secrets because nobody realized that the internet was a big deal then. So it was like a small group of people sharing trade secrets. And I actually learned from a technical analyst from Merrill, was my first teacher there. I then became, I loved the online thing, which is obvious from everything I've done since that time. And so I became what was called a SysOp there, which is like SYSOP, a system operator. And so I was the guy, and I shared shifts with other people who would download the entire database between, say, a 4-hour period. And then I had to go and filter that database and send it back up in as quickly as I could. And we got that down in real time, but you get maybe 400 messages an hour, and so I'd have to scan through 400 messages. And so I started speed reading everything about the financial markets. And I did that for like 3 years. So in addition to the trading stuff, I got a really nice education on everything else because I was reading all the stuff that all the bond guys were speaking about and the underwriting guys were speaking about and the sales guys were speaking about. And so it was a real nice rounded education that I got from them. But I really picked up most of them. They had a small trading and technical analysis section. And then I went out on my own with through E-Trade. I'm sure I should probably stop somewhere in here, but the story's really interesting how everything just progressed in a very, very nice pattern. At the time, I was also the boss in a huge claim operation. I had like 150, 175 employees over 5 states here in the western states. So I was in Denver. I used to go out to Oregon and Utah and Wisconsin and Arizona and California. And I also had the only modem in the office because we got a modem, which was very expensive, in order to send requests to the crime bureau, for fraud. We used it for fraud. And so I had to put the modem in my room. So in addition, in my office, and I was like one of the only people in the office. So in addition to, having one of the first modems, I also had one of the first private connections that I was able to go and hook up all my trading stuff to the company modem. And I did that for 4 years. And believe me, the day that I got laid off from that job, they had no idea what I'd been doing sitting there for 4 years. And at the same time, the company went from had 150 employees. And by 1998, which is when I left, I had something like 14 employees. So I used to get done with my work after 1 and 2 hours, collect that salary, and then go and trade for the rest of the day. So it was a really nice start. I was very, very fortunate.
Okay, that's very interesting. And there's a couple things I'd like to pick up on there. So probably the first thing would be that you came into trading right after the 87 crash. I mean, this was probably a time when I imagine most people were trying to get out of the market and probably scared of the market. Did you have any concerns at that time about starting to trade?
Well, no, you really don't because you're so risk unconscious. You're so risk stupid at that point. You know what I thought the greatest thing in the world was? And this is the first thing I ever picked up, and it was from a newspaper. You picked it up, and I just would look at stocks that were like $1 or under, and I would see, oh, it's got a low this year of 47 cents, and it has a high of 73 cents. I can make, 26 cents. All I have to do is buy the low and sell the high. That was my mentality. It wasn't sort of this grand investment scheme. It was just the stuff that I noticed instead of sort of the fundamental. I better get a portfolio and diversify it, and do my MPT, and go in and learn my risk management. The first thing I'm doing is looking at the numbers, which is always my thing. I'm a pattern guy from the word go, and seeing these numbers of high low, open, high low, close, and that's what got me started. I said, well, if it's going to be low at some point and high at some point, I just have to figure out when it's going to be low and when it's going to be high. So, I mean, I didn't have the risk consciousness. And if you take a look at the 87 crash, it wasn't like the 2000 bear market or the 2007 bear market. And it wasn't really, it was more like the 29 in that it came out of a parabolic rally. So all that happened is you gave up fairly short-term gains. So the market bottomed out very fast after that crash. And still, if you look at it on a blip, and I have a spider. I have a spider here. If I look back at that thing, and you go back 20 years, you go back to a monthly, I'm not sure you could even see the crash on there. I'm looking, okay, I'm to 1995. Yeah, I'm looking at 1985 to 1990, and you don't see a crash. And that's sort of the way 87 was. It was a very odd animal because the market, I'm going to say you kids today, but, experiencing it, the market was coming out of the Cold War, and everything with the bridge, the walls were falling down, and all these silicon tech companies were coming up. It was a very interesting time, and so everybody was very optimistic and upbeat. Plus, we were baby boomers in our 30s, just hitting our prime time in capital. We're just starting to make the most money in our lives, so it was just perfect timing for us. I mean, millennials have sort of the opposite timing. They're moving into an environment of lack versus abundance, and the sea levels and pollution and sourcing and all kinds of things, in a very manipulated stock market, central bank controlled, HFT controlled capitalism, world capitalism. Different animal in the 1980s when, Steve Jobs was still, not a billionaire, He was probably a millionaire back then, but not a billionaire.
Yeah, absolutely. And one of the other things you said, which I found particularly interesting, was the cost of technical analysis books back during that time. Also, I understand that commissions during that time were very expensive as well. Can you give us an idea on how much you would pay for a round trip of commissions, and how did this influence your style of trading when starting out?
No, I just posted I found an old thing. I don't know why. It was a Hambrick and Quist, whatever their name was. I remember they broke up around the turn of the millennium, and they were the discount house back then. And this was something like 92, 93, because it's right when Telecharts was starting out. And so on the same page as they had for Telecharts was the first sort of cheap data vendor. It was, and this is their price. Their cut rate price was $50 in and $50 out. And that was for 100 shares. There was a scale after 100 shares. So not only did you have that, you had on top of that, you had to pay more for each 100. Plus, you had the spread, and the spread was going to be in NASDAQ in the 1990s. The spread was 50 cents, 75 cents. So you were assumed that if you're going to buy something, you're going to hold it for a couple of years and then sell it, because you had to get past that transaction cost, and you needed that time for the transaction to eat up the transaction cost. And so, it was a 50 each way. So what you did was that your stock certificates were like, they were like, like your diploma in high school. You put them in a drawer, and you looked at them from time to time, and then you got value line week to week, and you look at the chart. If you were a TA guy, is it an uptrend or downtrend? Or if you're a Dow theory guy. And, E-Trade changed all that with discount fees, and they were still expensive. I think it was $29.95 each way or $25 each way to start out, even going up into 98 to 2000. I remember the heyday of level 2 shops. It was, what was it? Maybe you saw $19.95 each way, $20 each way. And that was the same time you were starting to get all the rebates with all the different guys coming in with Instinet and all the names. I can't remember the names. They all were bought out by each other. And so if you routed it one way, it was one fee. If you routed it another way, it was a different fee. So, but the cost structure was coming down. It really collapsed after the bear market in 2000 to 2002. And for me, it was Interactive Brokers. They were just they just wiped out everybody else. Maybe they weren't the first, but they did it best in terms of bringing it down to $1 or under for 100 shares.
Yeah. I mean, that's so crazy to think that, a round trip of commissions was over $100 plus a really wide spread, only just over 20 years ago. We now complain if it's anything more than a few bucks. So that's really interesting to hear about. So how did that affect your trading? Like, how long were you holding positions for, obviously having to factor those transaction costs in? How long were you holding trades for on average back then?
So 2 to 3 months minimum. I didn't even think about day trading until maybe 98, 99. And even in 98, 99, it was way too expensive for me. And I was out full-time trading at that point. It was just, to me, it was, I don't want to flip. I'll have to flip 30 times a day, and I'm going to have $6,000 in transaction costs that I have to overcome in order to make a profit. I mean, I want to live to be a ripe old age, and that's not the way to do it. You're going to get real stressed out if you do that. And I know a lot of friends who made lots and lots of money and really burned out badly because of, the high intensity of it. They couldn't maintain that. So that's why, I focused on swing trading, which has always been my thing. The swing trading to me, and at the very beginning, I wasn't sure exactly what swing trading was because I didn't really see much of a difference between day trading and swing trading. Swing trading is more like position trading, but position trading was the definition in many people's minds was too long. That was like weeks to months. So swing trading is more like days to weeks. And I've been in a fortunate position where I've been able to contribute to the definition of swing trading by writing Probably, I think it's still the best-selling book on swing trading that's ever been written, Master Swing Trader. I was told, because McGraw never told me. McGraw never told me the exact sales figures, but they told me it was the best-selling book in their textbook division between 2000 and 2010, and the best-selling market book in their textbook division. So, that to me tells me that it affected a lot of people, but I really don't know. I never asked for the exact figures of it. But so in a position like that, not only could I define swing trading, but I've done my best to try to define things like double tops, double bottoms, support and resistance, cup and handle patterns, Fibonacci levels, all this stuff in which there's some sort of Catholic way of looking at stuff. For example, with O'Neill and the cup and handle, it's got a, the handle has to go back to this extension and it can't go to that extension, and it has to be this long versus this long. Well, the market's not going to give you all that. The market's going to give you 80% of that, and the 80% of that translates into a 5 or 10 or 15% edge, So that's always interested me. So I've gone and done my best to redefine it. I've said it so many times now, and not only in the books, but being able to put it in something with a pedia on the name of it, at the end of its name, that it'll find its place into history. And that's one of my ego goals, is to be able to do that, to contribute to the dialogue on the financial markets in the same way that maybe Elliott did back in the 1930s. That's all I wanted to accomplish, and I think I've probably done that by putting a whole bunch of stuff out there that should have changed definitions.
Yeah. Well, I got to say, congrats on the huge success of the book. We're definitely going to dig into that a lot more very shortly. One of the things I want to ask you about while we're still covering your path to becoming the trader you are today, I think you mentioned at the beginning that you had a teacher or a mentor who was a technical analyst from Merrill Lynch.
Yeah.
How did you link up with him, and what were some of the big things that he really tried to drum in and teach you about?
His name was John Yurko. He was from Bayonne, New Jersey, and you can imagine that even in Australia, they probably know about Bayonne, New Jersey, which is one of the cancer hotspots of the country. And John, in fact, passed away when I knew him from complications of his environment. So John, he was a technician at Merrill Lynch, and he had to leave in his last years because he was a very advanced diabetic and his vision started to go. But he taught me about levels. And he taught me to think contrary. He taught me which indicators to use to keep it very, very simple. He taught me how to use indicators in conjunction with each other. Some very, very basic tools, but more about the price pattern rules. From the price pattern creates the indicators, not the other way around. You're using the indicators in order to improve your vision. And not just for confirmation, not just for signals, because if you're relying on signals, you're not going to see all the gray between green and red, And so he taught me to really pay attention to the price structure. So I believe I've got more out of that from him than anyone else. My other fantastic teacher, and I'm sure I'm probably missing half your question, but it brings it as a good point to bring it up, was Linda Raschke. Her full name, Linda Bradford Raschke, one of the market wizards, and someone who I had dinner with in 2000. And the last time I saw her was probably 2008, 2009. She calls me by my first name, and that makes me feel fantastic because I think she's one of the most awesome TA and trading people in existence. But she taught me about convergence divergence, which is, you try to, I've got my share of Twitter followers. You try to jam it into their heads about convergence divergence. You try to repeat the lesson in 10 different ways so that everybody from every sort of blockage they have in their brain and their heart, they could see what I'm talking about with convergence divergence, and still they don't get it. And convergence divergence is godly, meaning that you could translate that into money. And so it's a very, very important concept that comes straight from her. And she also taught me the other thing, which is about volatility, expansion, and contraction. My first book talks about positive and negative feedback systems, which is sort of an offshoot of trends and ranges. And when you're in a range, like we're in a massive, disgusting range since 2014, at some point, and it's like at the last third of every trading range, it starts to go from a negative feedback into a positive feedback, where the signals start to pile on top of one another, and then it becomes a stairs that's the break is climbing on, and that sort of positive feedback system. If you pick that up early, you get into breakouts or breakdowns much earlier than the signals are going to be. You're going to be in that thing days before you get your sort of signals from that stuff. And that's always been mine to be, the old trading adage about how you're supposed to, I got to get this right, I'll do it wrong. You're supposed to react, not anticipate. There's a whole school on that. To me, it's you anticipate rather than react. You get your technicals as perfect as possible, and then you find your spot, and hopefully no one else is there when you get to that spot.
Yeah. And I've got to say, Linda is really awesome. She was actually on the podcast. I think it was episode 48. So if anyone listening wants to listen to that episode, just go chatwithtraders.com/48 and you can hear an interview with Linda Raschke right there. Now, I feel like I should probably ask you to expand on convergence, divergence a little more. Like, why is this so important that we really understand this concept?
I'll go straight to Linda's definition of it. Convergence divergence is created by any 2 points. Any 2 points in the market are going to either agree with each other or they're going to disagree with each other. Now, there's so much you can do with that. Someone who can't filter is going to go, well, then everything is going to be convergent, divergent with everything else. But if you have analytical skills, you're going to go, well, some things are more important to be convergent than other things. Convergence, again, is when 2 points are doing the same thing, and divergence when 2 points are doing a different thing. A bearish convergence is when the thing that's weak is doing something that it should have done that was strong, and a bullish divergence is the thing that's supposed to be weak is doing something that's stronger than you expected. So I know that's a kind of definition that's going to, some folks are going to take 10 years to figure that out, but I mean, it's really nothing more than a 10-second little equation. But convergence divergence, classically, it's going to be, I use it in probably 2, maybe 3 different ways. Number one, I use three main financial instruments, and that's the SP 500, NASDAQ 100, and Russell 2000. Those 3 are going to form convergence divergence relationships up the yin-yang. And if you go back, start at 2000 and just go month by month and look at the convergence divergence relationships created by pure Dow theory, which one is leading the other one in price, which one is broken out to a new high or fallen to a new low compared to the other one, which one is leading a rally, which one is a laggard in a rally. That's all. That's godly information too. That's why a week before the SP 500 topped out 6-7 days ago, my whole thing was as an SP 500 rally, the NASDAQ 100 is lagging, which means it's a bearish divergence. And in that bearish divergence, you're not going to get a breakout. The SP 500 can break out, can hit a new high, but no one's going to follow it. And so you're going to get some sort of weird new high that's going to trigger a failed breakout. So a convergence divergence relationship. Russell 2000, which is small caps in the States, it's slightly different animal. Sometimes it's very important and sometimes it's not important. And that takes years and years of tape reading, but anybody who wants to look at the NASDAQ versus the SP 500, that's where you start. The second one is with some very simple relative strength oscillators. 2 main relative strength oscillators are for me are stochastics. I use some RSI, Wilder's RSI, but mostly stochastics. Keep it simple. George Lane, what was it, 1960s? He put that together, and if you become a student of stochastics, it will guide you for the rest of your life. So stochastics in which there's buy and sell cycles. So convergence and divergence is how is price moving in respect to daily, weekly, and monthly buy and sell cycles. So we're on a monthly buy cycle. Everything's on a monthly buy cycle after January and February bottom. So if price is falling, that's going to be a bullish divergence compared to the monthly buy cycle. So that's when you start to look at pullbacks and dips and buying lower prices. But you also have a weekly because it's a 3-dimensional chessboard. And the weekly is getting to oversold on a lot of stuff. And so, it's that chessboard of figuring out where you buy if you're trying to buy pullbacks. If you have convergence in the indices where everything is strong and you're trying to do trend following, or everything is weak and you're trying to do trend following. And you take a look at September 2008 and see where they were, where the averages were in respect to each other, in respect to the highs and lows in the past 18 months. And it predicted that after Paulson's failure in September 2008 I think he stopped short sales with the banks or something, that the market had hit a big high. Banks hit a monstrous high. It was like a massive short squeeze. It was like 15-20%. And the market collapsed into October. Well, it collapsed and went into that positive feedback loop to the downside, all on convergence divergence relationships that locked into convergence. Everything. NASDAQ said I'm selling. The SP 500 said I'm selling. Everything said it was selling. And then at that point, the secondary markets fall apart because, I was focused on equities at that point. At this, in this world, you don't. You focus on everything. But at that point, the secondaries followed. Then crude oil followed, and the metals followed, and everything followed except for the fear stuff. That's when in December 2008. That's when the bonds took off. Because that was the bond trade. That's where it started. So anyway, that's convergence and divergence. A third way that it's used is actually in conjunction with Bollinger Bands, because Bollinger Bands are two things. They're volatility. It's a volatility indicator, but it's also a relative strength indicator, because you're looking at prices relationship compared to a top and bottom band and a central mean or a mean reversion point. I call it a central tendency point. It's the, if you stretch the rubber band, it's going to flop back to the 20-day SMA or whatever he uses for your time frame in Bollinger Bands. And so if price is stretched too far, that's I got to get this straight. That's a bearish divergence, because it's stretched outside the top Bollinger Band, which means it's gone too far too fast and it's overbought and that kind of thing. So that's a bearish divergence. That's a bearish divergence. When it does that. So, but that's the relationships you get into.
Yeah, okay. And I presume, considering the amount of articles you've written over the last 14, 15 years, that you've probably written something about this, which maybe has some visual examples. Maybe if you've got something like that, we'll dig it up and we'll link to it in the show notes. How does that sound?
Yeah, it's if you go just to my contributor under Investopedia.com, and I'll send you a link for that.
Okay.
And cool. That hooks up all my articles. It's got all the article listing. And the current number is, and this is kind of awesome because this is pure ego and absolutely nothing else. My number is, I think, 338 articles now that I've written for them since October of 2014.
Wow.
It's kind of fun.
It's a solid effort.
That's a badge of honor. That's all.
That's a lot of writing. Okay, so just before we get into more of the specifics about how you trade today, one of the things that I'd like to ask about is, even though, and I'd like to ask most guests who come on, even though you had these mentors, like you mentioned, the technical analysis guy at Merrill Lynch and even Linda Raschke, even with these mentors and this guidance, what were some of the biggest challenges or setbacks that you had to push through as a developing trader?
Losing money constantly. That's a pretty big setback. Yeah, I mean, honestly, for the first 2 or 3 or 4 years, everything I tried turned. Excuse me, I'd use my right expression here. Everything I tried didn't work. I lost lots of money, and the thing that's turned me around is losing some of my passion and not being. Losing some of my excitement and my passion and losing my fear at the same time, and concentrating on the numbers and letting the numbers guide me rather than, oh my God, we're going to go bankrupt and we're going to have to sell the house, And once you concentrate on the numbers, you concentrate on levels, and you start concentrating on seeing that everybody else is your competition, not your friend. Everybody's your competition, not your friend. And I could thread that needle because I'm also a teacher, so I could separate out the two. And I mentor other people, but there's certain things I keep for myself still. There's certain things where, that I try to get out there, but I just keep those for myself, little bits and pieces of my systems and how things have worked over the years that I'll probably wind up never sharing with people, because the bottom line is, the Farleys have to eat, I was still working in the insurance industry during those 4 years when I was losing money. So I was getting it back. I was very, very protected. I was losing money every year, but my last years with the insurance company, I was making 6 figures. So I was getting the money back. I was keeping the trading account size up. Then I lost that job. I didn't ask to lose it. I lost it. And that was trouble. I had a hard time for the first 3 months. And then I started getting my equilibrium. And I started to become a break-even trader for the next couple of years. And no one's going to like this answer. But at this point, now I've been doing it for so long that I can actually give the answer. And it's an answer which is probably poison for trading educators. I make money now because I don't have to trade all the time. I make money because I don't need it. I make money every year. My returns are ridiculously good because it doesn't matter as much anymore. That's something which is very, it's a great truth of my life, which I wasn't able to make money consistently until I had other sources of money. And that's what worked for me. That I was able to reduce my passion because it wasn't like, well, God damn it, if I don't do something this week or next week, the family's going to suffer. Well, as soon as I did that, my returns, even down to a daily level, they've blossomed. They've blossomed. It makes me crazy. But that was really the thing, was sort of giving that up and giving up the passion I had for the market. That was the thing that's turned it around for me, for sure. And that, again, didn't come until I came back to trading after 2001. Things started to, because the other stuff took off, and I said, well, what the hell? I'm still trading, and all of a sudden the trading started doing well too. It also it saved my ass. You talk about the difference between needing it and wanting it. In 2007, I built up a really nice retirement account. And I was putting the trading earnings and the writing stuff into a large SEP account, which was that's like IRA here, self-retirement account. And so I was at Schwab, and at that time, Schwab salespeople were real pushy. I had them put in July of 2008, take everything. I had already gone into cash. I had them take everything out of money markets that they wanted to put me in. I put them in. I just had them put me into whatever the sweep money market was. And I said, I just want cash. I want nothing else. Because, the market worried me. And then I missed the crash. I missed it completely. I had exactly the same amount of money in March and April of 2009 as I did in July of 2008. And that was because that I didn't have to make it there. If the market was going to crash, I could let it crash. I'll just go to cash. My newsletter was 100% short. I play on the short side as much as I want. I don't like playing on the short side when volatility is 50, 60, 70. I can't handle those swings. And that's what it was like on some days back in the fourth quarter of 2008. And then in March of 2009, from that level head and all that money back in there, I started buying. I bought Apple. I made 380 points on Apple between 2009 and 2012 or 13 when I sold it. It was some ridiculous number. I made 100 points, 120 points on IBM. The stuff that came out of that was just ridiculous, And it was because I didn't have to trade 2008 if I didn't want to. And that was a very big lesson for me as well. About, I tell you, the return since 2009, I had trouble in 2010 and 2011 because of the algos. The robots took over, and the flash crash was the first time we realized the robots were there. We knew they were there, but that's when they exerted their influence and realized that the robots were really dangerous. And after the flash crash in May of 2009, I started to be at peace with them. I put out an olive branch. I complain and bitch about them, but that's what the new market's like. They used to call it the axe back in the level 2 times, the algos of the axe. And if you can read what the algos are doing, whether it's just sort of sweeping out stops or front running little movement or trying to make sucker moves for retail at highs and lows, which they do all the time. If you just sort of get a read of that, your life is a lot easier. You don't have to be long every day. You just wait for the big stuff. Like tomorrow's a big day, and really being in peace with them has improved my returns the last 4 or 5 years. It's been really awesome. It's a ridiculous market. It's one that's so hard to trade to people, but if you know how to trade it, it's really not that hard. That's a very funny sort of dichotomy that anybody who sort of has to tell other people what the market does. That's like a private joke. It's not that we mean to do it. But it's so hard to explain it. When you explain it, people look at you with sort of those dead eyes and go, they don't understand you. But if you just are at peace with the algos and just let them play their games, they're not bad masters either. They're really not very bad masters at all.
That's actually a topic I want to bring up with you in a little bit when we get into breakouts, because I think it'll be very relevant to that subject. One of the things I found very interesting in your response there is you said that you became a much better trader once your passion for trading started to sort of back off a little bit. Seems quite the opposite from what most people would say is like you've got to be very passionate about this to succeed as a trader. You're sort of saying that when your levels of passion sort of dropped a little bit, you actually became a better trader. I don't know if that's because you were sort of coming at this with a different perspective
I think it's a prerequisite for success, actually. I think if you're too passionate, you can make money, but you're going to lose it too. You have to overcome your greed. I don't know which is harder for people, greed or fear. I mean, I know it's sort of like there's so many cliches tied to it, so it's really, really hard to tell people. You've got to detach from both of the stuff. You get the greed and the fear. And the more you do that, your systems may work. You don't know if your system's going to work or not until you look at it without those blinders on. And of course, there's professional traders and people who do it every day, and that's something that we have our handle on, But the majority, and you see them, they struggle. And they hide the fact they're in a struggle, especially because so many white males who trade, that they're the ones that don't want to admit it. They don't want to show their sensitivity. They don't want to admit that they're wrong. But you know that they're losing money. So, you're compassionate, and you have to. I don't say was it easy or hard for me? I just had the opportunity to not be greedy or fearful. Other people have to do it their own way if they want to succeed. You could be, passionate. Passionate is good, but passionate gets you to the starting line in a lot of ways. You're trying to play catch up with passionate. At some point, when you become a master at your skill, it's not really passion as much as you better damn well do what your skill tells you to do 100% of the time, or else you're in trouble. That's more important than your passion at that point. You're passionate because you're an aspirant as opposed to a master or a journeyman or a advanced adherent. I mean, whatever, according to your profitability. Aspirants are the most passionate. New money, you're passionate. A regular good P&L, you feel real good about that. And then when it becomes, a part of your life energy, in other words, you need it to pay the bills, you got to be a lot less passionate about it because you can't risk losing it as much. There's always the risk is there, but you have to create a little. You have to create a little more. It also means taking less risks. It also, for different people, that means different things. For some people, it means size. For some people, it means holding period. Some people, it means the markets they trade. For me, it's mostly keeping track of how much I keep in cash at any time. Because I like to trade, so I always like looking at my cash hoard and saying, that's stuff that's not being risked, and that's how I manage it.
Yeah, no, I think that's really well said, Alan. I like that answer.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
So moving on, you've been trading for, I think it's coming up to 30 years now. Could you tell us a little bit about how you trade today? Like, obviously, you've read in the book, Master Swing Trader. Are you still swing trading to this day, or do you also do a little bit of day trading as well? Like, tell us a little bit about your approach today.
I day trade when I have to, and I day trade when I see it. If I see something that looks like a day trade, I'll take it because, I want to take it. I get that excitement and jump in and take care of it. Other times, I'll day trade, and I just don't trust the market, so in other circumstances, I consider overnight risk, and if there's too much risk, I'll dump it and take the money. And I take a lot of heat in my newsletter. It's a swing trading newsletter. When I say, "Oh yeah, by the way, I day traded, so I really don't have anything for you today," and I take a lot of heat for that. But day trading is a form of risk management when you're a swing trader. You day trade so you don't have to hold things overnight, so that some poll about Brexit comes out that kills you in the morning. So yeah, you day trade because at the end of the day, you're not going to have to deal with it. And so, I don't day trade all the time. I much prefer holding positions overnight. I'm holding the NASDAQ 100 overnight right now. That's a swing trade. it's gone down for a week, and I'm trying to pick a bottom. That's one definition of a swing trade. I've got bullish divergences up the yin yang where I'm at here now. So I mean, that's a swing trade for me. It'll only work. I don't think it works if you sell it tomorrow unless you have to. It hits your stop loss. If it works in terms of upside, I probably, unless I get a spike tomorrow, I might have to hold it till Thursday or Friday. So, I'm not sure how long I'm going to hold it, but it's definitely a swing trade. I'm looking to buy this when I want it and then sell when things get wild, which hopefully they will during triple witching at least. So you pick a spot for that. I'm holding some pullbacks on breakouts. I love pullbacks more than any other things. I don't trade continuation trades in this market. I haven't traded a clean breakout trade in forever. You trade it from level A to level B and then you get out, or you trade it from level A and then you stop out. The breakouts are failing left and right. So it's nice to be positioned when you get the breakout, but it's also nice to sell the breakout because you expect or suspect that it's not going to hold up. So, there's a lot of timing stuff. It's, again, very tough to teach other people. I'm pretty comfortable with it, and I teach folks about it all the time, and hopefully they get the message on it.
And what markets and products are you trading? Obviously, you mentioned the NASDAQ 100 there, so you're trading the indices.
American stocks, we're so spoiled. American stocks are just, to me, it's godly. I don't have to go to any other markets because I could trade. If I want to trade gold, I'll trade GLD. If I want to trade copper, I'll trade JJC. I won't trade USO or UNG if I want to trade energy markets because contango just wipes you out. I'll probably trade like Halliburton or whatever, stock of the day kind of thing. But U.S. stocks, I mean, futures is a special animal. I'm just not a specialist in futures. I'm a specialist in equities. I know things about them other people don't know, so I keep an advantage with it. I follow Forex. I traded it for a couple of years. I don't want to get up at 2 a.m. I really don't. I mean, the euro moves all the time. I traded the Aussie market, Aussie dollar, for a long time. I really enjoyed it because here it was like about 6 till 9 o'clock. It was fun, and I really like it better than a lot of other markets. But I got stuck. I just, if you're going to do Forex, do Forex. What I have a hard time is listen to Forex guys try to understand the SP 500. Good luck with that. Come see me sometime if you think you're going to understand it. There's a precious few who can, but if you're a Forex guy, I'll learn about the euro from you. But if you want to learn about the SP 500, you're going to need to come to me, And so I like that, and it also builds a nice community. There are a lot of people here in the States. It's all we do because it's what we got. One thing about Australia too was always resource centers like Brazil, and I spent time in Sao Paulo too. And so you can't avoid trading resource stocks in Australia. I don't know how it's even possible, unless I guess you're a Forex trader. But even then, you're trading resource stocks because you're trading the Aussie trades like a resource stock, like the Mexican peso, And so it's, to me, I like the versatility of U.S. markets. Okay. We still have 8,000 things to trade.
Yes, there's definitely a wide selection, plenty to choose from. So I think I read this on your site, or I heard you talking about it in a video, and I thought it would be really interesting to bring up here, seeing as we're talking about swing trading. And you said that many traders get into trades without actually understanding the dynamics of what makes those positions move. So could you speak to us a little bit about the dynamics that generate price movement and what we need to understand about that sort of concept?
Okay, two sides, and that number one is the price structure itself, and number two, where you get on board and where you exit the price structure. They're a classic sort of, we'll call it TA 101, classic sort of horizontal line that's support and resistance, and as soon as price exceeds that support and resistance level, it constitutes a breakout, and breakouts are bought through a breakout strategy and a breakout stop loss, and you risk this percentage according to a breakout strategy. And to me, that stuff is just so, I'll call it 1980s. It's so doesn't work anymore, and you'll get killed doing it. The price structure dictates what's going on at a breakdown level, assuming you're identifying the breakout and breakdown level. Classic example, since we don't have examples here, we're dealing with audio, and we're going to have to describe it. A stock comes back to an old high. So that high's been there for 18 months. comes back to that high after 18 months. That high is at $60. When it goes down to 30, 35, builds a base, comes back up to 60. Goes to 61, people buy it. And I'm going, why? There's nothing that says that stock won't turn around and come right back down. That doesn't constitute a breakout. The breakout is constituted by the price action that goes into that level. And so you could get almost anything into that level. You could get the fifth wave exhaustion climax of an Elliott 5 wave into that level. You could get three little bases that go up at 50, 55, and 58, so that it's been at 58 already for 3 months. And so when it goes from 58 to 59, 60 doesn't look like a lot. It's just going to go straight through, and you get this legitimate wide range breakout, this big, tall bar, volume coming in, excitement makes the evening news. Because you already had built up those levels. The price structure had put the wind at your back. It was a tailwind. At the time that you reach a breakout or a breakdown level, you have to go through a series of tests. The series of tests are, does the volume support the breakout or breakdown? Do the relative strength cycle support the breakout or breakdown? Does the structure of the rally into that level support the breakout or breakdown? This is the tricky one, number 4. Does the market support the breakout or breakdown? In other words, if you're the SP 500 and you're at the lower half of the trading range, and one of the SP 500 components is traded to the top because it's a relatively strong sector. Let's say it's some food stock that doesn't care that the banks are doing bad. When that food stock breaks out and the SP 500 is sitting and selling off that day, do you really want to own that food stock? Or are the HFTs going to get you because they're going to execute highly correlated ETF strategies that sell the entire component base in order to drag down the index? So that's the background. That's number 4. Does the SP 500, is it a bullish or bearish divergence at the time that you're looking at a breakout or breakdown? Breakouts and breakdowns, to me, occur in 3 stages. Legitimate, quote unquote, we'll call it legitimate. And each of one has trades tied to it. You have sort of the action phase in which price lifts off, exceeds a prior high, goes under a prior low. Then you have sort of the identity of that breakout. Some of them will, it'll be a big gap, big volume, big high. That identity is going to create some sort of climax, some sort of high. And I could be very close to the old breakout level. Then you have a reaction phase. The momentum that created that breakout is past, and now sort of the other side's come in and going, well, I'm holding the position. Do I want to get out now? Short sellers are going, well, as it run out of steam, do I want to sell now? Technicians are looking at it and going, oh, I've got divergences. Do I want to redo my call now and send out a downgrade or an upgrade? And so that whole process is going on. It's a reaction phase. Reaction phase is sort of a classic buy the dip phase. That in a legitimate breakout, when something comes back to a big breakout level, you want to own it. You want to own it because, damn it, you really wanted to own it when it happened. And now it's come back to that price and all the technicals are good. You want to be an owner. So that's the reaction phase, legitimately. And that reaction phase can take place in lots of different ways. Then you have the confirmation stage of when price comes back to the high of the initial breakout. Now, when price comes down, and this is another thing when you get into fractals, it makes people's minds crazy. When price gets back to the high of the initial breakout, it is, in essence, returning in a smaller fractal of doing the same thing it did when it broke out. It's coming back to an old high. So, but instead of looking on a weekly chart, you're looking on a 60-minute chart or a daily chart. But the same processes are in motion about that high being exceeded and going to an action-reaction cycle. But anyway, speeding up the story, when price exceeds that confirmation high, it's quote unquote confirmed. It confirms the breakout in the larger scale. So that weekly breakout is confirmed when that higher high is exceeded, theoretically. There's a lot of ifs, ands, and buts, and bruises and bumps in what the action-reaction resolution or climax or confirmation cycle is going to produce. But theoretically, what happens, and it happens quite often, is when that hits the confirmation stage, it's like dominoes. The daily's going to hit a confirmation stage. That 60 minutes going to hit a confirmation stage, and you're going to get bullish convergence. And what happens in bullish convergence? Price surges forward, and you have a very nice confirmation trade, which is a trend-following trade, which is happening in smaller time frames, but we're not seeing in weekly and daily because we're stuck in a big trading range.
So you kind of described, 4 factors that sort of make for a solid breakout opportunity, and then the 3 phases of a breakout once it actually happens. So whereabouts in all of that do you prefer to enter into this trade? Like you said, it's not ideal to enter just at the break of a line of resistance or support. So whereabouts in this phase do you ideally take a position?
Well, there's at least 4 different trades here. And I'm looking, depending, at any given time, if I'm watching it and this is undergoing a process, this is how I would trade it. If I thought the breakout was legitimate, I'd try it again before the breakout and take it higher. If I saw the breakout happen and I wasn't in it, I'm not going to chase it. I'm going to let it find its high and pull back. If I'm in it, letting it find its high and pull back, I'm very focused on the breakout trade, on the pullback trade, which is what I've been doing the last couple of days with the market dropping here in the States. So I've been very much involved in buying pullbacks in breakouts. If I'm a skeptic and I get this wrong and I'm long overnight and I'm wrong and the market gaps down, I'm looking at failure trades. It could be that a pullback gaps through a breakout level and it drops right into the 50-day EMA and a major Fibonacci retracement. It could be I will get a stronger sell signal on a pullback or a gap down in the morning than the buy. Excuse me, I got to back up a second because I'm going to give it to you wrong. It may be I'll get a stronger buy signal on a gap down in the morning than the buy signal I got today that brought me into the position that I'm holding overnight. So I'll say that again. I may get a stronger buy signal on a gap down into a major level tomorrow morning than the buy signal I got today that brought me into the trade. That gap down into a buy signal is a failure strategy or a failure swing. In other words, some failures will go and produce buy signals, not necessarily when they fail, but if they come into a major average, you may want to take a shot at a 50-day moving average, or when they leave behind something like a bullish island reversal and gap back into that same pattern that I got stopped out of the first time, then you will get a supplementary sell signal. So there's like a third trade right in there, maybe even a 4th trade right in there. And then a 5th trade would be, my initially, if I bought a dip trade was to sell the test of the high of the breakout. But then if it broke out from that high of the breakout, the confirmation trade there would give me a 5th or a 6th trade on it. Am I going to take all 5 or 6 trades on any given thing? No, I'm watching dozens of stocks and patterns and everything. I'm going to take a little bit here, a little bit there, take a little smorgasbord, a little sort of buffet of the stuff that's working today. And today it might be breakout trades. After the Fed, it might be a continuation strategy. So I'm trying to be in tune with where the SP 500 and NASDAQ 100 and Russell 2000 are today.
Okay. So you kind of described 6 different trading opportunities within a breakout or breakdown scenario there. For someone who's maybe a little bit less experienced or someone who's only been trading a couple years and still kind of learning the ropes, would you suggest that they just try and maybe, if breakout trading is something that really appeals to them, do you think it would be a good idea that they just try and pick 1 or 2 of those out of the 6 trades that you described there and really focus on those? Or, I'm sort of presuming it could be quite easy to get caught up in trying to watch too many things at once.
Yeah, and if you're going to if you're going to go to 1 or 2 of those strategies, you better become really good at it. And you also need to learn the tests and filters you need to place that position through in order to get the right information. Because there's certainly every breakout's going to come with a set. It's any diagnostic. If you can't do diagnostics on the trade you want to take, then you shouldn't take the trade in the first place. And diagnostics is the TA that you trust. You're going to look at the things you look at to tell you whether you believe price is going to move in the direction you think it's going to move in. For me, it's where's stochastics? Where's the 533 on my 3 time frames? Where's on balance volume? If it's a daily trade, and I only use on balance volume in daily scale. If it's on balance, I'm supporting a daily scale breakout. Where the Bollinger Bands, does the breakout push the Bollinger Band through the top of the top band, right away, setting it into an overbought status, which is kind of dangerous to buy into. So, I mean, I've got my quantitative and qualitative information that I'm applying at each of these testing points. And if it doesn't meet my criteria, I'm not interested in the trade. And that's, if you want to do it it's not even doing it for a living. If you want to be consistently profitable, that's what you're going to have to do. So if that causes you to be forced into like a little bit more research, it's the research you're going to have to take if you want to trade. You're not going to find sort of easy way out. But yeah, for your first couple of years, you probably want to look at the entire process, because the process could be bread and butter for you. But you're also going to want to decide, well, it's like me. I like dip trades better than anything else. Doesn't everybody? Dip trades are fun. So, pullbacks to support levels are fun. But, you want to know, especially why you're wrong. Why are you wrong when you're wrong? The losses give you as much information. And what kind of do you go into? I've been in some volatile markets when, you'll get some dip where, look what's here. Tesla Motors is just getting clobbered in the past few days. You get some sort of like wild price action. You go, do I really want to put my money into that situation where I could be 3-4 points wrong in the space of 3 minutes? So, it's like, okay, so you have to decide what your risk tolerance is at the same time, in addition to which you're going to trade.
Sure. Okay. Yeah, no, great answer. So just moving off that a little bit, I'd like to ask you a few things about stops. So how do you think about where to place your stop losses? Many traders are concerned with stop gunning and, brokers knowing where their stops are and that sort of thing. Is that really a genuine concern that people should have? And what's an obvious... Yeah, you go.
I think it's a massive concern. I don't think you should place physical stop losses. I mean, that's I'm sure you're also talking about mental stop losses, but physical stop losses, yes, I don't think they should be placed. Here in the States, it's an invitation to disaster. If you can't watch the market all the time, that's a problem. Okay. And maybe you want to put in sort of an end of the world stop loss, but an end of the world stop loss, as we saw during the flash crashes in May 2011 and in August 2015, because the industry is reluctant to call that a flash crash. Those stops are subject to stop running. So it's a different question from where it goes, because I certainly have mental stop losses. I know where I want to be out of a trade. You have your reasons for being in a trade, and there should be technical, numerical reasons. When those numerical reasons are broken, you need to be out of the trade. That could be a moving average. That could be a trend line. There's nothing wrong with that. It could be a Fibonacci retracement. I'm Fibonacci crazy. I use Fibonacci on everything. And but you also want to look at sort of let's call it an opportunistic stop loss, where you're willing to get out of any trade just because the market's doing something that's wacky and you don't understand. And so, you go, okay, I think I need to be out. Maybe this isn't the best price. I'm going to try to just get the best price in this sort of time frame, given the circumstances I have, and I'm going to go back to the sidelines. And so that's sort of that's an opportunity cost stop where you just don't know what you're getting into. So you're eating the cost of the transaction to get back to the sidelines. And I trigger that sort of stop endlessly. It may be the majority of my trades.
Okay. I mean, not placing a stop loss, to me, that just sounds very dangerous.
Yeah, it's not dangerous at all if you're watching the market all day. You're in a much better position if you're not watching the market all day than if you're placing a physical stop loss. Now, are you watching the market, and do you know your positions? If you've got 10 thumbs and you don't know your positions, it's one thing. I'll place a physical stop loss if I go out to the store or something like that. Or these aren't day trades. Physical stop loss on swing trades, I probably won't place one. But if I'm away from the market for an extended period of time, I'll close my positions out, or I'll have enough faith in them that if they get wiped out, they get wiped out. And because you can't. It's way too dangerous to do that. Again, I'm taking some leeway here in saying that people pay attention to what they own, and maybe that's not true with everyone. If you want to do a position trade, do you place a stop loss if you want a position trade? I mean, yeah, you can. If I was doing it all the time, would I pay? I've been doing swing trades now, relentlessly for 15, 20 years, and almost none of them have stops on it. But it's again because I'm sitting here every day. I know what's going on with that. So are you a part timer? Do you have to put protection? Yeah, you have to protect yourself. But my feeling for a part timer is that if you can't watch the market and you need a stop loss, you're probably trading way too big. You should be trading smaller and taking smaller profits and losses and probably not getting stopped out a heck of a lot less and sleeping at night just as well, rather than getting a big position that you want to be right in. Because you know what? When you have a big position you want to be right in, I hate to break it to you, but you're not that smart when you have big positions you want to be right in. I know I'm not that smart. I know I'm wrong a lot more often than I'd like to be. But that's why I diversify through lots of different things. And so if you get a highly correlated event where everything goes in one direction, I think you're pretty much screwed regardless of what you have. I think if you're not sitting there, you're going to get your stop's not even going to fill. So and that's what the flash crash people found out. Their stops didn't fill for 30, 40 points.
Okay, so let's just say for those who are placing physical stops, right? Ideally, they're in a place that's not obvious. Okay, where would you suggest is perhaps a more advantageous place to put your stop loss, if that's something you feel most comfortable doing?
You're going to have to go outside of a weekly range, and you also have to remember that the algos, one of the things they do is they look at average true range, and they will always go and spike average true range to try to catch stops that are outside of a certain range. So if you think a stock is only moving 0.75% or 1.4% a day on average, and you put it at 3.4% out, this algo is going to find a way to increase volatility to get that stop, unless you're in a directional market. If you're in a directional market, the algo is not going to do anything about it. We haven't been in a directional market since 2014 in U.S. equities. I know the Australian dollars had a directional market in that time. And other things have had directional markets, but we haven't had them in U.S. equities or U.S. indices. So for us, it's been very much a trap market where the algos are playing with ranges to take out stops. But if you're going to do it, it really needs to be outside of a weekly range. Take a weekly. One usually technical way to do it is take a weekly Bollinger Band and keep your stop outside the level of the weekly Bollinger Band. And that's going to tell you how much the volatility is stretching in that environment. I'm not really a percentage guy because percentages are kind of stupid. People put percentages of their total account size because it sounds like a very structured way of controlling risk. But you can't control a risk if you're taking positions for the wrong reasons. You've already destroyed your risk profile by getting the wrong stocks because your strategy isn't working. So your percentages aren't going to help you. So if you're still trying to be guided by finding your way in this dark universe of profits and losses, you want to get it out of the way of what's happening this week. Think in terms, if you're holding in a weekly to monthly time frames, you want to get them out of the way of a weekly range.
Fair enough. Good point. So last question for you, Alan. Before we finish this off here, are there any final words of wisdom you'd like to share with traders who perhaps feel as though they're not really making any progress and maybe just kind of spinning their wheels?
Well, you need to try something different. I know everybody needs trading education. You're going to get your share of trading education. It's become as cheap as it ever has and become in the history of mankind with the internet. The problem with trading education is there's so much of it available that you can't find the stuff that works for you. The stuff that works for you, you not only find through trial and error, but you have to look yourself in the mirror, dudes and dudettes, and decide what's working for you and decide if you need to build your own system from scratch with what you already know rather than relying on someone who appears to be successful to you right now. And once you start to build your own system based on your own intuition, your own input, and your own skill set, then you'll start to put together a profitable system that meets your qualifications in terms of back testing. I know everybody wants a back test, but you have to go and trust yourself before you backtest. No, anybody else's system, it's okay to take bits and pieces from it. You're going to have to come up with your own way of doing stuff. And that starts with the basics that I've talked about. I haven't talked about anything that's very esoteric. Folks don't understand me. I tell them straight. You really look them in the eye and you tell them the real straight stuff on how to make money in the market. And then they look at you like wide-eyed, like they don't know what planet you're from. And it's really the same risk stuff that's been before the algo showed up, before SO showed up, before portfolio insurance showed up, before the Nifty 50 showed up. And that's risk management. You got to control your losses, and then you control your losses and find your own way of doing things. You'll build a winning strategy.
Sound advice. Very good, Alan. Well, where can listeners go to find out more about you? Where's the best place?
The best place right now is in Investopedia, and I'll post that link for you, but it's kind of a long link. I'm in the process of giving them over most of my stuff. But you can find me also on Twitter at MST Trader, MSTTRADER. And I've got a very nice following, and you're welcome to come by and say hi there.
Okay, excellent. And where can someone grab a copy of your book? It's available on Amazon, right?
It's available on Amazon. It's also available now in 7 different languages. You can get it anywhere in Asia. It's in Japanese, Korean, and Chinese. I know it's in German. It's in Portuguese and Spanish and Russian and French. Excuse me.
Wow, very cool, very cool. Well, I'll make sure to include a link to that in the show notes at chatwithtraders.com. So, Alan, thanks a heap for coming on the podcast, man. It's been a whole lot of fun speaking with you, and I appreciate it.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Okay, what's up? How you doing? This week, for the second time on Chat with Traders, my guest is Morad, or better known as Futures Trader 71. As you could imagine, FT is a futures trader. He's also very short term and has been trading for around about 16 years now. During this time, he was the founder of a successful prop firm and more recently has started a brokerage, Stage 5 Trading. First time around, on episode 37, we spoke extensively about FT's path of becoming a trader, market profile and volume profile, and creating a legacy. This time, we spoke about all new topics. For example, how to learn a new skill, how to measure your progress besides P&L, how to remove attachment to the outcome, how FT uses a regressive risk management strategy, and plenty more too. This is a really big episode and FT shares a ton of practical info. So if you need to, listen 2-3 times and take notes as you're going. Actually, I'll also just mention quickly, there were a few minor glitches in the audio as we were recording. Please just roll with it. They only last a few seconds at most. Anyway, here we go. This is my second interview with Futures Trader 71.
All in all, everything's really good. I'm very happy.
Oh, awesome. That's good to hear. That's good to hear. We got a really great response from your last interview, so I'm sure this one will be well received also.
Hope so.
Yeah. So anyway, I've put together a few notes from my side. I think, some of the topics I'd like to talk to you about, which I've mentioned to you on Twitter. So pretty much trader development, risk management, managing drawdowns, tips for linking up with a really good broker. And I've also opened a Facebook group So anyone listening to this, if you want to join, chatwithtraders.com/Facebook, completely free to join, of course. I posted in there that I was having you back on the podcast, and if there were any questions that some of the members would like to ask you. So I've got a few members that have come. I've got a few questions that have come out of the Facebook group as well. So we'll tackle those as we go. So
I just requested to join that group.
Nice. Good to have you in there. So, all right, well, let's roll into it. So if anyone hasn't heard our first interview, which was on episode 37. So if you want to check that out, chatwithtraders.com/37. You guys can go and listen to the first time we spoke. For anyone who hasn't heard that yet, or who might be unfamiliar with who you are, FT, could you just give us a real quick sort of rundown on who you are, what you're all about, and then we'll take it from there?
So the 30-second elevator pitch is I've been trading professionally for about 16 years now. I started out in equities as a SOS trader, as a SOS bandit, so to speak, and moved to futures. I started out in Florida in Boca Raton, and moved up to Chicago to trade futures at a prop group in the Board of Trade. And essentially my entire trading career has been in a group setting or in a professional environment. And now I've moved away from being in a professional environment to creating a professional environment. I was running a prop shop at the Board of Trade since 2004, from 2004 to about 2010. And then from there, I decided to look online and start working on other things. And since then, I started a brokerage with a partner. The brokerage is called Stage 5 Trading. And my focus within the brokerage is not to sell the brokerage or anything, but to focus on trader development. In other words, my goal is to bring as much as possible the experience I had as a prop shop operator, and I was very successful doing that, to the retail public. So I'm pushing back. My goal is to push back against anyone that is in the business of just signing traders on, giving them the maximum leverage and kind of, shooting them off and letting them sink while they work on the next candidate. My goal is to help the industry by helping traders stay as traders for as long as possible. I'm not always going to be successful, but I believe slowing traders down and helping them understand risk and so on will help them get closer to achieving their goal of being a trader. So a lot of that, there's a lot of misinformation in our business, as I'm sure you've done so many interviews. I'm sure you've come across people who've said that before. There's a lot of misinformation, a lot of undue strain on traders trying to make it. And there's this veil of secrecy that I don't think should exist, because it didn't exist in my prop shop and we were successful. We're not automated traders or anything like that, so we're not giving away any secret sauce. So I feel like the best thing a trader can have is a structured, dedicated community that they can trust and interact with, and that'll help them move along, as opposed to being with a one-on-one mentor who may or may not know what they're doing. So that's where I am now. And I'm moving, now that the brokerage is set up and it's running, I'm moving towards creating a substantial course that takes someone who's coming into futures or trading in general and carries them through the process of understanding all the important pieces to actually come out as a professional trader on the other side. So my goal is to now take those who want to pursue this and provide a standardized process for coming out the other end, almost like someone who has an engineering degree or something. There's a minimum amount of knowledge that they should have. And that's the next big project I'm working on. So there's a lot going on. Just the short story is there's probably too much going on for my own health, but I enjoy it all.
Always good to keep busy though, that's right. So one of the things I didn't pick up on last time when I had you on the podcast, which I wanted to ask you about this time around, is the story of the XAUUSD bandits. I mean, they were quite well known when they were around. Can you give us a little bit of background and a little bit of context around who were the XAUUSD bandits and what did they do?
Sure. So the XAUUSD bandits started way before my time. They started around 1990, and it was generally there was a group headed by someone named Sheldon with Daytech Securities. And what this group did was, for the first time, they managed to get level 2 access, meaning they can see the full depth of the market on the various NASDAQ stocks. And they could see what the institutions are bidding and offering on any given stock. So depending on which stock is in play, most common stocks that were in play at the time were Microsoft and JDSU and tech companies like that. And what they did was they found a way to use what's called the XAUUSD system. The XAUUSD stands for a Small Order Entry System, and it was designed to fill small lot orders as opposed to going to a normal a clear market maker like Island or what we call an ECN to fill normal size lots, except we were trading anywhere between 10 and 40,000 shares per order. So it was an exploit of this system. And what happened with the Daytech group is they figured out this way of getting quicker quotes than the traditional method by using the XAUUSD system and being able to route these orders across the board as opposed to having to go through Arca, Inca, Island, and so on, a specific clearer. And so they exploited this and then built an entire business around it. I mean, there was a point where their shop had hundreds of traders in it. I was not in that process. I was still that was way before my time, but in 2000, I came across several people who were incubated in that process, were trading actually out of in Arizona, and had moved to Florida, to Boca Raton, Florida, and so they were trading the same process. There was a room of about 25 traders, some of whom were making ridiculous money. I mean, the Daytech group in general, there were many traders in there making over $500,000 a year doing this brainless manual arb, just buying in front of size, selling in front of size. And that's what we were doing for a while. So you would have a screen that had maybe 10 products, 10 boxes, level 2 boxes on it, of various stocks, and you were just constantly monitoring for size coming in and pushing the book, an institution coming in and just putting, a massive order of, say, 10 million shares to buy, and then they start to move that order up because they needed to fill it, and you would just be buying in front of them and then selling to them as they upticked. And when they upticked in what was called a teeny, which was 1/8 of a dollar, which is 12.5 cents. So that made the bid offer spread really large on, say, 10,000 shares. And that caused some guys to, some of the guys I traded with had, not that this is typical, but they would have, a couple of $100,000 days doing this. And so when I joined, I was trading 200 share lots. It took me a while to figure out what was going on. I had no idea what a bid is or an offer is. And by the time I had it figured out, 9/11 had come around, and also the market went from teenies to decimals. So you went from a 12.5 cent spread to a penny spread, and you're doing this ARB, right? So you're doing this, you're basically acting as a market maker. So all of a sudden, a lot of these traders just fell out because there was no edge anymore. So with high frequency and the penny spread, that ended up drying up, and it certainly dried up with 9/11 when the market was closed for 2 months. So I took what was left in my trading account, which I ran up from around $54,000 to a lot more, and I took that and I bought a home with it. I thought trading was done with. I bought a home in West Palm Beach and was looking for something else to do when I found out that there were still some opportunities in the equities side. And I joined Schoenfeld in Boca Raton and traded with them for a while, and then found out about futures and ended up, a friend of mine and I ended up jumping into a car and driving for 20 hours overnight to Chicago to find a spot in a prop shop to trade futures. So my stint in the SOS environment lasted about a year, a little over a year.
Okay.
And it wasn't something that I could tell from the very beginning that it was all based on how much money was being made. There was really no, compared to the investing and the personal trading that I was doing before it, it just, you could tell that it had no sustainable value overall. But as I said, there were a lot of Porsches and Ferraris and so on parked in the outside, and there was the allure of showing up. I mean, my first day showing up, I sat behind someone who was up $18,500 in the first hour. You know, you can't. It's hard to resist that. So but SOS was something that was cheap, and it was an exploit that just like all exploits in the financial market. It lasted for a while. A bunch of people benefited from it, and that edge disappeared.
Yeah, okay. No, that was really interesting to get your take on that, FT. And the SOS bandits, I noticed they're actually really heavily profiled in Scott Patterson's book, Dark Pools. So if anyone listening is keen to hear more about that, that's a good place to look. And also, if you want to hear more about FT's story about how he came into this business, check out chatwithtraders.com/37 for our first interview. So one of the topics I'd really like to dig into now is trader development. Let's start by talking about what's the process of how to actually learn a new skill. I mean, I think this is a big problem that a lot of traders actually have is knowing the process of how to learn a new skill. Because when we're in school, we have a structured learning environment, but trading, we're pretty much on our own with no structured learning environment. What's your take on this? How should we go about learning a new skill, just taking it back to basics?
That was the biggest puzzle I had to face when I was in a prop shop in futures, because that's the first time when I got exposed to having to be responsible for another trader, to train another trader for a portion of their profits once they made the turn. And it was a big part of my preparation for my own prop shop. How do we learn most effectively? I did a lot of sports growing up. I played a lot of soccer. You guys call it football, and basketball. And it's pretty much when you're looking at trading. And by the way, when I was hiring, I always favored those who are in a sport on a competitive level. Actually, I always favored anyone that was doing something on a competitive level, even if it's chess or music or whatever. These all require the same level of focused, deliberate, repetitive consistency. And this is the challenge, the biggest challenge that I see with traders, right? So traders like to come in and they want to take every ounce of knowledge they can get, and then they try this and dabble in that, and try that and dabble in this, and there's really no measured, sort of consistent, repeating process, which is required for the skill to eventually show that trader what works, what doesn't, what their weaknesses are, what their strengths are. And that's really important, as it's an important part of the process, because you want to play to your strengths. Like, my strength is reading order flow. I cannot trade just around order flow. So I create a hypothesis on the day, several of them, but I'm really focused on order flow to the point that if my hypothesis is wrong, the damage is not that great, and I can always improve my position in the market. But to answer your question, what traders need to know is that this is not going to be easy. And I know that it sells more books and courses and tools and indicators to say all you have to do is install this, or all you have to do is read this amazing book, and you'll have it figured out. But the process usually requires longer than you think, is more expensive than you think, and requires a lot more dedication than you think, and you will learn a lot more about yourself when you go to trade than you think you will. And in the end, the thing I always told my traders when I was interviewing them is, I can't guarantee your success, but I can guarantee that no matter what, when you walk away, when you come out the other end, whether you didn't make it and had to be cut from the prop shop, or made it and passed your agreement and are independent, you will know yourself a lot better, But the process has to focus on the stages of competence. Okay, and it's understood that everybody comes in and they think they know what they need to know, or they think they can acquire it by reading books or looking at blogs and so on. But what they don't know is what they don't know. Like, they have no idea what lies beyond their field of view. And so what you need in that situation, first and foremost, is someone else who knows that you can trust. And that someone else can be a person or a group, preferably a group, who can help you expand on the knowledge without adding too much baggage, too much fluff, and without misleading you. And it's very hard to do in the trading business, because there's a lot out there that is very misleading. There are a lot of mentors who have never traded professionally. There are a lot of program or indicator or system makers who have not seen success in that system and therefore are selling it, things like that. I've seen a lot of things which I was completely oblivious to before 2009 when I came online and started to look around. And that's why my focus is to cut through all that and kind of, I see a great benefit to just saying, here's what it's going to take. It's very ugly, it seems very difficult to overcome at first, but in the end, it's all contingent on your ability to recognize within yourself what needs to change and to make that change. So to answer your question, what does it take? It takes a little bit of help and the understanding that much of the time that you will focus will probably be on learning a trading system or an edge that'll make money. But really, what it's going to take for you to make money is not some trading system or an indicator. It is your ability to execute on something that has an edge in the market. I don't know if I answered your question there.
Yeah, no, I think that was a really good answer. And I mean, we're going to go a little deeper into this as well. So how can we avoid spending time on things that don't matter? Like, how can we be aware or conscious of the things we're spending time on, that they're actually the right things that we should be spending time on? Like, how do we know where to funnel our focus?
So that's the part where it helps to have a group, to be part of a group, or to have someone who has some tenure or experience in the market. They help narrow that field down for you. I'll give you an example. I have never I had almost a 92% success rate in my prop shop, and I define success as a trader completing their 3-year contract and leaving on a positive with positive equity, including membership. That's my measure of success, and my job was to kind of corral that energy. Someone comes in and they think, oh my God, if I do this, I noticed that this happens, and only if I can throw a 500 lot in the bonds to make millions of dollars in one day. No, we're going to focus on just this today. Today, you're going to focus on getting in long and scratching the trade. That's all you're going to do. You need to build trust in your ability to take yourself out when things aren't working right. You need to build trust in your ability to react to the market without emotion, or with as little emotion as possible, as opposed to going out and finding the best curve-fitted, optimized moving average possible for the product that you're trading. To me, that is not something you can grow from. I think you had an interview with Jeff Davis, who's a friend of mine, great guy, and he said a lot of the exact right things as far as, just focus on, just push enough to find something that suits your personality, that you can then look for an edge in. In other words, test it out, whether it's by clicking in a simulator and penalizing your exits to make up for the unrealistic fills or whatever, but push to the point where you can simply feel comfortable in doing something, and living with it. And then once you've done that, now you can refine that particular thing. And it could be as simple as, I will trade with fibs, or I will take the reversal trade after the market opens, and that's my trade of the day. If you can master that one trade, or 3 or 4 signals, 3 or 4 setups, if you can just become the supreme commander of those signals, I have money that's going to stand behind you and say, okay, let's turn it up. Let's go from trading 2 lots to trading 10s, 15s, 20s, 500 if we need to. And that's the way to make money. It's better than this process that I see traders go through, where they try what Aaron's last guest is doing, then they try the next guest, and then they get on Chat with Traders later and decide automation is maybe their thing, and then they fall back. Maybe I should test a moving average crossover. This guy's using stochastics, so let me look at that. And what you end up with is a whole world of people, of traders, who have invested a tremendous amount of time, a commodity that we cannot recover, just bouncing from one thing to the next, all of which could work, all of which might fail. But they have spent so much time at the beginning of the learning curve over and over and over that they have not been able to master that one thing. So to answer your question, if you find yourself constantly changing the approach that you're taking to the market, then you know something is wrong. For me, it was scalping, order flow. And when that didn't work anymore, I started to look at pretty much everything, just like everybody else. But then I started to look at volume profiling. I went from market profiling to volume profiling. And I started to notice, with detailed notes, I started to notice that there are certain things that happen consistently, just enough for me to be able to exploit them with size. And if I can exploit them with size and keep my targets modest, my stops modest, I'm able to create a positive outcome overall, a positive expectancy, and all that's left is for me to be confident enough in my numbers to put on a good amount of size. And that's where the money's made. The money's not in buying the low, selling the high short, and buying the low back. I think that's a fantasy. The money is in grabbing small, definable chunks of the rotations that happen throughout the day in the time frame that is suited to you, that you feel comfortable in. Some people feel comfortable in a 15-minute time frame. Some just want to be in and out in a matter of a few minutes. Just whatever is comfortable for you, the market's there to offer you the opportunity to make money or lose money, depending on, whether that time frame is in favor or not. I know that's a lengthy answer, but I'm combining a lot of different experiences that I've had, especially with our current clients in our brokerage. And my focus is always to not say, hey, look at this additional thing, look at this additional thing. My focus is constantly to, no, cut it down. No, you don't need 12 setups. You need maybe 3 or 4, maybe 5, become incredibly good at these 5 setups, whatever they are. And that's where your deliberate, focused practice should lie. That's where all of your journaling, tracking, and statistics should be built off of. These 3, 4 things that you're exploiting on a daily basis. And that's the way to know if you're completely lost. How do you narrow down the field? You narrow it down by knowing that I cannot be like a weather vane, just switching directions depending on the prevailing wind for that day. If you're doing that, then your chances are you're losing something that's very, very important. It's not the money in your account, it's the time that slips by and reduces your chances of being able to make the turn and make a living at this in a reasonable amount of time.
I really like your emphasis on the time there, FT. I think that's a really important point to make. One of the other things you said in your response there was, finding an approach that fits your personality. And this is something we hear quite often, especially on the podcast. From speaking with a number of listeners, I know this is actually something they struggle with. They're like, well, how do I know if something fits my personality? Like, how do I find that? How do I know if this approach is a good fit for me? Because the chances are, even if you do find an approach that is a good fit for you, you're still not going to be consistently profitable with it right away. It's still going to take some time. So, do you have any tips and pointers for how someone can identify when a strategy or an approach to trading is well suited to them?
Okay, that's a fair question. To answer that, I would have to look at the specific person, but let's take you, for example. You started out wanting to trade. You deposited, I believe it was $5,000 into an account, and you wanted to learn how to trade. And that led you to exploring, how do I trade? And I believe that led you to this broadcast, right? Which is a very, very successful broadcast. Do I have the history right?
Essentially, yeah.
Okay. So, Aaron, how would you like to trade wheat using moon cycles? How does that sound to you?
That's not appealing to me.
Okay. That doesn't suit your personality. How would you like to trade corn using the price of sugar? That may be something you'll be interested to look into, as long as there's a correlation, maybe not. But if you do the study and find that correlation, you'll suddenly find yourself, it's more of a feeling. You find yourself absorbed by this approach. For me, it was, the NASDAQ is moving up, the S&P is sluggish, the Dow is starting to move up. I'm buying the S&P. I'm ready to sell the NASDAQ if it doesn't continue and the S&P starts moving down. And I'm going to do that 500-600 times a day, trading anywhere between 2,000 to 3,000 round turns a day. That's all I did when I started trading futures. And that appealed to me. It was quick. If I was wrong, I was immediately out. But over time, it didn't feel right anymore, because it seemed like I was taking tremendous risk for very little return. So in my process of exploring other things, I felt that, fibs may be the thing to look at. And I got excited about studying fibs and Elliott waves and Drummond geometry and Gartley's, and I've looked at all these things, but there was always this sense that I don't get it. This makes no sense. Or floor pivots, floor trader pivots. I'm sure you've heard of those. They're mathematically based numbers that come off of yesterday's open, high, low, close that are computed and used for today's trading. That mathematically, that sounded okay, but to me, my personality is such that I wanted to understand what makes the market, what is it trying to do when it's moving up? What is it trying to do when it's moving down? And why does it sometimes move down with no volume and sometimes it moves down with a lot of volume? And so organizing the information in a way that explained these things that appealed to me, gave me a home, right? So I looked for an explanation using market profile, but market profile uses 30-minute time slots, doesn't take any volume into account at all. But when I started to switch, and this was by accident, my trading software, which was a CQG integrated client, had this option to turn on these volume bars, and I turned them on. And in fact, on my ladder, on my X-Trader, my TTX Trader Pro, the ladder had these bars on the side that showed you how much traded at each one of the prices up and down the ladder. And I started to notice as the market moved towards prices that had very little volume, it tended to bounce the first time as a push to those prices. It would take a small bounce before it failed, and it would push through, and then it would pull back to that low volume price before it continued. And so I started to look at, what if I looked at things from the perspective of volume per price over time? So I can see yesterday's volume per price, last week's, last month's, everything since the last swing low or swing high. And that made a lot of sense to me. And so that became the thing that I got excited about, and I threw everything else away because that made sense to me. It suited my personality. I had this particular curiosity. Whereas we have other traders within stage 5, for example, who trade tremendous size, who are going basically by a stochastic type of read on multiple time frames. That's, if I talk to them about volume profiling, they would get glassy-eyed and start to yawn. They've found what they like or what makes sense to them, what excites them, and they've spent time focusing on those things, deliberately testing and checking and playing back bar by bar what is happening as the day develops over time. And pretty much every trader I know that has gotten anywhere with trading, and I've known some really big ones here in Chicago, they have generally come from the field of, I trade by feel, didn't do very well, then decided, forget the feel, I'm going to go back and just go bar by bar by bar and study what the market is doing, whether it's pattern trading, candlestick, using some sort of an indicator, and so on. Each one of those people got to the point where they suffered enough with the poor outcome of their effort to go back and say, let me dig down and find just what I need. Just basically bare bones, cut back to exactly the minimum amount of information I need to make a decision. And it boils down to, what is the statistical probability of something continuing after a specific event? We have a large bar, an expansion of range on an expansion of volume, then every time that's happened, or most predominantly, when that happens, we generally get a continuation, another expanded bar on higher volume, but not as high as the first time it happened. And those are what I call impulsive and continuation trades. I can hardly catch the impulsive trade because it happens without warning. That's big money coming in and out of the market. But I can certainly try to do something with the continuation trade. And a continuation trade has a 78% probability of, if it's an impulsive move up, then a continuation trade generally has a 78% probability of testing, after pulling back, of testing that first high. So imagine the market moving up all of a sudden with great strength, and then it pulls back, creates this flag, and 78% of the time in the S&P minis, it will retest that last high, the original push. That's something I can really get into. So it's really a function of trying a bunch of things and then focusing on shedding everything else. Whereas most traders spend a lot of time just accumulating and never really shedding. They're looking at so much on their charts, it's impossible to make a decision without second guessing it, So that's where the words "find something that you're comfortable with" basically essentially means, sure, go out there and explore, but eventually narrow it down to something that you really like and make it as simple as you can.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved. Now, so has the way traders operate within them. Trade the Pool.
Okay, so just to take it the next step and to continue on this point, do you have any suggestions for how developing traders may be able to monitor their progress? Because the reason I ask that is because, like I mentioned just before, usually when you come to start trading a new strategy or take a new approach to markets, there is inconsistency in the beginning and often for the first few years. So is there another way to measure your progress besides just P&L?
Great question. I am very anti-P&L as a measure of progress. And the example of that is, if you look at any profession in which there's a pretty sizable demand, meaning there's a good payout. Think of a cardiologist or cardiosurgeon or a brain surgeon. There's a high demand for that kind of skill set, and so we pay a lot for it. Imagine if you needed brain surgery, and your surgeon happened to have measured all of his progress throughout med school, his residency, his or her residency and fellowship and everything else, was simply making the decisions on your healthcare based on dollars they earned. So I am going to do this particular procedure, even though you may not need it, because it gives me the maximum profitability. Or I can take care of the same issue by putting you on a course of antibiotics, which will make me $100 instead of $100,000, but may save you from going through risky surgery. So if we measure everything by P&L, we find that the world would be in a much worse place. And that is exactly what happens with trading. If you're sitting there, if you're a trader who's listening to this, and you spend much of your day trading while your P&L is flashing on your screen, you are essentially putting yourself in a situation where it's very, very, very difficult not to start trading that P&L. In other words, your trading decisions are not based on market behavior, market structure, and the auction, they start to become something that is based on how you feel about the amount of money you've made, or how you feel about how much money you've lost. You notice that most traders who are trading within their plan, they trade very little. There's a lot of space in between trades because they're being patient enough to wait for the next setup. Traders who are losing money generally have their P&L on their screen and generally are trading minutes apart. It's unrealistic that on good days they have to wait a half hour, maybe 2 hours in between trades, but on bad days they're waiting 2-3 minutes, and that's because they're measuring their performance with their P&L. You want to measure your performance, you have to track a little bit more information. Mainly, you need to track your errors. That's a huge thing. I have shown in the past, of course, on this broadcast we don't have any visuals, but I have taken someone's live trades and someone who was very diligent about recording each trade and whether it fit within the plan or if it's an error trade. Error trades are things like trades where you took a long when you should have taken a short. You have fear of missing out, FOMO. You've chased the market instead of waiting for it to get to your price. Taking someone else's trade. In other words, there was no trade for you, but someone said they just got long. That person made money on the last trade in your chat room or on Twitter or whatever, so you just decided to jump in with them. That's an error trade. A technical error trade, meaning you click the wrong button or something. And there are two others. And if you track those errors and you take those errors out of your performance, you would be absolutely astounded as to how much those errors cost. So your goal as a trader is not to look at how much money did I make on a daily basis. I mean, it's nice. That's why we're here. We're here to make money overall. But you're not just like the doctor or the surgeon or the engineer, your next trading decision is irrelevant of what your P&L is. In fact, your current trade is absolutely discrete in nature, meaning it has no relation to the prior trade. So your P&L is creating this artificial link in between all of these trades that are completely unrelated. Whether you made money on the long last time does not mean you'll make money on this long this time, because the short may be in order. So it's better to track, first and foremost, is your execution in line with your plan? So you need to start tracking your errors, and you need to start tracking how each trade has performed on its own. And the way I like to track a series of trades is not through overall P&L, but through expectancy. So we're looking at essentially what the average gain or loss is over a large sample. And the minimum sample size for anyone to consider whether or not they have an edge is probably about 50 trades, the absolute minimum. And so you're stringing together this expectancy, and we're looking for expectancy in terms of ticks or points instead of dollars. Let's keep dollars out of this. Let's keep dollars to bookkeeping on the weekends. But during the trading week, you want to track, here's my plan. Here's how I executed on my plan. I executed every trade on my plan. I executed 1 out of 5 trades. I executed 5 out of 5 trades. Who knows? But you want to focus on how are you interacting relative to what you plan to do. That's so much more important, because your exercise, your attention to become a professional is on the moment-to-moment execution, not the fact that you rode, a 10-point run in the S&P on a 12-point range day and you're a superstar. To those people, I say, watch out. Watch your risk. You're about to get whacked by the market, because that sort of thing gives people false confidence. But if you can come to me and say, even if you're trading for me, and you came to me and said, look, I lost $5,000 this month. but here's my log, and I see that you have essentially followed your plan for the most part, and you have very few errors, I would say, great job, keep going. Because it just means that you're executing your plan, but your plan does not have an edge for that particular period of time. And every edge disappears and reappears and disappears and reappears. There are times when the market's in balance, there are times when the market's trending, and you may be someone who has a plan that has more emphasis on balance than trend. And so you will lose. It's kind of like an automated trading system. Everybody has an edge for a period, and everybody has a drawdown for a period. It's just the nature of the business. Does that make sense?
Absolutely. No, that was an awesome answer. I really liked how you explained that. And this next question might sort of prompt for a similar kind of answer, but I'm going to ask it anyway, and you can give me your take on it. Traders are often attached to the outcome. Now, that's quite a problem. What would you say about this?
So, yeah, huge issue. I know there are some psychologists out there who probably focus all their attention, trader psychologists who focus their attention on this. So, attachment, and I try not to get spiritual on you. Attachment is a key source of suffering, and I'm not a Buddhist or anything like that. But it is true. In trading, let's take the typical new recruit to a prop shop, to my prop shop, okay? So I put up $25,000 in futures for the next trader into a sub account. I go out through this and do this extensive process of selecting a new trader. A lot goes into that. And then that trader comes in and starts to go through a course of understanding what a futures contract is, how to create an index, all this theory. And then very quickly, that's about a week. And then very quickly, they switch over into a simulator and understanding all the different order types and everything else. So still a technical part of the process that takes so we're about 3 weeks in. Then that trader spends about a month on sim, and the month on sim is really dedicated to the process of watching the market tick by tick by tick from the time they get in till the time they leave, documenting what they've done. And they develop an understanding of how their particular market flows. And all traders start out on a thin index like the Dow, something slow enough and so on to follow along. But I never tell them, no, you need to trade a Dow, or no, you need to trade crude. No, you're going to do the Euro stocks or the DAX or whatever. It's really a function of looking at different markets and deciding which one suits your personality, sort of. Which one is not boring you to death, really. And so once they've done that, they've pretty much accumulated all the technical skills that they need and have a false confidence in their edge. And I know this. And so they start to trade live. It takes the trader a process of burning through, out of the $25,000, they'll burn through about $18,000 in general, somewhere between $15,000 and $20,000, so we'll average about $18,000 in losses. As they work out their issues and so on. So the technical side of things really gets all wrapped up in about 5 to 6 weeks. And then they spend the next 4 to 6 months getting over the personality psychological problem. The great majority of the cost of backing a trader or turning a trader from an absolute novice who has no idea what a trade is to someone who's clicking every day and consistently seeing a positive outcome on most days, 80% of the time is spent on the psychological personality issues. And a huge chunk of that 80% is the attachment problems, what I call the attachment problem. It is the fact that we are unable to let go of what has happened and to look at it for what it is. So the fact that you lost money yesterday because yesterday was a choppy day or whatever, and it wasn't your type of day, you have to look at that in its own box. And you have to take that box and kind of put it away and look at today as its own discrete new session. Just like you have to look at every trade today from trade to trade to trade as its own discrete outcome. And each discrete outcome has an equal chance of either winning or losing, 50-50. Even though you might have a 70% win rate, even though you might have a profit factor of 1.5 to 1 or something, it doesn't matter. The very next trade has an outcome that is absolutely unknowable. And I think I talked about this in our first session, but it's so hard for people to see that. I'll give you an example. Imagine if Messi, every time he would go to the goal and he would miss, he would take a shot at the goal and he would miss. Imagine if for the rest of the game, he is measuring his next shot at the goal based on the last shot. Okay, I went too far to the right. Now I'm going to shoot to the left. And I'm doing it with a heartache, and I'm doing it with anger and resentment, and I'm disappointed in myself. Just imagine if that happened every time he kicked the ball. He would be a terrible player. Just as there are many, many terrible players in many, many sports who are angry at the fact that they missed an easy shot, or they should have smashed the ball and they end up hitting it outside of the line in a tennis court, or whatever. What you have to do as a trader is the same thing that you have to do as an athlete, and that is to recognize that every contact you have with whatever it is, the market, the ball, every contact is discrete. Its outcome is absolutely judged within itself. And that is so hard for people to get. Now, don't mistake this with the fact that you need an overall edge. That if you string all of these discrete outcomes together, you get a sample of n sample of data, and the overall outcome of that entire sample has to be positive. It has to be profitable. In other words, you can't have a system that loses 70% of the time and makes one-to-one profit to risk, profit to stop, and expect somehow to make money. It's mathematically impossible. But if you know that, hey, my very next trade has absolutely no connection with my very last trade, then I can trade freely. I can just look at the market for what it is right now, and that's detachment. And so detachment should not be mistaken with carelessness. Like when I say, hey, Aaron, you need to be detached from the outcome of what's happening. It doesn't mean that, forget about risk. I don't care. I don't care what happens. That's not detachment. That's just carelessness. That's foolishness. Detachment just simply means I am not defined by this trade. I am not defined by a series of today's trades or this week's worth of trades or this month's worth of trades. That is not who I am. I'm not a good trader just because I had a good month. I'm not a bad trader because I had a poor month. I am just trading my plan. And my plan says that if I follow the process and follow my risk rules, the overall and the overarching outcome is going to be positive. And so if you start to decide, and that's what happens to people who get emotional or who fight the market, they are in a deep process of attachment. And let me tell you something. This is much easier said than done. It requires an awful lot of maturity and introspection, and most importantly, it requires a tremendous amount of self-awareness to understand that, I'm starting to get hot here. I'm starting to get irritated. It's time for me to take my hand off the mouse and go for a walk, go make lunch, go refill my cup of coffee or whatever. Let's break this cycle. And that's the old cue, routine, reward that's covered in The Power of Habit, one of my favorite books by Duhigg. You have to break that cycle, and the only way to break that cycle is to bring light to it in the form of awareness. So if you find that you took a great trade, you wanted to get long in the ES today before this rally up, you took a long and you just put your stop, and that stop happened to be the low of the day, and the market hit your stop, and then it turned around and it ran up 16 points like it did today, you can't attach all this, they're watching me, I am cursed, and nobody can do this, it's a lie that people can trade and make money, this is all rigged, this is all for the big guys. None of that is relevant. None of that is relevant. You have to understand that there is a statistical probability that your stop is going to be the high of day or low of day, and it just so happened that time that was your time, And if you look at it from a journaling perspective, you'll find that occurrence, the fact that you caught the entire range of the day or the fact that you got stopped at the high or the low of the day, the occurrence is a lot less significant than your mind thinks it is. And the mind thinks that it happens a lot more often, and you're the unlucky guy because you have this strong attachment to wanting every trade to be a winner. And that's what most people do. We did a trader intervention as it's a normal feature of being at stage 5. I did a trader intervention on a guy named Michael today on his live results. And, I really wanted to impress upon him the fact that how he remembers things, because the issue he's having really is he's not keeping good track of what's happening. He has this confirmation bias in his mind. He's remembering things not really as they are, and we all do this. We spend a lot of time avoiding the loss. I cannot, as a professional trader, spend all of my time figuring out how I can avoid a loss. For me, I look for a measured loss that is balanced with a profit target for every trade, and my job is to take every trade. If I can manage it a little bit better because I have an insight, maybe the market's not moving in the direction I'm looking for very easily, it's moving in the opposite direction very easily, or size is coming in and pushing the market in the opposite direction, I might use that as a cue to reduce my unit size. I might go from a 48 lot to a 12 lot or a 6 lot, but I still have to take the trade because I know that I cannot attach myself to the fact that my last trade was a loss and so on. Okay, does that make sense? It's really an important topic, and it's really hard to get beyond it. But it's a big part of those people who are struggling to make this happen. It's a big part of the issue is just understanding that what happens right now is really not connected to what happened last time, and cannot be connected to what happens in the future. Because the past is unchangeable, the future is fabricated. All I can do is focus on what's the trade right now. And saying it is easy, I know, but it's your job, is to sit there and really focus your attention on the idea that I have to follow each trade as if it's the first trade of the day. Follow each trade as if it's the first trade of the day, all day, every day.
Wow. What a brilliant answer. That was really, really good. I'm pleased I asked that. And thank you for going into so much detail with that answer. I think that's going to help a lot of people listening to this podcast right now.
I hope so.
One of the other things I wanted to ask you while we're on this subject is, do you have any tips and pointers for how to properly manage periods of drawdown or periods of losing trades where you're sort of on a run of losers and you just really feel like nothing can go right? I know you kind of hit on it there with not getting attached to the outcome, but how should a trader properly manage a drawdown? And maybe if you could touch on the risk management aspect of that as well.
Okay, that's a really big part of staying in the game. So I could tell you in my career, I've gone through rough patches every single year that I've been a trader. If anybody has ever told you that they come in and they make huge money every day of the year, every year, then you'll want to check that trader's credentials. The fact is, most of the money is made in a short period of time, a short segment of the year. The rest of the year is simply staying afoot with the market so that when that opportunity comes to push, for example, the China correction in August, that big drop, you had to have been in the market and consistently in the market and following the same routine all the time to be able to participate in that in any meaningful way. And part of the process of having, a few short weeks of really, really good trades, good returns, a lot of weeks of just grinding along, kind of making a living just like everybody else. But then there's also that rough patch. We call it the rough patch. And I've had rough patches that have lasted anywhere from 2 weeks to 10 weeks. And they come and go with time. And most of the time, they simply force me to go back to stage 3 of competence, what we would call conscious competence. In other words, consciously, deliberately, focusedly following some sort of a plan, or our original plan, or a modified plan to suit the current market conditions. And so the way to manage rough patches is to have an understanding of when one has occurred. And the way you know one has occurred is to look at the streaks that you have. And this is, again, the conversation is always going to go back to really good record keeping. I mean, you're running a business. Just imagine you're running a bakery or an auto dealership or something. It would be crazy to think that you're selling something or you're running a business without some really accurate bookkeeping. Trading is a business, and bookkeeping is a huge part of this business. And so you can always go back and understand that, okay, I recognize a losing streak as, for me, a losing streak is 4 consecutive down days in a row. And I'm speaking about consecutive down days where I'm actually doing what I'm supposed to do as opposed to going off the handle and starting to fight the market or something. Those don't count as consecutive down days. It just counts as me being emotional and stupid, which means I need time off. And that's what I forced myself to do, is just to detach, just move away. But if I have 4 down days and I'm following my plan, then it tells me that something has dramatically changed. And so my response to that is and I'll go into how I'm managing risk through this process. My response to that is to simply take the following day off. The probability of being down 4 days in a row is 0.5, which is a 50% probability of losing, to the power of 4. So there's a 6.25% chance that I would have 4 losing days in a row. So it's like flipping heads 4 times in a row. So it's 0.5 to the power of 4, or 6.25%. I know that for me to hit that kind of probability, that's almost 2 sigma, or the second standard deviation. I'll back off the statistics a little bit. But for me to hit that, it's pretty hard for me to hit 3 down days in a row. And that's down days meaning I'm down in my P&L plus my cost, plus my daily fixed costs, rent, software, all that stuff broken down on a daily basis. The 5th day, I'm off. I'm not trading the 5th day. The 5th day is me watching the market, doing the homework and everything, watching the market, and I'm spending the day just going through trades from the past, just running through what has happened, pulling up higher time frame charts, and really trying to see, the goal is to see, has something changed dramatically enough in the market to tell me that something's wrong. In fact, last week, was one of these weeks where the market was dramatically unusual. We had several days where the market gapped up in a row, gapped up and never closed the gap, and it just continued in the same direction. That's unusual behavior. I didn't have a drawdown during that streak, but it tells me that something, hey, be careful, something has changed. How do I manage the losses or the risk intraday? I use a regressive risk strategy. And so let's say, just for relevance sake, let's say that I generally trade 10 lots in the ES, okay? And if I start out the day and I'm trading 10 lots and I take a trade and I take a loss, and my daily loss limit, let's say, is $2,000 or $3,000, let's call it $3,000 per day, okay? Which means that my average up day needs to be around $3,000 per day for me to stay in business in the long term. If I reach a third of the way down, then I am cutting my size to 6 contracts. If I get halfway to $3,000 down, then I'm only trading 5. If I get 3/4 of the way down, then I'm trading 2. And I continue to trade 2 contracts until I hit that limit. And it's very rare that I hit that loss limit, the daily loss limit. But I want to hit my daily loss limit with the minimum size possible. Now, that's not possible if you're trading 1 contract, in the futures, or a small share size in equities. But my goal is not to make back the $1,500 that I've lost this morning, or the $2,500 or whatever. That's not my goal. My focus is not the P&L. It really isn't. It took me a long time to actually be able to accomplish that. But my goal is to find my alignment with the market. I'm going to repeat that. My goal is not to make the money back. My goal is to find my alignment with the market. In other words, get in the zone and get in gear with the market. To find that wave, to be able to recognize that wave that's coming, and to be able to paddle my surfboard on top of it, and to finally stand and ride that wave back to shore. That's my goal. And I'm not going to be able to do that by insisting on trading 10 lots and 10 lots and 10 lots and taking losses, and then boom, 5 losses, 5 trades on a 10 lot, and I'm out $3,000 and I have to stop for the day. That's not going to help me. What I want to do is hit that $3,000 loss limit with my smallest size possible. Because if I can't accomplish that with 2 contracts, to where I can find my alignment and start building my account back up with a series of really good positive trades, then I'm not giving myself enough sample size or enough samples of trades to be able to find that alignment. So imagine the opposite. Imagine if you traded 10 lots and you have a $3,000 limit for the day before you have to stop for the day. Imagine if I go halfway through and I lose $1,500, and then all of a sudden I put on a 20 lot trade, and that 20 lot trade wipes away the rest of the $1,500. Okay, so out of the $3,000 I was able to participate in the market twice with 2 trades. 2 trades is not nearly enough to show me that something's wrong or my plan doesn't have an edge. My goal is to maximize it. If I'm gonna give away $3,000, I need to do it with as large number of trades as possible, because what happens is eventually I start to find what the market is looking to do. I start to find alignment. And as if I get down from 0 to $1,500 to $2,500 to $2,800, and all of a sudden I find myself from $2,800 down on 2 contracts, I start to come up to $2,000. Okay, I'm back to 4 contracts. I get to down $1,500, I'm up to 6 contracts or 5 contracts. Now I have alignment, and now I can start building that position back up. I have the confidence to push those trades or to take the trades that are paying off. I've found the edge again, and I'm building back up. And to me, every other way I've tried for myself and my traders has not worked. I've had traders use a constant, doesn't matter how far you're down, just keep trading the same size. Boop, 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 boop. And most of the time they just limit out for the day, and the account's locked and they're done for the day. What I do is I regress. I look for a regression in the amount I'm trading, and my goal is to create as many opportunities to read the market, to trade the market and read the market as possible. And I know that most people don't do that. But that, if I hit 3 days in a row on limit using that method, something is dramatically going wrong. It really is. And if you're trading 1 or 2 lots, just start out with your 2 lots, halfway to your limit. Let's say your limit's $600. You've lost $300 on your 2 lots. Switch to 1 lots and get really picky about your trades. Just find the trades that you are most confident in, that you have the highest probabilities on, and stake your 1 lot on that. And it should give you about 4 trades before you lose the entire amount. What you don't want to do is take your 2 lot trade, lose $600 on 1 trade for the day, and that is it. That is a very binary way to lose money. And my intent always in trading is to get the most, to make the market work as hard as possible to take my money away, if it will take my money away, and it often does. But I want to do it on as many trades as possible. I want to do it fighting not the market, but I want to do it fighting the probabilities, fighting the negative probability, finding that positive probability, the alignment with the market. I hope that makes sense.
Yeah, absolutely. One of the things I did want to ask you before we wrap this up here, and I actually wanted to ask you about it last time, but we sort of ran out of time then. Also, just a couple questions around brokerage. You're obviously the right man to ask. So, when starting out, opening a brokerage account can be somewhat of a daunting task. What are a few things that people should take into consideration before deciding on a broker?
Okay, so even though I'm affiliated with a brokerage, the brokerage is a way for me to fulfill a vision. And eventually I want to get back to prop using the brokerage, being able to vet people out through the brokerage. That's my goal. So my comments are not going to be from the perspective, take it or leave it, not from the perspective of, hey, come to stage 5 trading. We are the best of the best. That's not the goal. What I want to say is you want to be with a brokerage that, one, gives you the largest, as big a number of solutions to whatever trading method or software that you want to use as possible. Stage 5 trading is an independent introducing broker. In other words, we have relationships with multiple clearing firms providing many, many, many different types and combinations of software, and our brokers are trained to be able to find what it is you're trying to do and to match you up with the lowest cost solution that actually fulfills your need. Keeping costs down, especially at the beginning, is quite important. So we want you to connect with a piece of software that gives you the data that you need without having to pay additionally for data, or to give you the software that you need, the charts that you need, without having to pay additionally for charts. And sometimes you have to pay for additional charts because of the features that you're looking for. So having a broker with a vast number of outlets for solutions is important. The big thing about brokerage, and I wish they would change this at the exchange level, is the fact that people are out there advertising $400 or $300 per contract margins. That is just 8% or 7% of the required exchange margin in futures. Okay, so for the S&P, the required exchange margin is around $5,000, and that the $5,000 is really 1 to 20 leverage compared to the value of the S&P 500. So you're already getting a lot of leverage with the exchange margin, and then you have these brokers out there that are giving you 10 times that. So 200 to 1 leverage. And what that leverage is doing, and people see that advertised everywhere, and so they think it's important that somehow they have to have $500 margins. We don't want to do that. We have access to that in certain circumstances, and I manage risk for Stage 5 as well as monitor traders. There have to be some really exceptional circumstances, some experience, a lot of experience, or good streaks or something that would merit someone getting that much leverage. But we want to de-lever people. We want you to trade at 50% of required margins. We want you to slow down. That's the thing that most brokers don't do, and I think eventually they will. We want you to slow down. We don't want you to trade a 10 lot on a $5,000 account. You're going to kill yourself within a week or two. And it's a waste of your time, it's a waste of your money, it's a waste of our time, and it's a lost opportunity for everybody, including the trader. We want to avoid that. We think that's a disaster. It's kind of like handing a child a loaded gun. The outcome is not likely to be good. So a broker who's concerned about you and understands traders and trading should be helping you manage your risk. And that's what we do best, I believe, on a best effort basis. We want to give you the tools to help manage your risk. We want to de-lever you. We want you to start slow. $500 margins benefit the broker. Every broker wants you to come in and trade 10 lots and trade and churn, because they get paid. A broker only gets paid when you trade live. So they want to give you as much buying power as possible. I'm not interested in making money off of traders right now. I'm interested in a longer-term relationship, which includes the process of being in this community. It's very important for me to have quality traders as part of our chat community, our weekly webinar community, and helping us build a sustainable long-term business. And a lot of traders who start out trying to trade, but their job gets in the way. It gives us an opportunity to put them in our, S&P automated trading system, a professionally created trading system, or to invest their money in managed programs, managed funds that are fully regulated, fully transparent, things like that. I want to mention that, investing in futures is not suitable for everybody, but at the same time, we want to make sure we slow someone down. So if you have a broker who is very anxious to quote you a commission, to give you your login and password, and that broker is gone, and they're not doing anything for you, they're not informing you, they're not helping you trade better, they're not intervening, this is a typical structure that I see in our industry, and this is what we're changing. We want it to be a more personal thing. I name anyone in the chat room out of 200 some odd people that are in there on a daily basis, out of more than 2,000 accounts, I'm able to tell you something about that person. I'm able to tell you what their general performance issues are. Are they chatty? Are they not focused? Are they focused? This is what we want. We want more and more of a community-based structure. And if your broker can offer that, great. If they can't, Stage 5 is ready and willing. Not to sound like a commercial, but that's an important thing for me. And that's, by the way, is what is available to professionals. When I went and started my prop shop at Advantage Futures when they first started in 2004, that's what I got. I got the senior VP making sure he knew who I was, knew the names of every one of my traders, made sure that I got the best pricing I could, and made sure we're comfortable while we rented office space within their office, had the best connections possible, had the best servers possible. You really build loyalty, and now all you need to focus on is the market rather than, Could I get a commission somewhere else? Could I get better margin somewhere else? Maybe I can squeeze my broker for 5 cents or 10 cents. It's irrelevant. If you're hemorrhaging thousands of dollars every day because you don't know how to manage your risk, what difference is 5 cents or 10 cents going to make in your commission structure? It makes no sense. But that's what everybody's focus is on, because that's what everybody in the industry is advertising. Better commissions, lower commissions, and lower margins. But in the grand scheme of things, if you want to be a professional, those are not. Those seem like a priority, but they're not.
Mm-hmm. So one of the things I'd just like you to clarify and sort of make us clear on is you describe Stage 5 as an independent introducing broker. How does that differ from a typical retail broker? You know, someone like E-Trade, or just to name a name. Okay,
so let's take E-Trade, TD Ameritrade, or Thinkorswim. They are, for one, offering you a large number of services. So think of, I know this doesn't exist anymore, and I'm dating myself a little bit. Think of going to America Online or Prodigy or CompuServe to get an internet connection. What you're plugging into is a service that is built around giving you as much, providing you with as much as possible internally, and then giving you market access. Whereas if you go with an independent broker, you're generally getting direct market access. Someone like TradeStation, for example, has options, has futures, has Forex, or they don't have Forex anymore actually, and has equities. And they're not exceptional at any one of those, but they're giving you all of those outlets. I would not go to Thinkorswim or E-Trade or Scottrade or Ameritrade as a professional. I would go direct. I would be seeking, if I'm trading futures, I would want to go with a futures broker, a direct broker. If I'm trading equities, I would want to go with a direct equities broker, and so on and so forth. That's really the difference. The connection you get from an IIB or an independent broker is not focused on what service can I get you to be aligned with so that I can sell you on the service that I have. So I am forcing you to fit what I'm offering, okay? And in general, much of what happens after the account's opened is automated. You call because you're stuck in a position, you get a computer that walks you through the process and so on. With us, it is we tailor the service to you. We're going in the opposite direction. So if Aaron wants to come in and someone who has used CQG Trader and wants to power his, multi-charts using CQG, I'm not going to sit here and say, no, you'll have to use our Thinkorswim platform. And that's it. I am going to get you the CQG Trader, the same environment, the same charts, and I'm going to make it work for you at the best possible cost. That's what your broker should be doing, as opposed to forcing you to align yourself with what I have to offer. Because it's hard enough to trade. It's hard enough to align yourself with the market. Now you have to learn a new platform, and you have to learn a new process and figure out how to get your charts to look the way they did. That's not what we do. We just reach out to as many vendors as possible, as many clearing firms as possible, and try to provide the solution. If we don't, our brokers are required to basically say, we can't do it, we're sorry, but here's the number of someone who can. Even if we don't make money on it, you're off on your way to getting what you need. You need to have access to equities, plus Forex, plus futures. Well, we're a futures-only broker. Here's where you should probably go, and that's really the difference, as opposed to a giant kind of organization that has already set its course, kind of like a big ship, and it's hard for it to turn with the technology and what's being offered. It's hard for it to integrate that until much, much later. We are very malleable because we're small. We have access to all these pieces, and we don't own or maintain any of the software. It's someone else's software. We just make it available to you. That's all.
Very good. Very good. Okay. All right. Well, let's wind this down. So, FT, where is the best place to go if a listener wants to find out more about you?
So you can find me online at futurestrader71.com. Hit the contact link and drop me a note. If I can help you, I'd be happy to do it. And otherwise, you can find me on Twitter. Just go to twitter.com/futurestrader71 or at futurestrader71. And, I'm participating in there all day long, every day while the market's open. And as always, if I can guide you in the right direction, great. If I can't, then I'll let you know.
Awesome. No, I appreciate that. I noticed you just had the website redone recently. It's looking good.
Yeah, thanks. It's a slow process to redo those websites, but this one's a lot more friendly, I hope.
Yeah, no doubt. All right, man. Well, it's been awesome to have you back on again. Really incredible insights. So thank you very much for taking the time to share with us.
Always a pleasure, and I really appreciate your broadcast. I think it's probably helped more people than you think you have.
I appreciate it. Thank you very much.
Take care. Bye.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey, how you doing? Welcome to another episode of Chat with Traders. Thank you so much for tuning in, and let's do this. So, the trader I interviewed for this episode is Ryan Moffat from Black Pear Capital in Knoxville, Tennessee. Having been involved with markets for about 12 years, Ryan has experience in trading, strategy design, portfolio construction, and even alternative investments, all while working for several firms, one of which managed upwards of $2 billion. More recently, though, Ryan's ventured out to start a fund of his own, where he wears the badge of lead investment manager. Some of the subjects we check off during this episode include the snapping point that led Ryan to pursue trading and cold call 50 fund managers for guidance, how he was able to form various mentoring relationships, the first steps of starting a fund and the unseen challenges that came along with it. Plus, we discuss options, strategies, and research, but my favorite part is probably Ryan's insight on deliberate practice and recognizing mental discomfort as a positive. So stick around, folks, and I really hope you enjoy this episode. I'm Aaron Fifield, and here is my guest, Ryan Moffat. All right, Ryan, well, awesome to have you on the podcast, man. Thank you very much for doing this.
Yeah, it's great to be here. Exciting.
Cool. So the first question I want to ask you is about how you got started in markets. Like, what was your introduction? What happened? Tell us a bit about where this all started for you. I think it was roughly about 10 years ago.
Yeah, it was. It was about 10. Well, actually, it's probably about 11 years ago now, and maybe 11, 12 years ago. And before then, I was actually in land development. So worked in land development and sales, and it was a great job. I knew it wasn't something that was my be-all, end-all. And for me, I was really looking for something, what was I passionate about, and kind of looking around and trying to figure out really what my next step was. And one thing I did is I really looked at really to see what I read. People think, when you're in a bookstore, what do you gravitate to? What type of movies do you like? And I was getting really kind of frustrated with where I was. And it was kind of interesting because what happened within my land development is I left the company I was with, and I started another company with my partner, who was also working at the company I was with. And we started our own company. It was kind of in the same kind of real estate type deal, but really my mindset at that time was I want to make a lot of money so then I can do what I want to do, which is kind of an interesting mindset. And what I'll find out later is that's kind of a backwards way to think. But so as you can probably imagine, anytime you start a company with that mindset, with, we had some ideas, but nothing really crystallized, we totally failed miserably on our face. And so, I made good money when I was in land development and pretty much gave it all back and lost it all. So we were in the red. And at that point, I had my wife, and then we had a 6-month-old, my son, Jack. So at that point, I was very, very frustrated. And I was looking again, I got to the point in my life where I was kind of thinking, all right, instead of really going out and trying to just make a ton of money so then I could do what I want to do, why don't I just figure out really what I want to do and then do that? Because at least if I didn't make a lot of money, at least I'd be doing what I want to do. And so that's when I really went on this process. And it took a while. It took a few weeks. And, kind of a funny story. I got to the point where, and Aaron, I don't know if you've ever been there. I'm sure some people have been there, where you get so frustrated and you've failed so much. It's kind of a funny story, crystallized and burned in my memory. I was at a car wash. And I don't know if you guys have these in Australia, but we have these car washes where you basically pull your car in and you can vacuum it out and everything. Well, I had a Tahoe, a Chevy Tahoe, and I was vacuuming it out. And I was so frustrated. All this failure hit me at one point. And I started beating the hell out of my Tahoe with this rubber hose because I was so frustrated. And everything just hit me. And it's hilarious because the lady next to me looked at me like I was crazy, because at that point I really was. It's just so frustrated with everything. But that was a turning point for me, kind of a low point, but also a turning point where that's when I really figured out I need to find something that I love, that I'm passionate about. And so I did start going on this journey. And, I call it park bench days, where you go and you sit and you're like, what do I need to do with my life? And that's when I got some help with my wife. I asked her, what do you see me doing? And she's like, well, you read old finance books for fun. You read about hedge fund managers constantly, and you love watching the markets. You've always loved doing this. So why don't you, she's kind of said, why don't you try something in that regard? Why don't you just do that? And to me, I'm from Knoxville, Tennessee. There aren't hedge fund managers running around in Knoxville, Tennessee. So in my mind, it was just something that was way far off that I couldn't do. Something that I really loved, but I probably wouldn't be able to do in my life. Well, at that point, I stopped making that excuse for myself. And then, again, another thing burned in my memory is I saw an old PBS documentary of Paul Tudor Jones. It's Trader, which most traders have probably seen it. It's the best of all, because you're seeing a guy that is completely passionate about what he does, about the markets, but also about philanthropy. But it's right in his prime. And you're seeing this guy, and what's so great about this documentary, it shows him, at the heights, but also it shows him get crushed by these trades and how he handles it. And it shows you one of the best traders in the world ever. It shows you how he handles this, and it shows you just like I would handle it, or anyone else do, where, it hurts to lose. And so I saw this, and as soon as I saw it, I'm like, that's what I want to do. I want to be in the markets like that. I want to run a private fund. I don't care what it takes. And that is really kind of what started me on the journey 11 years ago, 12 years ago now. And then from that point on, I knew what I wanted to do. And from that point, it's taken me a long time to get there. I've gone several different steps to get there, through different firms. I ended up getting my MBA in finance and portfolio management and went and did all that. But really, the biggest thing that I did that helped me was, at that point, again, being in Knoxville, Tennessee, I didn't have a whole lot of access to, fund managers. So I actually cold called 50 fund managers, 50 hedge fund managers around the country. And 3 of them called me back, and 2 of them actually still mentor me to this day. So that's kind of a long answer to a short question, but that was kind of my start into the markets and really when I figured out exactly what I want to do.
Yeah, that's a really great answer, Ryan, and an interesting story as well. So a couple of things I want to ask you about that is, actually one thing I've got to add before I forget is that anyone listening who hasn't seen that documentary of Paul Tudor Jones, which is called Trader, you've definitely got to check that out. I'm pretty sure it's on YouTube. I'll find a link and I'll stick it in the show notes at chatwithtraders.com. So if you haven't seen it, do watch that. And I like how you said that it also shows him, at his highs and at his lows as well. I mean, it's some moments are quite raw. So yeah, really good documentary.
Yeah, it's incredible.
So while you were at the land development place, were you doing any sort of trading or investing just sort of on your own?
Yeah, I mean, I was, and I always, even, through college, actually in undergrad, I played baseball at the University of Tennessee. Even in high school, I always followed the markets. It was always something that I loved to read about, to do. And so while I was really in the land development game, I would have, because the one thing I always have done is journal. And so now whether it's a trading journal or just journaling, for the day, I can go back because I've got 4 or 5 journals filled, so I can look back 15, 20 years ago and still see, well, I wrote down some stocks that I need to look at, or wrote down some sectors I need to look at, or different trading strategies that I need to look at. So it's pretty neat to go back and see that, and that's one reason I've always done it. But yes, I mean, throughout that, I would always kind of on the back burner, nothing, obviously nowhere near what I'm doing now, but it was always kind of on the back burner of something that I always loved to do. So absolutely, I kind of participated it, I guess, you could say as a hobby then, because obviously I was getting paid to be more in the land development, but it was definitely something that was part of my life.
Okay, sure. So tell us a little bit about, once you said that you cold called about 50 different fund managers. What were some of those conversations like? What were you actually talking to them about once you got on the phone with these guys?
Well, the 3 that call me or email me or contact me back was pretty interesting, and it was very interesting. But the difference between the 3, and I actually talked to a few more, but 3 of them were just incredibly giving in what they were doing, and I guess with the cold calling and me being extremely persistent. They kind of saw that I wasn't going to go away, so they needed to kind of talk to me, or I was going to continue to call and kind of bug them. So, once we're really kind of talking to them, just really picking the brain, because at that point, I really didn't know, looking back at it now, I didn't know anything then, really. So I really didn't know even the right questions to ask. So really, I was just really kind of picking the brain on how to even get started. Where do I need to go? I mean, what does their strategies consist of? And that's really kind of where the conversations led once I started getting a feel for what they were doing. I mean, these were guys out of the CBOE, Chicago Boards Option Exchange, guys out of New York. And so they were, on some respects, they were really options traders, but then trend following traders that use futures as well. So those were the 2 strategies that I really keyed in on. And another reason I really keyed in on, because really I was talking with them along the same lines, or along the same time that I was in the MBA program, getting my MBA. And so it was very interesting, the contrast between talking to the fund managers and then talking to my professors, and the huge contrast between how they managed risk how they looked at strategy. And so that was extremely interesting and a huge learning curve, very sharp learning curve for me. So that's really kind of how it kind of snowballed. Is at first I really didn't know the questions to ask. I mean, I was probably asking pretty stupid questions, but they were extremely giving with their time. And again, I think a big part of it was just me being persistent. But again, it's knowing what I wanted to do with my life at that point. So doing whatever it took to do that.
Okay, so tell us about what happened sort of following those initial calls. Like, I think you touched on a little bit earlier, you went and you worked with a few firms for a few years that followed. Tell us a little bit about that. What happened there?
So really with the companies, I interned with one of the fund managers, and that was an incredible learning experience because not only did I get to learn a lot about the strategy, but I learned about the business too. So the internship, which was about 3 or 4 months before I really graduated with my MBA. And then once I got my MBA, I actually went and worked for an institutional, really advisory firm. So it was a little bit off of what I wanted to do, but I knew that I had to learn the business. And it was an incredible firm. It was about a 13-person firm. They managed about $2 billion. And it was incredible because it was not so much strategy to learn from that, but the operations part of learning, the business behind learning a firm or running a firm. And I learned how to clear 2,000 trades in a day, learn really the back office stuff of how Wall Street works, working with guys out of Goldman Sachs or JP Morgan or Fidelity or State Street, and learn the more institutional game. And this was pretty interesting because I learned institutionally how portfolios and traditional portfolios were set up. And while that was happening, I was also still continuing working with my mentors more on strategy. And so what I would see is the difference between how my mentors went about strategy, meaning they generally traded their own money. And if they traded their own money, they had to have robust strategies that did well in all kinds of different environments versus the institutional, traditional portfolio where generally you're going to be your stocks and bonds. And they're really set up as a long-only portfolio, right? It's only going to do well when the equities markets or bond markets go up. And so really kind of putting those two together and flash forward 7, 8, 9 years, and that's really how our key strategy at Black Bear Capital, that's where it came from, is putting those two together and filling the gaps in the traditional portfolio with really the robust strategies that my mentors were using, and that's utilizing options. So that's what I kind of worked with them for years, side by side while working at this institutional firm and testing a bunch of strategies out. And Aaron, you know as well as I do, and most traders out there, is you kind of got to do it by yourself and learn by losing a lot of money. And God knows I've lost a ton of money. But those are the learning experiences that let you kind of move forward in the trading game. So that was kind of how it worked in tandem, kind of moving forward. I was at the institutional firm for about 4 years, and then kind of moved on from there as my trading and kind of knowledge of trading kind of grew.
Okay. So while you were at the institutional firm, was it anything like you'd originally expected? And did your perception of the industry change in any way over those 4 years?
Absolutely. That's a great question because that was one of the biggest things that was a change in me. I think one of the biggest things that changed was me thinking that there was this special sauce somewhere that I wasn't getting where I was, or I needed to go work at a certain place to learn something. And that's very well maybe with strategy, but what I really learned is I knew more than I thought I did. And that another thing I learned is the industry is not a well-oiled machine by any means. It is amazing. A lot of times you kind of feel like it's put together with duct tape and coat hangers almost. Like it's kind of an interesting industry that it's again not just a well-oiled machine. So I think my perspective on that, and then really working at the institutional firm and working with my mentors, one of the perspective changes is I started to figure out that I could do this professionally. Looking around and looking at a firm that's running $2 billion, it gave me confidence to know I can do this, and it takes time. But, knowing, I was mentored by the founder of this institutional firm, which he was absolutely incredible and continues to be incredible, but helps me working with relationships, with raising money, and then just figuring out the game and figuring out the business, and then putting that together with my mentor's strategy and just kind of working those two. So I would say over those 4 years, it's just maturing a little bit and getting confidence enough to knowing that I could do this professionally. So I think that's the biggest change in me that happened over those 4 years.
Okay. So I'm really keen to ask you about how the fund actually got up and going. But before we get into that too far, I really want to ask you about the mentoring aspect, because you've mentioned it a few times throughout our chat right now. You've mentioned mentors as though there's a few of these guys. So you've said that you worked with one of them. The other guys, what's their incentive to actually help you and support you? And I ask this because, a lot of traders wish that they had someone in their life who played a mentor-like figure. So I'm just trying to sort of understand why these mentors were willing to help you and how that sort of relationship came to be a mentoring type of relationship.
Yeah, that's a good question, because really before I got in this, I saw and read a lot of biographies, listened to a lot of people talking, and they always talked about mentors. And really until this time, I had some in different parts of my life, but not really professionally. And then I think a couple things, and I've had a lot of mentors and they've played different roles in my life. And some of my first ones that really I cold called, and I think a big part of it was them seeing that someone was really willing to do the work to acquire knowledge. And also I did projects for them. I mean, I would build different Excel projects to help them out. So they were getting something from me, but I was willing to do anything I could in order to get knowledge. And so at that point, obviously, with me going through the MBA program, we would work all the time on huge Excel projects, and it's absolutely incredible what you can build out of there. And so I would build them models, Excel models, to help them out, and kind of tit for tat, they would work with me on strategy. And then once you kind of develop the relationship, then it's not so much of what are you giving me or what am I giving you? It's just kind of working together at that point. Other mentors I've paid. I've had some mentors that they charged so much, but what's kind of interesting is once the relationship did get started as well, that kind of went to the wayside as well, and now you're just kind of working together or doing projects together, or really doing anything to help each other out. And I think a lot of it is, and we see it now too with us working with other people as well, when you find someone that's willing to do the work, and you find someone that is extremely persistent and focused on what they're doing, you want to help them out. Everyone's been there. And so I know I do, and my mentors did the same thing. So it's a little bit of both. But a lot of times you do have to break the ice and get in there. And whether that's some mentors, are paid, some of them, maybe you can do a project for. That's really how I broke the ice with some of my mentors. So, with somebody looking for somebody, just ask. I mean, that's the big thing. And for me, I was like a lot of times afraid just to ask. But, once I really found out was really what I want to do with my life, I wasn't afraid to ask anymore. I knew I had to do something to get in front of these guys. So, a little bit of both and be creative. That's what I had to do. And it worked out extremely well.
No doubt. And just to add on to that a little bit more, was your relationship with these guys, like you're referring to them as mentors in our conversation here, did you ever call them a mentor? Like, was there ever a point where you said, will you be my mentor? Or was it really just a relationship that kind of developed?
Yeah, it was really just a relationship that developed. And it was almost like after, a few months or a year goes by, it's like, you just kind of look back and say, wow, he really took me from here to there. But on some respect too, it's a relationship to where, they're getting a lot from it just as much as you're getting. And so, now that you asked the question, I never really thought about it, but no, it never was like, you are mentoring me at this point. It was never that, defined. So it was more just a relationship. And two, again, it wasn't like we had something scheduled every day either. It was like if I needed a help with something, or they needed a project, so it was kind of an ongoing thing with some of them. Some of them was a little bit more scheduled. Obviously, the ones I worked for and worked with. But, with the ones that I really cold called and worked with over years, there might be months that go by, and then, I send an email or something just to catch up with them and say, hey, we're working on this project. I just wanted to get your feedback on that. And so I guess it never was really defined as mentor-mentee, but it was more just a relationship kind of moving forward.
Yeah, no, that's really interesting to hear that. And it might have been a bit of a strange question, but I just asked it because I think there's a bit of a misconception that to get a mentor, you've actually got to ask someone explicitly, will you be my mentor? And I actually recently wrote a short guide about this. So guys listening, if you want to check that out, it's called The Comprehensive Guide to Trading Mentorship. And you can download it for free at chatwithtraders.com/mentor. Yeah, so moving on, let's talk about how you actually started the fund. So at what point did you feel confident to start the fund, and what were some of the first steps you took?
Yeah, that's pretty interesting because that really happened. So fast forward. So obviously, I guess cold called these managers was about 11 years ago. So fast forward 9 years to where now we're about 2013, 2014, and that's how long it took me to really get to the point where I felt comfortable asking for other people's money. And it took that long because I needed to lose a lot of money. I needed to lose in every way possible so I'd figure out, actually how to move forward with it and do well. So that was a big part of it. And then really, I guess what pushed me forward was getting to the point where I see people around me, kind of like I was saying, working with the institutional firm and working with those guys and how they started. And a lot of it is just starting. And really the amount that I started with outside money was $30,000, and that's it. And that was the most nerve-wracking $30,000 I've ever taken, because to me at that point it could have been $30 million or $300 million because it was somebody else's money. And now I'm dealing with somebody else's emotions, somebody else's expectations. And for me, I'm very, very hard on myself, probably more harder than other people are going to be on me. So that was very difficult. And so that was kind of the first step into, I guess, the professional realm, if you can call it that, with $30,000. But I did have another person's money. So I guess that first step was where, and it's kind of interesting because when I took that first step, it kind of led me into a whole different ballgame of now I had to figure out, okay, well, if it's somebody else's money, now you have to figure out the business behind that, right? You have to get the documents behind that. You have to get everything surrounding it. And so what a lot of people, what's very interesting is when you're dealing with other people's money, almost the easiest part about it is the trading, the strategy. That's the easiest part. The hard part is dealing with other people. The hard part is the business part. Now, I love both the parts of it. They're both extremely interesting to me, but I had to learn that other part. And I was around at the institutional firm and working with my mentors, but doing it yourself is a totally different ballgame. So that was kind of the start of it, and then kind of scaling it up from there. So, turning thousands of dollars into millions of dollars and doing it that way, but also being comfortable scaling up. And that really happened about a year and a half ago when we did, me and I had Tyler, who is my full-time trader in research here. We did a lot of work on ourselves, self-development, but also on our strategy, because we understood that if we're going to scale this up to where we can do the most good for the most people, we had to be extremely comfortable in scaling this thing up. And you got to think about everything from execution to dealing with all the limited partners. So you got to deal with the entire gambit. And so from the $30,000 mark up onto the millions mark, there was about a 6 month span where we did a lot of work, 6 to 9 month span on ourselves on the strategy that once we really got comfortable, it's like a switch flipped, and money started coming in more regularly. We started being a lot more clear on what we do, what value add we have for people, and a lot of that came with clarity within ourselves. So again, long answer to a short question, but I don't know if that really answered the question you're asking. But that's kind of how we kind of led into a little bit more where we are right now.
Yeah, absolutely. No, that definitely answered it. So I'm interested to know, where did you get that first $30,000 from? Was that someone you knew, or was it almost a complete stranger?
No, it was family. It was my sister.
Okay.
So,
okay.
Yeah.
Nice.
Yeah. So yeah, I mean, it's friends, family, and fools, right? I mean, that's how you get your start. But yeah, it really started with family, and then from that point on, unfortunately, I don't have a whole lot of extremely rich friends, so I had to get outside of that very, very quickly. But what that forced us to do very, very quickly was we had to figure out what our edge was versus everyone else and why we were different. And that really forced us to do a lot of extremely hard work on ourselves and on our strategy. And that was the best thing that could have happened to us, is have those constraints on us. I mean, creative constraints, pretty much, to where we only had, we didn't have all the means and resources. We had to be very, very clear and focused on what we were going to do and how we were going to add value to people. And so us doing that, and once we got clear, again, it's when people started coming to the fund, and we started growing this thing. So.
Okay. And did you have any sort of track record that you'd built up yourself before actually opening the doors to your fund? Or was it something you sort of built on the fly?
Yeah, I mean, we had a personal track record, just proprietary funds. I did that. So I did have a track record moving forward, but really, with our people coming in, it wasn't so much of results, it's them buying into the process of what we're doing. Because, Aaron and every trader out there, the results are going to come and go depending on what your strategy. No strategy does well all the time. And so knowing your process well enough to know when it's going to do well and when it's not going to do well, or if you've got multiple strategies, when they're going to pair together, and having complete clarity in that. And that's really, our clients and limited partners, they're great because they buy into the process. And that way, when you have your drawdowns or when times are a little bit tougher, they understand why. I mean, we kind of liken it to, when you're flying in an airplane and you feel turbulence, you're not just going to jump out of the airplane in midair, right? You're just not going to do it. And it's interesting how pilots, they can feel all kinds of turbulence. They don't really care too much because they're very, very familiar with the airplane. They're very familiar with how to fly the airplane. They probably know every nuts, all the bolts, all the screws, everything, every part of that airplane. Well, that's what we try to do with our clients and limited partners, is they should know the strategy just as well as us, so they'll know when it's going to do well and when it's not going to do well. And so that's what we really try to do, is have that clarity for them. And I think that's when partners really started to gravitate, is when we really were clear on the process. We did have a track record, and then obviously we've got a ton of back-tested results. But it's just knowing when it's going to do well, when it's not going to do as well, and being comfortable with that. And with our strategy, it serves a certain purpose in a portfolio for our clients. So we want to be very clear on what that purpose is and what the strategy was created for. And that's really what they're buying into.
Okay. I like the way you put that. That's really good. One thing I'd like to ask is, what's been some of the challenges of starting a firm that you maybe didn't anticipate going into this? It's kind of like the question of, what questions did I ask my mentors? And it was almost like I didn't even know the right questions to ask.
in starting a firm, you don't really know. You don't know what you don't know, and so the expectations, you always want to expect the best. But I guess one of the biggest ones is especially over the last year and a half is learning about the private fund industry and the hedge fund industry, and seeing actually how it works and how it operates. And when you're running a fund that's less than $100 million, you don't get a whole lot of looks from people. It's amazing, the industry where the big funds get bigger and everyone else just kind of languishes a little bit. But also what's very interesting is how you see within the fund industry where a lot of the funds generally are really just stock long only funds. They're formed as a limited partnership, but in essence, they're really just kind of a long only fund. And you see that a lot. And that really kind of surprised me. Before I got into this, I always thought hedge funds, you're going to have an esoteric strategy that you're not able to get, anywhere else. But that's really not the case. We utilize options and we do well in actually volatile environments, and we do well when equities don't do well. So we are a little bit more esoteric, and that's why we have it in a private partnership. But it's really interesting. The industry is a lot of stock pickers, it's a lot of fundamentals. And I guess that's another thing as well that was a little bit surprising to me, that how quantitative or mechanical strategies aren't looked down upon, but they're not as favorable to institutions. They're not as favorable to some family offices. They're still looking for more the fundamentals type stock picking, which that was kind of a surprise to me, because I thought it would be just the opposite, because we are a mechanical strategy, so we're more data driven. So I guess that was a couple things that were a little bit surprising to me, just running a private fund. With a firm, the biggest thing surprise is how much other stuff you do besides trading. It's very interesting. My week consists of, when we have a busy week trading, it lasts us about 30 minutes during the week. Now, obviously, we don't have an intraday strategy or anything, but we just, all our work is done on the research, the back testing. So our trading is very, very, very boring. Extremely boring, and that's the way we feel it should be, because if it's exciting, then we're doing something wrong. But all the other work you have to do outside of that, and that's creating a almost a brand to let your partners know, this is what we stand for, this is what we want. We want our culture and build our culture within our firm of deliberate practice, of focused energy. And so that's something that I guess it's building within any business. But when you start a firm, I always thought, I'm going to be trading all the time, but actually all my time spent on really building the business, which I love, which is a good thing. But it's just one thing that you'd expect a little bit different. When I got into it, I was like, well, I'll be trading all the time. And that's not the case at all.
And you made an interesting point earlier too, and it was actually something I was going to ask you about, is as a fund, is it easier to raise capital if you have a quantitative approach over something that is a little more discretionary? I always thought that was perhaps the case, but you're saying it's often quite the opposite. So that's
we've kind of had. I guess it really depends. I mean, some people like quant strategies, but we've kind of seen it both ways, but really some of the big institutions really are still looking for your more fundamental bottom-up type investing, which is fine. It's all good. But with us being quantitative, we've had a little bit different, I guess, results from it with some of the larger institutions, and that's fine with us. I mean, again, we're going to be a little bit more esoteric, and within the option space, that's another thing that was pretty interesting to me is, even within the industry, the options still, people don't know a whole lot about options and how they really work. They know a few strategies, like a covered call or maybe doing covered calls or buying a call or a put. But when you get into complex option strategies, which is what we do, it's we're talking with CIOs and of large institutions and having them take them through just like I would have to take my wife through or somebody that had nothing to do with the finance industry. So there's a lot of education there. And I guess that's a big thing is we're really having to educate people on how you can utilize options to be very creative and to reduce your risk in your portfolio, which a lot of people, when they hear options, they think risky, just like when they hear futures, they think risky, when in actuality, if you have someone that knows what they're doing, it reduces risk by quite a bit. So again, that's a big thing. It's just education within the finance industry, which I thought it would be just the opposite. I thought the finance industry would know all about it. But with what we've seen, it's a lot of education, which is fine. We love educating people and talking shop, so that's not a problem with us.
Sure.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved. Now, so has the way traders operate within them. Trade the Pool.
So tell us a little bit about the actual strategy or strategies that you trade. Like, how do you actually approach the market?
Yeah, so we utilize complex option structures, and that's just kind of a fancy way of we put a bunch of options together to create a risk-reward structure that we want. And so kind of the basis in our bread and butter is what we call the Atlas strategy. And the Atlas strategy, kind of like I mentioned, is what I did is utilize the foundation of what my mentors would utilize with options. And they would have to have strategies that did well in all kinds of different environments, whether the market was going down or sideways, or if it's choppy or volatile. They needed something to do well because the way they made their money was off their gains. So if they had any gains for the month, and they didn't take home any money. So they didn't have management fees or anything like that. So they had to be very creative, and they utilized options to do this. So what I saw from my institutional experience was the traditional portfolio, generally they're not very diversified. I mean, people think they're diversified with stocks and bonds, but in actuality, they're not at all. And obviously anybody can read anything Ray Dalio has printed and knowing how much risk just a stock portfolio has. So what I saw was we can really fill a large gap with creating what we call the Atlas strategy now. And what we utilize is options, and generally we utilize it in what's called a butterfly structure. So if you're not familiar with complex options, a butterfly is basically we just do an all put. So you buy one put, you sell two, and you buy another one. And just graphically, it's got a wing, a body, and another wing. That's why it's called a butterfly, which doesn't really matter. All it is we have a strategy, and in higher volatility, it does extremely well. So in an 08 type environment, 07 type environment, 2011, last year when the volatility was extremely high, it eats it alive. It really likes volatility. And the whole reason it does this is because we're a net seller of options. And if you know anything about insurance, when somebody's old and sick, their insurance premiums are higher versus someone that's young and healthy. Well, a volatile market's kind of like a sick market. So there's a lot of premiums in options. And so it's a lot easier for us to trade in that environment versus like a 2013 type environment where there's very low volatility. It's a lot harder. It's more of a pain in the neck for us to trade in that. So what we've done is we created a mechanical strategy utilizing these options that we utilize in just a traditional portfolio. So our partners, limited partners, we take a very small portion of their portfolio, no more than 10%, and we outperform with what we have. So we're not looking for 5 or 6 or 7% returns a year. We're looking for 20 to 30% returns a year. And because we have a small portion of that portfolio and it can outperform, and it outperforms when the rest of their portfolio is underperforming, it does an extremely good job of hedging the portfolio, but also gives them something that's growing at a quicker rate than most of their other things in the portfolio. Because generally, with stocks, you're going to look at about 7-8% annualized return over about a 10-year period. So we want to have something that's going to be a 20, 25, 30% annualized return over the same time type period. So that's what we created with the structure, and that's really kind of the purpose it serves within the portfolio. A lot of our people, they have maybe IRAs that they've rolled over from a 401k, or it's a small piece of their portfolio, and they aren't doing a whole lot with it. That's where we can really add value to people, is utilizing their small amounts in their portfolio. And also with institutions, we just give them a nice hedge to their long equity exposure. So that's really kind of where we fit within the game with our partners.
Right. Okay. So you kind of outlined what you've labeled as your Atlas strategy there. Do you have any other strategies which maybe aren't like flagship strategies that you're also trading?
Yeah, we constantly are researching, trading, building new systems and strategies, and because even for our own book, so for Blackbeard Capital's account, we want to have stuff that hedges the Atlas strategy, right? So if it's going to do well in volatility, or the market's going choppy sideways, we need something when the market's going up, right, or low volatility. So we've built other strategies that do well utilizing options. That's really our expertise. And we'll build using weeklies, which if you're not familiar with options, every option has an expiration period, and some of them have short expiration periods, like just a week, which are called weeklies. Some have long-term, where you may be 50 or 60 days to expiration. So we'll utilize kind of the entire gamut and really try to diversify our own book, utilizing different expiration periods with different strategies that do well in different types of environments. So when we kind of look at the environment scale, we kind of break it up in 5 different environments. So really, when we're in a position, the environment can be 5 different types. You can have a crash, market crash, or when it goes down hard. You can have a gradual downturn. You can have the market go sideways. You can have a gradual up market, or you can have basically a sharp up market, or when the market screams up. And really, those are about the only 5 things that can happen once we're in a strategy. So we build our strategies around our different systems in order to do well in those different type of environments, and just really put them all together. And because not all of them are going to do well in every environment, but when you put them together in a portfolio, it does extremely well in diversifying your entire book, which is kind of what we look for.
Okay. So let's talk a little bit about the mechanical aspect of your trading strategies. Like, what's your preference for mechanical over strategies that require more discretion?
Well, kind of what we found is, because I've traded discretionarily, I've traded mechanically, and really what I've found is really great discretionary traders are mechanical in nature, meaning they have a strategy and they have guidelines or a trade plan, and they follow it. And that's really, when we say mechanical, that's all we're talking about. It's something that if you can't really give it to someone else to trade for you, or if you can't program into computer, then your trade plan's not clear enough. And whether it's discretionary, you call it discretionary or mechanical, it's basically just knowing what's going to happen, or what's going to make your decision or create an adjustment, and what's not. And that's the whole purpose of this, is so you're not making decisions on the fly. And the whole reason you don't want to do that, which every trader probably knows, is the whole emotional aspect of trading. And what happens when you're losing money or you're making money, and what your body does and what your brain does, once you start getting aware of that, you know that you're not making your best decisions at that point. And so when we decided to really go mechanical, all we're saying is we want to have every decision made prior to having to make the decision. So prior to having to make an adjustment or take a profit. And we want it to be data-driven, meaning we want to have proof over something that's statistically relevant. And most of the time, that's 50 different observations that this works. And so when we talk about being mechanical, all we know is we want the data to to be behind it, data driven, to prove that something works. And also, we don't want to be in a situation where we're having to think on the fly, because your lizard brain takes over when you're doing that, and you make terrible decisions. They're emotional decisions, and then you end up trading your emotions, not your strategy. And actually, one of my mentors kind of told me that at one point. When you get into that point, you're trading your emotions, not your strategy. And it took me about 5 years to figure out what he meant. But it's an extremely powerful statement. And when you start getting aware of what happens when you trade, that's when you start figuring out and putting in firewalls in place, which is another thing we do, is really put firewalls in place to minimize and prevent mistakes during trading. So I guess that kind of answers your question a little bit about mechanical versus discretionary. But one thing I will say is good discretionary traders, they basically they do the same thing, right? They have their trade plan, and the good ones follow it. And that's really all. So trading is very simple. Create a trade plan that has an edge, that has positive expectancy, and then follow it. The first part's easy. The second part's not as easy, following it. And that's where you get into the whole awareness and emotional part and trading the emotions. So that's a whole nother discussion.
Absolutely. So while on the subject of mechanical strategies, compared to a mechanical equity strategy, right? What additional complexities or considerations are there for backtesting and developing an options strategy?
I guess the big thing with backtesting any type of option strategy is I guess with future strategies, equity strategy, you can take 30 years, put in a computer, and it'll spit out, if you put in certain parameters, what it would give you. With an option strategy, you actually have to go by hand by hand, day by day, to really get good, clean data. And you have the data, but really to see how the strategy would operate. And we have software that will do this. But what I thought was a constraint, what I thought was a kind of a pain, actually turned into a blessing, because what it did was it created and forced us to see the results day by day, year after year, for 20 years. And so you get real comfortable with seeing how the strategy is going to work. And so with, I guess, an option strategy, I guess with backtesting, there's not that much difference, because you really have the same goal and trying to get the data. But just the way you have to go about it with options, with more of a complex option strategy, is a lot more time intensive from what I've seen. Now, I may be wrong on that. I mean, obviously we haven't backtested every single strategy equity wise or options wise, but the way we do it is extremely time intensive. And we have Excel spread. We keep all our data in Excel spreadsheets, and keep every single piece of data as part of the backtest, so that we know, because what we've found in backtesting is we'll go in with one theory, or we may go in with, say, okay, let's test this. And then once the data kind of shows, we'll gather the data, and it tells us something totally opposite. It tells us that what we thought was going to work, the total opposite. It's very counterintuitive, which has really led to the Atlas strategy. We actually went into testing something that we were trying to hedge another strategy with, and the data came out to where this is what kind of told us was an extremely impressive strategy. And then we dug more just in the data. So we didn't want to be biased with it. We just want to dig into what the data was telling us. And that's what's kind of interesting with our backtesting, is being so intensive and going through it day by day, hour after hour, for years and years and years. You get such a good feel for your strategy and for your product that you really don't need models anymore. You just have such a good feel for it. So again, long answer, but I think the biggest thing is just the time intensity that you have to put into the way we backtest.
Mm-hmm. Okay. And so I'm just interested to know, where did you actually develop your skills using Excel? Was that something you picked up during your MBA, or just something you've picked up along the way?
It came really just from need with work, and then we were very intense with it during the MBA program. That was one of the biggest things we picked up from that. And then from that point is building trading models, is just curiosity, just saying, okay, I need this data and I need it to be in some sort of model. So you'll dig in and being curious and using Excel. That's what's such great about Excel, is it's very malleable. And so it was just really curiosity and kind of forcing myself to learn certain things because I needed it. I needed it for my trading model. So that's what I did. So it's a little bit of both, a little bit about, education from university, but also a lot of it was just doing it on my own. I mean, I would go get macro books on macros and just go through the books and just take little tidbits of that, plug it in my sheets, see what would happen, kind of go from there. Just like anything, just like trading, you just see what works and go with it.
Yeah, okay. So is there any reason why you've decided to run with Excel over using sort of other standalone or open source programming languages to do, I guess, heavier sort of tasks?
I guess it's just because I've known it and built on it. I don't think Excel would be any better or worse, maybe. I guess it's just learning a new language or getting into something else. We've actually started talking with a programmer to really program a lot of our execution. And he was going to be doing that with obviously different languages other than Excel, although we could build it in Excel. But for me, it's just I'm very familiar with Excel, so I just kind of continue building on top of that. Now, Excel might be the worst tool in the toolbox. I just haven't learned how to use any of the other tools.
Yeah, makes sense. So I don't know if you know of anything, but are there any resources you might be able to recommend to anyone listening to this podcast who might be interested in using Excel to backtest and do different sorts of analysis on their trading?
Yeah, and I will say this. So we utilize Excel to gather we do have a third-party backtesting program. I probably did not mention that. So we use OptionView for that. So to get our data and go through trades and actually to get the market data, knowing what the market prices would be for the last 10, 20, 30 years, we utilize OptionView for that. For Excel, what we utilize that is to take all our findings and then utilize our basically Excel models in order to kind of get what the actual results would have been. And so it's a little bit of both. So we really gather the data utilizing OptionView. We capture it with Excel. So we utilize them both in tandem.
Okay, cool. Got it. All right, well, let's just change gears completely for the last part of this interview. So before we hopped on a call, I was having a quick flick through the blog on your website, and there was a few things that caught my attention. One was an article on deliberate practice. Could you explain the idea of deliberate practice and how it's different from practice just in a general sense?
Yeah, deliberate practice is interesting. If anyone wants to read about deliberate practice, where I really got the concepts from was it's actually Anders Ericsson that I believe came up with kind of the term deliberate practice, and then it's really talked about in the Talent Code and Talent is Overrated, those two books, and they'll do a lot better job of explaining it over me. But really what you're talking about, and the best kind of the way I put it example wise, is the difference between how a Tiger Woods in his prime would practice at golf. Let's say we're at a driving range and he's practicing his game versus the way I would practice. And so I've been playing golf probably the same amount of time as Tiger Woods has, yet I'm nowhere close to the way he is. And why is that? Well, it's the way we've gone about practicing. And so when he goes about on the driving range, he's really got a goal for every single ball he hits. He knows exactly what he's working on. He's got a goal for the practice going in. He's got a goal for pretty much every ball he hits and every swing he takes. Versus when I go to the driving range, I may be drinking a beer, I may be just hitting balls, trying to hit a certain sign out there. It's just totally, totally different. I don't have goals, really specific goals going into what I'm working on in the driving range. And that's really the exact kind of example we try to use with everything we do in the firm is when we're going into something, especially trading is a fantastic example for this, is have a specific purpose for what you're trying to do with anything. Really, if you're going into a task, what are you trying to get out of it? Why are you doing it? And that will really focus you in really figuring out, well, first of all, do I need to be doing this task? Is it the right, am I doing it the right way? And you'll start being a lot more focused. And when you are focused on that task, you get better. You get 50 times better than if you just went about it, which the way most people go about anything, kind of like I go about golf. So kind of willy-nilly, you don't really think too much about it. You just go into the task in order to get through it. So I guess that's kind of I don't know if it's a good example of what deliberate practice is, but it's really just having a goal for whatever you're doing at the time. And if you kind of keep that in mind for everything you're doing, you start really focusing on how you spend your time, which is a huge deal. And in trading, just like any sport, I come from an athletics background. Trading, music, sports, they all have very, very easy. It's very easy to attribute deliberate practice to it. So when we're back testing, we want to be very focused on exactly what we're trying to get out of. What is our goal for the back test? What is our theories going in? What type of strategy are we trying to get out? Why are we trying to get out of it? What type of data are we trying to get? So all this stuff that goes into back testing, and when you pull out of it, you get an extreme amount of information, and you get so much better as a trader, or anything you're doing. So it's extremely important, I think, for anybody to be very, very good at what they do.
Yeah, that's a brilliant answer, Ryan. I really like the analogy with Tiger Woods. I think that was well suited. The other thing that caught my attention while I was on your blog was an article about recognizing mental frustration and discomfort as a positive thing. I'd love it if you could talk about this a little bit, like how so?
Yeah, this is pretty interesting. It's really hard because it's the human condition. We grow. The only time we grow is when we're really working hard on something, and that frustration. That's where you want to be. And when we kind of wrote that article, and I looked back at my life, and you always do it. I mean, any trader can say it. I mean, every trader knows their biggest losses. That you can crystallize them in their head. It's amazing. And why is that? Because you feel the frustration, and you want to figure out why you had those losses. And think about anything in your life. Everyone, when they go through their hardest times, that's when they grow the most. And so really, when I wrote that article, it kind of had an epiphany of saying, well, what if I looked at my life and really designed it every single day to have some period during the day to where I was growing. Now, when I'm growing, just like if you're working out, if you're doing a good workout, you're going to push yourself, and it's going to be extremely uncomfortable, but that's where the growth comes. Mentally, when you're learning a language and the words on the tip of your tongue, that's where the growth is, because that's the brain stretching. That's the brain creating new pathways, new neural pathways for that new language. And what we found is a lot of people structure their day to avoid frustration, to avoid pain, to avoid hard situations. And that's exactly how they're going to grow. And so we want to flip-flop that. And, as a firm, Black Bear Capital is try to create situations for us is to be frustrated. Now, when I think back to, creating the Atlas strategy, we had so many days where we would work on this thing, and you talk about deliberate practice, cranking on these back tests and getting data and getting so frustrated because the ideas we had, we thought something was going to work, and it totally didn't. The data said something totally opposite, and so we're back to square one. And you get so frustrated with that, especially the 10th or 11th or the 13th time it's happened. But looking back on it now, that's what created the robust strategy. If we hadn't had that happen, we wouldn't have the conviction in the strategy we have in now. We couldn't go to a client and said, we've done the work on this, and we know the million ways it doesn't work because we went through them. But it's the frustration that got us there. That was the growth. And one other thing about deliberate practice, you're doing deliberate practice right when you can only do it for 2 or 3 hours, because after that, you're so focused, your body gets tired, your mind gets tired, and when you read the books about deliberate practice, you read about, the world-class violinist, they can only practice for a couple hours because they're so focused in doing it that it's all your brain and your body can handle. And so that's kind of what we utilize that as. So we kind of were asking ourselves, so what if we get frustrated every day? That means we're growing every day. And I don't care if it's physically, working out, we work out quite a bit, or if it's mentally, or if it's working on our trading, but just grow every single day. But knowing that, when you're in that frustration, when you have a loss and you're frustrated, just the sheer fact of knowing that that's the growth, it makes it a little bit easier to get through it as well. So, I think that's a very important concept for people to utilize, because most people seek out comfort, and that's not how you get better. Is through comfort. You get better through pain and discomfort. And that's hard for most people, but it creates a huge opportunity for people that will kind of put themselves through that and will just kind of realize that, this is the way I'm going to be able to get to my goals. And if I want hockey stick-like growth where it shoots, then I need to be extremely uncomfortable. And the Navy SEALs are just, they're unbelievable at that. They are the premier example for being uncomfortable and how you can push your body, mind, spirit, everything through discomfort, an incredible amount of growth. So I think that's an important article. We kind of had an epiphany and we're like, I think this would be helpful to people. So I think it's pretty helpful.
Yeah, absolutely. That was another awesome answer, Ryan. And what I'll do is I'll put links to both of those articles in the show notes at chatwithtraders.com if you guys want to check that out. So, man, this has been awesome. Where is the best place that listeners can find out more about you, Ryan?
Yeah, well, they can definitely go to our website. Obviously, if you have links to the articles, that would take them to the blog on our website. They can sign up and subscribe to our blog. We send out updates every week, and on the weekly updates, we actually talk about everything from trading to personal development. One thing that I really talk about a lot is trading is 90% figuring out and being aware of who you are, and the other 10% is the strategy. Because if you're fully aware of who you are, what your strengths are, why you're trading, then the actual trading part is a lot more simple. A lot of times we look to work with people. We're actually looking for a few people to actually coach a little bit, to maybe confer with, mentor a little bit. So if anyone's interested in that, we would be willing to kind of take a look at that. This is going to be very, very specific. We're not looking for a bunch of people, and it's going to be quite intensive. So blackbeardcapital.com and sign up subscriber, and that way they can also hit me up on my email if they need to get me directly, and that's just rmoffett@blackbeardcapital.com. And if it's RMOFFETT at blackbeardcapital.com. So those two places, and we'll be kind of all over the place. So if they have any questions or anything, we love to talk shop, whether it's futures, options, equities. We love trading, so it's my passion. So whatever they have, we'd love to talk to them.
Good stuff. And are you also on Twitter?
We are. I believe it is Blackpear LP. So at Blackpear LP is our Twitter handle. I believe that's it. So if you want to follow us, we'd love to. We again send out tweets on all kinds of stuff. So we'd love to hear from you.
Perfect. All right, Ryan. Well, thank you very much for doing this, man. It's been a blast, and let's stay in touch.
Absolutely. Sounds good. Thank you so much.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to 200
markets.
Before we survey, you could imagine sponsors want to have a pretty good idea on who their message is going out to. And of course, I just want to get to know you a little better as well. So if you can spare just a couple minutes, please go to chatwithtraders.com/survey and complete, I think it's about 15 questions. They're all multi-choice answers. It's very easy. And like I said, it'll take you no more than a couple minutes. So that's at chatwithtraders.com/survey. And just because I really do appreciate you taking the time to do this and ultimately show your support, I'm going to give you a free gift. I'm not going to tell you what it is right now, but if you go to chatwithtraders.com/survey, everything is there. So if you can support the podcast by completing the survey, please do that. I'd be hugely grateful. Okay, so let me tell you a little bit about this week's episode. It was actually recorded back in March. I'm not sure why it's taken me so long to release this one, but anyway, here it is, and it's with Dr. Eve Hilpish, the founder of the Python Quants. The Python Quants do a lot of good for those involved in quantitative finance. As such, they frequently host meetups and workshops, have developed platforms and analytics libraries, and often contract to exchanges, banks, and hedge funds for custom Python development. Eve is also a 3-time published author, with his most notable title probably being Python for Finance, which was released through O'Reilly. He regularly gives presentations and speaks at events on the subject of quant finance and lectures at universities too. Needless to say, he is a busy man, but I was thrilled to lock him down for the podcast. So over the next 60 minutes, you'll hear us unpack many subjects related to being a quant and why programming in Python can be a useful skill to have in your toolbox. Now, I will mention some of the discussion in the later part may be a little heavy for non-programmers. So if there is something that doesn't make sense or you'd like more context around, please just write in the comments at chatwithtraders.com/84, and I'll either do my best to answer this for you or point you in the right direction with a link, or I may even ask Eve if he can respond himself. Anyway, I hope you can take something away from this. I'm Aaron Fifield. Here is Eve Hilpish. Hey Eve, welcome to the Chat with Traders podcast. Thank you so much for being here. How's it going?
Good. Well, very well. Thank you for having me. It's a great pleasure.
No trouble whatsoever. Now, I know you're not exactly a trader, but you are heavily involved in quantitative finance, and you're also a huge advocate for the Python programming language. So, I mean, guys listening know that I've been, learning Python myself over the last kind of 6 to 8 months, give or take. So maybe the reason you're here is slightly selfish, but nevertheless, I think you'll be able to share some awesome insight for listeners, especially from a quant perspective as well. So I'd like to start by talking about how you originally got into finance. So take us back. Where did the interest come from?
Well, it's kind of interesting. When I was pretty young, I wanted to become a medical doctor, actually. But my girlfriend back then and wife right now, actually, she was interested in business administration. So I started to get interested as well, reading stuff she brought back home, so to say, about business and finance, things like that. This was actually the first time I was like 17 or something, when I actually heard for the first time about that topic, that you can study that and so forth. For me, my family was all about medical discipline, more or less. And later on, actually, when I started out, really it wasn't finance as we understand it as of today, but I started selling insurance policies back then, which had kind of an investment component. So I started following financial markets. I was really intrigued by asset management, by mutual funds and savings products and so forth. And this was actually the first point. So this led me to later on during my studies to focus on financial market theory, banking, and actually everything I did during my diploma with a major of business was about finance, financial markets, and so forth. So started out quite early, and it led me to focusing on this area actually.
Interesting. Okay, so just so we're clear, you graduated with a diploma in, what was it, finance?
Business administration, but I had a strong focus on economics, financial economics, as it was called. I later on moved on and did my PhD in mathematical finance. So I then specialized even more, obviously, started doing option pricing theory, dynamic hedging strategies, and stuff like that. So it was kind of a continuum of what I did. So
Right, okay. So when you did your PhD, what were your intentions of studying for that? Like, how did you plan on using this after you graduated?
Actually, I hadn't any concrete plans for or to use the stuff that I did during my studies. It was really that I really enjoyed doing this PhD work and fiercely wanted to do it. So there was no question of not doing it. I simply did it. And during this time, I did it kind of in external mode, which is something you can do in Germany, actually, where you do part-time at the university and then you can do other work or whatsoever. I started working during that time. It's roughly a total of 4 years. I started working as a management consultant for financial companies. So it wasn't really in this hardcore computational quantitative finance area, but still it was in the financial industry. And only later on I merged the two areas, if you like, my professional background of consulting, management consulting work, and quant finance, and obviously these days technology to what we do today. But this took quite a while. A couple of years.
Okay, sure. So tell us about that first job you had. Like, what was your role when you did finally, merge those two together and you were starting to put your quantitative knowledge to use?
It was actually for the first 3 years of my professional working life, if you like, where, as I said, in the management consulting area, and I did this for quite a while afterwards when we founded our own company, the first one in 2001 already. I got on my own with 2 partners, and we still did the same things, but I already started back then bringing more and more quantitative things into what we did. And now it's kind of, it was a gradual transition, but now I'm on the more or less completely quantitative side and more technology than ever. So it's kind of not kind of a straightforward career path, if you like. But this Python for finance thing started out then almost 10 years ago, roughly 10 years ago, where we started implementing our first solutions using Python. Back then, in the days where we even didn't have a NumPy, it was called numeric back then, and so forth. We started out quite early, where people said Python is not really well suited to do finance at all. Actually, that's when we started out doing it.
Right. Okay. Well, bring us up to speed, Eve, and tell us about what you're doing today. Like, what's your current involvement in the industry?
Well, I guess one of the most popular and famous things, I guess, what I produce is my Python for Finance book for O'Reilly. And I think these are the two things that make up what we do on a daily basis. So on one hand side, it's Python. On the other hand, it's finance. So actually, we work usually on a contractual basis for financial clients. This ranges from banks to asset managers to hedge funds to exchanges. Exchanges have been quite a bit of a focus recently and over the years. Almost any kind of financial company that we work on projects for them, obviously with Python being involved. So what we don't do is kind of do other projects just for the sake of the project and then doing focus on C++, for example, in this regard. So what we are good at, and there I guess we cover the whole value chain, if you like, from trainings to books to platform to our library to the services, which means the consulting and development. This is Python and Python for quantitative finance. And if you want to get a little bit more specific, what we focus on is what I usually call computational finance and financial data science. These might be the best two sub-disciplines to describe what we do in quantitative finance.
Cool. Okay. Well, could you give us perhaps just an example of some of the projects you might work on the consultancy side of things?
Yeah, obviously, more often than not, we sign some NDA contracts, obviously, non-disclosure agreements where we are not allowed to speak about the things we do. But there's at least one good thing that we can talk about. This is something we did for Eurex, our German derivatives exchange, which is a part of Deutsche Börse, actually. There we did a Python-based tutorial series where we did a couple of things for them. So we wrote a tutorial about the VSTOXX volatility index and how it is calculated, what you need to do when you want to implement this in Python, how to recalculate historical values and so forth. It's kind of a very involved thing, using lots of option pricing theories and not rather complicated, but still involved financial algorithms. And we wrote this tutorial like in a book style. And actually, right now, I transformed it to a book, so it will come out soon. And therefore, I can speak about all this because it's public and it will be published as a book. And not only this, what we also did, we wrote a backtesting application for them, where you can backtest strategies for the whole history of the VSTOXX index involving VSTOXX options, VSTOXX futures, and so forth. And in the tutorial, we explain the strategies that it can use. We explain how to value futures, how to value options. And again, this is kind of a public thing. Everybody interested in it can Google it up. It's called VSTOXX and Variance Advanced Services. So if you Google Eurex Advanced Services, you will find the right place to start and to go from there.
Okay, well, we'll dig up a link and we'll be sure to include that in the show notes at chatwithtraders.com. So I know you've been working with asymmetric return capital a little bit recently. Can you tell us any more about what you're doing with them?
Yeah, this is kind of an emerging asset manager, a hedge fund, which is focused on volatility trading strategies. So I was talking about the VSTOXX and various things we've done. So there's kind of a few synergies involved in what we do there. And even more synergies with regard to that we apply for them. And this is one of our first big users, at least as I'm aware of, because our DX Analytics library is open source. So we don't even know who is using it for what purposes. But here we work with our client in a very close fashion to apply our DX Analytics suite. We should include the link as well. So it's dx-analytics.com. It's open source, so you can download and test it. And we use it there for advanced derivatives analytics and risk management purposes. We have built kind of, in addition to what the open source library provides, kind of a complete system around that to really make use on a daily efficient basis that when the decision makers like Prime Risk, who's the founder I'm working with since more than 2 years right now, needs to make a decision, then he has kind of real-time capabilities to apply what we have built with DX Analytics. This is kind of an interesting company to mention in the context we're discussing here because more or less you can say that ARC is a Python-based hedge fund, if you like. So one of the co-founders there, actually, Adam, gave a talk at our conference last year in Manhattan where he spoke about how to build a hedge fund with Python. So this is actually a very good example for what we discuss here. Interesting.
Is that talk available online anywhere?
This is not available online, so we do it for Python Quant series. Maybe we cover this later on in cooperation with Fitch. So for those who have signed up for the online tickets, they have access to it, but it's not publicly available, unfortunately, depending on what perspective you have.
Got it. Okay, cool. So on an individual level, like for yourself, do you actually participate in markets in any way? Are you, actively trading? I know you're not actively trading, of course, but are you investing in any way, shape or form?
Yeah, I mean, what I do is kind of more or less for retirement purposes that I have my continuous savings plans and so forth. In this regard, investing in mutual funds and different asset classes. But what I'm not doing is kind of day trading work or whatsoever. I mean, I'm involved in so many things and traveling quite a bit. So sitting on an airplane for 8 hours would make me nervous if something would go wrong. And on the other hand, obviously, being involved with so many financial institutions which have obviously heavy trading shops. businesses makes it also a little bit difficult depending on the work that we do, how we get involved in things. And usually we are quite close, for example, with what I described earlier with ARC. And so there might be also conflicts of interest, but this is not the main reason. The main reason is that, I'm running a few businesses, not only the Python quants, a few other side businesses as well. I'm traveling quite a bit, so I decided for myself, don't get even more nervous and have even more workload being involved in the markets on a daily basis, actually.
Sure. That makes sense. Now, let's spend a little time actually talking about quantitative finance. So, first of all, what does the term quant refer to, and how does a quant vary from other types of market participants?
Yeah, I mean, the term quant is, as far as I see it, used in many different ways these days. So maybe in a more narrow sense, it describes the quantitative analyst to a certain extent, whereby I mean not an analyst starting out in the business, but an analyst analyzing anything with quantitative means, which means typically lots of numbers are involved, lots of data is involved, and you get down to the numerics and to the many digits that might be important in this regard. So a quant in a bank usually can also have different roles. So you might have a pricing quant, which is responsible for the pricing of derivatives instruments. You have a risk quant, which is more or less in the back office, for example, responsible for things going on overnight when it comes to value at risk or XVA calculation. So you have many types of quants. But in the end, what every type has in common is that they work with many, let's say, numbers, with data, with formulas, with math, and try to make sense of the markets in the end. And from my point of view, what I mentioned before, in a sense of that we do computational finance and financial data science, there might be a third major role where we are not involved that much. Is kind of the model quant. I guess this is the starting point where it all started out with the rocket scientists on Wall Street in maybe the 80s, where they hired physicists and mathematicians to come up with better models for instruments already traded, but where sometimes nobody knew for sure how this is to be valued. But I guess when it comes to the ratio, to the proportion of the model quants in relation to the whole quant universe, this is less than 1%, I would say. People focusing today of building and coming up with new models. The majority of people is more or less concerned with implementing what the models say and what you have to do in terms of compliance and trading and so forth. Then we come to computational finance. How do you simulate a stochastic differential equation? How do you price this with numerical methods? And the guys working on the financial data science, more or less making sure that all data is available, that data is consistent, that it is processed in an appropriate way. So this is more or less my world of thinking. Other people might have a different world of thinking, and they can cut it differently. But from my point of view, I usually think of the model quant, the computational finance guy, and the data people, the financial data science people that take care that everybody gets the data who needs it, and in time and with the right quality.
Okay, that's a great answer. And I like how you mentioned that there seem to be many different types of quants, because, I mean, it's kind of become obvious to me that, you know, there's the guys who are very deep into the math and they're coming up with the formulas. And then you have those who are more focused on just analyzing big data to develop, you know, algorithmic trading strategies. So, no, that was a brilliant answer, Eve. How would you say a quant looks for opportunity? Like, just generally speaking, how does a quant look for opportunity and areas where they can exploit the market?
Yeah, I mean, there are quite a few areas where quants are working on. So if you have a look at the history of kind of investment, I mean, it all started out more or less with kind of fundamental research combined with speculation. So we always had this kind of, groups of people where the one group was saying, well, we have to deeply analyze things that are going on, the fundamentals of the company, what are the prospects, how does the market look like, and so forth. More or less others that said, well, I'm in the markets, but I'm simply trading. So maybe the Great Recession in the 20s in the US and so forth is like kind of a picture of what this kind of situation might lead to. These days we have many more things, and this is where the quants come into play, because neither fundamental analysis nor the speculators are that quantity, if you like. It more or less started out with the Markowitz theory, the portfolio theory based on mean variance, where for the first time someone came up and said, well, let's have a quantity look at how things are going. To keep the word simple, and this was already a major breakthrough, we focus on certain statistics that characterize different stocks, actually, as the expected mean return, as the to be expected volatility. And let's take these two parameters. I mean, it's a little bit too simplifying, but still used these days heavily. But let's take these parameters and let's build kind of mathematically optimized portfolios based on our criteria. I guess this is more or less the starting point of quant finance when you have a look at the history. Only later on, we have the other area where we say, well, with the Black-Scholes theory and option pricing, where we then start to talk about derivatives, which means securities whose price, whose value is derived from something else, kind of a stock, an index, or whatsoever. I guess there maybe people started talking about quant, but more or less for me, portfolio theory, mean variance, the CAP-M, for example, are all examples of quant work as well. Coming to the option pricing theory of Black-Scholes, which later on awarded them the Nobel Prize for Economics. Actually, we're at a point where we say now we need to get back to history, because something like Black-Scholes theory was already invented by a guy called Bachelier, a French guy who wrote his PhD thesis about similar topics in 1900, but his PhD thesis in math, actually, back then, about speculation and how to price options with arithmetic Brownian motion was only 50 years plus later on discovered. So nobody was aware of what he already invented for multiple decades, actually. So maybe this was the first real quant, if you like, on our model quant definition as of today. So we have the people who try to optimize portfolios with regard to certain mathematical methods, quantity methods. We have the model quant guys. Later on then, the emergence of trading strategies where statistics is used, for example, statistical arbitrage. When it comes to derivatives, the theory at least goes that when you use a strong arbitrage argument, there is kind of a existing provable mathematical relationship between A and B. So you have option pricing theory, and this gives you the relationship. There should be no doubt in theory, but in practice, obviously, there is a lot of doubt and a lot of market, so to say, playing into that game. But the statistical arbitrage, you are aware of that you might want to exploit kind of a historical relationship with regard to correlation or whatsoever, where I say, well, statistically, if you traded this and that way, like gold versus gold miners, for example, is a classical trade, then we should make money because now we have kind of something which is statistically beyond the normal, beyond one standard deviation or whatsoever. We might speculate of bringing this back to the historical means or to the historical values that we observed. And this goes on until today, where we have, there are many disciplines and sub-disciplines in between that, where we have today the high-frequency traders, which are not exploiting kind of financial relationships more or less, but they are trying to exploit the market microstructure, playing the system more or less and not going about financial economical principles, if you like. So what I always say, the whole financial theory, when we talk about quant stuff, is more or less based on daily historical closing values of indices, stocks, and so forth. But what these people are doing right now is still lacking kind of a financial background, financial theory, which can compare to the daily closing price-based theories that we have available. So many types of strategies that you can use to exploit the market, actually.
Right, so just narrowing in on the topic of research here, one thing I'd like to ask you about is, do you utilize machine learning in any way during your research phase when you're looking for opportunities within markets?
So I must, so to say, in this regard, confess that we are, due to what we do, derivatives analytics, option pricing, and so forth, we are, what I mentioned before, on the side where we at least think that we are in a position where we can more or less derive prices from what we observe in the market in a not deterministic fashion, but in a rather robust fashion, and can prove this mathematically, so to say. So in my daily work, at least a few machine learning approaches are deployed, but this is nothing which represents kind of a focus as of these days. I know many people are kind of eager to use it, and I even get approached by people I don't know from around the globe actually, who are interested in this topic about applying machine learning to finance and what this implies and so forth. And I mean, these days, if you hear about AlphaGo beating one of the greatest masters of the Go game and so forth, artificial intelligence, deep learning, machine learning, I mean, all these disciplines people are so fascinated about, and everybody is thinking of, well, we must have something in there in this big toolbox which we can apply to financial markets. And I'm pretty sure there is something, but frankly, I have, at least for my daily work, I haven't seen anything where I say, well, this is kind of a real area where we get major benefits of applying this or the other technique to what we do. And if we speak about we, I'm not speaking for the whole industry, I'm speaking for our focus areas, actually.
Okay, that's an interesting answer. It's interesting. So, still on the same topic here, is everything you do, is it based purely on price, or do you use other things in combination such as fundamental and social data? Do they come into the picture at all?
I mean, generally speaking, obviously what you're mentioning here, price, fundamental, social data, are all sources that are used in the industry to base investment decisions on and so forth. But again, I would say what we do is at least 90% based on price or market data, which is readily observable, and where there is typically no doubt about it. So if you think about fundamentals and price earnings ratios, which are forecasted and which then influence, there's kind of still lots of uncertainty around that. Social data as well, about the quality and so forth, all the people that try to make sense of Twitter data and so forth. But again, I've seen so many talks about this over the last 2, 3, 4 years. But still, I'm not aware of anybody who is using this kind of as a major tool and makes consistently above average returns. So generates significant alpha, if you like, as we call it in the industry, out of that. There might be some people who don't speak about it. There are also companies, startups that focus completely on that. But I'm not aware, at least from what I've seen in terms of talks and read papers about that, where it is. But as a supporting thing, I mean, this might be really valuable in terms of like risk management. I've seen a talk recently where they said, well, we don't want to exploit the markets based on social data, but for example, we want to generate kind of risk-relevant information. And this was a bank speaking about that in the sense that they said, well, we are lending to so many companies, but we want to exploit the social media to get kind of early indicators with regard to the risk for default for loans in our portfolio. And this makes sense. There I can see kind of a strong connection when many people are tweeting and traders are tweeting and speaking about, oh, well, this company and there's something, I don't know, we don't know, there's a risk on the horizon. But this might be valuable information for a bank to say, well, we must speak to these people because there might be something at risk. But this is on a longer term scale. And it's not like in financial markets that there's kind of an idea and it's exploited by 20 players, bigger players in the market, and then the opportunity has vanished. Risk of a loan, I mean, this is more like a thing over months, quarters, or even years where this information might be relevant. But I want to add one thing, and there I see kind of a huge opportunity, and I'm working closely with Thomson Reuters. Actually, what they are now bringing out, it's now in the beta testing phase, is kind of, first of all, they implemented a unified API to their whole data universe, which means historical data, tick data, as well as streaming data. So, and their data universe is huge. And around this unified API, actually, you have a Python wrapper available these days. And that's the reason why I'm coming to this point. And with this Python wrapper to the unified API, you not only get prices for an index or whatsoever, you get more or less all the fundamentals that you need for a company. And you get access to news data, to social data as well. So having this kind of unified tool to process such data on a large scale. I mean, just think of a trader sitting in front of his Bloomberg and Thomson Reuters terminal and trying to figure out this manually. This is surely impossible. This doesn't work. But having this unified API and Python as a language, it's not the only language, but one of the languages they support is Python, obviously. But having Python available, for example, and being able to now easily combine all the information, this might bring up something where people say, well, now we got it. Now we cracked the code, and now we got the breakthrough with regard to combining all the different sources and different types of data that is available.
Okay, so is that API available to everyone, or is it a premium service? Like, how do you get access to that?
Actually not available, obviously, to everyone, but if you are a subscriber to the Thomson Reuters Icon terminal, then this is actually included. But you need to have the data service, the terminal license itself, and then you get access to the API and to the Python wrapper anyways. So, but the API, I guess, is the big thing.
Got it. Okay, that's very cool. That's awesome.
Yeah, for research, it's kind of this will be a quantum leap, actually, from my point of view.
Yeah, no doubt.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
So tell us a little bit about the Python quants. You mentioned it a little bit earlier, but let's spend a little time on it and share with us, where did the idea come from and how this gets started?
Actually, I mentioned that I founded my first company in 2001, and for personal reasons, I left this company. So we are still friendly, the founders back then, myself. And when I started my own company, I mean, this was the point more or less when we started using Python. So roughly 10 years ago, I started out with a company which is now called Python Quants. Back then, it wasn't called Python Quants, but we named it 2 or 3 years ago to the Python Quants. We used this name for quite a while, but back then we made it official because this was actually, or describes the work that we do. We use Python to do quant work, what we're discussing in this podcast, actually. So this is where it all started out. And I guess what we do right now, and I mentioned it before briefly, is that we try to cover the whole value chain in this niche market, if you like, that people, no matter what kind of company they're working for, want to apply Python for their quant work. We try to provide everything that they need, which starts obviously with the books, 3 books, my Python for Finance book, with O'Reilly, there is the derivatives analytics with Python book, with Wiley Finance, and the next one coming out, listed volatility and variance derivatives, also with Wiley. Everything obviously Python based. You find all the codes, and we are not providing the codes in the book. We provide GitHub repositories providing the books. We provide on our quant platform where you can easily register. We provide executable Jupyter notebooks and all the code. So the book example already illustrates what we all offer. So the books, the codes, the quant platform, also training around that, if you like. We organize events around that. So we have our next big event is in May. It's the first week of May, from the 2nd to the 6th. We have 5 days for Python Quants conference in New York, Manhattan, where we have 4 days of intensive training, starting with the introductory part. Then we have a technical part which focuses on advanced libraries and performance Python, input, output, and so forth. We then have a full day of Python and Excel, so how to best combine Python with Excel, which is still kind of obviously a very popular tool in the financial industry. We then have also an algorithmic financial trading day, where we cover the basics from backtesting, in and out sample, and so forth, implementing algorithmic trading strategies, and doing even live trading on the platform. So people coming in the morning, they will do their automated algo trading in the evening. So I guess it's a very intense one day, but people can get back home and start their own trading strategies afterwards. And then obviously we have the conference day, the 6th of May this year, where we have usually 10 talks with high-level speakers out of the industry using Python for quant finance and associated things, like sometimes also people speaking about R and Julia which I consider also as very nice open source technology in the space. Stuff we also use, especially R, as a complement for Python. In addition to that, just to make it complete, we also organize meetups. My biggest meetup group is the Python for Quant Finance meetup group in London, where we have roughly 1,300 people. As of today, we started out a little bit more than 2 years ago, and you see London alone is kind of, although we are really niche, Python for Quant Finance is a double niche, if you like. We are very active, usually having meetups with up to 100 people, 8 meetups a year, many other things that we do, and so forth. So many things around everything with regard to technology, services that we provide, training, development, consulting, the books that we have, and also the community aspects, the conferences, the public trainings, and also the meetup groups that we run. I'm also running something in New York as well. So it's kind of, in the financial centers of the world, doing Python for Quant Finance. And this year, we will also conquer Asia as well, starting in June when I will be in Singapore. So we try our best to spread the word and to help people.
Yeah, that's awesome. And that 5-day event sounds really great. I wish I could make it along. Too bad I'm on the other side of the world. But
we're getting back to London as well. Usually we have the London one in November. So later in the year, we are in London, and in May usually we are in Manhattan.
Right. Okay. Cool. So, who are the type of people who generally attend these types of, your meetups and your events and that sort of thing? Are they people who are like professionals within the industry, or do you get like quite a few independent traders and, like who attends these types of events?
I mean, it's a great mix. Speaking of 1,300 people in one group, you obviously have a mix of starting with students interested in a topic or PhD students, postdocs, to industry players, startup people from the fintech space, people working for the biggest banks at all, like Bank of America, JP Morgan, people from hedge funds, traders who trade on their own. So I think we cover quite the whole cross-section of people that you find that are either already using Python for Quant Finance or want to use it. So we have many people, and I'm always asking, was it the first time here, and do you use Python? So the typical questions during the meetup, and we have at least 20 to 30% per meetup where people are coming for the first time and haven't used Python really. Some people say, well, I have done a little bit, but now I want to apply it really for my finance work. So people who really want to get into that and want to make better use of this fantastic ecosystem that we have for Python.
Okay, well, let's spend a little time on Python as a language. So it's clear that Python is your weapon of choice. Why did you choose Python over other programming languages?
I mean, it's a little bit, usually I start out by saying, well, there's so many languages in the world, but there is English. Speaking English as of today might be the best choice as a foreign language. If you're a native speaker, there's not that much of reasoning behind doing it because you simply do it. But if I could only learn one language these days, it would probably be English. If I could only learn one programming language, it would probably be Python. Python doesn't have anything where you say, well, this particular feature or this kind of syntax, idiom, or whatsoever you single out is not found in any other place. So Python is, from my point of view, nothing that special. It makes more or less the combination of so many things. On the one hand side, obviously, it is the syntax, which is typically quite appealing to quants, actually. So if you're mathematically inclined, if you like equations, if you know how to code LaTeX in order to produce nice-looking documents with lots of formulae, then you will like Python for sure, because it's so close. You will find that you are back home and not in a foreign country. Many people say, well, Python fits in your mind. You have many languages where kind of the barriers of entry are so high, and you get frustrated only to get the most simple things running. And this actually is not the case with Python. So you can easily start out. It's even for my son, who is 9, who's sometimes coding a little bit with my guidance. Also to the absolute expert programmer. So Python is kind of scalable, and then But if I would have to single out one thing, why Python over other languages, and then in parentheses for finance, I would say, well, it is probably the ecosystem that we have. All the libraries, everything that you can use in terms of third-party libraries, if you like, all the major open source projects like Pandas, PyTables, scikit-learn, scikit-image, you name it. All these fantastic libraries that you get for free and which are kind of very, very powerful. And especially to single out in this ecosystem one, I guess Pandas for data crunching, number crunching, financial time series analysis, visualization, and so forth is something that brings many people to Python. The other thing is that actually IPython Notebook in former days brought many people to Python, our nice web-based interactive development environment. But this has become language agnostic with the Jupyter project. So they now have different kernels running, and there's no need to come to Python for Jupyter. You can do Jupyter with Julia R as well. So, but back in the days, it was kind of these single libraries which are powerful, and actually some nice tools that we had to offer and still have to offer, obviously. So they haven't gone, but they have become more or less language agnostic.
Right. Well, I can tell you that I wish I certainly started programming when I was 9 years old. I'd be much further ahead than where I am right now. But I guess now's better than never. So now you mentioned right at the start there that there are so many languages out there that you could have chosen from. But you went with Python. Is it a popular choice used in the finance industry? Like, obviously, you use it in the finance industry. Is it like widely accepted?
Yeah, I think it's one of the most popular languages at all these days. Many of the biggest banks in the world now do major things in Python. To name two, there is Bank of America Merrill Lynch, where they have implemented their core risk management and trading platform, which is called Quartz. It's actually a big project, mainly in Python. Obviously, typically doing these big projects, you don't use a single language only. So you have typically a blend of technologies and languages that you use. But Python is the major language driving this big project. And the last number I heard is that it's with 14 million lines of code. It's kind of the biggest financial system based on Python in production as of today. The other one is JP Morgan with Athena. They're trading and also risk platform where Python also plays a major part. So big banks are using Python, and you can name it. Pick out any bank, Deutsche Bank, and so forth. To some extent, they are using Python. I mentioned those who have it as a strategic platform technology. Others, for example, Deutsche Bank uses it in many, many places, but not maybe as a core technology, if you like. So if we now go more to the asset management, the hedge fund side, and I guess the hedge funds have been here front runners. You will find many of the biggest hedge funds in the world that make heavy use of Python. To name just a few, it's PDT Partners, it's AQR Capital Management, it's Two Sigma in New York. So some of the biggest hedge funds in the world use Python, again, as a strategic technology for what they do for research, production, and so forth. On the asset management side, this is my experience also with regard to the business and trainings that we do, is that asset management, the classical asset managers are now catching up and also have discovered that Python is kind of a good choice. But it's kind of a little bit beyond the wave. And what I see next is kind of getting more and more questions from the insurance industry. We haven't spoken about that, and it's not our focus as of today, but I see more and more coming there as well. And in the end, I guess Python will be kind of a strategic technology for almost any company. And getting back to our introductory example of ARC, of the emerging manager in New York, and I can... There are many other examples that did it similar. Once you start out on your own these days, and you can start from scratch and don't have legacy codes, 10 million lines of C++ code in your pricing library, then it makes sense to use Python. 10 years ago, when we started out and did our first steps, it wouldn't have made sense to use Python for kind of everything, and especially not for your heavy analytics tasks. But as of today, if you're an owner of company, And it's your money and it's your time, and you have to make sure that everything runs and you do in the best way you can. Then typically you choose Python because, especially when it comes to analytics, I guess you have a factor probably of 10 or sometimes 20 in terms of reduction of number of lines of code that need to be written to accomplish the same when you compare C++ and then moving to Python. So you're much more efficient. You get much more done in a much shorter period of time by using Python than other languages. But I don't speak against other languages, don't get me wrong. I mean, C++ and then all the compiled and high-performance languages, they have all their place. And Python can easily interact with these languages and libraries implemented based on them. But when it comes to interactively explore stuff, prototype, and bringing this as fast as possible and as efficient as possible to production, I guess Python is kind of the right choice.
Yeah, no, that's huge and an awesome answer, very insightful. In the past, you've given many talks, over the years, you've given a lot of presentations. One of the common themes throughout these presentations seems to be open source. What's the reason for your big push on open source and being such a big advocate for technology and code and software being open sourced?
Yeah, I mean, if you think back in history, then you had a time where open source was something which was exotic. We said, I started out back in the 80s with the C64, and you had to buy your games, and this was really expensive. It's there wasn't open source available. You could type stuff that you found in magazines or what. This was open source, but you had to type it by yourself. But I think now, as far we have come and what this means for our society, I would even like to say, when it comes to GitHub, for example, how many amazing projects do you find on GitHub these days where you can make use free of any charge, where you can have a look at what's going on, and where there is the opportunity for other people to contribute and to improve that thing. And I want to get back to the example that I mentioned before. Pandas, from my point of view, is kind of a paramount example in this regard. When Wes McKinney started working on Pandas, he was employed as an analyst at AQR Capital Management, obviously one of the biggest hedge funds in the world. His intention was to promote Python, but coming from R, he was aware of that the data frame object, actually, which is so nice to use in R, is missing. They said, well, we need this in Python as well, and so he started implementing Pandas and started rebuilding, if you like, compared to R, things that have been in R for quite a while, and now we introduced it to Python. But this was kind of a proprietary project for AQR. And it was not kind of a core project. I mean, by writing a data frame for Python, you don't make money per se for a hedge fund. You make money by how you use it, what data you crunch, and what kind of algorithms and insights you come up based on the data you're crunching. So they made they made the decision indeed to open source it. And now we have, this is one of the biggest libraries at all. I don't know whether the current PDF documentation stands at 2,000 pages already. The last count I have in mind is probably 1,800 pages for this single library alone. And it's so powerful, and it has grown so fast, and it's become so huge and immensely beneficial for our ecosystem. It would never have been the case if AQR would have said, well, this is something proprietary that only we should use. We don't open source it. Nobody should learn about what we have in Python and so forth. No, they did, from my point of view, the correct decision and said, well, this is not our core. If we open source that and provide others with the benefits of what we have implemented, then we might benefit back by others contributing to it. So we can use maybe features we haven't even thought about before, that others implement, and we have kind of the benefits as well. And this is kind of the perfect win-win situation that you see in so many areas, and Pandas in our ecosystem is kind of one of the major examples. So now millions of people use it on a daily, weekly basis, and have the benefits. And AQR also has the benefit, because the library is now a hugely developed, highly efficient thing with a gazillion of features. They never would have brought it that way. I mean, there are many things that they don't need, but overall it's kind of beneficial for our whole ecosystem, for the whole Python community. So this is what I think of open source, where the major benefits are, and there are many, many more in terms of what these days, typically when you apply for a developer position, you typically don't write any typical CV anymore. You just send the link to your GitHub repository and say, look what I've done so far in Python and JavaScript and C++ whatsoever. Here's what I can do, what I've worked on, and people can have a real look at what, and not a real look at real things, and not at a CV who tries to sell something that is not there in the best possible manner. But many other arguments apply to this particular topic from my point of view.
And it really highlights the value of collaboration too. So while we're on this subject, I'm keen to get your take and your views on what do you make of what are your thoughts on the pros and cons of open source languages versus traders who use proprietary languages that are native to individual platforms? Like, what are the pros and cons between those two kind of approaches to programming, if you want to call it that?
I mean, obviously, when you learn kind of a general purpose language like Python, you can apply it in many different places. To learn a proprietary language, which you can only apply in one place, might be a good investment during a certain point in time for a specific reason, project, or whatever are doing at this point. But I guess in general, it should be the other way around. We have a couple of examples in this regard. For example, if you think of this big front arena trading front office system, they use Python, for example, which is a general purpose language, to describe payoffs on their platform. This is the opposite, so to say. They say, well, we have a proprietary platform, but we use something as common as Python. Many people, you can speak of even millions, can already program to do something which is specific to our platform. And I think this is the right way. Why would you invent kind of another spoken, written language to write a poem or whatsoever? I mean, English is there, or maybe you have another mother tongue or whatsoever, but there's typically no need. But I guess in the end, it's all about specialization and payoff and investment. If you say, well, what we are looking for and what we need is available out there, and there is such a huge business case, and this is sustainable for quite a while, let's do something on our own. This might be the way to go. So, for example, Goldman Sachs has its own language with slang internally and so forth. So there might be good reasons for bigger institutions for certain environments. But in general, I would say if there is something around which might be at least as good as what I have in mind to solve the problem, why not using it? I mean, just to have a proprietary, it's what I usually also use as an argument against proprietary data science platforms and so forth. So, we have Jupyter Notebook. This is used by millions of people. There are, I don't know how many tens of millions of Jupyter Notebooks are available, but there are still people these days, they reinvent the notebook and come up with a new notebook with another format used by 500 people and with 1,500 notebooks available, and which will never ever get the traction of what is already there. So if there are good reasons to do that, because your company has specific requirements, you want to use it internally, fine. But as a startup, I would doubt this model, actually.
Okay. Yeah, that's a really good point. So what are some of the best resources that you would recommend for someone who's keen to start learning, the language of Python? Someone who's just maybe an independent trader, they might not be a PhD or have any programming experience. What are some good resources that they could start out with?
I mean, in this regard, I must come back to what we do. Obviously, when it comes to learning Python for finance, there's my book, the trainings we give. If you go to my private website, hillpish.com, you find, 50 plus talks about different topics in notebook style, so you can easily copy that and use it on your own. There are others who provide trainings, or like Code Academy and so forth. There are many, many places where you can start out. But so in the end, it's not only for me, I guess for everybody, it's impossible to name all the good resources that are out there. And I really think that there are many, many good resources out there. What my recommendation typically is, to people asking me this question, because I'm getting asked this quite often, is learn the basics by reading a nice book or an online resource like the scientific lecture notes, which are out there on the GitHub for free. I don't know, 200 pages of well-written lecture notes about Python for scientific applications. So it's completely for free, and you can study that. Do something like that as a starting point, and then pick a project and learn and pick up along the way what you need. Going to Stack Overflow, Google your stuff, looking left and right. So, for example, I knew about Python, for example, but it might be a nice project. I really like using the Raspberry Pi, for example, where you can easily learn Python. You can implement many nice projects based on a Raspberry Pi, which is also fun if you like that stuff, to learn Python, but not only Python for the sake of Python, but to implement nice things that you can do with Python based on a Raspberry Pi, even including other hardware elements and so forth. So this is usually my recommendation. Pick a project that you're interested in, and then try to build this project and pick up along the way all the ingredients, Python ingredients, other technologies that you need in order to accomplish the goal of your project. I guess from my point of view, this is the best learning experience. This is the very reason why I like to write books, why I like to implement bigger things on my own, because this is the best way to learn. I'm getting a producer and not that much a consumer is the best way to learn. Just produce, whatever it is.
Really good. So, I mean, just another question to bounce off that one. Realistically, what sort of commitment is going to be required from a non-programmer to become efficient with this language?
That's also it's a tricky question in a sense. I said the Python fits in your brain. Actually, it's nothing usually that blows up your brain. But in the end, I would say if you're really interested in learning it, you will learn it quite fast. Just think of more like a child who's interested in playing a certain game, or when I remember the days when I got my first computer, time didn't play a role because it was so much fun to do it. I was like, no matter how long it takes, I will master it in the end. This was my thing. And back then we did assembler and stuff like that. This was much more involved than the stuff we see here. So it took weeks or even months until you got the first results. Here with Python, you start out and you see the first graphics that you generated on your own like 5 minutes later. This is a real short feedback cycle. But I guess learning the basics, picking up a project, implementing it in a realistic fashion, and doing it part-time or whatsoever, maybe half a year, and I guess you never have reached kind of a decent level of Python. Okay,
sure. And just to pick up on what you mentioned a couple of answers ago, the course on Code Academy is awesome. I've done that one. That was really helpful. I think that was actually the first one I did, so that was my introduction to Python. And I learned a lot from that. So, all right, Eve, well, let's wrap this up. We've been talking for almost 60 minutes now. Where can listeners go to find out more about you? So maybe your best website, and, I know you're fairly active on Twitter. What's your Twitter handle?
It's DYJH. So.
Okay. And best website where listeners can find out more about you?
This is our company website, which is tpq.io, like the Python quants, tpq.io. From there, you get kind of directed to the different areas, to the book stuff and so forth. And my private website is hilpisch.com. There you find all my talks and stuff like. I have even there kind of links to my Raspberry Pi project, what I mentioned before. It's kind of resources which are not kind of directly associated with our company work, but stuff which is obviously to 90% about Python and quant finance.
Yeah, that's great. Now I'll be sure to include all those links at chatwithtraders.com so listeners can find them all there in one place. And just to recap, I know you've written 3 books. Can you just give us the title of those books in case listeners want to check those out?
Yeah, the first one, which is actually out since almost 1.5 years right now, it's the Python for Finance one, which has been published by O'Reilly. This was December 2014. Then in July 2015, last year, my Derivatives Analytics with Python book came out. This is a little bit more involved. This is really about the finance side. It was an outgrowth of my university lecture. So this is more, again, about quant finance and how to do it in Python. The Python for Finance book teaches how to do it. The other one doesn't teach how to do Python. So, but the two together are kind of good companions if you're interested in derivatives analytics. And the third one is even a little bit more specific in the sense that I focus there on a certain product category, which is listed volatility and variance derivatives. Quite popular instruments these days with increasing volumes over the years, and explaining everything based on Python code and more or less on interactive Python sessions. So very interactive, very easy to follow, and with all the books come all the resources. Every single figure, every single plot, every single table that you find in my books is reproducible with the code that I provide. So reproducible research and publishing is what I'm looking for here.
Good stuff. All right, Eve, well, let's call this a wrap. Thank you very much for coming on. I really appreciate you taking the time to do this and speak with me this morning. So enjoy the rest of your day and let's stay in touch.
Thank you for having me. I also really enjoyed it.
Hey, I hope you found this episode interesting. And like I said at the beginning, if there was anything which you didn't quite understand or you'd like more context around, just leave a comment at chatwithtraders.com/84 and I'll do my best to point you in the right direction. Or I might even ask Eve if he can help out as well. Now, the second thing I'd like to repeat, which I also mentioned right at the start of this episode, is I'm running a survey for Chat with Traders. Okay, this is a very short survey. I think it's about 15 questions, all multiple choice answers. Take you about 2 minutes to complete max. The reason I'm running the survey is because, as you know, the podcast is free and it's financially supported by sponsors. Now, I want to make sure those sponsors are a good fit for you listening to this podcast, and the sponsors want to know that they're connecting with a relevant audience as well. So if you can help support this podcast, please go to chatwithtraders.com/why. It's all there. So please show your support, and if we don't speak in the meantime, I'll catch you next week.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it.
What would your trading look like? Access ongoing
Podcast hosted by Aaron Fifield.
All right, traders, I hope you're ready for this one. We have a really big episode in store, so let's get right into it. My guest this week has been labeled by Forbes as one of the most successful traders of the last 40 years. He was also profiled in Jack Schwager's The New Market Wizards. The man I'm referring to is Blair Hull. Prior to trading, Blair was a serious blackjack player for 5 years during the 70s. From there, he took his winnings to the floor of the Pacific Exchange to trade mispriced options, and shortly after, founded one of the world's premier market-making firms, Hull Trading, in 1985. At its peak, Hull Trading was active on 28 exchanges in 9 countries. Then, in 1999, the firm was acquired by Goldman Sachs for $531 million. Today, Blair is the founder of Hull Investments, which is the parent company of an actively managed ETF, Hull Trading Asset Allocation, and proprietary firm Ketchum Trading. Listening to this interview, you're going to hear more about Blair's career and his observations as a trader, why he believes great things happen in teams, and having an edge. Because like Blair says, if you're missing an edge, there's no reason to play. So here it is, folks. I'm Aaron Fifield, and here is my interview with a trader who I look up to and greatly respect, Blair Hull. Got to say, before we go any further, it's such a huge honor to have you here on the podcast. So thanks a lot for agreeing to do an interview.
My pleasure.
I'd like to get this underway by asking you about your first trading experience, which started at the blackjack tables. How did you get into blackjack?
Well, my brother-in-law used to go from San Francisco to Tahoe every weekend, or not every weekend, but say every 6 weeks or so, and he'd play blackjack. And he said that he paid for his vacation by going and playing blackjack. And I thought, this is ridiculous. This guy is an accountant. If he were really making money, he wouldn't be playing at the $1 table. He'd be playing at the $5 or the $25 table. And so I didn't really believe him, but I did read the book, Beat the Dealer, and I tried to did it myself to some extent. And I found that there was an edge. You could get an advantage playing blackjack. So for the next 5 years, 1971 to 75, I played 50 days a year in blackjack while I still had a full-time job. But every chance I had, I was in Nevada, either at Reno, Tahoe, or Las Vegas.
Okay, so what was that full-time job that you were holding down at the time?
I was working at Kaiser Cement as a middle manager. I did have an MBA from Santa Clara University and was doing financial analysis for a cement company.
Right. Okay. So would you mind telling us a little bit about the strategy that you were playing to win at blackjack, and were you successful with this right away?
Well, this is there's a book called Beat the Dealer by Ed Thorpe it really came out of a academic article. Most things do come out of the academic world that are substantial. In 1958, and then it was a hardback book in 1962, and then a paperback in 1966. And this gave a strategy, and there have been, I'm sure almost 1,000 books written on blackjack since that time that people realized it was a winning game. And of course, with all good things, they do go away. The casinos learned how to counteract the players over a long period of time. It took them until about the year into this century for them to learn to counteract the players to such an extent that it's very difficult to beat the game of blackjack today, but still possible. There are some games that can be beaten.
So when you were playing it, the strategy that you were playing to win at blackjack, was this what you might call a foolproof way of making money? Like, how great was your edge?
Well, nothing's. I wish there was something foolproof, but the best advantage you ever got was 51-49. That means there's a 50. You had a 2% edge. That means for every $100 you bet, you'd win $2. But it takes you a long time to get into the long run. Anytime you'd go up and play for a weekend, you'd play 8 hours a day, 2 straight days, and you'd still have only a 2 out of 3 chance of being a winner at the end of that weekend. So this was a game of chance. Having the odds in your favor was certainly a game that I learned I wanted the odds in my favor, not in the odds of somebody else. Now, if I were to play craps or play blackjack or play the slot machines, the odds would be in the casino's favor. And we're going to transition into trading and investing. And William Sharpe at Stanford University, a Nobel Prize winner, defined an investment as a sacrifice of current consumption for expected future gain. Well, gambling is just a sacrifice of current consumption for expected future loss. So we want the odds in our favor, but there's still, whether the odds are in your favor or somebody else, there's still a lot of uncertainty.
Okay. And did you ever consider what you were doing as gambling? Like, most people think when they go to the casino, whether they win or lose is pretty much just sheer luck, because they are gambling. Did you ever consider what you were doing as gambling in the traditional sense?
No, I do not consider I consider myself as an investor. I'm not going to play with somebody where the odds are in somebody else's favor. It's not. It's just not part of my. Anytime I make a wager, whether it's on the golf course or wherever, I must have the edge in my favor.
Absolutely. Okay, so a little bit later on, I know that you became part of a blackjack team. I know this was a strategic move on your part. What were the advantages you saw from joining a team and playing blackjack?
Well, I have a philosophy that all great things that happen in our world happen with teams, not with individuals. And I learned that at an early age with the blackjack team. The first thing that I did when I learned about the blackjack team is I met the founder, and then I had to go take some tests, some exams. One of the exams was you took a 52-card deck and you took 2 cards out, and then he put a stopwatch and he said, ready, go. He wanted you to count the cards and to tell you what the last 2 cards were and be correct all the time. And so I had to be relatively fast. So I learned how to develop a skill of being faster counting the cards. The second thing I had to do is I had to take a basic strategy test, and that is what do you do when you know what the dealer has and you know what's your cards. And it's usually a multiple choice question: hit, stand, split, or double. And so I took that test, and I think I got 94 out of 100 right. Well, blackjack really requires that you get all the answers right. You're going to give something back you're going to give them an edge back to the casino. So the fact that we took exams, and there were 10 different timed tests in order to qualify for the exam, led me to be a much better blackjack player than I was originally.
Okay. And did one of the motives for joining a team was that you were able to get more bets on, you were able to play more hands and that sort of thing? Was that one of the reasons for joining the team as well?
Well, certainly it did help to get more money into action. More individual bets allowed you to get into the long run sooner. So that was an advantage. That was part of it.
Okay, excellent. So what was it that motivated you to up and leave the blackjack tables for the floor of the CBOE?
Well, actually, the team got barred. We all got barred in 1970. I guess it was early 76. And so it was hard to get a game. And so, but at the same time, I had been working on developing a model that would calculate the expected value of an option. And I associated a probability distribution with the stock outcome. And then I calculated the net present value of the expectation. And that model actually converges to another model that was developed a year earlier called the Black-Scholes model. So I had developed something very similar, very close to the Black-Scholes model. At the same time it was developed. So I had a value for the option, and then I tried to buy under cheap options, and I tried to sell expensive options. That was the strategy.
Okay, and if you had to summarize it for us, what ways did blackjack help you to prepare for trading? And why were you, actually you kind of answered that. I was going to ask you, why were you attracted to options markets over other types of markets?
Well, the blackjack, in any kind of a game, whether it's gambling or investing or whatever you call it, there are 2 things you need. You need an advantage, and then you need to stay in the game. And what blackjack taught me is that I had to bet in proportion to my bankroll. I had to bet in proportion to my advantage. If I had a big advantage, I could bet more money, but never more than 1/50th of my bankroll. So if I had $100, I could never bet more than $2. So that's a pretty good rule. You think about it, you're going to go to the casino and you have $10,000. The most you can bet is $200. Or you will risk ruin. You risk losing all your money. So when you're playing a game, whether it be trading or blackjack, and you lose half your money, you have to cut your bets in half. And most people they'd try to get even, but you have to do the opposite. So I'd say staying in the game was the most important thing that I learned. In fact, you mentioned CBOE. I actually started on the Pacific Stock Exchange, where I leased a seat for $500 a month. But I would go around and there would be an option that would be, all the public were going after this option. It was, I had it worth, according to my model, of say 25 cents, and it was selling for $1. And so I had sold maybe 200 of these options, and I'd run around and I'd say, oh, that's such a juicy bet. And then I'd look at I'd look at the price again. Oh, I got to sell some more of those. And then I'd say, I've already have that bet on the table. I envisioned a stack of chips. And so I couldn't. So I wouldn't overbet. And so overbetting is the thing that kills you in any kind of game. You can have a winning strategy, but because of the way in which you wager, you can almost be guaranteed to go broke. So it's important as to whether you have an advantage. How much you bet is as important as getting an advantage.
The models that you created, that you had calculated, did these set you up to be a profitable trader pretty much straight out of the gate?
Well, I don't know if it's straight out of the gate. I think I remember I was down $1,000. I went over with I took $25,000 that I had won on the blackjack tables. This is in 1974 dollars, so you'd probably put about almost a 10 on that, I guess. But 10 multiple on it in today's dollars. I was pretty successful, fairly successful the first year, fairly successful. Yes, there were, at those days, options were mispriced. And it was much easier to beat that game, much easier than it is today.
Yeah, can you just give us a bit of an example and kind of explain the idea about options being mispriced? Do you have some sort of a basic example to help us understand what you mean by mispriced?
Well, one thing about options is that they do tend to be overpriced. If there were a tendency for options at all to be priced, they tend to be overpriced because there are fewer people that can sell options. Everybody can buy an option because the clearing firm or the brokerage firm, Merrill Lynch or Morgan Stanley, you put a certain amount of money, let's say you put $10,000 into account. If you pay for an option, you pay for it out of your account and you own it and you get the payoff after. If you sell an option, you need a certain amount of collateral, but they have to keep track of the collateral, and they won't let people sell options unless they have a fair amount of money in their account and they know what they're doing. So although it's a risky endeavor, selling options is definitely preferable to buying options as a general rule. So that would be one way of a mispricing of an option. Now, not all options are mispriced, but if they're mispriced, they tend to be overpriced rather than underpriced.
Right. So can you tell us a little bit about how you traded the 87 crash? I know this was a very big day for you, where you made a significant amount of money as most people were losing a significant amount of money. Can you just tell us a little bit about that story?
Well, the 87 crash, we had options on in all kinds of places. By 1987, and I went down to the floor in 1977. We had built an organization and had about 19 people working together. Now, I realized that I am a believer in teams, but I did start as an individual and then hired somebody, and then we made a partnership, and so there was a team of us, 19 people in various positions. It was interesting that the Federal Reserve and the banks tightened credit at the worst time. They suddenly told everybody that they had to reduce their positions. So that put me in a position that we actually happened to be short the major market index, which was a mirror of the Dow on that day, on Tuesday when the market reached a low. And I had to go over to the Chicago Board of Trade because I was the only person that could actually trade on that seat. We owned and leased seats on the major exchanges. And so I was actually in that pit at that time. And it was interesting that the New York Stock Exchange, everybody had panicked. They didn't know what to do. And the Chicago Mercantile was going to halt trading. And I was trying to figure out what happens on trading halts. And I finally told everybody that that's the culmination of panic when they've halted. So we want to be long on the halt. And then I was in the right place at the right time when a firm that used to exist, Drexel Burnham, and they went out of business not too long afterwards, came to the floor, and the Chicago Mercantile had shut down. So the only place they were trading equities was the Chicago Board of Trade in this major market index. And they asked me where would I buy 100. They knew that I was a guy that was on both sides of the market, and I gave them a ridiculously low price, and they said sold. He later sold me another 50, and there was the only 150 contracts that traded at that price. So I was in the right place at the right time.
So you bought those, I believe it was around about like 2 ticks off the lowest price. Was that right?
I think that is right. There was another trade. There was another small trade. There were 150 lots at 285. There was a 2 lot that traded at 287, and then there was some traded at 290. But that's sort of interesting. 2 ticks. Well, that was the low price. The price that I brought them with a low price, and there were no other trades at that price. But I'm curious, how did you get that information? It was 2 ticks off the low. You said 2 ticks. No, it actually was the low. My contract was, you said 2 ticks off the low. Where did you get that?
Oh, okay. I must have misheard it or misread it somewhere.
Yeah. So it actually was the low price. 150 contracts was the low tick.
So that was 87. In 85, you started Hull Trading, which I'm really keen to ask you more about. So how did Hull Trading come to be, and what were your objectives for starting this firm?
Well, it was an extenuation of my own trading. Normally on the floor of exchange, a trader would have clerks. And I actually had tried to build a computer system. I knew that things ought to be automated. And when I saw the exchanges, and the first time I walked down, having been a computer programmer before, having some programming experience, I should say, I knew that when I saw the floor of the exchange in 1976, I said, this place, my God, if I come down here, I better make a lot of money very quick because it's all going to be automated. Now, the direction of technology, I knew the direction of technology, but my timing was off by about 30 years. It took us until about the year 2000 to actually get automated options exchanges.
Yeah, so that's really interesting. Can you tell us a little bit about what were some of the things that you were doing at Hull Trading, which were very unique and innovative for that point in time?
Well, when we had a decision to make, we usually wrote an algorithm and created a system that would execute that trade. We did believe that everything that we were doing by hand could be done by a machine. And so when exchanges, we have the status quo at a lot of things, and it's hard to break the status quo. When it was finally broken in about 1990, and in Germany actually had the first automated options exchange out of the Deutsche Terminusbüro, which became Eurex. And they were the first ones to do it, and we were over there in Europe providing liquidity on those exchanges, so we learned in Europe.
Okay. Now, one of the things which I find quite interesting about Hull Trading, and I'm hoping you can share a little bit about this, is the type of people that you were hiring there. I understand, and correct me if I'm wrong, but you were sort of one of the first to employ, your PhDs and mathematicians and those sorts of people over the traditional trader types. What was your reasoning for this?
Well, I had a job in corporate America, so I looked at things as from an organizational standpoint, and we did believe that one needed an objective way of buying and selling things. You couldn't, especially in the options market where everything was related. And so we had quantitative models that would tell us how to price the SPX options versus the NASDAQ options, say. And so we needed mathematicians and computer scientists to not only come up with the algorithms that would give us fair values, to risk adjust those fair values, and then automate that process to get those prices to the traders. And that took a lot of higher mathematics and computer skills to do that.
Okay. Could you give us a little bit of insight to how you would describe some of the strategies that you were running there at Hull Trading? like maybe sort of the frequency, what sort of markets you were involved in, obviously options markets, but I think you were in about 9 different countries at the peak. Just tell us a little bit about the type of strategies that you were running.
Well, most of them we were trying to buy undervalued securities and sell overvalued securities, and stay as neutral as possible. Nobody liked risk, but our capital would swing significant amounts on any one day, just because things became more mispriced or less mispriced. So the strategies, although we did do a lot of option strategies, and of course we hedged with the underlying instrument. If we'd sell calls on IBM, chances are we were a buyer of the stock, or we were doing some other option to offset that transaction so that we would be relatively neutral IBM. But another strategy that we employed about 1998, somewhere in 1995 actually, was we bought and sold securities in a separate portfolio. So we were operating on, I think it was called the DOT system then, and so we automated a process. And we would do things like, you might think of it as pairs trading, where you would buy one stock of Pepsi and sell Coke, or used to be General Motors and Ford, or it might be Morgan Stanley and Goldman Sachs, where we would. But what we did is we really took a security and we took the 5 most correlated securities and we built a basket. And then we'd say that this stock is going to follow that basket. So if that industry tended to go higher, we would tend to be a buyer of that stock, et cetera. So we tried to fairly price securities, and then we would make a market around our fair value. Everything we did was to come up with a fair value and then put a bid and an offer around that fair value. Never thinking that we were going one direction, but always being willing to go both directions.
Okay. So Hull grew at an incredibly fast pace. At your peak, how much volume did you account for in the various options markets that you traded?
Oh, that's hard to tell. I do think we were certainly large in Chicago. We were in Frankfurt, London, Paris. We were in Tokyo. We had a joint venture with Daiwa Securities, which was certainly interesting. So it's hard to say. We were doing over 1% of the New York Stock Exchange stock volume, equity volume, though, at that time. Actually, one of the firms we did trade with a lot with was Madoff, and this is with legitimate portion of their operation. But Peter Madoff and I were both served on the Cincinnati Stock Exchange board, and we found that Peter and I didn't see the world in the same way. He had a firm that executed order flow for other people at various prices, and so sometimes he liked to trade them above the market or below the market, and we had an automated system that would provide bids and offers around what we considered a fair value. We didn't really care who we traded with. Well, Peter Madoff had this idea that he thought we shouldn't be in there providing this liquidity, and we shouldn't be getting in the front of his trades. And I think one of my greatest compliments was that Peter Madoff said, "That goddamn guy Hull, he's costing me $250,000 a month. Got to get rid of him." So it's my greatest compliment.
I like that. That's funny as. In 1999, you were acquired by Goldman Sachs. What was Goldman's motive for acquiring Hull Trading?
They saw the way the world was going. They couldn't compete without an automated electronic market maker that could analyze data and come up with fair values for securities so that they could trade them. They could provide good liquidity for their customers and for others. And they saw that they could build what we had. Probably going to take them about 2 years to get where we were, but by that time we'd be 18 months ahead of them. So they just wanted to shortcut the process.
Okay. And what did they do with the firm following the acquisition?
Well, the first thing they did, which was really quite bright, they went on a hiring spree. There were 250 people in the firm when when we sold. Within a year, they had 450 people. So what they did is and actually Henry Paulson said this. He said, I look at this as a DNA transfer. And what we're going to do is we're going to take your methodology and the way you look at problems and markets, and we're going to take that throughout our firm. And so I thought that they were very effective in the way in which they hired and trained people.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved. Now, so has the way traders operate within them. Trade the Pool.
Moving into current times, can you describe to us what is Hull Tactical Funds? Like, give us the rundown on what you're doing today.
Well, one of the things, I talked about blackjack and I talked about option strategies. I actually have been intrigued with the direction of the general market. And I have felt that there's got to be some edge in whether the Dow Jones and the S&P 500 are going up or down on any one day. And not necessarily one day, but over a longer period of time and over multiple horizons. And I actually presented a paper in 1981 where I was on a panel actually with Ed Thorpe, who presented another paper. But what my paper did, it talked about gambling and timing the market. And what I concluded was that gambling gave me a better return on my investment. Blackjack gave me a better return on my investment relative to risk, and options did the same thing. So for the next 18 years, I sort of said, hey, timing the market isn't for me. But I returned to that. I returned to that strategy in about 2006. And was working on a very short-term strategy. Then in 2008, when the market collapsed, I said, I've got to have a systematic and disciplined way to deal with this. And that's when I started to really work to develop a strategy for really timing the market. So it's pure market timing. Can you be on the right side of the S&P 500? And that's what the Hull Tactical Funds is about, and the ETF, which is HTUS, is the symbol, and it's been operating for about a year.
Okay, and that paper you referred to, I believe that's available online for everyone to see, isn't it?
Oh, yes. We have a paper that is very transparent about our strategy, and it's on a website called hullinvest.com, or you can get it through the Social Science Research Network, SSRN, and just Google Blair Hull. It's called a Practitioner's Defense of Return Predictability.
Okay. Well, I'll link to that in the show notes as well, so you'll also be able to find a link to it there.
The basic idea here is that there's this stigma against market timing. Whether it's the Nobel Prize winners, everybody says Vanguard funds have been, they are created by the idea that you can't time the market and that timing the market is dangerous. Well, that may have been true up to about year 2000, but with this explosion of data that we've had with new government data, the internet, even Twitter and social media, we now have a situation where with new predictive analytics, that it is now possible to time the market. Just as we have cars being driven by machine learning techniques, it's now that your portfolio should be driven by predictive analytics.
So I just want to be very clear here. When you're talking about market timing, what does that actually refer to? Are you talking about like buying the very bottom, selling the top? Like, could you just elaborate on what you mean by market timing, please?
What we believe that there is some optimal position of equities and cash that you should have every single day. And that comes out of a variety of information. So what we do is we actually publish this an hour later. And one of the ways, if you look at hullinvest.com, you don't have to buy the ETF, or all you have to do is copy our strategy, because we give you what our optimal position. We have a short-term model, and we have we have a long-term model and multiple short-term models, and we have a short-term adjustment to our long-term, and we have a position every day. So you could just copy our strategy. That would be one easy way to do it.
Okay, so this might be a bit of a newbie question, but what's the benefit of creating your own ETF? Like, how do you make money from that? Like, how does that work?
Well, there's a fee that goes along with every ETF that you buy, even if it's the S&P 500. Like the spiders have a 9 basis point fee associated with it. So you're going to pay for every $100 you have invested, you're going to pay 9 cents a year on that. And most fees could go up to they could be up to 1.5% or 2%. The fee for this fund is 1%, and that's 93 basis points go to the people who put the fund up, put the ETF, and had the strategy, of which we get about 2/3 of that, because there's a variety of things that you have to pay for. So it basically, any ETF that you buy, you're paying an expense. There's an expense ratio associated with every ETF.
Okay, that makes sense. That's something I was completely unaware of. So what are the securities that make up your ETF? Are they, really just cash and, what is it, the S&P futures?
It's cash and either the S&P futures or spiders, the ETF. Either one of those two. And we may be long or short. The fund can go 200% long, or it can go or it can be as little as it can be 100% short.
Got it. Okay. Well, Blair, just for the later part of this, of our discussion here, I'd like to get some guidance from you for upcoming traders. Now, one of the things you've kind of it's kind of been the underlying theme for our conversation so far, which I've noticed, and you've obviously talked about it in talks you've given in the past, is the necessity of having an edge and having an advantage whenever you come to, a game such as trading. What is your definition of a trading edge?
My definition of a trading edge is that if you do this trade multiple times, you will come out on top. You end up making money. That's the definition. If you did this same kind of trade, whether it was with this chart pattern or with this relationship of these things, and you did it hundreds of times, in the long run, you would have more money than you started with. That's my definition of an edge.
So if a trader feels as though they do not have an edge, right, and that's a problem and it's a reality for a lot of traders coming into this business, is that they do not have an edge. What should they do in an attempt to try and get one? Like, where's maybe where should they even start? Like, do you have any advice? I know it's a bit of a difficult question, but do you have any advice that might point them in the right direction for where to look for an edge?
You're probably not going to like this answer, but if you were to go to a casino, let's talk about going to a casino, and you didn't count the cards, so you're not going to play blackjack, but you can play roulette, you can play craps, you can play, baccarat, poker, but you didn't have an edge. So that means that every 100, all you got to figure out is that for every $100 I bet, how much am I going to lose? Am I going to come out? And because you're going to, And that's your disadvantage. So if you have a disadvantage of all the games you're going to play, my recommendation is that if you're an investor, and that's what I am, I would not play. I'm not going to play. If I'm missing an edge, there's no reason to play. There's no reason to play. There's a reason to give other people money. I mean, if you get some joy out of it, and that's where gambling comes in. There's some joy. People enjoy the fluctuation. It's a fun game. It's a fun game to do it, but you don't do it for financial reasons. It's only going to hurt you financially if you don't have an advantage. We're doing that. We have I have a proprietary trading. We have the ETF, which we hope has an advantage, and we have a proprietary trading system that has servers. We do things with computers. We have computers that trade. We don't have people that trade. And we have 25 different servers at Aurora at the Chicago Mercantile Exchange. Well, each of those, and we're trying to figure out, did this server and this strategy lose its edge? Because we have our capital fluctuations go up and down. We probably do any on each one of these servers. We do anywhere from 100 trades to 2,000 trades. I would think on each of these servers. Well, maybe could be up to we could do 4,000 trades on one server, sure, easily. And we're evaluating those trades. We look at the trade from the time when we transact it, and we look at the P&L 1 minute later, 5 minutes later, and an hour later. And then, of course, we look at then we look at it at the end of the day. So each of those trades are sort of marked out into the future. So then we go back and do a post-mortem to say which trades were effective and which weren't. So we're always worried that our strategies are losing an advantage. In fact, you should assume that whatever trading system you have, the profitability is going to go down because somebody's going to discover that, and they're going to take part of the action.
Yeah. Okay, so this is something I want to ask you about is, you can almost be quoted as saying you need to be systematic. It may seem obvious to you why there's a need to be systematic, but would you mind explaining for anyone listening to this podcast why you believe there's a need to be systematic in your trading approach?
Let's see. I keep going back to the game of blackjack because you count the cards, and if you have a positive count, that means the odds are in your favor. So you'll bet some money during that time. If it's a negative count, you bet as little as you can. So we try to determine what our advantage is, and we bet in proportion to that advantage in a systematic way, in a disciplined, systematic way. There's so much randomness that occurs in the marketplace. You got to reduce the randomness to any extent you can, and doing it in a systematic way is the only way that I know about of getting more consistency. We want consistent profits, and those are hard to obtain. So we want to remove as much randomness as we can, and by being systematic,
that's a really great answer, Blair. I like how you describe that as removing randomness from markets, or from your trading as much as possible. When you're evaluating a strategy, what are the most important performance metrics which you give the highest value to?
Well, there are all kinds of things. There's the return per trade and the return on capital and the hit rate. What percentage of the time are you correct? There's down, how much time underwater. I love that one. That's time underwater. There's maximum drawdown. I mean, you could go on and on. You get these reports of the strategy from a money manager. He's got 26 different measures, and so some people say there's a Sharpe ratio, which is the return divided by the standard deviation of return, and there's a Sortino ratio, which says it's the return, but it only takes the standard deviation of the downside of when you lose money. I'm real simple. I just take the return divided by the standard deviation of the returns and annualizing that number, the Sharpe ratio. And Sharpe ratios over 2 I like, and Sharpe ratios under 2, I will take Sharpe ratios up above 1. I'll take Sharpe ratios above 1. I don't like Sharpe ratios below 1.
Okay, so a Sharpe ratio less than 1. If anyone is trading a strategy with a Sharpe ratio less than 1, you would sort of discourage that?
I'm not very excited about those.
Okay.
Of course, if you combine a lot of Sharpe ratios of 1, you can get Sharpe ratios of 2 or 3. And we have a trading firm that, of course, it's got lots of servers and all kinds of overhead, but there are many traders that have always, their entire life, they've traded with Sharpe ratios over 10.
Over 10?
Over 10, yes.
That's huge.
Now, the problem is they have all kinds of costs associated with that. And a lot of this requires those servers at the Chicago Mercantile I was talking about. Those are pretty expensive. It's costing us, I'm sure, I don't even know what our bill is over there, but I'm sure it's $50,000 to $100,000 a month.
Wow, okay. So in your personal opinion, young traders coming into this business today, where do you believe they should be focusing their efforts?
Well, I think I'm assuming that they have a good education. I'm assuming they have at least an undergraduate degree and that they've taken some quantitative courses in their math, and they've at least gone through calculus in there. So I would say they concentrate their efforts in making sure they're up to date on new techniques. I did go to graduate business school, but there are now quantitative finance programs all over the country. There must be 30 of them, which are master's degrees in financial engineering. I'd make sure that they, at the earliest possible age, that they pick up a computer language, and Python or R would be the languages I would recommend that they code in. If you don't code in a language, you don't get an R door. There's no question about it. You don't even apply for a trading job unless you can program and well in one of those two languages.
Yeah, so that's a really interesting point you make there, Blair. So if someone is very efficient in one of those languages you mentioned, I believe at Ketchum Trading, R is the language that you focus on there. If someone is very efficient in R, let's say, but has no trading experience, are they someone who you still may consider for a position with you?
We might do that. They would be up against some other top competition with somebody that probably without a master's degree in finance or some experience, if they were just an R programmer or Python. Now, we might take a C++ developer who didn't have we might do that, but certainly the financial engineers would have to have some either education or experience in the financial markets.
Okay, sure. Very good. So just one last question before we close this out. Do you believe it's become harder for traders to make money in the past 10 years or so? And if that's the case, do you think it's going to continue to get harder for traders to make money in these markets?
Well, I have this idea that markets do, it's just water seeks its own level, and markets are meant to be more efficient every day. And so that means that no matter what you do, your edge is going away a little bit each day. And that it really takes, but there are tremendous opportunities and quantum breakthroughs in doing things that people have not thought about before. So I do think there are tremendous opportunities. At the same time, whatever strategy you have today is going to be less profitable tomorrow.
Okay. Well, Blair, it's been incredible having you on the podcast. Once again, thank you very much for doing this. I really appreciate you taking the time to speak with me and share a lot of your insight with everyone who's listening to this podcast right now. So where can listeners go to find out more about you?
Well, hullinvest.com is the website that we have where there's more information on the ETF, the Exchange Traded Fund, HTUS, and there's read the paper. It would be interesting for you to read the paper, Practitioner's Defense of Return Predictability, and then take the quiz that is on the on the website, there's a quiz that will test your knowledge of predicting the market. It's all about education.
And that quiz is on the Hull Invest website?
HullInvest.com, yes.
Excellent. Thank you very much. It's been a huge honor. Let's speak soon.
Very good.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's up, and welcome to another episode of the Chat with Traders podcast. If this is your first time listening, my name is Aaron Fifield. I am your host, and thank you very much for being here. My guest this week is Jared Tendler. Jared is an internationally recognized mental game coach. His clients include world champion poker players, the number one ranked pool player in the world, professional golfers, and more recently, traders too. If Jared was to summarize exactly what he does and what he specializes in, it would be removing negative and excessive emotion from decision making. So naturally, this serves as the underlying theme throughout our conversation, but we also discuss high-level topics like variance, the major crossovers between high-stakes poker and trading, how psychology has been oversold and when it really matters, plus how to identify various types of tilt. Now, all show notes for this episode can be found at chatwithtraders.com/86. And if you enjoy this episode, please write in the comments, which are directly below the show notes, and share it with your friends and followers on Twitter too. That'd be really awesome. Anyway, here we go. This is my interview with Jared Tendler. Well, let's just get into it. So, I mean, one of the first things I'd like to ask you about is your life prior to poker. I mean, what was that like? What were you doing?
So I got into this field because I wanted to play professional golf. In college, even before college, I was always dreaming of playing in the U.S. Open, playing in the Masters, and obviously winning those events. Wasn't good enough because I kind of started tournament golf a bit late to play Division I. So I went to Division III Skidmore College. Figured I'd get a good education if golf didn't pan out. And that the summer after my freshman year, I tried qualifying for the U.S. Open. There were 2 rounds of qualifying, and in that first round of qualifying, I shot even par, played one of the best rounds of golf I've ever played in my life, tee to green, and just completely choked on the greens. Missed a bunch of short putts. That was totally because of pressure. And it ended up missing a playoff by a shot, which was pretty brutal. And so I was kind of recanting this story to a friend at a club that I play at, and he showed me a book called Golf Is Not a Game of Perfect. And it kind of got me into psychology, and I kind of dove into that. I was a 3-time All-American in college, won 9 events. But by the time I was graduating, I still was having difficulty really performing under like really intense pressure of like national events like U.S. Open, USAM, big time stuff. And so I'm not one to kind of just try something unless I feel like I've got a really good avenue to be successful. And so I felt like the psychology that I'd learned had helped me. Like I said, I did well, did great in college, but it just didn't help in those major pressure situations. So I dove into psychology, ended up getting a second degree, undergrad in psychology on top of my business degree, and then went and got a master's in counseling psychology, trying to understand more about how to break down mental and emotional problems, which I thought was lacking in the traditional golf psych help. So I basically spent several years doing that, getting educated, getting trained. I'm technically a licensed therapist, although I never practiced that way. And then basically just quit my job, moved to Arizona, where I knew nobody. Talk about retroactive overconfidence. I had no idea how overconfident I was, but I probably wouldn't have taken such a big leap if I wasn't. Started to build a practice there, working with golfers, joined a golf course where I was kind of working alongside a teaching instructor there, which was kind of a vision that I had that, if golf is such a mental game, then there should be mental game coaches or sports psychologists at every golf course. It's kind of what I reasoned, but as it turns out, golfers really are not ones to put their money where their mouth is. The everyday player wants kind of the easy fix. They want to buy a set of clubs. They want to watch a half-hour, video on TV, or, kind of get the quick tip kind of stuff. They didn't want to do real hardcore work. And as it turns out, I did have a chance to solve my mental game issues and started playing some professional golf. I had a weekend where I shot 63, 65, 69. That really kind of opened my eyes to just how far I had come with my mental game. And yeah, like I said, played some professional golf. Didn't make any money, so I'm not really sure how professionally I'd call myself. But it was right at that time that I met a poker player on the golf course, and that's kind of what got me into poker.
Awesome story. Well, tell us a little bit about how that person you met, who was a poker player themselves, how that kind of changed the game for you. Like, what happened from that point? I mean, what were some of the things that you picked up from this person? Like, how did that sort of change your path?
Yeah, it's interesting because, I mean, I'm not sure. In fact, I actually had worked with one poker player before that. Who was a friend, but, he wasn't necessarily that serious. But I say that because this particular guy, his name is Dusty Schmidt. He was kind of like the perfect person. You talk about good luck, perfect person for me to, make an entry into poker for several reasons. Number one, he actually was a former professional golfer. He was leading the money list on a mini tour in California called the Golden State Tour. He actually, as a junior golfer at 13 years old, broke Tiger Woods' record in California for the most junior tournaments won in one summer. I think he won like 35 events. So the guy was really talented and kind of working his way up, and ended up having a heart attack at 21 or 22 years old, not from cocaine. I'm sure many people are going to think that, but he had some kind of like aortic spasms or something. It wasn't sort of the traditional heart attack, and it basically just kind of derailed his career. His doctor said he couldn't do anything physical or anything really straining physically. So his golf career was over, and he just happened to be friends with Casey Martin, who was a golfer, and then kind of met another friend and who got him kind of into online poker. And that was I think back in 2005, 2006. And he, when he and I met in 2007, was making between $20,000 and $30,000 a month. Had an insane work ethic, and so when I met him through mutual friends on the golf course, he was having just massive anger issues to the point where he was literally just like ripping his desktop computer out of the wall. He was, smashing his monitor. He was breaking mice. I kind of joked because he basically paid for my sessions through the savings of his computer equipment, not to mention how much money he made on top of it. But he was perfect because he really understood golf. So he kind of knew how to speak to me, but then obviously understood poker at a high level and was able to share poker-related concepts, in a golfing kind of way. And so he was able to kind of show me the ropes, help me to understand, what the online poker world was really all about. And so, he and I got started like in October of 2007. And it wasn't like I just jumped right into poker at that point. I mean, I really had no proof of concept. I had no way of promoting myself. So it was really at that point where I was kind of actually starting to play professional golf. And it was an interesting choice point because in February of that next spring, Dusty happened to be part owners in an online poker training site called Stocks Poker, who incidentally was co-founded by a guy who was formerly in the stock market. That's where you get the name Stocks Poker. He had the moniker of Stocks Trader was his online name, and so this online training website these training websites were just kind of popping up, and there was really nobody discussing the psychology of the game, and so Dusty, gave me an offer to participate in it because he was, a big part of that website. So part of what made my story with him so saleable was that, like I said, he was making between $20,000 and $30,000 a month before he and I got started. And obviously, there's a little bit of luck involved in poker, or I should say, a lot of luck involved. But when you play as much poker as he does, around 1,000 hands an hour, you take luck out pretty quickly. Over the 4 months after he and I started, he made $600,000. So it was a pretty remarkable transition, and obviously he was pretty thankful of it. And as a thank you, I basically got this opportunity to start participating on this training site. And so I made some videos and was interacting with people on the forums, answering questions, and really trying to understand the kinds of issues that poker players had to deal with. And it wasn't very long before I had a roster full of poker players as clients, and kind of realizing that continuing to play professional golf was actually the risky thing, and jumping into poker was sort of the safe bet.
So I just want to jump back a little bit to something you said earlier in your response, and you said how this Dusty guy who you were working with was just super angry and ripping computers out of the wall, etc. Why was he so angry? Was it because of having that heart attack and having to leave his golfing career behind, or what was the cause of such great anger issues?
A lot of it for him was variance and basically losing to what he saw were mediocre players. When you're competing against, one of the good things about trading is you don't always get to see your competitor. I realize that's not the case for everybody, especially big options traders. But, in many instances, you're playing against the market. You're not playing against individual people. And so you can see how bad these people are. And so that was very difficult for him to deal with, something I call entitlement tilt. And then the other side of it was injustice tilt, where he just couldn't deal with the variance. I mean, in golf, yes, there's definitely a lot of variance and good luck or bad luck, much more so than golfers realize. You get the occasional bad bounces, you get the gust of wind, your ball plugs in the bunker. You hit a perfect drive, it ends up in a divot. You hit a perfect shot, and all of a sudden it hits a cart path and goes out of bounds. So there's some crap that can happen. But in poker, it is so built into the fabric of the game that it was very difficult for him to make that mental transition. So we had to work really hard. And the thing is, like, he's a very logical person, or at least desires to be. So it was very easy for me to work with him. I try to make the instruction that I give very logical, and sometimes it seems very simple, but getting there is not always obvious. So for him in particular, there was one story where this was me kind of like really trying to understand poker, and at some point I said, like, listen, so like you're basically telling me that like that variance happens all the time, and yet it still pisses you off. So I was like, it's kind of like watching a weather forecast, and the weather forecast says, today there's an 80% chance of rain, and you go outside without an umbrella, and then you get pissed off when it rains. It was kind of like what he was going through. And I realize it's not a perfect analogy, but for him, it really just kind of made something click, that he's like, yeah, like I'm getting pissed off about something that, number one, I have no control of. Number two, exists all the time. And so it really just becomes like a business expense, that losing in these particular spots is necessary. Especially in poker, where you're dealing with a lot of perception. Poker players make a lot of money, and not all their money, but they make a lot of money because bad players think that they're good. And so you're basically battling up against the perception of skill, not just somebody's actual skill. Because if it's just about actual skill, then poker would become a lot like chess, where you have this worldwide ranking system. And for all intents and purposes, if you're within 200 points of each other within a ranking, you could be beaten by somebody with a lower ranking. But if I'm ranked, if I have a rating of 2,000, in chess, and you have a rating of 100 or 500, there's never a scenario where you're beating me. But in poker, you could get like literally somebody who has no idea how to play poker, and they can beat Phil Ivey. They could beat some of the best players in the world over a small sample.
Okay. So, I mean, how do you move on past that? Is it just a matter of kind of accepting the reality of, you know, kind of what you just spilled out there, or is there sort of something more?
Yeah, I mean, it differs for everybody. That's why I say it was in particular for him. But what has made me successful working with golfers, again, I still have some golfers, poker players, and traders, has been being able to understand a couple things. Number one, what is the faulty logic that is blocking you from being able to internalize or accept a message like that? And then two, how are we going to train it if it doesn't just sort of magically click in place like it really only does for about 5 or 10% of my clients? So basically, that first part is by far the most complex, right? But it's important for everybody listening to, number one, get an idea of what the major kind of mental issues are that you're dealing with. Are you dealing with anger? Are you dealing with anxiety or fear? Are you not trusting your gut? Do you lack discipline? Are you losing confidence, or are you overconfident? Just a kind of a handful of the issues, and then start to try to drill down and understand exactly what those issues are about. And there you have an opportunity to start to figure out what the flaws are, and then devise corrections to them. And the key in terms of the integration of those corrections is that they have to be applied in moments of high stress and pressure, or basically like when you're trading, or when you're playing poker, or when you're actually competing on the golf course, right? You can't just study your mental game off of the table or away from the action, away from the trading day, and expect those corrections to be integrated. You have to have what I call an injecting logic statement. And you don't have to have it. It's just kind of a technical term that I use. But basically, the injecting logic statement is the correction to that underlying flaw, right? So let's say, for example, you are struggling with a series of losses, and all of a sudden now you start locking up some profit, prematurely in a trade. There's obviously good reason for it, right? You're trying to, regain a little bit of confidence, regain some momentum in your way, but you almost get pissed off at how much advantage or how much money you're giving up. So what you'd want to try to do is figure out what the underlying cause is there. Is it some loss of confidence, right? And if it's some loss of confidence, then you'd come up with an injecting logic statement that would actually correct that that weakness in confidence. And then during the trading day, when you sense that your confidence is weakening, or when you're in a trade where you have an opportunity to lock some profit in, then you take a couple deep breaths. And the deep breaths are not a kumbaya meditative kind of thing. They are simply an opportunity for you to take a mental step backwards to get your mind a little bit stabilized, so then you can inject logic and have that logic actually impact your actions or your decision making. It's a bit like if you have a heated argument with a friend or a family member, and it's just gotten so emotional that it's just not productive anymore. So you literally step away, you go to another room, you go outside, and you cool off. So the deep breath, or the couple of deep breaths, is just an example of that, right? It doesn't have to be this meditative thing. Sometimes people get a little bit, glazed over when they hear breathing or meditation. It's simply about readying your mind to be able to accept that logic and have that logic actually affect your decisions.
Okay. Now, that was a really awesome answer, Jared. We're going to go much deeper into this. I think before we do so, though, it's probably a good idea if I can just ask you to give just a general gist of poker. Like, what's the objective of poker? Because, like myself, I've never played poker. I've never sat down at a poker table. And I'm sure many listening to this in a similar situation. So just so we don't get lost as we go a bit deeper into this, could you just give us a general gist of what poker is as a game?
Yeah, sure. Poker is a game that is generally played for money. So, many of you traders will appreciate that. And like trading, it's a game that has many different variants to it. So you could play 5-card draw, which is a game where you're dealt 5 cards. And then the draw part is there may be a round of betting, number one. And then you get to decide how many cards in your hand you want to keep. You like all 5 cards. then you can keep all 5. If you want to get rid of 2, then you can draw 2 more and get 2 new cards. But you're basically trying to make a hand, right? And a hand could be a pair, 3 of a kind. They could be a straight, so 4, 5, 6, 7. Typically 5 cards in a row, so 8. A flush would be all of the same suit. So they're in poker, or really in cards, there's 4 suits, hearts, diamonds, spades, and clubs. So a flush would be 5 cards, all of the same suit. And then a full house would be having 2 of a kind and 3 of a kind in your hand. Then you've got a 4 of a kind, a straight flush, meaning that the cards are not only in the same order, 4, 5, 6, 7, 8, but they're also all of the same suit. And then a royal flush is doing all that with 10 jack, queen, king, and ace. And the way that I listed those are in order of strength. So the hands that you make that are higher up on that list will beat the hands that are lower on that list. So 3 of a kind beats 2 pair. Or even a pair. So basically in poker, whether you're playing, a 5-card draw, or there's one of the more popular versions is No Limit Texas Hold'em. That in that game you're dealt 2 cards, and then there are 5 what are called community cards that are laid out as the hand goes on. So in that game, and let's say it's a table full of 9 people. All 9 people are dealt 2 cards, and then there's a round of betting, and that betting in No Limit Hold'em can be any amount that you've brought to the table. So let's say the buy-in was $1,000. The very first hand you play, you're dealt pocket aces, which is the best hand that you can have. And so you bet, and somebody else raises you because they think they have a strong hand as well. Well, now you have an opportunity to re-raise them and bet even more money. So let's say your initial bet was $50. They say, no, I make it $150. And then you say, okay, no, you know what? I'm going to bet $500. Or even go all in and say, you're betting the remainder of your chips in front of you. So the $950 that you had left. And then that person has the opportunity to either call your bet, or to fold. And now let's say they call and they had a pair of queens, right? So now you're playing your pair of aces versus your queens. The probability in that hand is obviously in your favor because aces are the most profitable hand. So there are some charts that people can look online for this particular variant of poker, No Limit Texas Hold'em, and what you'll see are basically hand strengths, and so I don't know the exact probability, but I think it's something like either 3-1 or 4-1 is the advantage for aces versus queens in that scenario. So I say that in part because poker is a lot like it's a very mathematically driven game. There are statistics, there are odds, there's probabilities, and it's your job as the poker player to understand those probabilities and understand how those probabilities are going to change as the betting goes on. And so just to finish up the description of this game, so my aces versus their queens, now what's going to happen is the flop will come out, and that means the first 3 cards of the community cards out of those 5. And so now if we weren't both all in, and I didn't know what that person's cards were, let's say, I called his re-raise of $150, for example. And so now I would have the opportunity to bet again. And so there's another round of betting after the flop. Then the turn comes out, which is the 4th card. There's another round of betting. And then the river is the last card, and then there's another round of betting there. So that's one of, maybe 40 or 50 different variants of poker, or 2 including 5-card draw. And really, as I said, it's a lot of statistically driven, but there's obviously a lot of live interaction that goes on when you're playing live poker, where you're trying to understand the psychology of somebody. Obviously, there's a lot of bluffing involved, as I think a lot of people tend to think of in poker, but bluffing tends to be overestimated as being a big thing in poker by non-poker players. Bluffing by the professionals is something that they do, but they don't tend to think about it as bluffing. They sense profitable opportunities by which to represent something that would appear to be a bluff, but is really something that they have determined is positive EV. That has a positive expected value over the long term, making a play like that. And in particular, they're going to look for weaknesses that a particular opponent is going to have, and they're going to work to exploit those weaknesses as best as they can. One sort of note, in my view, I look at poker kind of like, or I should say professional poker players. I look at professional poker players kind of like the house, in any casino game. So you take blackjack, for example, and let's say you're playing, the house is playing blackjack against somebody that has never played before. They don't have, the chart that says kind of what the statistics are to minimize the edge that the house has. And so let's say the house in that interaction has a 6% edge. They will take that forever, and that's why Vegas is such a why there are massive casinos built in the middle of a desert, is because the house is always going to win in that transaction over the long term. And the same is true with poker players. Poker players are the house. They have an edge that is going to vary based on the skill level of their opponents, and where I come in, it's going to vary based on their skill level, as it varies, as I mentioned with Dusty or with other players, based on how well they're able to control their emotions and their mentality. So hopefully that was a good answer.
Yeah. So just to summarize that, obviously this is a card game. There's a lot of variance, like you've already mentioned. Where do poker players actually get an advantage? Is it in the bet size? Is it in reading other players and their ability to do so? Or is it their actual strategy? Or is it, kind of a mix of both, like, it is in trading?
Yeah, it's all of the above. They will get it in every way they can. They'll get it in how long that they can play. So their ability to maintain kind of mental endurance. So, you take a recreational poker player and they may be actually pretty decent, but as the night goes on, they're going to get tired and their decision making is going to start to wane. And so, really good poker players are going to be able to play at their best for longer. So not only are they better from the start, but they're even more their edge gets even greater as the other player weakens. They're better in their understanding of the odds. They're better in understanding, how other weak players think. And so, poker players will kind of categorize weak players. They call them fish. The whales are obviously the big ones. Card sharks are trying to attack the fish. That's sort of the common terms there. The fish will have sort of different, they're different types of weak players. Sometimes players are weak passive, which is like the worst that you could be, meaning that you're going to very often give up to signs of strength. So if I'm aggressive and constantly re-raising your bets, then you might fold and we might not even get to the fifth card and I'm already winning, because as soon as you fold, you give up whatever's in the pot. And so in those instances, me as the strong player, I'm just going to keep re-raising you until you show signs of strength. And when you do, then I'm going to fold because you probably have a hand. And so poker player, really skilled poker players are going to know kind of what general type of player you are. And then once they zero in on what type of player you are, they're going to start to really know the nuances, so that in certain situations, so as the poker hand is being played, there are dynamics that you've got to take into account, like where are you sitting at the table, right? So when you are raising early on in the betting process, right, you're one of the first people to act. That's generally a sign of strength. But let's say of those 9 people, you're the 7th person to act, and no one has acted before you. Now all of a sudden, the hands that you can play, are going to go way down on that hand strength, and you can raise into a pot trying to win some money without anybody actually challenging you. So there are opportunities where players can take advantage of weaker players in pretty much every avenue you can look at. And where I have really kind of come in and is that there's become less and less weak players. The education has gotten stronger. Online poker to a degree has dried up a little bit. In live poker, it's still very, very profitable. But really good poker players need to look for every edge they can. And so when their decision making is dropping, they look to me to help to maintain that.
All right. Now, I'm really interested to know, Do the professional poker players that you coach think of poker as gambling as anyone else would? You know, it's a betting game. It's held in a casino. Most people are immediately going to think of gambling. Do the professionals view it in this way still?
No, I don't. I mean, I don't know that they may have back in the 70s or in the 80s. But I think in general, if they think about it as gambling, they're not really that good. I mean, to me, and the ways that I've discussed it with them, you know, gambling is something that you're betting on where you actually don't have a skill advantage, or there isn't one that's known. And in some cases, or in more cases, it's where the skill edge is actually against you, and you're gambling because there's the opportunity to make a lot of money, you know, with small amounts of bets. So why roulette is so popular. So no, they don't think about it that way. I think the stigma in general has decreased a lot societally. It still has a long way to go, but yeah, I don't think they view it, you know, as gambling. And I think they're, unfortunately, you know, having to work hard to convince, you know, family and friends that it's not something that they should be concerned about, especially when they're making, you know, hundreds of thousands of dollars a year or sometimes millions.
Right. Okay. So, I mean, it's fair to say that they look at poker as a business and they treat it like a business, yeah?
They do, for the most part. I mean, I think one of the things that I end up having to have a lot of discussions with, certainly some of the younger players, is treating it more professionally. I mean, you know, you can think about some of them, you know, coming out of college, playing poker, they've never had a real job. They're super talented. They work their ass off for several years, grind their way up, and suddenly now have lots of money, and so then their work ethic starts to decline. They start to party more, they start to travel more, they start to burn money, you know, and they kind of take it for granted. And so, you know, it's like an athlete who, you know, had never really had to work hard, and then suddenly is faced with a declining skill set. And they've got to now work their ass off again to regain some professionalism and not lose their opportunity to continue to do great and win a lot of money or make a lot of money.
Right. Okay. You know, really good answer again. I'm really interested to know, like, what is it about poker? Like, why are you attracted to poker and why are so many others attracted to poker over other card games? I mean, is there an edge in poker which you can't find in other card games, or not to the same extent at least?
And by other card games, you mean like other casino games or card games like bridge or gin?
Other casino games, yeah.
Yeah, so what's nice about poker, right? In a casino, the house is basically charging you rake. You know, it's like some of the fees that you have to maintain your account. You know, there's somebody charging you juice to operate your business. You know, you're not getting a free ride. So the casino is there taking, you know, money out of every pot, every hand that's played. They take some percentage, and that percentage, you know, varies based on how much money is on the line. So the casino is there making money that way, but they're just providing the opportunity for you to go play. Whereas with a casino game like, Pai Gow or blackjack, the casino is there to really profit from that game in particular and the way the cards are played. And so, you know, to create an advantage in blackjack, you have to be able to count cards, and you have to have the casino, you know, structure the game in such a way that allows you to take advantage of that card counting ability, which is why people who do that really well get kicked out, because that's how the casino makes money. And if you're not, if you're getting in the way of their ability to do that, then you're going to get kicked out, you know, as, you know, morally or ethically wrong as, you know, we may think that is. You know, the casino is a private business, and they do get to make rules as long as they're not breaking, you know, state laws or governmental laws. So in poker, right, the reason that there's so much money for you as the professional is because of the same reason that there's so much money, you know, as the casino operator is in having, you know, slot machines or poker or you know, any of the other, you know, table games, which might even sometimes include, you know, like Caribbean stud poker as a card game that they offer.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved. Now, so has the way traders operate within them. Trade the Pool.
So just sort of tying this back into trading now, what are some of the most obvious crossovers that you see between poker and trading? Like I know you obviously work with a lot of poker professionals, and you're also starting to work with some in the trading field as well. What are some of the major overlaps that you've noticed?
Yeah, I'd say, and to clarify too, I mean, I feel like I'm in kind of like the year 2 or 3 of where I was with poker. So I do understand trading, and kind of like I was in poker. I played poker as a kid, understood the game a little bit, but really understanding the high level nuances of what traders go through on a day-to-day basis is something I'm still learning. So I do profess some ignorance there, although I've been steadily, as you said, increasing the number of traders that I'm working with. So the big crossover is dealing with variance, right? And I think a lot of traders have difficulty dealing with that as well. In particular, because what makes trading, I think, far more complicated than poker is the fact that the game continually changes. At least the rules of poker are fixed, and aside from any, changes that might be made, by a tournament director or by a particular casino and how certain things are handled, by and large, the rules of the game aren't going to change. But in trading, it becomes very, very difficult to know, was this the right decision? Did I actually have some, good risk reward here, or probability of that made the trade worthwhile, or was that not the case? And I was misreading the market, because the game can continually change. A lot of the traders that I work with, they are dealing with or they're profiting in very high volatile environments, and so for them, the last 6 months to a year has been somewhat challenging. That being said, right, that the adjustments that need to be made, doesn't mean that their entire trading strategy goes out the window. But the ability to continually evolve is something that poker players need to deal with, something traders need to deal with, and that challenges people's confidence. It creates frustration in that process. Frustration when you're losing money is a big thing. It sometimes can create fear. It sometimes can create overconfidence when you feel like when you've kind of found something and you get a little overconfident thinking that it's just going to continue to work without adjustment. Poker players and traders both deal with losing stretches and down stretches. They make tons of mistakes, and some people deal with those mistakes better than others. They've got to deal with focus issues, boredom. You're dealing with a market that not a whole lot's going on, and you end up starting to trade just because you're bored. You're looking for some action. In essence, at that point, you're kind of gambling. Poker players do the same thing. It's something called being card dead. So you're just getting weak hand after weak hand, and you just have to keep folding and folding and folding. And especially in live poker, it can be brutal. In live poker, you might be dealt an average of about 25 hands an hour, and it's not uncommon for you to have to fold all 25. Or if you do end up having a hand that you could play, have somebody instantly re-raise you, but you're not, your cards are not strong enough where you can continue and have to fold, soon after putting money in. So, those sorts of things can be problematic. Sometimes, well, not sometimes, but traders sometimes have difficulty transitioning their strategy from different markets. If they move from one segment or one industry to another, that difficulty sometimes is a bit of entitlement or overconfidence, thinking that the fact that they're profitable in one sector or one variant means that they're automatically going to be that way in others. Poker players do that all the time. They're doing great in no limit hold'em. They start playing pot limit Omaha, or they start playing PLO deuce to seven, another variant, and they think they're going to be great at it. And they may well be against other players who know nothing, but that sort of overconfidence can happen. Sometimes poker players get so angry when they're losing money that they'll jump up in stakes. They'll start doing things that they know are not profitable. In essence, trying to make their money back as quickly as they can. And traders obviously do the same thing as well. And in trading, it can get really bad really quickly. I think those are, I'd say, probably the biggest ones.
Yeah, absolutely. I mean, it's really funny how much of an overlap there really is. I mean, Saturday night, I caught up with a few friends, and one of them actually plays online poker, takes it pretty seriously. And, we were just having a conversation, and just the amount of things that were just so similar between the two disciplines was really crazy. I mean, it was almost as though he was a trader. We could just sort of keep that conversation going. It was quite bizarre. But, so a lot of really great points there. And, we're starting to get into the emotional aspect of it. So, this is one of the things you're an expert in, is removing emotion from decision making. Talk to us a little bit about that. Like, why would you want to remove the emotion, and what's the benefits of doing so?
Well, I guess I should qualify it and say negative emotion, or in a sense, excessive emotion, because you can be excessively positive as well, almost too happy, too overconfident, too excited, can be problematic. And the reason is because it's going to impair your decision making. That is not just an opinion of mine. It's sort of a neurological reality, and this comes from some research on the brain, and also a pattern that's been was realized about 100 years ago in something called the performance stress curve. And so, putting those two concepts together, you have a process in the brain that many people think of as the fight or flight mechanism, but that really only kind of like oversimplifies what this reaction is doing. But the basic idea is that when your emotions rise too high, they actually have the power to shut down higher brain function. So people often think about their decision making, right? The thoughts that go on in their head. They think about that space in their mind in a way that is inaccurate. That when your emotions rise, it actually starts to eat away at the number of things that you can think about and the strength of those thoughts to turn into action. So if you've ever had a situation where, like, that you should not be exiting this trade, or you should not be forcing a mediocre trade, and yet your hand still moves over and clicks exit or enter, and you're wondering, like, how the heck that can happen. Well, it's happening because the emotional system has become overactive, and it's decreased the strength of your mind to take that thought and turn it into action. And so that is the main sort of reason why we want to remove the emotion, is to be able to retain sort of full conscious control, clarity of mind, and then obviously, precision in terms of execution. So this performance stress curve basically shows the relationship between, it kind of looks like an upside down U, right? If you kind of think in that bottom left-hand corner of this graph, in that scenario, you have very little emotion, and your performance is also very low. Right, so you could think about that as a scenario where you're super bored or you're just really tired, right? Your performance is going to be poor. Well, your performance is going to be equally poor on the other side, where your emotions are super high and your performance is also going to be really bad. There, you're very excited, right? You've made a ton of money and now you're going to keep trading, right? Or you're super angry, really fearful, or greed has taken over. So in that scenario, you're sort of equally as bad, because the emotional system has done roughly the equal thing to your decision-making process. Now, as you kind of climb the hill, in a sense, to the peak in the middle, that's where your emotions are most balanced, and that's what we're after. That's the point where you're in the zone, where you're in that flow state or in peak performance. That is where there's almost no friction from you being able to access the technical expertise that you have acquired over the years, matching it with your senses of the market and being able to create those intuitive reactions where you kind of just know what's going on and you're able to make lightning fast decisions without any hesitation, right? As I said, without any friction. And so really what my job is about is, in essence, removing those points of friction. I kind of liken the mental game or what I'm doing in my job to like the oil in an engine, right? The engine is really what makes you profit. That's your skill. And if you don't have enough oil, right, too little or too much emotion, then the engine's either going to overheat or it's going to seize and obviously not perform well. But when you have things just kind of humming, that's where you're making the most money because your decision-making process is at its peak.
Very good. So, how do we get into a state where we're, as you called it, humming? Like, what are some of the exercises that you run through with the players and the traders that you work with to kind of help them keep their emotions balanced?
Yeah. So, to be fair to like what I'm trying to accomplish with players, it's not a simple thing, but it's also not overly complex. And I say it's not a simple thing because part of what I've tried to do with my work has been not to take the sort of traditional sports psychology stuff and just kind of plug it into poker or trading or even golf. And the reason I say that is because a lot of sports psychology will say block out the emotion or try to use previous experiences where you've been humming or been in the zone as a sort of a reference point to try to recreate it today. And I don't think that works long term. It might work temporarily in the short term, but something that we might not be able to prove is more than a placebo, right? Like a sugar pill that isn't really producing anything of real effect. It's just a temporary, manipulation of the mind. And so really what I'm after is isolating all of the specific reasons why your emotions are either going to be too high or too low, right? And so we look at anger, for example, as a cause of too high, or a lack of focus or a lack of motivation as a cause of it dropping too low. And we actually try to systematically go in and understand why it is that you're getting angry in those spots, why it is that you're losing motivation or focus in other spots, and put in specific corrections for those things. And as a byproduct of making those corrections, you are automatically more emotionally balanced. It doesn't mean that you're going to be permanently emotionally balanced and humming, because there's a constant evolution that exists within your skill set, within your mental game, and so there's a constant need to be improving all aspects of your trading. But at a minimum, right? Anybody that's listening right now, the first thing that you can do, and I think the most important thing to do, is to start to study your own emotional reactions that you have throughout the day, right? So often when I start working with new traders, or not new traders, but new clients, their knowledge about their skill set, or about their emotional skill set, is really poor, right? They'll come in saying, I'm losing a bunch of money here. I feel myself, kind of hesitating. I'm forcing trades here. I'm losing focus here. But when you actually start to break it apart, they don't really understand why. They don't know the specific situations in which it's occurring. They can't recognize the thoughts or the reactions that they're having in those spots. And I'm not saying that what they're coming to is not something I can work with, right? It's a start, right? So the easiest way you can start doing this is to start by identifying the specific trading errors that you have. Okay, the trading errors that you have may give you an indication that there's some emotional reaction, whether too high or too low, that's present. And when I say may, right, it's really important to know that sometimes a trading error is simply a tactical one, right? I'm not going to over prioritize the importance of the mental game, but here's where I can almost guarantee that a trading error is caused by a mental one. When you have continually made the same trading error year after year after year, and you keep trying to learn more about the markets or learn more about the stocks or the companies that you're following, you think that the solution to that trading error is more technical knowledge, then you know that it's mental, right? Then you know that there is some anger, some hesitation, some lack of discipline that is present in that spot. So basically, your C game, right? In poker, people, really just in sports, people think about their A game, right? But they don't often think about their C game, the worst aspects of their decision making. that's a really important thing for people to begin paying more attention about. What are the situations in which you suck, right? It's very easy to just say, oh, that was just, the market went crazy, yada, 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 I lost a bunch of money. Or to say, oh, that only happens once a month, not a big deal, right? But the problem is that by not fixing those mistakes, you are limiting your ability to continue to progress as a trader, not to mention the amount of money that's being lost there. So I know I haven't gotten into really specific nuances about how to actually fix this stuff, but hopefully this framework is at least helpful to get started.
No, I think that's a really good answer. And I mean, maybe if you could just expand a little bit on, something you said there about, one of the first things you should do is actually study emotional reactions and really identify your trading errors. What's sort of like, how should someone actually go about that? Like, are they supposed to keep a journal each day? Are they supposed to write this down as things happen? Or like, how do they keep track of this? So if they were to work with someone like you, they can say, well, these are the things I'm struggling with, and kind of have something tangible that they can present. I mean, is there a way that you'd suggest someone actually studies their emotional reactions, as you called it?
Yeah, definitely. I mean, I think the key word is study, right? And so that you're not assuming that it's going to be knowledge that you're going to produce instantly in one day, right? I think that tends to be the thing that people get a bit frustrated with in this process, is they sort of want to kind of know immediately, and don't realize that under, like, the mental game or mental skill is very much like technical skill, right? And any skilled trader is not going to assume that their technical knowledge is going to appear instantly. So you do have to kind of work at this day by day. So here are a few suggestions on how you can do that. Number one, yes, you can take notes during the trading day. If you're a trader who trades, let's say, less than 20 to 30 trades a day, then you've got ample opportunity throughout the day to take 30 seconds to write down the thoughts, like the specific thoughts that you had in your head around the time that you made that trading mistake, the emotional reactions. If you sense, something's going on, if you, sometimes those emotions are felt in your body. You might be, clenching your fist when you're angry. Your face might get tense. Your shoulders might get tense. You might be kind of leaning into the monitor, or into your desk. You might be leaning back if you're, kind of dismayed. So you're kind of looking to try to like fully kind of map out the thoughts, the emotional reactions, the behavioral reactions, and obviously the trading mistake and the thoughts that you had around that trading error, as a way of kind of mapping out each one of those problems. Now, if you trade at a very high frequency throughout the day, then what you're best doing is making sort of just a very, very quick note, maybe like a timestamp, whereby you can go back at the end of the day to take a greater look at it. Now, in either scenario, I think you also want to ideally be expanding upon those notes that you're taking during the trading day afterwards. So, if you want to think about this as a journal, if you want to think about it as a log, where you're just taking data down, I mean, it could be as simple as just a Word document. You just open up and date it and keep track of all of the mistakes. And then maybe once a week you go back and review them. And at that point, you're looking for patterns. My job is not that much different than your job, right? Especially those who are technical traders. You're looking at patterns within the market to understand where you have opportunities to exploit and make money. For me, I'm not looking to exploit my clients, but I'm looking to exploit opportunities whereby their knowledge is lacking, and be able to create some correction. So the first thing you're trying to do is really create a map, because sometimes, traders, poker players, golfers, who, you name it, even if they do have an idea of what their mistakes are, or even what the emotions are, sometimes their priority is off, right? And so they kind of come in saying, yeah, I've got this fear issue, but it turns out that this anger issue, it happens more frequently, and when it happens, it tends to be more costly. But the fear to them is just more obvious, because it's more kind of out of the norm for what they think is appropriate. Anger for them just seemed to be more normal, so it wasn't as much noticed until we really got to talking about it. So by looking and reviewing at your note taking, once a week or once a month or every several weeks, whatever frequency seems to make sense for you, you can start to look at the patterns and understand how costly the errors are that you're making. And look, there's a lot of good advice out there. I mean, people can pick up my book, they can pick up other books, and start to try to find solutions to these mistakes. And for sure, people are going to be able to make those corrections based on some of that advice out there. Where coaching might come in is when you just get stuck and you're unable to fix a problem that is very costly. But if it's not that costly and it's not happening that often, then you just keep working on it. But that awareness is at least going to give you the opportunity to make a correction.
Now, a lot of these mistakes you've kind of outlined here, or not mistakes, but challenges, I guess is probably a better word. Do the professionals have these same challenges throughout their career, once they reach a certain point? Like, are these ongoing challenges that constantly need attention, or is it sort of like once you kind of cross over from what might be called an amateur to a pro, do a lot of these challenges become less prominent? Like, how does that work?
Yeah, I'd say that they change throughout the course of a career. I mean, I think, you may solve an anger issue that existed when you were an amateur, and then when you become a professional, then fear becomes, a bigger issue because now your livelihood is on the line, and maybe you have a family, and so beforehand there wasn't as much on the line. Now there is, and so the nature of the game changes. So the way that I would say it is that like the mental game is always an important thing to be aware of, to be thinking about, to be focused on as a point of improvement, as a point to be improving your decision making. But the specific things that you may need to deal with within this sort of framework, may change. So it may go from having to deal with anger issues to then maybe having to deal with motivational issues. Maybe you have so much success because you solve your anger that now you're kind of you're achieving a lot of your goals, and sometimes people forget to set new goals, and so they lose motivation for as simple a reason as that, and that's happened to certainly poker clients of mine, and as well as trading clients. So you think of it more of as the evolution, but I can't say that there's any particular pattern that exists that is sort of purely amateurish type mistakes and purely professional ones. People are people, and they kind of come into an endeavor, with a set of issues that they're bringing from other things in their life, and those issues tend to play out, in that environment, in poker or trading or golf or et cetera, and where they tend to not get fixed, they tend to kind of remain and linger, and then there are sometimes, certain ways of thinking that you bring from everyday life into trading that are kind of antithetical or don't match with the realities of it. For example, understanding of variance, right? I don't typically think of that as like a mental game issue, per se, as much as it is as a flaw in your technical understanding, because it would be like a business person not understanding, their expenses. I mean, that's like a fundamental component of being a successful business person, right? You've got to understand where your income is coming from, and you got to understand, what your expenses are and where that's coming from. So if you don't understand variance, then you're not really understanding a fundamental business expense. So I tend to think of that less as a mental game issue, but my point in general is that these issues will tend to just evolve over time. I mean, I had a conversation with one of the top poker players in the world recently, and we were discussing something that was very, very similar to what weaker poker players deal with, even successful ones, which is self-criticism over mistakes. This player's mistakes, the weaker players would love to make mistakes that good, but his difficulty dealing with mistakes, was causing a lot of frustration. It was limiting his learning, and it was affecting his overall mood and mentality and the frequency with which he was going to play. And it wasn't costing him as much when he actually got there, but it was something that he didn't want to keep around. So that dealing with mistakes was something that he had to deal with, and something that much weaker players have to deal with too. So it's much more about evolution than it is about sort of pure kind of categories of where they are.
Yeah, and I understand that one issue that affects traders or poker players of all levels is something you refer to as tilt. Would you mind sort of describing what is tilt and how to recognize when you're actually, as you call it, on tilt?
Sure. So tilt, there's kind of a couple definitions for it. One was the definition that was there before I came into poker, which was tilt was pretty much any reason for you to play suboptimally, right? So you're making decisions that are less than what you would consider to be your best. And so upon studying, poker players and their descriptions of tilt, for several years, I really realized that, 80+% of their descriptions tended to be about them getting angry and making bad decisions. And so for me, tilt is just another word for saying anger. For a lot of poker players, they'll say, tilt is anything, as I said, less than playing your best. But what if you're drunk? What if you're tired? What if you're fearful? All of those reasons are going to need unique solutions to them. So, anger is really the biggest one. In trading, I would call the equivalent greed and fear, and maybe to a lesser degree, loss of discipline. They tend to be the words that traders use most often to describe their mental game issues, when I don't think that they're actually experiencing greed nor fear or a lack of discipline, that it's something more than that. But within poker, what I did was break down 7 different types of tilt, or 7 different types of anger that would exist. One was running bad tilt, which meant, players were losing for several days in a row, sometimes weeks or months, and they were, just getting crazed as a result of it. And the solution to running bad tilt has to do with the understanding that emotion accumulates over time. Okay, the brain has a mechanism by which it can, in essence, digest emotion. Right. So you have a stressful day, you got angry one day, and so you go to bed not in the greatest of moods, but you wake up the next morning, you feel fine. Right. Nothing bothering you. You feel it's like a normal day. Well, where did the emotion go? Right. In essence, the brain has like a stomach that digests the emotion, much like it would the actual stomach digests food. But what happens is when there's like a really emotional day, or then you might go to bed and your sleep might even be disrupted, in part because your brain is digesting all that. And then when you wake up the next morning, you don't feel quite right. It's almost like an emotional hangover, so to speak. And so when you start that trading day, or the poker player, goes down and sits to play poker again, they're not starting with like an empty cup in a sense, right? Their tilt threshold, their threshold by which the anger is going to affect their decision making has been lowered, right? Or their emotional level has already risen, however you want to think about it. And so in essence, it's going to take less tilt-inducing stuff to get them pissed off to the point where they're going to make bad decisions. So dealing with that accumulated emotion becomes really, really important. And so for traders who have this particular issue, one of the best ways that you can start to break apart that accumulated emotion is to do some journaling, is to write. And the writing, the purpose of it, first and foremost, is to get out of your head what those emotions are, right? You go have a couple beers at the end of the day, right? You're going to feel better, right? But are you going to actually get rid of the emotion? Probably not, right? So venting to other people, has a way of getting the emotion out, but it's also not as productive. So keeping things inside is not a great thing. When you vent on paper, what you do is you give yourself a record of the emotional reactions that are occurring, and that becomes helpful when you go back and look at it a day or two later and you see, like, what the hell is going on here? Why am I getting so pissed off? And that's an important question to ask, regardless of the mental game issue that you're dealing with. In particular, we're talking about tilt. Why is it that I'm getting so pissed off here? Is it because I just can't deal with losing this many days in a row? And so then you're able to start to solve things. But at a minimum, you can start to deal with running bad by just getting that emotion out and minimize the accumulation day by day so that you can give yourself a chance to kind of reset. The next type of tilt I talk about is called hate losing tilt. I should have actually called it competitive tilt in retrospect, because like traders, poker players, you're going to lose a lot, right? And for people who are competitive, especially those who are athletes or were in any kind of forms of competition earlier in their life, they have more control in those other avenues. They've been more successful. And so they have more control over winning and losing. So not only do they hate losing, but now they've entered a profession where losing is built into the fabric of it, and it just pisses them off. There's no way around it, right? There's a lot of competition. Well, what you have to do there is have to really start to understand exactly what it is that you're competing for. and that's how you can start to correct it and reframe the nature of the competition, right? And so, you can look at your goals as being something that you're competing for, sometimes confidence or good feelings, emotions, you're competing for. And when you start to understand exactly what the nature of the competition is, you can start to round out some of the edges that will create those problems. Injustice tilt, entitlement tilt are two ones that I've mentioned already today. Mistake tilt, revenge tilt, kind of always a fun one. In poker, that would be a particular player is just constantly beating you, or they say something or do something that kind of just annoys you, and then they beat you, or a particular player who has just gotten the best of you, time after time after time, and they, now just hearing that person's name gets you pissed off. As I mentioned, right, trading is a little bit less personalized than poker is, but revenge trading definitely exists, in a way of trying to get the market back for screwing you, right? So maybe less about a person and more about getting the entire market back. And then the last one is called desperation tilt. And this is where I would say there's a line drawn between a performance issue, right, versus an actual gambling problem. And this is a very important distinction to make for some traders and poker players to make, right? A performance issue means that what you're doing, and let me describe first. So desperation tilt basically means that when you are so desperate to recapture your losses that you'll pretty much do anything, right? You're going to increase your bet sizing. You're going to enter trades that you're going to start placing bets in industries or in names that you don't even know anything about, right? It becomes more pure gambling in a sense. That desperation to win overrides all logic, and you do a lot of stupid shit that you're regretful of, the next day or even later in that day. When it's a performance issue, you can handle those losses. You can handle all the dumb stuff you've done. When it's a gambling issue, now you're betting with life savings. Now you're betting with money that you borrowed from friends. Now your life is becoming impaired, and that's where you've got to really look in the mirror and say, do I actually have skill in this game, or am I just a degenerate gambler? And fortunately, most of my clients have been in the former category where it's a performance issue and we are able to correct it. But if somebody has, a gambling problem, like I mentioned, I refer them to somebody locally because it's not something that I work on.
Yeah, okay. So, I mean, a lot of these kind of characteristics or personality traits or issues, whatever you want to call it, how much of this do you think is sort of tied back to or as a result of earlier experiences in life?
I think a handful of it is, not all of it. I think there are certain, so I had a trading client recently who, just had a really chaotic relationship with his father and his mother, right? And had been in therapy before, thought he had resolved these issues, and comes to me several years later, really struggling to be consistent, right? Making money, losing money, knows he's got an edge in the market, but when the losses start to mount, it's like something just totally hijacks his brain, and he's unable to maintain control, and so the losses mount and kind of override whatever gains have been made. There's a clear-cut case where, prior experience, there's almost like a larger version of accumulated emotion at play here, where emotions from earlier in your life are triggered, during the trading day, right? So you're not really kind of dealing with a fair situation, right? The emotions from years ago kind of live in your mind, and they get triggered and quickly flood your ability to think clearly and make clear decisions. But then we have other sets of issues like, perfectionism or high expectations or difficulty handling mistakes or some illusions of control, illusions of permanence that, certainly, emerged through our lives or through their lives, but never really were that problematic, right? There was never something in their life that they took as seriously as trading or as poker or as golf. And so it's in that stress that these sort of flaws in our psyche and in the way that we approach learning, the way that we approach performance, and the way that we even think about trading, start to emerge, right? So, sometimes, especially for those traders that have been around for 10, 15 years, sometimes you're making trading mistakes. Sometimes you're making psychological mistakes. in regards to trading because it's something that you learned, 10 or 15 years ago. And it turns out that knowledge is still kind of lingering in the back of your mind and just pops out at inopportune times, right? So one example would be, thinking that emotion is the cause of your problems. And so you've sort of blunted or like try to deny or avoid, the anger that you've had. So you just kind of keep stuffing it away and suppressing it, trying to avoid it. And so that way of thinking, causes these big blowups, right? But it's not like you have like major flaws that are causing that anger. It just means that you haven't actually dealt with it all of these years, and it just keeps popping back out. But and the flaw regarding that anger might be due to your weaknesses in understanding variance, or your weaknesses in understanding what you can truly expect of yourself, or what you can expect of the market. So sometimes it is early, and sometimes it's more of these sort of pure performance issues, like I mentioned.
Yeah, right. Okay. Some of the things we've talked about here, I'm thinking might be a little bit overwhelming to someone who's just come into trading, might have only been trading for, let's say, 6 months. At what point in someone's trading career is psychology really important? Like, when should they start to pay attention to it? Like, is it worthwhile getting stuck into it right at the beginning? Is it best to do it maybe once you have developed a strategy of some type? Is it important when you're scaling up?
Yeah. No, it's a really good question, and I think psychology in the bigger scale has been oversold to a lot of people. I don't think it will ever be more important than your tactical knowledge. So the shorter answer is, if you're somebody that doesn't have any major issues, from earlier in your life, then psychology is not important to you, or it is at a very minimal scale, only something maybe in the neighborhood of 5% of your time, ought to be devoted towards it, until you've developed a profitable strategy that you can prove. Because at that point, if you're getting angry, it's more likely that your anger is a symptom of maybe high expectations of yourself, or something that is going to be related to, earlier in your life, not something that emerged from trading, because you're not good enough yet for that to occur. So you're basically looking at the prior issues as occurring there, and that's not a trading thing, right? So you may need to deal with some psychology, but don't deal with it within the context of trading per se, right? Wait until you've developed a winning strategy to do that. And so then the question becomes, like, once you've established that strategy, and you can know that, yes, this is a trading error that is not being made because I actually don't know any better, right? I'm not losing discipline because I don't know better. I haven't proven the strategy. Sometimes people, lack discipline because they're not certain of what their strategy is. How can you be disciplined about something that you're not certain what the rules are? You can't be, right? Discipline is something that is measured up against your goals, measured up against the points of responsibility that you're taking. And so without that being super clear, it's impossible for you to be perfectly disciplined. So that's an example where, trading knowledge is really important to have. And so then once you start to see that your trading errors, like I mentioned earlier, are just not getting fixed, right? That there are certain things that are recurring. You're recognizing that, yeah, I keep making this same kind of mistake. I'm exiting this trade too early. I'm, in the market more often. I'm just sort of, over trading because I'm bored, and it's happening too often. That's when you know that the mental game or psychology is becoming more important, and that can happen at any point. Now, you mentioned sizing or scaling up. This is a really important concept. It's kind of like moving up the ranks, in baseball, or the difference between competitive sports played in the regular season, whether we're talking about football or American football or basketball, golf, right? Kind of the regular season stuff versus the playoffs, and then the playoffs versus the World Cup final, the Super Bowl, or the Masters, the back nine on Sunday, kind of thing. As you increase those, or in essence, scale up, you have greater likelihood for your weaknesses to get exposed, whether they be tactical or mental. And too often people kind of fail to consider that reality when they are sizing up or as poker players would do as they jump up in stakes as well. And it's important to have a good understanding of what those are, right? And so what I coach my players or traders to do is to always understand what their C game is, always understand what their biggest weaknesses are. And when they're sizing up, when they're jumping up in stakes, when they go and compete in some bigger events, that they first and foremost have a really good strategy, one that they know very well, for correcting those mistakes, because those are most likely going to be the things that are going to trip you up. And if you can actually make the corrections to those mistakes in those instances when you're sizing up, then you actually go a long way to really internalizing or mastering the corrections to those mistakes so that they can actually go away and not become problems anymore.
Mm-hmm. Okay. No, that's really well said. And I think that's a really honest answer as well, especially coming from, someone like yourself who's working in the field, to say that it's maybe not the most important thing to be focusing on right at the very beginning. So no, I respect that.
Yeah. I think. Sorry, I just have to jump in one more point, because I think there's a lot of places that like psychology is oversold. Like when I got into golf, right? Golf was 90% mental. Like that was the thing that people said, and so it just made intuitive sense to me. Like, well, why isn't everybody not focused on this psychology thing? Well, it turns out it's not that important, right? How you swing the golf club is the most important thing. How you make decisions at the trading, in trading, is the most important thing. Because if psychology was 90% of the game, then the Zen masters, the Buddhist monks, the meditation teachers, look, they should be the best golfers and the best traders. The Dalai Lama should be a great golfer, but they're not, because they don't have the technical skill. Yeah,
that's really well said. Let's just do a couple questions that came in through the Chat with Traders Facebook group. For anyone listening, if you want to join the Facebook group, it's totally free, of course. chatwithtraders.com/Facebook, and just follow that link and hit the join button, and I'll, of course, let you in. But yeah, I posted in the group to say that I was having you on, and if anyone had any questions for you. So we'll just take just a couple of those. One of the first ones here is, would playing poker help as a developing trader? So for someone who hasn't played poker, has no poker experience, is it going to be beneficial for them to learn the game in order to become a better trader?
I guess it would depend on how long they've been trading. It sounds like they're fairly new to trading, so I would say no, because it's just going to be more of your time divided. If you're a seasoned trader and you have an interest in poker, then I can't see how it could hurt at that point. Think of it like cross training. Football players playing basketball players, playing soccer or whatnot. So there is that cross training effect that can occur. You can learn things in different ways, but I certainly wouldn't advocate for people to split their time up, because you only have so much of it.
Another one here is, I guess this is probably more for intraday traders, so guys who might be sitting in front of the screen for maybe 8 hours at a time with pretty high, who need to be alert and aware of what's going on. What tips can you give them for maintaining concentration throughout the trading day?
Yeah, so I would start to, number one, spot the trends in where those dips are occurring, because it's going to occur in some pretty predictable patterns. The dips may occur because the market just kind of gets flat for half hour, an hour, and so after 10 minutes, your attention seems to lag. It might occur after a big loss or a big win. It might occur predictably at 11 a.m. Every day. So once you have an understanding of that pattern, you can start to understand again, well, what's occurring there, right? If it's the 11 a.m. dip, then maybe it's something physical. Maybe you're hungry. Maybe you're not drinking enough water. Maybe the caffeine from the morning has worn off, and you need to drink more of it, which I'm not something I'm advocating for. but you need to do something physical to boost your physical energy, and so your solution there, again. When we're talking about boosting attention and focus, from a psychological standpoint, we are mostly focused on goals. Okay? Goals define the direction of our focus, and the intensity of that concentration can be dictated or corrected when you sort of reconnect to your goals. It's kind of like an athlete who a commentator might say, is digging deep, right? There's moments where the momentum has kind of shifted against them, and they dig deep and pull out, some strong performance thereafter. what's happening when they're digging deep? I think they are reconnecting to why it is that they care so much. So as a trader, what I would suggest doing is writing down your short-term goals or your long-term goals, whichever one you think is going to give you that little boost of inspiration. And so, number one, when you're able to recognize that your focus is dropping, it's important to act at that point, right? So when I was discussing earlier that performance stress curve, the farther down you fall, whether your anger is rising too high, or in this case, your focus is dropping too far, the farther you fall on either side, the harder it is to climb back up to the top. The quicker you can catch yourself, the easier it is to climb, and it's just pure distance, right? It's like if you're climbing up a mountain and you fall, 10 feet versus 100, right? You're going to obviously climb up faster. So that's the idea here. Spot the trend quicker, and then in that moment, take a couple deep breaths and remind yourself of your goals. Perhaps even read them out loud. And in that moment, start pushing yourself to maintain focus, much like you would push yourself if you were in the gym trying to lift more weight, right? The gains that exist or that occur when you're in the gym occur when you actually have to force something, right? If you only do what comes easily in the gym, you don't get stronger. So if in this case you're trying to increase your mental capacity, your endurance or your focus, you've got to push yourself, and you've got to push yourself in those moments. Those are your weak spots, and that process is how you can push yourself in a way that's going to get you more focused. Now, one last piece here, which may be really helpful, right? Just forcing yourself to focus more doesn't automatically mean that you're going to make sound trading decisions. So what you may want to do is look for the typical mistakes that you would tend to make at that time, right? If it's purely, yep, I'm just kind of dial tone and I'm not even really reading the market that well, you're not, you could autopilot the market, right? To a certain degree, right? If there were huge edges to be seen, you're going to spot them, just by sitting there, right? It becomes more of like the nuanced stuff that you miss. And so you want to come up with a couple reminders of key things that you ought to be focused in on, at that time. So it's recognize that your focus has dropped, take a couple deep breaths, remind yourself of your goals, push yourself to be more focused, and then remind yourself of a couple technical reminders so that you can actually make some sound decisions.
Really great advice. So that was a really phenomenal answer. Just one last question that also came through in the Facebook group. What are your thoughts on meditation? I think you're probably the right person to ask about this, seeing as you're in the psychology realm. What are your thoughts on meditation?
Yeah, it's an important question, and I'm glad it got brought up because meditation is something that's taken off recently, mindfulness, and I think for good reason, but like a lot of things, it can be oversold. So meditation can be really good to help to build mental strength, in essence, like control of your mind. It can be really good for gaining self-awareness. So the task that I was asking people to do earlier, it allows you to create greater presence, allows you to sort of like look inward and understand your thoughts better, understand your emotional reactions better, understand what's triggering your emotional reactions. Beyond that, the way it gets oversold is that people use it as a solution to their anger problems, to their fear, to their, lack of discipline. And in general, it's not, right? If you're using meditation in that way and you're also, doing some direct psychological work on your anger, then yes, it's totally appropriate. But you don't want to use meditation as a covering, as like a way of avoiding or blocking out your anger, because it's not going to solve it as deeply as it needs to be, to the point where it disappears for that particular reason. So you have entitlement tilts, right? Or you have a difficulty dealing with long stretches of losing. Well, once you understand what that difficulty is, then making that correction is going to fundamentally alter your reaction to those situations in the future. It's kind of like taking a bomb and diffusing it. The bomb can still be there, but it's not going to actually blow up, right? Whereas meditation almost like puts sand over the bomb, so now it becomes a lot harder for it to get triggered. But ultimately, in the long run, that's going to limit your upside mentally, because you're not actually really growing. You're just growing mental strength. You're not actually resolving problems that are going to free up mental space. And just to clarify that last point, when you have these mental issues kind of running in the background, right, and they are unresolved, they're not solved, they're just blocked out, protected, avoided, whatever, it's kind of like your computer with programs running in the background, right? So all of a sudden your memory, your resources are being consumed, but nothing's open on the desktop, right? So your computer is not going to function quite as crisply, not as sharply. Things might be a little bit slower in spots. That's the consequence when you don't resolve mental game issues. And frankly, it's the same consequence when you don't resolve technical issues, right? Your C game, right? So that's why it's so important to become aware of them and correct them directly. And meditation can be a tool in the process of that, but it is not generally a solution in itself.
Awesome. Well, I've really enjoyed this conversation, Jared. I mean, I think a lot of what you've shared with us is really good insight. Me personally, I think there's a lot of psychology stuff out there I don't really relate to too well. I find it a little bit wishy-washy, but I mean that's just me personally. But I think like what you've spoken about here is really tangible, if that's the right word. I think it's really sound advice. So no, I really appreciate you for coming on. Thanks a lot for doing this.
Absolutely, Aaron. I appreciate that feedback because that's frankly I was a consumer like that too. So I've kind of made my program the way that you described for personal and professional reasons.
Yeah, no, that's really cool. So where's the best place that listeners can go to find out more about you?
Yeah, they can go to my website, jaredtendler.com. They can follow me on Twitter at jaredtendler. If they want to check out my poker website, it's jaredtendlerpoker.com. And I'm also on Facebook, but primarily just for poker. I don't use it a ton. It's Jared Tendler Poker.
Okay, and you've also got a couple books out as well, don't you? Do you want to share those?
I do, yeah. So I've got the Mental Game of Poker 1 and 2. The first book covered the main mental game issues, tilt or anger, fear, motivation issues, and confidence issues. And then the second book dealt more with peak performance or the zone, got into really efficient learning. Over the years, I've had to become an expert in learning because to correct your mental game issues is a learning process. So there's a lot of information in there to actually improve your learning efficiency. And then it also gets into decision making, goal setting, focus, and mental endurance. So it's kind of like get rid of the crap in your game, and then volume 2 is let's see how good you can become. And I will say too that the books are available both in softcover, ebook, and also audiobook. And the audiobook you can get for free, and there's information about how to do that on jaredtendlerpoker.com /free. Basically, you just sign up for a free account on Audible, and you can get your first book for free and make it my book.
Awesome. Okay, well, I'll link to that in the show notes. Both of those. And you've also got a podcast as well, don't you?
I do, yeah. It was recently a very mental game of poker focused, but I kind of got bored of having the same conversations with professional poker players. So in the last 8 months, 8 to 10 months, I've started expanding it out and interviewing kind of mass market authors. Like I had the author of a book, Deep Work, Cal Newport, who wrote a book that I highly recommend about focus and depth in work. On the show, and there's been authors or professionals like that in kind of all walks of psychology. So that's on iTunes and on both websites.
Awesome, very cool. Well, I'll of course include links to everything we've just mentioned here at chatwithtraders.com, so you can find everything there in one place as well. Jared, once again, man, thanks a lot for doing this. I truly appreciate it.
Absolutely, Aaron. It was great to talk with you. Thanks for having me on.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Traders, what's going on? I'm pleased to have you here. Let me introduce this week's guest. This week on the podcast, I spoke with Tom Sosnoff. Many of you will already know who Tom is. He's a pretty popular name within the industry, but if you don't, Tom was a floor trader on the CBOE for roughly 20 years, before going on to co-found Thinkorswim, a very popular trading platform and brokerage. In 2009, Thinkorswim was sold to TD Ameritrade for approximately $606 million. Tom left the company shortly after and started financial news show Tasty Trade. Anyone who has watched the show knows Tom is very opinionated, and he didn't tone it down for this interview either. Having listened back over this episode afterwards, I am a little disappointed I didn't push him for more depth on some of the bold statements he does make, but I guess that is hindsight. Anyway, in this episode, we hit on the issue with being too risk adverse in markets and in life, Tom's extensive trading career, plenty of talk about options, the value of intellectually challenging ourselves with respect to finance, and much more as well. Now, just before we roll into the interview, I do have something very cool to share with you. For the first time, Chat with Traders t-shirts and also hoodies are now available with 2 designs to choose from. But these are only available for a limited time, so you have until September 2nd to purchase. Otherwise, unfortunately, you will miss out. To view and purchase the t-shirts, you can go to chatwithtraders.com/t-shirt. Now, there's no dashes in that. It's just chatwithtraders.com/t-shirt. Both the t-shirts and hoodies are printed on American Apparel, so they're premium quality and very comfy to wear. Again, that's chatwithtraders.com/t-shirt to treat yourself. All right, this is episode 87, and here is my guest from Chicago, Tom Sosnoff. I noticed you did a TED Talk last year, being 2015. I mean, what was that like? That must have been a pretty cool moment in your career.
It was okay. You know, it was weird. I got there, like, they had me come at like 6 o'clock in the morning, and I didn't go on till like 11. And by the time I got on, I was already done with that. I was ready to get out of there. So after walking around for 5 hours there, I kind of lost a little interest. It was okay. The clock I had in front of me wasn't really giving me a good time, so I thought it was okay. Not my best.
Sure. Well, I mean, I really enjoyed the talk, and I want everyone listening to this to actually check it out. I'm going to link to it in the show notes. But one of the things you spoke about during that TED Talk I thought was really interesting, and that was, and I'm hoping you can share this story with listeners just briefly, was the story about how you started out as a golf caddy and the game that you used to play with everyone there. I understand it somewhat shaped your risk tolerance and your respect for probabilities. Would you mind sharing that with us?
Well, it's funny because I like to feel like I had way more life lessons when I was 14 and 15 years old from an old caddy master named Jimmy Rocco. I don't even know if he's still alive today, but he would clean me out of. They used to call when you caddied 18 holes, they'd call it a loop, right? And I was just a kid. I was maybe, like I said, 14, 15, and 16. And we had to do 2 loops on the weekends. Otherwise, you couldn't go out in the morning, because there wasn't enough caddies. So we'd have to go 36 holes. And I felt like every dime I made, it was all cash back then, too. And I felt like every dime I ever made, Jimmy Rocco took from me. So it was a cheap life lesson, as they say. But he cleaned my clock for a couple of years before, I finally got some money back from him. But he used to used to pick us off with chipping into a bucket for quarters, and yeah, it was a pretty good life lesson. We were all just a bunch of dumb kids, and Jimmy Rocco was a total grifter, and it's good life lesson, as we say.
That's awesome. So how did the bucket, I don't know if you want to call it the bucket game, but whatever it was, how did that actually work? I mean, you flipped a coin into a bucket, and whoever could chip the ball into the bucket got to keep all the coins. Is that right?
Yeah, so back then, we would use, like, you remember like going to a carpet store and buying a 2-foot carpet sample. Mm-hmm. So what Jimmy Rocco would do is he'd go to this carpet store in the neighborhood and he'd pick up a bunch of sample carpets, maybe like not really shag carpets, but just like a little bit of a soft carpet, because they didn't have AstroTurf or something like that back then. And he'd put down a carpet on one side, and about 15 or 20 feet away, he'd put a garbage pail with no wall behind it. And what we'd have to do is, if you wanted to step up and there'd be balls there and clubs, and if you wanted to step up with a sand wedge and chip it into the bucket, you had to put a quarter into the bucket first. And so he'd be behind this, caddy masters were always behind some door, behind some screen or something. And he'd be sitting there watching all the caddies, and there'd probably be like 100 kids or 50, 100 kids, whatever it was. And we'd all take our turns, and we'd walk up, throw a quarter in the bucket at a time, or, 2 or 3 quarters, whatever change we had on, and take our shot. And if you made the shot, you got all the money that was in the bucket. And we just wanted to make the shot, and he just wanted our money. So as soon as he saw enough money in the bucket, he'd come back out, throw his quarter in, and the guy was a great golfer, and he killed us every time. Every time he shot, he made one. So, And
it'd only take the shot if the bucket was full.
If there was enough quarters to cover the bottom of the garbage can.
Yeah, so he was a smart man. Very
well,
cool.
Yeah, I mean, at the time, it was money to him. It was personal to us.
Yeah, absolutely. I can imagine.
Yeah, after my experiences playing golf, one of my favorite stories with him, since we're on Jimmy Rocco stories, is he convinced me one night as I was getting older. I was probably like 18 or 19. I don't know, maybe 17 or 18. I don't remember what I was, but I was playing golf at that point on like the golf team at my high school. And he convinced me that I was a better golfer than him, even though he was a great golfer. And one night we went out and played 9 holes, and he made me give him a half a stroke a hole, and he shot a legit 31. And so I was giving him a half a stroke a hole on a par 36, and he shot a 31. Needless to say, I lost all 9 holes, and I owed him my caddy money for the next 3 weeks. So
that must have been devastating.
Well, in the long run, it was relatively cheap for me. Those were cheap lessons. Probably made me into a better trader. Mm-hmm. So who knows?
Yeah. No, absolutely. I mean, that's the sort of thing that sticks with you for sure.
Oh yeah, for definitely a whole life.
Yeah, and also in your TED Talk, I found it really interesting. You spoke a lot about risk, and not even just risk as in risk in financial markets, but just kind of taking risks in life, which I thought was really interesting. So, I mean, I really want everyone to check out your TED Talk. Like I said, I'm going to link to it in the show notes. But
I think people are generally, especially this generation, people tend to be really risk averse, and I think it's a big mistake. And when we were growing up, and I was in my early 20s after I finished college, I kind of had the mentality, we didn't know, there was no such thing as entrepreneurship then, so we really didn't know, we didn't know the difference between taking risk and not taking risk, but we kind of figured out that, if you're ever going to do something in life, if you're going to take your shot or whatever it is, you probably want to do it when you're younger. I think that's more common sense than anything else. And so, we were willing to kind of roll the dice. And I think today, with tons of debt from higher education, with just a lot more pressure on you to succeed and everything, people are a lot less willing to take risk. And I think that's really changed the environment around risk-taking and the environment around entrepreneurship and some of the creativity that's out there today among millennials.
Yeah, so that's actually something I wanted to ask you. I thought it might be interesting to get your take on how do you differentiate good risk and bad risk-taking? Is there a difference between, being I don't know, having that entrepreneurial spirit and going out and getting it and just being careless? Is there any difference between good risk and bad risk? How would you differentiate that?
Well, I think when it comes to in the trading world, I think that there is, anytime you're in a highly efficient marketplace and you're able to assign real numbers to real numbers and real probabilities, because in other words, if something's tradable, it has real markets and real probabilities. And then I think there's a difference between high probability and low probability, which to me is a difference maker with respect to what they call real risk. Meaning that, it's healthy to learn how to be successful. I think I think when you're taking, different kinds of risk in life, it's a little harder to assess what you're calling real risk. Like in other words, something has a 95% chance of success just in general. Like, I have a 99% chance of driving home tonight and not getting into an accident, or maybe 99.9% chance of driving home tonight and not getting an accident. But then what are the risks, if I was to get in an accident? You know what I'm saying? Like, I don't know if it's efficiently priced. Like, car insurance is not efficiently priced. Hurricane insurance is not efficiently priced. It's probably 80% over. So I think a lot of the risks that we take in life, generally speaking, are not efficiently priced. So I think one of the problems that people have with taking risk is they generally lose. And the reason they lose is because there's no context around that risk that you're taking. In the world of investing and trading and everything else, and the stuff that I love to do, there's so much efficiency around pricing that you can put real context around risk, and therefore it's a whole different game. And that's what I love about the business.
Okay, well, let's get into that. So, I mean, how did you get into trading? Like, where did you start out?
Right after college. It's really the only business I've ever been in. I got a job right after college. I graduated in college the summer of 1979, and in the fall of 1979, I went to work for Drexel Burnham. 1979, 1980, and 6 months later, I moved to Chicago to come out here to trade.
Okay, so a couple things. I believe you graduated with a degree in political science. Like, what actually attracted you to financial markets? I mean, those sort of seem like two totally separate things.
Well, remember, 1979 was a time when gold was. I don't know. How old are you?
I'm 25.
Oh, you're 25. Okay. Well, you're in between my kids' ages. So I have a 23-year-old and 27-year-old. So 1979 was the year that gold and silver were exploding. This was the Hunt brothers cornering the silver market. We were in a real recession. Interest rates were approaching, 20% in short-term rates. Long-term rates were higher. Gold and silver were exploding. There was chaos. The markets were dead. There was nothing going on. And we were in a real recession. Kids coming out of college, you would take any job you could get at the time. That's just how we all, there wasn't anything out there. They weren't searching for, 22 and 23-year-olds. And, so I would go to any interview I could. My first choice was to work for a lobbyist in either state government or national politics. And I wanted to, hopefully get a job with a lobbyist or a politician and learn my way, whatever that meant. But the job interviews that I turned out to be best at were in the world of finance. And the first job interview that I really had was to go to work for Drexel. And, at the time, you kind of bullshit your way through. And turned out, that was a better field for me. And then the first time I went and visited the exchanges in Chicago, which was the Chicago Board Option Exchange, I walked on the exchange, and 30 seconds later, I'm like, this is where I want to be. This is the coolest place in the world, so I want to be here.
No doubt, no doubt. Okay, so, I believe you were only at Drexel Turnham for a short amount of time, and then they actually went bankrupt. What led to their bankrupt? Like, what went down there? And
Well, I was actually there only about 6 or 8 months, but when I left there, they were an extremely rich firm, and they were not even close. Their bankruptcy was all around the junk bond crisis. And I don't know if you remember the whole Michael Milken incident, but Michael Milken kind of created the junk bond era, and he was a Drexel person that made hundreds of millions of dollars. And in the downfall of Michael Milken came the downfall of Drexel Burnham, and so. The reality is that it was much more of an isolated situation tied to one person, and that was probably in the mid '80s. It was a long time later. It was probably 5 or 6 years later. I had already left the firm, and I was already in Chicago, kind of making a name for myself on the floor of the Chicago Board Option Exchange.
Okay, got it. So when you did go to the CBOE, I mean, where did you start? Like, how did you learn how to trade, and what was your learning curve like there?
Oh, I'll never forget. I got to the floor, and I was backed by a couple of guys from New York that I met at Drexel that wanted some young kid with no ties to go to Chicago. I was 23, and so I didn't have any ties. I wasn't married. I had no reason not to come to Chicago, so I packed up my car, came to Chicago. I was on a seat the very first day that I came out here, and I walked onto the floor. I had no idea what I was doing, where I would go. I didn't understand a thing anybody was saying. So I picked a crowd where there was not that many people. I remember at the time it was a National Semiconductor, and which the symbol was NSM back in the day. They're no longer in existence. And I walked in the crowd, and there was a guy there that was from the same hometown as me. And I walked up to him, and first I walked up to his clerk, who happened to be about the same age as me, and we're still friends today, 35 years later. And I said, "Hey, we're from the same town." He said, "Hey, how you doing? I'm here clerking for my brother." So I walked up to his brother, who was in the crowd. He was trading, and I said, "Hey, we're from the same town." I put up my hand to shake it, and he goes, "Fuck you." And so I knew right there, okay, this is not going to be a picnic. And I figured it out really quickly. The trading floors were lots and lots of alpha males, very tough kids, all independent, all strong egos, and it was the kind of thing where they were all grifters, and they were nice people, but they were just all the same makeup, and it kind of fit my personality. I fit right in, and I spent the next, I figured it out after a couple months, and I spent the next 20 years there.
Okay. So a lot of your learning was essentially sort of almost like a trial by fire sort of scenario.
Oh, absolutely. No, they throw you in there. Over the years, I hired lots of traders, hundreds of traders over the years, because that's how I got a job. Somebody, backed me. And so I figured, when I started making money, I have no problem, trying to back others. And we hired kids that were going to go on, for PhDs and brilliant, MBAs, and some of the smartest people around that never were successful. And we hired, professional wrestlers, professional football players, you name it. Over the years, we tried everything. There was no miracle formula for floor traders. Some people had it, some people didn't. 3, 4, 5% of the people made it. And I was lucky. I was one of those people. That's all. It was just luck.
The guys who backed you initially, did they offer you any sort of guidance or mentoring, or was it?
No, nothing.
Okay.
Absolutely nothing. It was a total, but I didn't even offer that to the people that we hired, because we didn't know, we said, "Hey, listen, go down there, go make some money." And, we used to, in hindsight, we used to laugh about it, but really, we didn't offer much. It's kind of hard to explain. It wasn't a business that, there was only a few outliers. And for everybody else, it was, we were pretty much trying to survive at the top of the pack. There was a couple of outliers that made it to a different level. But for the majority of us, we were the best of the rest type of thing.
So were there any major realizations you had during your time on the floor that made a significant impact on the way you traded?
It's a very fair question. I think over time, we definitely tried to think outside the box a little bit, meaning that we tried to do things like we managed money, we built our own technology. I was never one to sit still. So we managed money. We built prop trading firms. We built new technology. We did program trading, which was like the precursor to high frequency trading. We tried everything throughout the years to see, what will take us to another level. So I never sat still, but my takeaway was always the same for me. I tried to outwork everybody because I knew I couldn't outsmart everybody, so I tried to outwork everybody.
I like that. Have you always had this quantitative way of looking at things that you do now? I know on Tasty Trade you're often talking about things in a very sort of quantitative manner. Was that always the case?
It probably didn't start that way for me until late on my floor trading career, and really as we started to build Thinkorswim. During the process of building Thinkorswim, I learned for the first time how to articulate the business and how to talk about the things that we were doing, and also how to put context around everything that we were doing. So I would say that, in fairness, it wasn't in the first 20 years of my floor trading career, my goal was to make money, and was to put myself in a position where I could choose what I wanted to do, at a different point in my life. And we got to a point where we had made enough money where we could go out and build Think or Swim. So that was what we chose to do with our capital, and we rolled all the dice and built an amazing firm. And at that point, I started to learn about the quantitative side, about the idea that there could be real probabilistic outcomes, that everything was as efficient. I always knew everything was efficient, but I didn't know that you could take that efficiency and apply it to scalable technology and to predictability with respect to outcomes.
Right. Well, I'm very keen to hear more about how you started Think or Swim and that whole journey in just a moment. But I'd really like to dive deeper into options. I know a lot of listeners will be really interested to hear what you have to say on the subject, of course. So what was it about options that appealed to you over other markets, let's say stocks or futures or any of those markets?
Well, again, it came down to, if you had, when I was 22 or 23 years old, if you had said to me, hey, we're going to send you to the floor of the New York COMEX exchange so you can trade silver futures, I probably would have been a futures trader. It just so happened that life works out in such a way where, you end up in a place where wherever I would have ended up, I didn't know anything about. So I happened to have ended up on the option exchange, which was probably a function of the seat leases were a little cheaper on the option exchange than they were on the futures exchanges. So I ended up in options. I fell in love with options because they are strategic, and which is very different. Futures and stocks are very black and white. You either pretty much you buy them or sell them, and there's no gray area. I mean, you're either right or wrong based on pure direction. I learned quickly in options that it's much more than direction. It's a very strategic. It's a gray area game, and you can be right and make money. You can be wrong and lose money. And I'm sorry, you can be right and lose money, or you can be wrong and make money in options. And that was a huge difference maker for me when I finally figured it out.
So, you talked a little bit there about the grey area of options. I mean, what are some of the misconceptions outsiders often have about options trading? Is there anything that stands out to you?
Sure. Well, the most popular misconception is that there is this that 85% of the people lose, and there's a ridiculous amount of risk with naked options. And the reality is the only way to be successful in the world of options is to learn how to trade small, how to manage your profits, and how to sell options naked. And it's everything we do at Tasty Trade now goes completely counter to what the traditional norms are with respect to traders, investors, and the entire industry. We're the complete black sheep of the world, which I love when it comes to trading and investing, because we are advocates for individual active trading when we believe that it's the only way to be successful.
So why are you so fixated on that? Why do you believe it's the only way to be successful?
Because I actually don't believe. I believe in the statistics, like you were mentioning before. I believe in the mechanics behind the statistics. And if you have a statistical chance of success that is better than a statistical chance of failure, then all you need to do to meet that probabilistic outcome is to create enough occurrences. So I believe in active trading, and I believe it's important to create as many occurrences as possible in order to be successful. Hence the reason we were successful on the trading floor, we just didn't even know it.
But that can be done with other products as well, like stocks, futures, Forex.
No, it cannot be. It cannot be, because you cannot create a statistical chance of success that is greater than 50-50. So it can't be done.
And what if you have a quantitative model that's...
There's no such thing. You can throw all those quantitative models in the garbage. They're absolutely worthless. There's never been one. You can never prove to me that there's ever been a successful quantitative model that's been distributed on any level. It could be. Now, that doesn't mean there's not high frequency models, and that doesn't mean that there's not prop trading models when you're market making. But there's never been a customer, institutional or retail, that's created a quantitative model that can beat the markets? So the answer is that doesn't exist. That's all crap. That's all horseshit.
I don't really know what to say.
Well, I mean, listen, I've been doing this a long time. That is the answer, and that's the truth. Nobody wants to believe that, but there's no such thing. Artificial intelligence, quantitative modeling, none of it works. None of it exists. Forget fundamental analysis. Forget technical analysis. Forget economists. It's all irrelevant. Everything is random. Marketplaces are random, but there are different prop models, market-making models. That's fine. High-frequency models. We all know that. But there are no other models other than creating. The only way to be successful is to create. That's why hedge funds don't make money. That's why nobody makes money in cyclical markets. And the only time anybody makes money is if benchmarks go higher. Except the tastytrade way, which is creating a methodology and having people understand and learn that if you do things that are statistically strong, even though you don't have a theoretical edge, you have a probabilistic edge, and it's real.
Okay, can you just explain those a little more when you say a statistical edge and a theoretical edge? How do you differentiate those two?
So markets are priced. There's no mispricing of markets. So stock markets, futures markets, forex markets, option markets, everything's priced perfectly. The world prices everything perfectly. There's too much capital chasing virtually risk-free rates right now are zero. So there's too much capital chasing any return they can get their hands on. So there's no free money out there at all, which means there's a buyer and seller one tick wide for every possible, liquid product out there. So there's no edge. So we can eliminate that right away, which is why all quantitative modeling is garbage and everything else. So that brings us to then, how do you make money? Well, the way you make money is that the derivatives marketplace overprices fear, which means that we charge too much money for fear, and we charge too much money for limited profitability by definition. So if you're willing to limit your profitability and fear is expensive relative to itself, then for us, that's an opportunity. And we consider that completely unique to the methods we've created. And when I say we've created, they're out there. I mean, anybody can do it, which just means when implied volatility gets really high, we sell it. And you sell it in the form of selling derivatives so that you have an opportunity to collect time decay as it contracts, and it contracts twice as often as it expands. And it's a lot for one short podcast, but essentially that's what we do every single day, especially now for the last 5 years.
What would you say to those who are, there are traders out there who are making money in other ways. What do you think that's a factor of luck, or?
Some of them lie, and some of them are tied to a benchmark, so they guess something. Some of them lie, and some of them are outliers. Of course, there's people that have been long gold. There's people. Nobody's made any money being long the stock market for 2 years, and we're at a record high. So if you sure, if you went out a couple of years ago and you bought, you put all your money in Amazon, or you put all your money in, Apple or Netflix 5 years ago, you had a pretty nice run. And if you put all your money in Amazon last year, you had a pretty nice run. But when you're talking about in general, people don't make money with 50-50 bets. People make money going to Vegas too, but the odds are against you, and over time you can't. So all we're saying is we don't care about outliers. We care about the masses. And if the masses are if the masses are this huge global consumer, then the only way to do it is to put yourself in a position where the statistics favor you. That's it. There's no such thing as people making money because they all of a sudden learned a new form of technical analysis, or they figured out they have a great artificial intelligence platform, or they're better at reading a balance sheet than somebody else. Once they outlawed insider trading in the U.S. to the 8th degree, none of the hedge funds made any more money. I believe the past world of one-hit wonders and some crazy, trader on some bond desk somewhere, or some international desk somewhere, those days of stealing money from your customers are long gone. Everything's too efficiently priced right now. So we live in a world, if you want to learn how to make money, you've got to learn how to sell overpriced fear. It's the only given out there that has a contraction that has a reversion to the mean characteristic that works, and that's it. And it's not something tricky. It's just the nature of the beast.
All right, so let's just dumb this down a little bit. I'm not an options guy myself, so I'm sort of trying to play catch up here a little bit. But, selling overpriced fear, what do you exactly mean by that? And also, if you could just take it one step further and let's just break down the key elements crucial to successful options trading.
Well, here's a couple of things that are crucial. Number one, you need to be product indifferent, which means you can't worry about what product you're trading. Number two, you need to be strategically indifferent. So essentially agnostic to strategy. You can't be scared of different strategies. So you're product agnostic and you're essentially strategy agnostic. Now the next step after that is understanding the value of liquidity. So if you don't have, like, you're in Australia, there is no such thing as a liquid option market in Australia, which stinks because you have to trade in the US. And that's a bummer because of the hours and places like that. But you have to have liquidity in order to be successful because you have to be able to get in and out. So your product indifferent, your strategy indifferent, and your number one focus is on liquidity. That's just for starters. Then you've got to learn some basic things, which is number one, you've got to learn how to create enough occurrences so that you can create the outcome that you're hoping for. Number two, you have to learn how to maximize your success rate, and that happens from managing your winners, not worrying about your losers. That's the next step. And then ultimately, you got to understand the math behind it and why certain things work. Why is price not mean reverting, but implied volatility is? And then what is implied volatility? Is it a factor of what? We know it means expected move, but what drives implied volatility? Why is sometimes implied volatility high and why is sometimes implied volatility low? Things like that. So all that stuff, Aaron, is things you're just going to have to, over time, it just takes, it takes a little bit of work. I mean, we have a few thousand viewers in Australia alone. And just imagine, that's, obviously we used to have a business, Thinkorswim Australia, but still at Tasty Trade, we have a few thousand Australian viewers, and it's great. And they get it. It's just, it's a tiny sub-segment. It's 1/10 of 1% of the people out there that actually trade in Australia.
One of the things you said in there, you spoke about price is mean reverting.
No, I said price is not mean reverting.
Oh, price is not mean reverting. Sorry.
Yes.
So what exactly does that mean when price is not mean reverting?
Okay, so that means, like, let's say you had a stock. Let's call it XYZ, all right? And XYZ starts out at $20, and XYZ goes to $100. There's nothing out there that suggests that XYZ has to go back to $50. Because at some point, $50 may be the average or the mean, and there's no reason that XYZ has to go back to 50. XYZ can go to 200. XYZ can go to 300. XYZ can go to 0. It doesn't mean anything. There's no reason it has to go back to, even though markets are cyclical, there's no reason XYZ has to go back to $50. But let's say XYZ has an implied volatility of 20, and all of a sudden, the average implied volatility in XYZ is 20, and all of a sudden, XYZ implied volatility goes to 50. Now, implied volatility is mean reverting. So at some point in the future, and usually it's the near future, implied volatility in XYZ will go back to 20, may even go down to 10, and then it'll be mean reverting back up to 20. But the takeaway here is that you have an asset class that is mean reverting. It's implied volatility, and nobody uses it, or very few people use it for that purpose. That's why it's so valuable.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved. Now, so has the way traders operate within them. Trade the pool.
The next thing I'm really keen to ask you about, to expand on a little more, because you've mentioned it a few times now, is the number of occurrences. So, how does the law of large numbers play into your trading? And just
sure,
I really like this point. I think it's very good that you.
Let me give you a really easy example. So you go out and you have a handful of pennies, all right, in your hand. You have a handful of pennies. Let's say you have 100 pennies you're able to hold in two hands. And you throw them all up in the air, right? And now over time, if you throw 100 pennies, 1,000 pennies, 10,000 pennies, whatever it is, if you throw 10,000 pennies or 20,000 pennies or 100,000 pennies, you're going to be pretty damn close to 50-50 heads or tails, right? But if you throw up 100 pennies in the air, you may end up with 60 or 70 pennies coming up heads and only, 30 or 40 pennies being tails. And all of a sudden you can go around saying, hey, I'm really good at flipping coins. I can flip as many heads as I want. Or to give a better example, if there's 100 people in a room and each one of the 100 people has 10 pennies in their hand and each 100 people throw up the 10 pennies, one of those 10 people or one of those 100 people is going to have 10 heads or 10 tails. And when that happens, are you going to say, wow, that person's a great coin tosser? Or are you going to say, hey, that was just an outlier move, they got lucky, it happened that way? Well, in the world of investing, we think that person that got 10 heads or 10 tails is a genius. And they're not. It's just the statistical chance of coming up with 10 heads or 10 tails. So the law of large numbers comes into play because if Aaron, the self-directed trader, goes out and makes 20 trades per year, which is what most customers do around the world, or 20 different investments over the course of the year, which is 1 or 2 a month, there's no way you can be long-term successful. But if Aaron, the self-directed investor, goes out and does lots of high probability option trades where you're selling premium and you do 3,000 trades next year, there's a highly probable chance that you're going to come within 1 or 2% of the exact number of the probability or of the probabilistic outcome that your predictable probabilistic outcome. Like this year, I don't know how much money I'm going to make, but I'm going to be right approximately 74.5% of the time. Because that's the average I do with all my trades. Now, that doesn't mean I'm going to make money. I can lose money and be right 74.5% of the time. But what it means is that it means to me is that I'll take my chances, and that being right 74.5% of the time, I know I can turn that into a winning year for myself.
Mm-hmm. So on average, just so we can put this in perspective further, how many trades would you take in a year?
Last year, Last year I did 9,400. The year before I did 7,700. This year, right now, I'm on pace to do 10,000. That's just me. I can't speak for other people. And I'm a retail customer using the same technology and the same commissions as everybody else.
Okay. So for a retail trader, someone who may not have a great big account, what would be the minimum account size for this to actually be feasible for someone to do anywhere near that many trades, like factoring all your transaction costs and that sort of thing?
That kind of trading, probably a couple $100,000 to be fair. You'd want to have portfolio margin or a couple $100,000. In the world of average size trades, the average size trade for active traders in this business is just under $50,000. It's between $45,000 and $50,000. That's the average size account.
So for someone who wants to sort of tap into this law of large numbers and really get their trade numbers up, but doesn't have a great big account, maybe a couple $100,000, what sort of advice would you give to them in that situation?
Well, how much money are you talking about?
Well, I know a lot of people start out with accounts between 5,000, 10,000.
I mean, I think that's great. And if you can start out with anything, like both my kids started out with accounts, between $2,000 and $8,000. And I think it's a great learning experience for them and for anybody else. I mean, your goal at that point is obviously to become more aware. we call it market awareness and clear up the concept, and you start to learn about products and strategies. You start to learn about statistics and probabilities, and you start to learn about risk taking and everything else. So I feel like they're infinitely stronger because of all of that. But you'll start off with spreads mostly and lower probability of success. It's harder to make money. This is a business that there's parts of it that are very much nonlinear. And when you talk about small amounts of capital, although you can create much better statistical returns, it's more difficult. There's certain limitations, but I think that the consequences of starting young and starting small are invaluable, and the mistakes are well worth it. Let's put it that way.
Now, when you talk about statistics and probabilities, what sort of level of math is required to be able to come up with these numbers?
We have two things we say here, Aaron. Two things. One, if you can you play blackjack?
I've never played blackjack, no.
Okay, well, if you played blackjack or craps, you can do it with your eyes closed. And we have an old saying here at Tasty Trade: if you can order a pizza, and I know you can order a pizza, if you can order a pizza, you can trade.
Okay.
It's not rocket science. It's very straightforward. We're no longer, when I grew up in this business, it was all eighths and sixteenths and 30 seconds, and it was a little bit more complicated. Right now, we've reached the point where it's none of the above. I mean, it's all decimalized. It's pretty much industry standards for everything. This is not hard stuff. We have a solid 100,000 plus Tasty Traders, and in the world of Tasty Trade, it's we've just scratched the surface. So I think we got to give people a lot more credit for the average level of intelligence out there and globally. I mean, we are a very smart society, and we do not challenge ourselves. One of the things that we say here all the time is we need to create more intellectual challenges. We have way too many people playing Pokemon and not enough people challenging themselves intellectually with respect to finance, and that's our goal. Challenge you intellectually, never dumb it down, make it as hard and complex as possible, and never let our foot off the gas pedal.
Now, I think it might be really interesting to hear about your logic for entering, trades. So considering you take, anywhere between 7,000 to 10,000 trades in any given year, what's your logic for entering these trades? Like, what's that based upon?
It's all mechanics. It's all mechanics and opportunity. We look for, we're contrarians. So we look for price extreme. That's not because there's any edge to price extreme. There's no edge to being a contrarian in a true sense. The reason we do it is because it engages us and it gets us involved in the making of a trade. So one of the things we do is we're contrarians by nature. We love the counterparty to the trade aspect of taking the other side of what everybody else wants to do. So when the world's long, we're short. When the world's short, we're long. That kind of thing. That's one thing. That's the engagement side. The other side is, it's all based on strategy. It's based on the amount of decay we've created for ourselves daily. It's based on the amount of occurrences. We're always engaged. We're always involved, and it's hard to explain until you get it going at that level. But what we do, this is not hardcore trading for the prop traders, for the professionals. We are strictly 100% retail. No institutions, no prop traders, none of that stuff. But this is all retail consumer trading, and we think everybody's capable. It's just an intellectual challenge. I would have given you a different story 25 years ago. 25 years ago, there was opportunity that was a different kind of opportunity. The markets were wide. They were inefficient. You could drive a truck through markets 25 or 30 years ago. But those markets don't exist anymore today. And if you're going to trade in today's markets and you're going to trade as an individual investor, you are not disadvantaged to the professional marketplace. Okay, you're not disadvantaged at all. You have better technology, better content, and your fees are almost exactly the same. So your disadvantage is know-how. If you don't have the know-how, you can't compete.
Absolutely. Now, one of the things that a lot of traders are very much into, and some even say that it's, maybe 90% of the challenge is trading psychology. I understand you feel very differently about this. Can you give us your take?
Trading psychology is 100% bullshit. It's people like to, we're enablers. Our society is we've created a society of enablers. And so we make people feel good about their inept financial abilities, their lack of know-how, it's not because they don't have the right, trader psychology, or they're not seeing the right trader psychologist. It's because, and most of the people that are trader psychologists that I've ever run across would have zero value in my world. This is not a right brain, left brain type thing. The reason people aren't successful is because they don't take the time and the commitment to be successful. That's all it is. And I'm tired of enabling people and trying to make everybody feel good when the industry is conflicted by the true sense. This industry makes money by managing other people's money and by selling people money and by selling fear. And the only way to get around that and to change that culture is to develop the know-how yourself. And 99% of the people are unwilling to develop that know-how. So the idea that there's some trader psychology out there, it's complete bullshit.
But I mean, even operating like a mechanical strategy or being very quantitative in your approach, do you think that there is a certain degree of psychology, even though it's not nowhere near 90%? Do you think that there's a small part of it that does come down to your psychology?
No, I think it's mechanics. It's like anything else. It's almost like breathing. I think listen, if you're talking about ego, that's fine because, everybody has egos. If you're talking about, risk-taking and things, I don't consider that part of your, quote, psychology. I consider that all part of your mechanics. Now, if you want to consider psychology mechanics, then sure, but I don't. And I think this is a game that that comes down to mechanics. You said before you didn't play blackjack. I don't believe blackjack is a game that there's a psychological element to blackjack. Just like I don't even believe there's a psychological element to to any card game, even poker or craps or anything else. I mean, I know people argue that there is in poker, but if you've ever watched poker players, most of them play by the book. And when you're playing any other kind of game, it is straight by the book. So, and now we're starting to see even sports has become, a game of mechanics. We used to say, oh, this head coach or this manager is a genius because he pulled the right string or made the right move at this time. And the reality right now is everything is becoming part of sabermetrics and statistics. And of course it's going to go that way because 95% of the time, that's going to win every time. So no, I'm poo-pooing the whole psychology aspect to it, and I'm suggesting that it's a lack of know-how, it's a lack of desire, and until we get people willing to take on that intellectual challenge, we'll give ourselves a crutch and call it psychology.
Okay, sure thing. So I said a little earlier that I'd like to pick up on your days of starting Thinkorswim. So just obviously changing subject a little bit, what motivated you to start Thinkorswim? Like, where did the idea for starting a new platform come from?
Well, we were standing in the same pit for 20 years, and in about I didn't move from I had a 2-foot spot for 20 years, basically. And at some point when we saw the markets changing, we're like, it's almost like you kind of see the hurricane coming and you're like, I'm going to be the first one out of here, not the last one out of here. And essentially, that's what I did. I decided I wanted to be the first one out. And I luckily had a good career and had made, enough money. And I rolled the dice and with my trading partner at the time, Scott Sheridan, we decided to build Thinkorswim. We didn't exactly know what we were doing, but we hired some really smart technologists and we messed around and figured it out over time, and we loved it. It was one of the greatest experiences of my life until Tasty Trade.
And I mean, it was such a huge success. What do you think with it, maybe the underlying factors for why it was so well received?
We hired very smart people that, this is, we had a vision, and it turned out to be a great vision, but at the time I didn't know. But we had a vision, and we hired people that were able to execute our vision rather than change it, and we got lucky. And when I say we got lucky, listen, it was a ridiculous amount of hard work. I didn't see my family for 10 years, so it wasn't like, It wasn't like we just said, okay, here's an idea, now you guys go build this. I mean, it was total sweat equity, and I worked my butt off for 10 straight years. I was traveling, never came home, working overnight with developers, working with clients. It was a brutal challenge, and lots of ups, lots of downs. We made breaks for ourselves, and it worked. We built a great company, a great product. We actually cared about the customers, every single one of them. I wouldn't trade my floor trading experience, and I wouldn't trade my Thinkorswim experience for anything. And I didn't want to sell Thinkorswim, but we lost the company because we were public, and we lost it to a buyout from TD Ameritrade, and we built tastytrade, and I wouldn't trade tastytrade for anything now.
Okay, so I had no idea about that. So you kind of lost the company more than actually made a conscious decision.
Well, I shouldn't say we lost it. We sold it for $750 million, so it wasn't like a bad trade. I mean, we got paid, right? So, I mean, we created $1 billion company basically, and that's pretty impressive in a business where we were just a bunch of floor traders. So I'm ecstatic with what we were able to do, and I'm really proud of the accomplishment. It was a major, a lot of people work their butts off to get places, and sometimes it works and sometimes it doesn't. And for us, it worked, and it was pretty special.
Yeah, no, that's massive. So tell us a little bit about tastytrade. Like, what's the vision for tastytrade? What sparked that idea? What's going on there?
When we sold Thinkorswim, I was working for TD because I had a contract for a couple of years to finish out my career. And I went to the CEO of TD Ameritrade. I said, his name was Fred Tomzek. He's a great guy. And I said, Fred, I love you guys and I love Thinkorswim, but I can't work here. This is my hell. It's conference calls, it's meetings, it's conference calls. It's a big company, and I like to run my own show. And I said to him, I go, Fred, am I going to be the CEO of TD Ameritrade someday? And he goes, not a chance in hell, Tom. So I go, okay, then I got to leave. And I said, but I'm going to go build another firm, and I'd love to work with you guys. And so we sat down and we sketched it out, and I said, I'm gonna build. First I built the technology, and now I'm going to build the content. And I wanted tastytrade to be the content that allowed people to go to another level. And it took us a couple of years to figure everything out and to learn how to build a media company. And everybody told us we couldn't do it. We couldn't compete with TD. We couldn't compete with CNBC. We couldn't compete with Bloomberg. We couldn't compete with anybody, and I don't even know today if we don't have a bigger audience than all of those, they all do. I know we have more active traders than they all have, and we have the largest active trader audience in the world, and we've been profitable basically since day one, and I feel, really good about what we built. It's a beautiful company. We're a think tank, and it's the coolest thing I've ever done. So it's wild.
Now, I don't know, I think it was maybe last year or the year before, you made a series on tastytrade with your daughter, Case, to teach her how to trade, which I thought was really cool. So, I mean, what was that whole experience like, and where did you even begin to start, with teaching your own daughter, like someone in your own family?
Well, Case is my firstborn. So, and when she got out of college, she went to work for a startup in Chicago. And it was a small startup with just a couple people. And, I wasn't sure if they were going to make it or not, but I thought it was a great experience for her. And when a job opened up here at tastytrade, I talked to her and I'm like, listen, you have a chance to, we're a young firm and you have a chance to, to really learn and to learn stuff you might never have done before. And I would love, it would be a dad's dream come true to have an opportunity to, work with you, spend time with you, work with you. It'd be cool as hell. I mean, I couldn't think of a better thing in life, So she's like, all right, I'll give it a try. And when we were sitting there about a year or two after she was working here, I said, let's do a series. I'm going to teach you to trade. And Case is not your, Case is sarcastic. She's snarky. She's not a yes person at all. And she's, we have a great relationship, but resistance, and she asked some questions, and she was a true beginner. I mean, there was no, she had never made a trade before, and she had very mixed results, but she still trades to today. So she's trading even actively as of today. So I did something.
Yeah. I'll put a link to that series in the show notes if anyone wants to check that out. It's very cool. So,
sure.
Tom, I just got a few more questions here that came through from members in the Chat with Traders Facebook group. So we'll just run through a couple of those. So one here was, what advice do you have for those who want to trade for a living?
Go for it. I mean, it's hard. You have to make sure you have to have the capital. You have to know what you're doing. If you're in Australia, I don't know where your listeners are and everything like that. It's a little more difficult because of the hours and the scheduling and things like that, and the fact that there's no really domestic markets. Stay away from pure black and white products. If they don't have underlying derivatives like options, be very careful. Make sure you have enough capital. You have to really be in tune with some of the stuff I talked about, which is managing winners. Don't think you can do it through technical analysis. Understand all the products and stay small. The key is staying small. And don't ever forget that you have to stay small. I don't care how many years you've been doing this. One of the biggest turnarounds for me ever in trading was realizing that I was always trading too big and I needed to get smaller. And so it's a huge, huge benefit. And I think I would never discourage somebody from doing what they want to do. I think I've had a great life because of trading, and it's changed the way I think about, lots of things and businesses and everything else. And it would be very unfair to me to say to anyone that you shouldn't do this or try this or you can't do it, because I don't believe that. I think you can.
Awesome answer. I love it. Another question that came in, do you have any tips for hedging or spreading options?
Well, we call it adjusting or defending. I mean, generally, you don't, there's no such thing as hedging in my world, but there is such a thing as reducing basis. So one of the things that we do is whenever you own an option, you sell something else against it. Whenever you own anything and you have the opportunity to sell something else against it, you do. If you have the ability to reduce basis, you do it at any cost, meaning it should be your first mechanical endeavor. No matter what you own, if you own a ballpoint pen and you have an opportunity to reduce the basis on that ballpoint pen, which is the cost of that pen, then you do it because you have a higher statistical chance of success if you're able to do that. And before somebody says, but you're limiting your profitability, who cares? The key to success is limiting profitability to reduce your basis, to reduce your costs and improve your probability of success. So that's the answer to that question. You don't do something to immediately hedge it, but you do lots of things to reduce your basis.
Well, thank you very much for doing this, Tom. Before we wrap this up, do you want to share with listeners where they can go to find out more about you? Where's the best place?
Well, the only place they can find more about me right now is at tastytrade.com. We are a free site. We're available to anybody anywhere in the globe. Tasty Trade is 8 hours a day of live content. The archives are free. The content is free. It's an amazing product. I think it's the best financial product in the world. And enjoy. Just watch it. There's more information on there. There's a million hours of information on there. It's just an incredible resource for trading, for investing, for fun. We have fun. And we have 40 different shows, 8 hours a day live. I think there's 16 or 17 different people in-house that produce the content, and we're a small firm of 80 people located in Chicago, Illinois. And enjoy.
Sure thing. Tastytrade.com. Make sure you guys check it out. Tom, once again, thanks so much for doing this, man. I hugely appreciate it. It's been very interesting speaking with you.
That's awesome, Aaron. Thank you so much.
Hey folks, Aaron here. Just a quick word following on from the episode. I hope you really did enjoy it, even if you perhaps didn't agree with everything Tom was saying. I know he did make some pretty bold claims, but that's cool. He's obviously got his reasons for thinking this way, and we all have to find our own path. That's something we've heard before many times over. Like I said, I do kind of regret not pushing him for a little more depth on some of those statements. But anyway, as I mentioned right at the beginning, for the first time, Chat with Traders t-shirts and even hoodies are available right now. These are only available for a limited time though, until the 2nd of September. So don't sleep on this. Get on over to chatwithtraders.com/t-shirt to pick up a t-shirt or even a hoodie. There's 2 designs to choose from, and each item is printed on American apparel. So they're very comfy to wear and awesome quality. Again, the link you need to go to is chatwithtraders.com/t-shirt. There's no dashes. It's just plain chatwithtraders.com/t-shirt. Hope you like them. Feel free to hit me up on Twitter if there's anything you want to chat about at chatwithtraders. Otherwise, I'll catch you next week.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's going on, team? Welcome back to another episode of the Chat with Traders podcast. I know I say it all the time, but thank you so much for being here. I really appreciate you tuning in. My guest this week is Dave Lauer. Dave is a former high-frequency trader for firms such as Citadel and Alston Trading. He's worked specifically in various areas of the HFT pipeline, including research and modeling, building hardware, and programming and operating strategies, which are measured in millionths of a second, or microseconds. Following the flash crash, Dave left his role as a trader for various reasons we discussed during this episode, and now, as a partner of Core Group, he consults to institutional managers on market structure and best execution. Dave was also featured in the VPro documentary, The Wall Street Code, along with other Chat with Traders guests, Haim Bodak, Eric Hunsader, and Blair Hull. I really enjoyed speaking with Dave, and I hope you'll enjoy listening just as much. Show notes for this episode can be found at chatwithtraders.com/88. Now here it is, my interview with Dave Lauer. Start by telling us a little bit about how you got your start in financial markets. Like, where did all of this begin for you?
I'll try and keep it quick, although I like to tell the story. I think it's kind of a funny story, but I got my start as a kid. So when I was young and I was playing around with a little thing, called AOL, which was America Online, and you could put together this sort of paper, I guess we would call it now, like a paper portfolio of paper trading. And I just put all these companies that I knew, and it was the mid-90s. And so the companies I knew were Intel and Microsoft and Cirrus Logic and US Robotics and that kind of thing. And I said, oh, look at this. I could buy this portfolio for $2,000. And so I told my parents about that, and they just kind of dismissed it. I think I was 14 years old or something. And then, a year or a few months later, it was like, oh, hey, look, this portfolio is worth $4,000. I went to my parents. I'm like, you really should buy this. And they just said, oh, you don't know what you're talking about. Forget about it. And a year later, it had doubled again, and it just seemed to keep doing that. And so eventually we started a stock club, and focused on high tech, and that was a pretty lucrative thing to do in the late 90s, going into 2000. And so that's kind of where I got the bug for markets and trading. And so when I went to school, I did computer science and I got a master's in finance. And I came out and I still wanted to do high tech. So I started at a startup that was funded by Goldman Sachs. And we built a piece of hardware for accelerating low latency trading systems and low latency trading desks. And so I did that for a few years, from 05 to 09, and it was a pretty good time to sort of be involved in that part of the industry. And then I eventually decided I should be doing the trading, not selling equipment to the traders. So I became a high frequency trader. And I worked at Citadel and then at Alston Trading. I did that for a couple of years, and I did everything from quantitative research and modeling to programming the trading strategies, and managing them and executing, dealing with them, executing trades, that kind of thing. And they scaled up pretty large. I specialized in ETF market making, auctions, opening and closing auctions, event-based trading, like around news events. And we also did quite a bit of interlisted arbitrage between different geographic markets, like US and Canada, for example. And that ran through 2010, and the flash crash, where I was working at one of the largest liquidity providers for the E-mini market. And so obviously the flash crash was an interesting event to see from that perspective. It was on the desk right next to me, and I was really good friends with those guys. And it was kind of eye-opening. So I think within a year after that, I had left high frequency and I'd left financial services, and I really had no interest in the industry anymore. I was kind of disgusted with it. And I built a storytelling website with a good friend of mine. And the first story I told was why I left financial services, why I left high frequency trading. And it was 2012, so it was kind of fortuitous. It was just a good time to talk about that kind of thing. And someone from a radio station in the U.S., National Public Radio, asked me to come on and tell the same story. And I did. And the next thing I know, I was getting calls from the U.S. Senate and the SEC and from Brad Katsuyama at IEX. And, so I kind of found this new path back into the industry where I realized I can, kind of take what I had learned and use it in a different way. And so ever since then, that's been what I've done. I've tried to help people understand market structure. I've really focused on institutional asset managers and helping them reduce the friction of interacting with markets, reduce the cost, reduce the opportunity to leak information and have slippage, that kind of thing.
Right. Well, I really want to break this down because this is super interesting. So just going right back to when you mentioned that you got involved with a startup that was funded by Goldman Sachs. I'm really keen to hear a little bit more about that. What were you exactly working on there? Was it the actual hardware and not the sort of the software, but more of the hardware that's used for high frequency trading? Is that right?
Yeah, so we built a piece of hardware. The company is still around, although they've since shifted. But what we did was we built this piece of hardware for something called middleware messaging. So, at almost every high frequency trading desk, you have all these market data feeds coming in, right? And then that data has to get sent out to lots of different models. Those models have to act on that data and then send orders to the market. And that is true whether you're dealing with, massively distributed co-located systems or not. And so the hardware that we built, we actually put feed handlers in the hardware. We'd started with like Itch, Arca. We had an Oprah feed handler, which at the time was something that almost nobody could contend with, those data volumes. They were just massive. And so we had actually built this accelerated networking appliance that would go into the data center. And, like I said, Goldman was one of the funders. And so I spent quite a bit of time at Goldman, was a contract worker there for over a year, and sort of got to play in their development lab and data center, which was just, for a tech geek, kind of the craziest thing that, you can imagine. It was just a ton of fun.
Right. So had you had much experience with the actual hardware aspect of things prior to this?
No. I'd always been a software guy, although, I've been building my own computers since we built my first one with my dad when I was 7. But, so I knew some stuff, but I was very new to the hardware space. I really came into it as a programmer.
Okay, sure. So, that hardware that you were working on, where did that actually fit into things? Like, where was that? Where did that go, I guess, is the question. Like, did it go in the data centers?
Yeah, it would go in like the firm's main data center usually, where you would bring all the market data feeds in. Although some did want it in colo spaces, and that was more practical. If you were in a colo space that had multiple exchanges, obviously it was a little expensive to put a piece of this hardware in every colo space. But eventually, not at the company I was at, but others went that route where they started putting these things in cards rather than in appliances like we did. And then it made a little more sense to go, to all the individual colos.
Okay. And was this used solely by Goldman, or was it used industry-wide?
Yeah, it was industry-wide. I mean, there was a really interesting way for me to be introduced to the industry. I'd never worked on Wall Street before, never done anything, professional in financial services. And being the third employee at this startup, I was in almost every meeting at every major company, every major big bank, most of the hedge funds, all the prop shops, and understanding kind of how they all worked and what their problems were, and then how maybe what we were doing could help with some of those things.
Right, got it. So tell us a little bit more about the next step from there, where you went on to Citadel. I'd be keen to hear about the type of things you were employed to do there.
Yeah, so you can imagine I don't really talk specifically about what I did there. I'm happy to talk kind of generically about my years in HFT, but it's still a very secretive industry, and not wanting to ever take the risk of litigation, I just generally don't talk specifically about companies that I worked at.
Okay. No, that's cool. I totally understand that.
Yeah, not being a lawyer, I just assume if I don't do that, I'm okay.
All right, so we talked a little bit about how HFT firms optimize their strategies for speed. Besides the actual hardware, like the types of hardware that you worked on, are there any other ways that they, like what are some of the other ways that HFT firms to use to really reduce their latency as much as possible?
Yeah, so it's funny because, working at Tervella, which was the startup I worked at, we solved one part of the problem, but it didn't matter if you solve one, block in a pipeline if you're only as fast as your slowest point, right? So at that time, in those few years, I became a real latency measurement and mitigation specialist. That's really what I focused on. And I came up with different techniques for measuring it, ones that are sort of just starting to become more mainstream. Just a couple of years ago, you saw the Financial Information Forum adopt one of our techniques that we had published a paper on, which was about, instead of looking at volume in terms of messages per second, we used to look at it in terms of messages or network frames per millisecond, because the microbursting at the millisecond level was a major component of latency. And so, you needed to control for that and be able to handle microbursting on that time scale. And I'd imagine these days it might even be, they might be down to the microsecond. But, we would look for opportunities to optimize latency that you would measure in double-digit microseconds. When I had built one of my trading strategies when I was actually in HFT, and believe it or not, this was in Java, but it was running on a server in a colo space, and I would measure every message in and out of that box. So it was an event-driven strategy, so it was very easy to know when the message came in that I was reacting to and the order went out, which was the reaction, and I would measure those wire-to-wire latencies at the network switch level And my average or median latency was around 40 microseconds from message hitting my server to order leaving my server. And at tolerances of 40 microseconds with standard deviations of double-digit microseconds, you have to look for every possible source of delay. And so you just look at up and down the entire stack. You look at your networking equipment from on your switches and your routers. You look at the kind of lines that you're using, whether you're all fiber or you have to hunt down fiber to copper switches because those kill your latency. You have to look at the network card that you're using. You want to use kernel bypass technology so you're not dealing with your operating system overhead. And that's then you have to tune all of your network card settings, your network driver settings. It all depends on the particular network chip card, the chip in the card and the driver that you're using. You want to tune your OS and your buffer sizes. And that's before anything has even hit your own software, which you have to just profile and tune rigorously. And one thing I was able to do with that trading strategy was if I got an event that I wanted to react to and I tried to react to it and I missed, I could measure the response time of that exchange on average to the times that I would get my fills, and then I could measure the time from the public market data feeds of whoever beat me to that fill to hitting that order, and I could profile my competitors and understand exactly how fast they were, and I would know exactly how many microseconds I had to take off in order to start beating them again. And it was something that you had to pay attention to. It would come up every week or two. It was this, sort of this race with each other. It was very difficult and it was some really interesting and challenging engineering problems. But, I think in the end you started to wonder, why am I spending all this time trying to shave microseconds? What exactly is that doing for the market?
Now, I've got a couple questions based off of, what you said there. So probably the first one is 40 microseconds. Are you able to put that in perspective for us? Like, can you compare that to anything at all?
Well, it takes you 300 milliseconds to blink your eye. And that'd be 300,000 microseconds. It takes a nerve impulse, I think about on average 80 milliseconds to get to your brain. So that would be 80,000 microseconds. So, I'm not sure. All my scales are in millisecond, that we can relate to. So microseconds, you're talking millionths of a second. So 45 millionths of a second. It's a time scale that's hard to get your head around. And that was in like 2010 and 2011. So these guys now, they're dealing in single digit microseconds. They're optimizing nanoseconds. Things were headed that way when I left, but that's certainly where they're at now.
Yeah. That's incredible. I mean, it's so hard to get your head around just how granular that amount of time is, you know what I mean?
Yeah, there's very little you can relate to.
Yeah. So you said that you were like analyzing and monitoring your competing HFT firms to see, how many microseconds their orders were sort of hitting the servers and bouncing back out. And if other firms were just a couple microseconds, like a couple millionths of a second faster, did that mean that you would lose if you weren't faster than them? I mean, I know that's probably a bit of a newbie question, but I mean, was it really like that?
Well, for the things that I was doing, it was pretty black or white. It was, an event would hit, you'd want to go clear out a bunch of price levels and, either you got it or they got it, because the quantitative side of what we were doing was not, dramatically advanced, I would say. I mean, it was probably hard math for most people, but it's not like, we always used to say it ain't rocket surgery, what we were doing. So it was very much about speed, and many HFT strategies are speed dependent, and that's why you have this competition over lasers and microwaves. Now, back then, it was the spread networks line, the Chicago to New York line. was a major change, a major shift. And if you weren't on it, that you might as well go do something else. And that was a difference of like 2.5 milliseconds or something like that. So, there are other strategies that are more quantitatively driven that are not as speed dependent. But there's a pretty substantial class of strategies that are speed dependent. And I should clarify. Often when I mean speed dependent, I mean, it's usually not about who's second fastest. It's usually about who's the fastest. Now, that's for aggressive trading strategies. For more passive market making strategies, it's okay to be in the group of the fastest. But it's all about sort of queue position for the passive market making strategies. So, as you are slower, it means your queue position is further and further in the back, right? You're further and further towards the end of the line. And the closer to the end of the line you get, the more toxic the order flow that you're interacting with is, which, the more informed. It means that generally you're on the wrong side of the trade. So when you're at the front of the line, you have this backstop of a bunch of people behind you, where if you get hit and you realize you don't want to be in this position, you can scratch out at whoever, with whoever's behind you. But if you don't have that backstop, then generally, if you get hit and you don't want to hold that position, or price is moving against you, you're screwed. You're going to lose money.
And you talked about using lasers and microwaves in your response there. How are such things being used?
So pretty much for market data transmission, although some people also send orders over those lines as well. But if you can imagine that point-to-point data transmission is just it's going to be faster than a line that runs underground that probably doesn't go in a straight line. And also data traveling through the air is going to be faster than data bouncing around a fiber optic line, bouncing off the sides of the wire. So, there's a pretty substantial latency difference, even if the distance itself is the same. Even if somehow you got a fiber line that was point to point, traveling wirelessly is still going to be faster by a little bit.
Mm-hmm. And these data transmitters, like, lasers or microwave towers or whatever you want to call them, are these individually owned by said HFT firms?
You have some that are owned by individual HFT firms. There's a guy who tracks a lot of this stuff. I think he's a Belgian anthropologist, and Alexandre Lemonnier, and he does really interesting reports on wireless data transmission and whether individual firms own the towers or vendors own a bunch of the towers too. So like McKay Brothers, and I forget the other firm, but you have vendors that own these towers and sell the wireless spectrum, bandwidth on the towers, and then you have some HFT firms that have just gone ahead and built their own.
Okay, and that's the same for some of the cables that are underground as well. Is that right?
Yeah, that's true. Although most of the time it's, firms don't lay their own cables. Most of the time it's vendors that own the cables or telecommunication companies that own the circuits.
Okay. So, anyone who's maybe seen you in the Wall Street Code or heard you speak in other interviews has probably heard your story about trading during the flash crash. But for anyone who might not have, heard your take on the situation, would you mind sharing that story with those listening to this podcast?
Yeah, sure. I'd love to. It was, like I've said before, it was a pretty, impactful event for me. Really changed how I saw the impact of high-speed trading on the market and just generally, the complexities of market structure and where it was leading us to. It was just kind of a normal day at the time. In 2010, there was a lot more volatility. I mean, now we're starting to see volatility, but for the last couple of years, we've been in a pretty low vol environment. But in 2010, that wasn't the case. I mean, I got my start in actual trading in 2009. So it was a very, very volatile couple of years. And so, the markets, they were down a couple percent, rioting in Greece, that kind of thing. It wasn't anything exceptional. Our day was just kind of proceeding as normal, and we were trading, and I was working on new trading strategies at the time. I don't remember any more of the exact times. I'd have to look it up again. But, it was like around 220 or so. I look up at CNBC, and the Dow was down, whatever it was. And I look up a couple minutes later, it dropped another 100 points. And I said, oh, man, that's a pretty quick drop. I went back to what I was doing and, took a look at our trading strategies. Everything was going fine. Looked back up a minute later, it was down another 100 points. My boss was sitting right next to me, as a friend of mine. And I said, hey, why don't you look up, look what's going on. And he looked up and he said, whatever, and went back to what he was doing. And I look up a minute later, it's down another 100 points. And I said, hey, something's going on here, I think. He looks back up, he looks at it, we start looking at all of our trading strategies. And we weren't, during the day, we had, again, like I said, some trading strategies. A lot of our stuff at the time hadn't been really fully built out yet. We had moved from one firm to another relatively recently. So it wasn't hard for us on the equities desk to shut down what we were doing. But, what we looked over, as I said before, the futures guys were right next to us, and they were starting to scramble. They were starting to panic and to, no one had any idea what was going on. And so the market dropped again and obviously kept dropping. At one point, the CEO of the firm came running over to the equity index guys, and he was just, shut it off, shut it all off. He started screaming. We ran over. We started helping them, close programs down. Everyone's just shut it. Everything's just control C, everywhere you can go. Kill the programs, hit the stop buttons. A bunch of things had your big red button to just stop trading. And then we all kind of, at that point, no one knew what was going on. We all kind of gathered around one monitor, which just showed the E-mini order book. And as you're watching the order book, of one of the most liquid instruments in the world, you start seeing price levels disappear and quantities just drop to nothing. And they, the bids and the offers, they start spreading out where usually it's a very thick book. And then they start, moving away from each other. And suddenly the book's gone. And we're looking at it, we're like, what the hell's going on? There's nothing there, and we didn't know, was it a data feed problem? Was something crazy going on? We look up at the TV, the market was down, like crazy at that point. And sure, it's easy to look back and say, oh, but then everything bounced back. And, but at that moment, you had never thought this could happen. You had no idea what was going to happen now. You didn't know what to do. You didn't know if you could trust your data or not. All the feeds were screwed up. Yeah, I think I remember the SIP at that point was minutes behind anything. And so you just kind of sat there and slowly traders came back into the market. Things started to move. We started turning things back on. But, there was that moment that I'd never forget where, you don't know if the market's coming back. You don't know what just happened to it. And, I think it was that thing, that just made me start to really question what was happening. And really, as a firm, it set us in a strange direction too. I remember the CEO coming out a quarter later and he said, oh, we're going to get more involved in the public debate and make sure people understand what we're doing and see if we can help. And so, it was a real turning point, I think, obviously for the industry and for regulators. And it was a dramatic way to experience it on the floor of one of the largest E-mini traders.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved. Now, so has the way traders operate within them. Trade the Pool.
You know, there's still a lot of debate and a lot of confusion about what actually really happened that day and what sort of caused it. I mean, do you have your own version of what you think may have led to that event?
I do, yeah. I'm a student of complex systems. It's something that was just a passing hobby at the time of the flash crash, but over time I've gotten much more into and spent a lot more time reading books about, and I'm a strong believer that that the market is a complex system, has been for a long time. It's a different kind of complex system now than it used to be when it was human driven. And to me, there was no cause of the flash crash. It's that simple. In a nonlinear, complex adaptive system, you don't have cause and effect. You can be the regulators and point to the Waddell and Reed order and say, well, that was what caused it. But you've had those sized orders before and since, despite being rare, and they didn't cause flash crashes. So it's a very unique confluence of events that you require to have something so dramatic happen. And so my preferred term that I've read in the academic literature is this feedback loop, or this illiquidity contagion. And so the system entered a positive feedback loop, and all these agents reacted in the same way, much like we did on our trading floor. We pulled everything. So did everyone else. All the liquidity providers, because you didn't trust your data, you didn't know what was going on, so you stopped trading, and that's what happened. And it's a million individual actions that led to something like that. And that's the kind of thing we see on a regular basis on a single stock level now. And I believe that a big part of that is that we need a greater diversity of market making. We need market making on different time scales, and there are ways to encourage that from a regulatory perspective. That at least in the U.S. we don't go down that path, but in other countries like Australia and Canada, you guys have, and I think that makes for stronger markets.
Yeah, no, that's really interesting. And I don't know if this is almost, a little bit beyond the scope of the podcast, but would you be able to sort of explain what you mean by there's no sort of cause and effect in complex systems?
Yeah, so, it just means that in complex systems, you have emergent phenomena. You have things that sort of just self-organize or just come out of, chaos is a term for it. It's kind of a very specific term. It doesn't, it doesn't mean, sort of the chaos as we think of it. It's sort of a mathematical term, but, you have this transition to turbulence that happens in complex systems, which is, if you've ever seen pictures of fractals, many fractals are actually, the visualization of what it looks like, what the math looks like of a transition from a system to turbulence. And so when a system transitions into turbulence, it doesn't do so because something happened in particular. It does so because it's an emergent property of a complex system. It's kind of complicated. Obviously, it's kind of complicated to explain it, but chaos theory and nonlinear dynamics have a lot to say about this kind of thing. And what it means is, if you think there was an event that tipped a system into turbulence, and you can say that event will always tip that same system into turbulence, that's cause and effect. That's linear causality. But if you have the same event happen, and sometimes it will push a system over and sometimes it won't, then you can't really say there's a cause and effect there, because there's too much going on to model it in a linear fashion. You know, it has to be this dramatic confluence of events that happens that pushes it, you know, that pushes the system over the edge. I think it's the, you know, not being really an expert in this, I think that's the best way I can explain it. I don't know if that helped or didn't.
Yeah, no, that was really good. And I think that's similar to what you explained in the Wall Street Code. I think it was you that said that, you know, if all the same events were to happen again in the same order, you might get a totally different result. Was that?
That's right. That's exactly it. And that's the most important part. It's, you know, it's like, it's sensitive dependence on initial conditions. It's the butterfly effect, right? So it's not that, you know, maybe it is modelable and maybe it is not. But the thing is that at our level, you know, there are such tiny differences between what pushes the system into turbulence and doesn't, that we might think it was the same set of things that happened, but, you know, we're not able to model that impact of something so tiny that we wouldn't even be measuring it, and yet it blossoms into such a large impact, you know, on a complex system.
Yeah, and it's hugely fascinating. So following the flash crash, you kind of mentioned right at the beginning, you had like this epiphany one day that led you to pretty much quit working within an HFT firm. I mean, can you tell us a little bit about what was going through your mind at that point?
Yeah, it was interesting. I mean, it was May of 2010 was the flash crash, and I definitely got concerned. And like I said, you know, our firm, the CEO came out a quarter later and he's like, hey, we're going to be involved in the, you know, public discussion, blah, blah, blah. So, you know, let me know if you have any ideas on market structure or anything, you know, what you're thinking. And so it was funny. I wrote this whole thing up and I was like, you know, I think we should advocate for these kinds of changes in the market. And a couple of the changes would have hurt the firm, no doubt. And I said, but as a firm, if we're long-term focused, if we're really interested in that, you know, long-term, strong, resilient markets are what are in our interests rather than maybe short-term profits. So, you know, we should look at this stuff. And I emailed it to him and I asked to sit down with him and talk to him about it. And he did. He sat down with me and he practically laughed at me. He did. He laughed. He looked at it and he like laughed. He's like, no, this isn't what I meant. This isn't what I was talking about. I was like, oh, okay. You didn't really mean what would help the markets. It, you know, was how do we sell ourselves or something like that. So, you know, that was another event that kind of set me on a different trajectory. I kept working there for another few months, and then my wife got pregnant for the first time, and I said, all right, I don't know how I'm going to, you know, tell my kids this is what I was doing, or, you know, and this is really not meant to be a judgment on people who are in the industry, continue to do it. I have very good friends there. This was a deeply personal thing. And, you know, I said to my wife, I said, I just don't think this is what I should be doing. I don't think it's a good use of my time, of my, you know, intellect. I feel like I could be doing better stuff. I came up with this analogy. You know, the work was very stressful. You know, you're writing software that is responsible for millions of dollars going through in very short timescales. Bugs would be incredibly stressful, cost a lot of money. And I said, I don't know that, you know, you have a certain budget of stress in your life, right? You can only have so much stress before you're done. And I said, I don't know that this is what I want to spend my stress. I said this, I don't know if this is what I want to spend my stress budget on in my life. I feel like I could be doing more responsible things, or, you know, something that made the world a bit of a better place, not to sound too bleeding heart or anything. But so it was really funny. By May or June of the next year, I left. And so actually moved into my mom's house in New Jersey from Chicago. And so there I was, 31 with a pregnant wife, living at my mom's house and unemployed. And it was pretty sweet.
So tell us a little bit about what you do today. I know you're founder or co-founder of Core Group. I mean, what sort of projects are you involved with there?
Yeah, at Core, we're a market structure consulting shop. I got a partner who has great experience also in market structure. He's been kind of a leading voice for years, Chris Nagy. We've got a bunch of programmers that work for us, and we do all sorts of different market structure consulting projects. But we have recently, and it's funny, this just is coincidental, but just today we're launching our new website at KORtrading.com, and we're really, narrowing our focus to what we call best execution consulting. So a lot of our work has become working for institutional asset managers, hedge funds, pension plans, mutual funds, long onlys, that kind of thing, and long shorts. But anyone who's pushing large orders through the market and needs to make sure that they're using sort of industry-leading best execution practices, policies, procedures, that they're doing robust quantitative analysis. We've gone from a situation in which there was very little data on trading available to one in which there's way too much. And so now you have lots of firms at these large institutions that are collecting all this data, analyzing their trading behavior, and they're overwhelmed by it. They don't even know how to, what to make of it. And so we try and help them understand what their quantitative analysis means, making sure they're doing the right kind, they're looking at things in the right way. We hope that we help people reduce their transaction costs. And, when you work for pension plans or mutual fund companies, and you know that those cost savings go directly to people's retirement, that kind of thing. That's the kind of thing that I like doing. We do market structure workshops where we'll do a half day or full day session, and we'll completely customize it to the firm, and that help them understand the history of market structure. How did we get here? Where are we? What are the complexities of market structure? What does it mean for you as a firm or as a regulator? We've done that workshop for several regulatory agencies in the U.S. And so that's the kind of stuff we do in our for-profit lives. We also founded a non-for-profit called Healthy Markets. And at Healthy Markets, we've got institutions who are members. So we represent, again, the institutional asset managers and the spectrum of small hedge funds that are a little over $1 billion to large asset managers like Janus or SEI that are hundreds of billions of dollars. And with those asset managers, we help them understand and keep them on top of market structure. We comment on new regulations, mostly in the US, but sometimes in other countries. We try and help regulators see things from the investor's perspective. We advocate within the industry for better standards around transparency and disclosure. We do rigorous examinations of ATSs and dark pools. And we're now in the midst of building something that we call the Healthy Markets Research Institute, which is going to provide a data platform for academics and other people that want to study market structure, where they can get public and proprietary data in an unconflicted way from an independent provider for free, with public and proprietary data, so that people can do studies on market structure with proprietary data, and then other scientists can replicate those studies, and see if they can get the same results, or if they can refute or support the results of other studies. That's a little thing I like to call science. And for some reason, we don't have that in market structure. We have regulations that are being written right now that are not based on data, that are not based on detailed study of what's going on in markets, or that are based on conflicted studies. And that's a dynamic that we're looking to change.
Yeah, right. Very cool. So you said something there about, how we've gone from a situation of having very little financial data to now having too much that we don't know what to do with it. You wouldn't happen to have any sort of stats or idea on how fast the amount of data that's available is growing, would you?
Yeah, actually, it's something I'm trying to work through right now as I spec out the Research Institute platform. We just got a grant, so we're actually building it right now. I can tell you that I was just talking about this yesterday with someone where If you look at opera data and SIP data, so if you take peak data rates, which is what you kind of have to plan for, and you try to build something that can store that kind of data, you need to plan for around 22 terabytes a month. And that's just top of book equities and options. Now, options is the major component of that. So when you take options out, it's more like 1.7 terabytes a month. But so that's the scale you're talking about. Now with the research platform, we're planning on doing equities to begin with, although we will do futures and options quickly thereafter. But we want to do full depth of book equities. And for that, for a few years of data, you're talking over 100 terabytes.
That's incredible.
Yeah.
It's a lot of space.
It's a lot of space. And that's why we have to partner with people like Google or Amazon to try and figure out how to make sense of that kind of data.
Right. Okay. Wow. So, while you're there at Core Group, I know it was sometime in the past couple of years, you actually testified to Congress on the dangers of high-speed trading. What were some of the issues that you raised with them?
Yeah, so I've testified before the Senate Banking Committee twice, and both times I try and take this perspective that I think I like to think is very pragmatic. I don't think that high-speed trading in and of itself is a bad thing. I think that I'm a technologist, I'm a programmer. I think that the march of technology is inevitable and it's a good thing. But I do think that some serious issues are leading to unnecessary complexity in our markets. And a lot of those come down to conflicts of interest. So, when you look at exchanges, and exchanges are part regulator and part publicly traded for-profit entity, that's an example, a pretty dramatic example of a major conflict of interest, right? So what should the exchange be optimizing for? Should it be optimizing its revenue, or should it be optimizing the quality of its market? And these things are often not the same thing. So, I often talk about that fundamental SRO conflict. I talk about the conflicts with brokers routing orders. What should the broker be optimizing for when the client pays a fixed commission and the broker gets charged per share depending on where it routes the order to? Should the broker be optimizing for its client's execution quality or for its own costs? And if it's optimizing for its own costs, then it's going to route to high rebate venues where it sits there passively and most likely doesn't get executed, versus routing for execution quality, where it's going to route to an inverted venue and have to pay but get executed and get better execution quality. So these fundamental conflicts, we find them in all sorts of places, and often they can exacerbate some of the negative aspects of high-speed trading, of which there are some. And there's nobody in the industry that will tell you that there are no negative aspects of it, but there are a few in the industry that will tell you there are no positive aspects to it also. I think that, most trading at this point is high speed. And the question is, is it this kind of activity that's been called predatory, which is aggressive trading and structural arbitrage of the market. And that's a lot of what, like it or hate it, some of the issues in Flash Boys were very relevant, were very accurate. Having worked at IEX and worked with those guys, I can tell you that personally, it was a very good depiction of who those guys are and what they were trying to do and what we were trying to do for, I worked there for quite a bit of time. And, there were structural issues in the market that had to do with market data feed, latency differences, and high-speed firms exploiting those differences and brokers catering to that exploitation. So these are the kind of things when I go before the Senate, you try not to get deep into the detail, but you try and point out those high level issues, that there are conflicts of interest, that there are structural design deficiencies, and that for some reason the SEC is not taking action. And so you try and encourage, Senate Banking Committee, who holds the purse strings for the SEC, and has oversight responsibility. You try and encourage them to push these kinds of priorities.
Right. So can you flesh out some of the, you highlighted there, some of the high-speed firms that are using what some people might call predatory tactics. Can you flesh out exactly what some of those predatory tactics might actually be?
Yeah, so, again, the Flash Boys example is one that, despite all of the attempts to refute it, really has not been refuted. And that is that if you don't route your orders in a latency-aware way, then you will see substantial order book fading. And this still happens. And you will hear many groups cite many studies that show that it doesn't happen. And every single one of those studies is in a foreign market that's not fragmented. So it's kind of a ridiculous analogy. But in the US, you have a situation in which the NYSE is in Mahwah, and NASDAQ's in Carteret, and BATS is in Secaucus. And if you have a market maker resting orders in all of those order books with lasers between data centers or microwaves between data centers, and you, as an institutional broker, send a large order, without considering how it's being sent between data centers, and that order is going to clear out a price level at one exchange, and it's going to miss most of the liquidity on the others because those high-speed firms are going to fade the order book in front of that. I think that's an issue. High-speed traders will tell you that's not. They will say, well, that's us adjusting our risk, in response to supply and demand. I think that that's a little of a stretch. It's one thing if your orders get hit across all exchanges and then you adjust. Sure, of course, no one's going to begrudge that. But the idea that you can benefit from structural arbitrage because of high-speed lines, I don't see the benefit. I don't see the improvement in market quality that results from that. I just see increased volatility and uncertainty and order book instability. So, I think that's an example of a structural arbitrage. And when you dig into the data, sometimes you see that it's more than just canceling. And that's when people start to talk about predatory. So, it's one thing if you've got orders resting across these different exchanges and you pull them in response to something happening. It's another thing if when you see something happening, you don't just pull your orders, but you start aggressively taking out liquidity elsewhere in order to move the price against the order in transit. And so that's where you go from order book fade to something that a lot of people would consider predatory. And when you dig into the data, you see that happening. You don't just see cancellations. You see aggressive orders racing ahead of institutional orders. Now, there are brokers that have figured this out and for whom it's not an issue. And there are others that haven't, that use less sophisticated order routers. So that's one example. Another example is data feed arbitrage, where if a venue is pricing midpoint orders based on the SIP and you have direct feeds, you're anywhere from a couple hundred microseconds to a couple milliseconds faster than that matching system. And so that during price level changes, you can exploit that latency difference. And that's another example of a predatory structural arb that doesn't enhance market quality. So, I think those are the things that we want to be concerned about and that we want to address. And even if it's not a big issue, so even if the one that I just described, this midpoint arbitrage, the data latency arbitrage, is not a big issue, which many would argue it's not, and I still have yet to see data on whether it is or isn't. But it's a confidence issue, and markets are predicated on the confidence of participants. And that's why IEX has been so successful. Those guys are on a mission, and like them or hate them or think that they're just marketing, whatever it is, their business model is different, and they are really there to serve investors. And that kind of confidence and trust has become rare in the industry, and that's unfortunate, but it does play a big role.
Yeah, so I mean, I had Dan Azen from IX on the podcast a few weeks back, and he was really interesting to speak with. So what was your involvement with IX? Like you said before, you worked there for a little, I don't know, what was it, a year or a few months or something? What were you working on there?
It was about 8 months. So it was when I just started being a consultant. And like I said, in 2012, when that story first went out on the radio, Brad was one of the first people that contacted me. So I went up and I met with them in the spring of, or early summer of 2012, when they were just getting started. No one knew who they were, what they were doing. And I loved it. I loved what they were doing. I joined up with them right away. And I had a great time there for about 8 months, just working with them on early designs. I helped to design the technology systems that were ultimately built, or to some extent built, and some of the anti-gaming techniques. I'm on a couple of their patents, and I loved it. I loved what they were trying to do to find a private market solution, not to depend on regulators. I'm still close with the guys there, and I have an immense amount of respect and admiration for what they're doing, what they've done, and I think they're doing it for the right reasons, and that's what was so refreshing to me. And it's kind of part of a broader point. Like I said, I left the industry and I was kind of disgusted with it, and having come back in and put myself out there and talked to a lot of people in the industry about what I'm doing and why, it's been a really amazing and inspirational thing to meet a lot of like-minded people. That you find out that there are all sorts of people in this industry. It's not just the caricature that you hear in popular press. And there are a lot of people out there that, have a philosophy around trying to improve markets and understanding that what we're doing is sort of a fundamental part of the global economy. And, that there's more than just, a profit motive at work, and that there should be. And that's been a great part of all this, and also, a great part of the work that I did with those guys.
Yeah, no doubt. So, I mean, you must have been thrilled to hear that they were approved as an exchange, just last month, wasn't it?
Yeah, absolutely. I think they worked hard for it. I think it's an innovation that deserves its chance. And I frankly, and this was in our comment letters, we're a nonprofit. We didn't really want to take a stance on the issue, but we found some of the criticism to be a bit absurd. The idea that 350 microseconds would ruin the NMS system or ruin the order book and make liquidity unattainable when you had latencies higher than that accessing NYSE liquidity, or far higher than that accessing Chicago. It just, some of the arguments were kind of off the wall. And I thought really dramatically illustrated the split in the industry between investors. And it was my count that I think $4 or $5 trillion of asset managers supported IEX versus their competitors and a lot of proprietary and high-speed trading firms. And that was a pretty dramatic illustration to me of what's going on in markets today.
Okay. And as we know, IEX was, before becoming an approved exchange, was a dark pool or an ATS. I mean, what's your views on dark pools? Like, what effect do dark pools have on listed exchanges? Like, is there any harm that can come from executing off exchange?
Oh, I believe so, absolutely. And one of the principles of our nonprofit is that we believe in displayed liquidity. We believe in open competition for order flow. Resilient markets are ones in which exchanges are the strongest part of the market, that there's ample incentive to display orders, and which order flow is not being segmented and siphoned away, and that and in which market makers are profitable. That's what we believe. And so and which a lot of evidence bears out, and a lot of data and academic study bears out. So, I think that when you have dark pools being run by bulge bracket brokers or major order routers, that's a pretty substantial conflict of interest, and there have been a lot of enforcement cases that have shown that to be true. Hundreds of millions of dollars at this point of enforcement, and that when you that there is a place for non-displayed liquidity, both on exchange and off. And these are very important and critical features to have in a market. But when you have, 20 ATSs of any, substantial volume, and massive fragmentation across ATSs and disparate business models and fee schedules and internalizers that are siphoning off all of the retail order flow, so that never makes it to an exchange. You have all of these impediments to profitable order flow from a market maker's perspective, getting to the market maker on the exchange. And to me, that's an issue. That's what leads to more fragile markets. So we believe that, retail orders should go to an exchange like they do in Canada and Australia. We believe that dark pools have a role, but that it should be a much smaller role than they currently serve, and that all of this massive fragmentation is a bad thing. That there is a nice happy medium somewhere between the futures market, which is monolithic, and the equities market, which is completely fragmented, and that regulation is sometimes needed to kind of help nudge the system in the right direction.
Yeah. Okay. So, we should probably start to wind this down. Is there anything you want to add before we wrap this up? Like anything you'd like to see changed moving forward? I don't know. Is there anything you'd like to mention, or do you think we've pretty much covered enough for the time being?
Yeah, I think we hit a bunch of different things. I think that from a programmer and more of a scientific perspective, I believe in data and data analysis, and I want to see markets and regulation being much more data driven as opposed to these arguments that are filled with opinion and bias right now, and that's sort of what we're seeking to do with our nonprofit. And I like to also empower people with information and help them understand the complexities of the market. Whether through stuff like this or when I work with asset managers. And so I think the more information we get into the hands of everyone and then into the right people, the better. So I'm always open for more opportunities to do that, and happy to come back on if people are interested, and if there are more questions, or if people want to send me questions directly, I'm always happy to correspond.
Absolutely. Well, where is the best place for, any listener to connect with you or find out more about you and core group? Where's the best place to go?
Yeah, if you just want to hear what I think, I tweet a lot, so I'm sure people know. So that's my handle is just DLauer at Twitter, or if you want to email me, it's dave@kortrading.com, or you can just go to our new website, kortrading.com, and there's a contact form there also.
Good stuff, man. Well, I'll put all those links in the show notes as well at chatwithtraders.com, so you can find everything there all in one place. Dave, I just want to say, man, thank you so much for doing this. It's been awesome. It's been really, really fun. So I appreciate you coming on, man.
Yeah, thanks for having me. I enjoyed it.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey traders, what's good? Nice to have you listening to episode 89. Now let me introduce this week's guest, Blake Morrow, also known as Pipsar on Twitter. Blake started out as a stockbroker in 1995, but this only lasted for a short period of time before he switched teams to become a trader. A wealthy friend put up $50,000 in starting capital, which Blake lost around about $30,000 of it within the first 6 months. Though, before wiping out entirely, Blake was able to turn that remaining $20,000 into roughly $1.5 million in the next few years that followed. He's since been involved in various trading and technology firms, but today, Blake is the chief currency strategist for WiseTrade, co-founder of Forex Analytics, and most importantly, an independent FX trader. Over the course of this episode, you'll hear about Blake's story in greater detail, how he navigates Forex markets using charts and technical analysis, as well as an understanding of economic drivers, some tips for beginning traders using leverage, and plenty more too. So here we go. I'm Aaron Fifield, and you're listening to Chat with Traders featuring Blake Morrow.
I'm excited about this because it's been a very slow day, to say the least. I mean, this is like the worst week to be in the markets, aside from the time between Thanksgiving and Christmas, especially that last couple of weeks. So
why is it so slow?
It's just, lack of liquidity. You got a lot of European traders are gone. A lot of North American traders. This is their last week of holiday before their. We have a Labor Day weekend here in the U.S., so things are, it's a long weekend, so everybody usually wraps things up after Labor Day weekend. Then, it takes a good week or two to get things back in the flow, because you get a lot of hedge fund managers. They come back on the 5th of September or 6th of September, and then they have a week of meetings, trying to strategize, and liquidity starts to pour back in after that. So, it's just everybody's wrapping up their summers. So, and everybody knows it's typically a slow time of the year.
Okay. So, I mean, even though like Forex, everyone kind of refers to it as the most liquid markets in the world, when a lot of people go on holiday, do you still kind of have an effect like that? Like, does it?
Oh, absolutely. Yeah.
So how do you change your trading to kind of work with that?
That's an interesting question. It's usually actually just making sure your stops are a little closer. I pick up my position size sometimes. It depends on the environment, though. Sometimes I'll. If the ranges, like today, the ranges were a little bigger, so I narrowed my trade sizes a little bit, widened my stops a bit, and kind of let the trends take hold best they could. Some days when I know there's a 30 pip trading range and there isn't much, I just I'll keep a tight stop, and I might even actually take a little bit bigger position. So instead of trying to make 30 pips or 50 pips in a trade, I might only look to make 10 or 15, but a little bit bigger position will compensate for, some of that lack of liquidity.
Yeah, right. Okay, cool.
Yeah.
All right, Blake. Well, let's just get started. I mean, I can't remember if I mentioned this to you beforehand, but I constantly get hounded by listeners to bring on more FX traders. So I just want you to know you're probably making a lot of people really happy right now.
Oh, great.
Talk to us about your introduction to trading. Like, how'd you get into this? What was your intro?
Wow, that's a a funny question that a lot of people always ask, it's especially where I live. I live in Phoenix, Arizona, so I'm not in the center of the financial universe. I'm not out of New York, or I'm not out of Chicago here in the United States, where, I'm probably more of a, I guess, a normal trade, I guess, if you will. And so when people ask me, like, how did you get into the currency market? It's always an interesting question, and I've got a long-winded answer. But when I left the military, I was in college, and I was going to school full time and working my way through college. I was actually a doorman at a bar. I was in my 20s. I was early 20s, and I worked some retail during the afternoons, and then I'd go to school during the day and at nights. And I had one of my best friends who was a stockbroker, and you have to think, this is back in the mid 90s. He was a stockbroker, and he was kind of like I don't want to say a boiler room type of setting, but he was he got on the phone and dialed 300-400 people a day, and it was just a numbers game. But he'd get people on the phone and sell them stock, and he's like, Blake, you got the gift of gab. You should try being a stockbroker. And I said, I don't know anything about the stock market. It's not really my interest. He goes, it doesn't really matter. You can talk, and you can probably sell. You should try it. He was making a lot of money at the time, especially me being in college, and I saw the car that he was driving and the lifestyle he was living. I'm like, yeah, I'll go in for an interview. And I did, and I got the job. I didn't know anything about the markets. I got the job. I went and got my Series 7 and, my state license, which was a 63 at the time. I think it still is anyway. And I became a stockbroker. And I did it for over a year, or about a year, and I really wasn't too happy with selling people stocks over the phone. I was good at it, and we brought Pixar public. We were part of that public offering, which was pretty neat. So my clients did well, but it wasn't. It wasn't something that really interested me. And fortunately, that same guy, he had learned how to trade from a market maker. They brought a company public back in the 90s called GoToNet, and he sat with the market maker for like a couple of months straight. And this market maker really taught him, order flow and, depths of the market and how to navigate through them. And he that was right at the time that day trading in the United States was getting really on its feet. And Jeff Burke and Chris Block of Block Trading, they were on the front cover of Inc. magazine, and they were called the Bad Boys of Trading, or the So's Bandits. I forget exactly what the title was. They were on the front cover, and we had a mutual friend who was extremely wealthy in the insurance industry, and he was the boyfriend of a woman I knew. And so we approached him with this, magazine article, and saying, we told him, hey, we can do this whole trading thing. It should be easy. So, of course, it's always easy. And it was in 1996, and we went to the same offices that those guys were written up in. They're called Block Trading. They had an office in Houston and Dallas. They had one in Scottsdale, Arizona. And so we went in the Scottsdale office in the mid 90s and started trading there. And I really, so funny. When I first started trading, I started with a certain amount of money, and within the first 6 months, I think I lost like 60%. Or close to 70% of the equity. Now, keeping in mind that as a trader, you live off the market. It's not like I'm drawing a salary or anything. And I really struggled that first few months, and eventually found my wings. Over the next several years, I traded myself in a nice, prosperous position where I left my investor. I also partnered up with a couple other traders. One of the principals at that Block Trading office in Scottsdale, he moved with us. We all moved to Dallas, and we opened our own brokerage firm. And we had a license at the time, NASD and SEC, licensed firm, and we had our own day trading operation. So back in the late 90s, even into, the early 2000s, the technology wasn't as it is today. I mean, internet was still in its somewhat infancy. People didn't have high-speed internet in their homes. When I downloaded my charts, back in the 90s, I used to download them, via, a telephone cable, and it would take like hours to download like 200 charts. It was ridiculous. But at that point in time, there were a lot of day trading offices. So we had our own office, and so we had, I think at our peak, we had about 15 or 18 traders that were in our office, and all, from all different walks of life, and really, really great traders that I learned a lot from. And eventually, we had a technology company that was spun off from that brokerage firm that built direct access to trading technology. And we sold that company to the WiseTrade Group in 2003. I think it was early 2003. And so I've been with the WiseTrade Group ever since. And that's where I really got my trading started. And I lived off the markets for many years, just solely in the 90s and early 2000s, trading. Yeah.
Excellent. Yeah, that's a really great story, Blake. And I'd just like to backtrack a little bit to once you left the brokerage, you said you went on to block trading. So block trading, was that a prop firm, I take it?
No, excuse me. That was just drinking some coffee here. It was they didn't have prop firms. They were all independent traders, kind of like the firm that we had in Dallas. So you would have, like, let's say an individual like yourself or myself, and I had, let's just say you had 50 grand and you wanted to start day trading. Well, back in the 90s and even in the early 2000s, regulations were pretty lax, where we used to have some major leverage. It was the leverage you could have trading the equity markets was much different than, in the mid 2000s, maybe late, I forget what years it was. It was probably 2007 or 8 or 9. They changed the leverage that day traders had. You didn't have back then. You didn't have to have $25,000 in your account to be able to have day trading margin. You could, and the margins that we had were incredible. It was like, 20 to 1 or maybe even greater than that. And so with a, $50,000 account, $100,000 account, or in our case that we had accounts that were, in the $500,000 range at that time, we could trade whatever we wanted and as much as we wanted. I mean, I would trade 5, 6, 8,000 shares of Yahoo at a time, and I never ran into any type of margin issues. So a lot of individual traders would go there. I'm sure there were certain prop firms. I just wasn't aware of them. Block trading was more of an independent traders would go there, and like I said, we didn't trade from home. No one really traded from home because we didn't have the technology. So everybody would go to these trading offices where we'd all share ideas, and we all had the speed to be able to trade from there.
Okay. Yeah. Right. That makes sense. That's really interesting. And you mentioned your wealthy friend helped you out with capital in the beginning. Yeah. I mean, it'd be nice if we all had a wealthy friend like that. But was he hesitant to hand his money over?
Yeah, he was. But he also, if I could explain to you the kind of person this guy was, he lived a pretty lavish lifestyle. He had exotic animals and exotic cars and exotic girlfriends, for that matter. So I think he was probably more of the risk taker, type of person. And but he was very street savvy. And one of the things that he did, I remember when we first opened our accounts, and you had to have like a long account and a short account because you couldn't, the way that the back office worked back then, that's what you had to do. I remember when we first got the accounts open, he goes, all right, here's a book. and it was the Mark Douglas, The Disciplined Trader. That was like the first book that I ever read on trading, and unfortunately, it's the late Mark Douglas. If you don't know him, I've known him personally. I actually worked with him on a couple of projects, maybe about 7 or 8 years ago. He's one of the premier trading psychologists, and wrote many books on trading psychology. But I remember I got this book, The Disciplined Trader, and then he also signed me up to be coached with several different traders, another trading psychologist, two technical traders, where I learned really my skill set of how to read and analyze the markets using Fibonacci's at that time, and that was a really those stepping stones. I didn't really think about it so much at the time, but looking back, that was probably what really set me off in the right direction, was really understanding how to look at charts, how to analyze them, and identify where proper entry points were, and those types of things. And but he was, to answer your question, he was pretty nervous at first, but he also took what I feel were the proper steps at that point to get us, where we needed to be and be profitable.
Okay, and was he incentivized in any way? Like, did he take a split of the profits? Yeah. Yeah,
absolutely. We split the profits. We had a percent sharing plan, of course.
Okay. So how did he react when you lost, between 60 to 70% of that capital he'd handed over?
Well, when that happened, and keeping in mind, I think I was about 26 or 27 at the time. He was, this wasn't a large amount of capital for him, so he didn't really think about it a whole lot. He had confidence in me, and the funny thing is, over the course of the next, I guess over the course of the next 2.5 years, because of the time. Now you have to imagine the time. That time in the mid to late 90s was the internet.com boom, if you will. And so we ended up doing really well. We had a lot of positions in some smaller internet name stocks that ended up blowing up and really kickstarted my trading career. So he ended up doing extremely well. But at that point in time, he knew. He's like, listen, you're new, and you're going to get this. And he also knew that it was more of a, if I'm going to eat and I'm going to survive, I'm going to make it work. And I told him, I'm like, I'm going to make this work. We're going to make this work. And he had the confidence in me. And I think really what turned it around at that point is my trading partner. He had his own account, but was the guy that actually got me into being a stockbroker at that point in time. He really was the driving force behind me, sitting me down and saying, listen, we have to be disciplined in how we trade. It's not just throwing darts. We have to really, start to analyze the markets and understand where, entry points are and what your risk is. And all the things that I really wish I would have learned, right at the very beginning. And it took me some time to learn some of the things that I try to teach traders in today's trading world.
Yeah, okay. And just before we move on to this, to talk more about your actual turning point, I'm just interested to know, like, how were you paying your bills? How were you eating and keeping up with expenses during that period when you were starting out and you lost, like you mentioned, 60 to 70% of your capital? How were you getting by?
Well, fortunately, I was always really good with my money as far as squirreling away for a rainy day. So I lived a lot on ramen noodles and peanut butter and bread. And fortunately, my mother had she had moved to Sacramento, California at the time to take on a contractor position. And she had this rental property which is over by our local university here in Phoenix. And it's definitely nothing to write home about, but it's you know, a lot of college students were around there as well. So I got to live there, not rent free, but she was pretty lenient if I was running a little behind. So, but those stresses mounted. Those were really stressful times, and those are times where, you know, really the market. And this is where you have to dig down really deep as a trader. You have to really, it's where your strength comes from, is through those trying times. And I feel fortunate that I had to go through some very tough times early in my career to really make sure I could turn it around. And because, you know, in retrospect, you realize, man, I never want to put myself back in that situation. But also it, you know, helps you really dig deep and really, figure out what you need to do to be successful in the markets. And I was one of those people that, you know, West Coast trading for us in the United States, especially where I live, you know, the markets were opening at 6:30 in the morning. That means I was up at 4:30 and at the office by 5:30, and then you know, the market opens at 6:30, closes at 1. But I would still be in the office for hours on end afterwards, looking at charts, analyzing the markets, trying to figure out what I wanted to do the next day. And I think a lot of that drive came from, I really needed to feed myself and put food on the table and make this work.
Yeah, so essentially, like, you almost feel as though you wouldn't have become as successful as a trader as you are today if it wasn't for those tough situations in the beginning where it was kind of like do or die.
Absolutely. And, you know, I think one of the, I agree with you. And one of the things that I try to explain to traders now is, you know, make sure you have enough money set aside. If you really want to trade for a living, make sure you have enough money set aside so you don't have to deal with some of those stresses, because, you know, depending on where you're at in your life, at what point you're at in your life, you maybe take some of those risks. But, you know, if you have a family, if you have a wife, if you have kids, it's much harder to take those types of risks. I'm glad that I went through those experiences when I was young, and I didn't have a family and I didn't have kids, and I could take on those risks. I wouldn't have done it any other way. But, you know, for traders that are starting out, and they're trying to, you know, just, you know, become successful, getting rid of some of those risks are probably really important as you start your journey as a trader, I think.
Yeah. So let's focus in a little more on your actual turning point as a trader. So you'd obviously gone through a pretty rough patch. What happened in order for you to go from a losing trader to a profitable trader?
You know, a lot of it, first of all, I would say is a little bit of luck. At that point in time, like I said, we took a couple of positions, and they ended up doing really well, which gave me a little bit of cushion. So that obviously helped quite a bit. After that, it was more about discipline. It was more about discipline and realizing that I needed to wait for a certain setup to evolve. I got caught, just like a lot of people at that point in time, and even traders, you know, here I am 20 years later, and I watch traders trade the markets. Everybody gets caught up in the inertia of the market at that moment, and the excitement, and they chase prices all over the place. They think, oh, a move is happening, I've got to be on it, and by the time they get in it, it's already too late. The markets have turned. So what I realized early on, and one of the things that's really been I would say the backbone of my trading, has been being patient and waiting for the market to set up. That has taken me so far in the markets, and it's one of the things that I think that if I would have learned early on, I wouldn't have been put in the situation that I was put in initially. Because at that time, Aaron, you have to realize that there wasn't traders' education wasn't like abundant, and the internet wasn't abundant at that point in time either. You couldn't just search anywhere for, oh, what is a good chart pattern, and oh, you know, what does it take to be a successful trader? weren't that many web pages available. There wasn't those types of resources. So a lot of what I did at that point in my life was trial and error, and based off of what I've, the few books that I read at that point. But I think really the turning point was the discipline in actually waiting, realizing that I didn't have to be trading every second of every day, and realizing that I needed to let a trade come to me. And if the trade came to me and I could plan around what it looked like, I could realize, okay, where's my stop going to be? At what point am I wrong? And where am I looking to get out? And what does my risk reward look like? Risk reward was one of those concepts that I fortunately picked up very early in my career, and realized that, hey, if I'm going to risk $1, I need to make 2 or 3 or 4 or more, and if I'm going to risk that $1, I need to make sure that that is the maximum amount of risk I'm willing to take in that trade. And those are the types of things that really got me to where I'm at today, and those basic rules.
Okay, so for you to increase the amount of discipline you had as a trader, I mean, what specifically were you doing to increase that discipline? Was it just a matter of being a lot more self-aware of what you were doing? Was there any sort of practices or things you tried to do to actually increase your discipline and, sit on your hands?
That's a great question, and I'm glad you asked that, because fortunately I had my best friend, even to this day. I just actually had beers with him last week. The guy that really got me into the industry and taught me how to trade, he is still to this day, even though he's not in the industry, he still is he does trade from time to time, and he calls me up and says, hey, what do you think about this? And I'm thinking about shorting that and that type of thing. So he dabbles in the market, even though he does other things now. Fortunately, I had him sitting next to me, and he was an absolute drill instructor, if you will, like a military drill instructor. He would sit next to me and he would smack me on the back of the head, saying, "What are you doing? Why are you doing that?" And if I'd made a couple grand that day, he would literally unplug my computer as I was sitting at it. He'd say, "You're done." And he'd unplug my computer and make me go home. So I didn't ruin the rest of my day, and it might have only been 8 o'clock in the morning. But those little things that I could sit back and laugh at now, years later, those types of things really made a difference in how I traded. And so fortunately I had somebody that I could talk to. I guess the point I'm trying to make is I had a companion, a trading partner, somebody who I trusted, that I actually grew up with, that really I could rely on him and ask, hey, what do you think about this? And I'm looking to buy this. And he's like, well, why are you going to buy it there? It just, the stock just moved. It just moved $10, and just this morning somebody was buying it $10 cheaper. So here you are paying this $10 premium on the stock. Why would you do that? I had somebody that walked me through the process that we could talk, we could both, banter back and forth. And that made a huge difference in my career.
And just to continue on that point, when you're starting out, you don't necessarily know what's a good trade and what's a bad trade, or I don't know if that's the right way to frame it, but I think you know where I'm heading with this. How were you able to kind of realize what worked and what didn't work so much for you?
Well, you can figure out what didn't work really quickly by your P&L. So that was pretty obvious. But that's a great question, because I learned from charts. I mean, I didn't come from I wasn't an economics major. I wasn't somebody who prepared to enter the market through an Ivy League school education and, made my way into the markets that way. I really learned through charts, and charts were almost taboo at the time. It was kind of a, now charts seem like they're incorporated in everything that everybody does, no matter what they do in the markets. But at that time, it really wasn't. And so the benefit that I learned is that utilizing a chart, I could use historical price movements to help me identify where a possible entry point was, and I could actually know at what point I made a mistake. Now, as I have spent 20 plus years in the market, I've learned a lot about what drivers move the markets, especially being in the currency market now. When I made the switch really back in 2003 to 4, right around then is when I really stopped trading equities and went strictly into currencies. But some of the things that I've picked up over the years is really learning about what drives an instrument or an asset class from a, whether it's a macro or micro perspective. And that has also helped me as far as my entering, knowing when to enter the market. So I can actually basically have a theme on what I'm trading and why and the direction I'm going, and then find a technical point of entry, based on what I'd learned over the years. And so what I've found, though, just to answer your question, and I know I'm probably going in a circle here, though, Aaron, what I learned is I didn't have to get really fancy with my analysis. The analysis that I do today is basically the same analysis that I did 20 years ago. And so for me, I learned more of a process. And once I found the process that worked for me, that I don't want to say it's a secret sauce, but something that, if I look for this fib level on this trend line, crossed over with this trend line and this RSI, look, the probabilities are that, more times than not, the trade's going to work out. And if I can put a maybe some sort of macro theme behind what I'm trying to do, I'm just increasing those probabilities. And it really didn't take me too long. I want to say too long, a few years where I could figure out on a chart, this is what I need to look for in order to have what I would consider a good shot of having a successful trade. And then, it's interesting. What's more interesting is, just like any trader, I would fall into the normal traps. I would make a lot of money quickly. I get to my head would get too big. Then my risk management goes out the window. Then I take a big loss, and then I have to take a step back. And what I always realized is, I always went back to the same setup that I had learned years ago, and say, okay, well, when I see this, this, and this, that is, that's what typically will work for me. So I always go back to the basics. And so now what I do more than anything is I just do the basics. I don't try to vary my process much. My process always stays the same.
Okay, that's a good answer. I like that. So let's go into this a little further, and then we'll probably get into some specifics about FX. So, just give us an overview of how you're trading today. Like, what are the type of opportunities that you look for and try to take advantage of?
Can you ask me this question in September, like maybe mid-September? Late August is not the best time. No, jokes aside, all the type of setups I really try to do is I really try to match up just some basic technical indicators. I'm not doing anything fancy, and that's what I host a daily webinar, and I've been doing it for 13 years now, and everybody knows when they see my charts and they see what I'm talking about, my charts look the same. It doesn't matter if it was today or you saw that you haven't seen me for 4 years and you were popped on my webinar 4 years ago. You'd see the same charts and same indicators and same trend lines, and everything looks exactly the same as it did 4 years ago or 6 years ago or 8 years ago. So, I typically will look for pullbacks. I don't chase price, and that's one of the things that I learned the hard way. As I mentioned to you earlier, I learned the hard way early on is I never chase price. I always wait for prices to come to me. So in other words, I'm always looking for some sort of pullback. Fibonacci's are great tools because that tells you how deep a retracement is. And obviously the deeper the retracement is, the less likely a continuation of that trend is. So I'm always looking for a 38% retracement or a 618, which is the golden fib that really produces the most I want to say hits or retracements will come to those prices the most. If I can match them up with what I'm looking for an RSI or I'm looking for a trend line, if I can match up those areas together, the more I can get to line up, the higher the probabilities are. And that's what, as a trader, I'm really more of a risk manager. I'm managing risk, and I'm trying to line up as many probabilities as possible in my direction at any given time. And so, for a typical setup for me, it's like I'm looking for a pullback. I'm seeing if I can, if that pullback will pause somewhere where there's a general trend. I do look at correlations. Correlations this time of the year, when there's less liquidity, they tend to be less reliable because you just don't have as much liquidity in the market. So if somebody's buying gold today, or that doesn't necessarily translate. I'm buying gold, so therefore I'm selling the dollar. You don't get those correlations as tight when there's not as much liquidity. But I do look at correlations. I look at the cross rate effect, meaning that if the euro dollar is doing something specific on a major cross, that's going to influence how I look at the rest of the euro crosses as well. So I can say, well, the euro dollar is really, really selling off today. So therefore, if I'm trading a euro cross, meaning like the euro New Zealand currency or the euro Canadian currency, I might be looking more as a short side trade in that because of the cross rate effect. So there are several different things that I might look for as a currency trader, but typically they're all the same things. It's kind of boring, but people always think that trading is some glamorous thing, but it's really quite a boring process that I follow every day.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
Okay, so I asked this question to Nicola Duke, who I know is a good friend of yours, when she was on the podcast about Fibonacci's. So why do you think Fibonacci's work? Like, why do you think that's something useful to watch for, especially the 61.8?
Well, Fibonacci's is such an interesting concept. First of all, Fibonacci's really go back to the mathematicians and how we have come to the conclusion that almost everything natural has some sort of Fibonacci ratio attached to it, whether you're talking about the distance from your forearm to your wrist, to the distance to your wrist to your pinky finger, the distance between your pinky finger to your pointer finger, on a horizontal basis, to a leaf in nature, or pretty much everything. Everything has like a Fibonacci equation and a number that really correlates. And what's interesting is that it can be translated into human emotion. That's why when everybody looks at a move and they say, okay, that was a strong move in the market, and now we're getting a pullback, a 50% pullback, automatically relates to somebody in their head subconsciously that was now it's half off. It was so much more expensive, but now it's half price. If it's a 618, it's like a natural emotional response area for people. And so if you know that about traders and about people in general, the herd mentality can really be used to your benefit. And knowing those Fibonacci ratios really is where, the herd mentality is meeting. So why it becomes so important and so valuable, in my opinion, is when you can match up different Fibonacci's based on different viewpoints of the market. So I might be looking at the euro dollar, saying, okay, well, there's this big move from 110 to 115, and it's pulled back to where we're at today at 111.50. Oh, great. That's pulled back about, a 618 or maybe 62%, retracement. But then I can look at it from somebody who's on the short side saying, okay, I was short from here to here, from 114 to 113, and it's extended itself 161% extension, and it's now gone so far where I've almost have to take profits at this point, where I can get different Fibonacci ratios, whether it's a pullback or an extension. If I can get them to line up at a certain point, the more what we call confluence or clustering, the more Fibonacci's I can get to line up at a certain point, the more I can argue that we're going to have a turning point, whether it's a bounce or it's a pullback from that specific area. And it's something that, I've always found very fascinating, but I think it has more to do with the human emotion component behind the market than anything. And as a trader, I try to capitalize on that. I always think about this one simple concept when I trade the markets. When people are buying, I want to be the one selling it to them. When people are selling, I want to be the one who's buying it. So that's why when there's a pullback in the market, and we just had a strong move higher or lower in the dollar, if it's pulling back, people are selling it, they're just trying to get out, they're rushing out the doors, I'm looking at a strategic place to be a buyer. And when people are rushing in to buy the dollar or sell the dollar, they're just rushing in to get in, I'm usually I want to be the person selling it to them. And so keeping that in mind, that always keeps me thinking one step ahead of everybody else. And using Fibonacci's helps me strategically find those technical points on the chart that I think are going to be those turning points where, it switches from being, all the buyers coming in to the sellers coming in, or vice versa. Okay.
So you're pretty much using it as something like a read on the market psychology, I guess.
Yeah, absolutely. Yeah. And trading is all about, I know that's drawn a lot of computer algorithmic type of trading that are trying to beat the humans, so to speak, in the markets. But really, it all comes back down to human emotions and what's driving it, and understanding what's driving those emotions, and at what tipping points that people get. They get too antsy where they have to sell, or they feel like they need to rush in and buy. Kind of understanding what other people's positions are in the market and where they're coming from has really helped me a lot. It's kind of like, I'm sure you've heard this before, interviewing so many traders over the years, Aaron. Trading is like playing chess, but when I play chess, I'm playing against a lot of very advanced people in the markets, and they might be trying to think 3 or 4 steps ahead. I'm trying to think 4 or 5 steps ahead of everybody else. So that's where a lot of these fibs come into place, because I can look at the market and say, well, if they were buying up here at 114 and here we are at 111, at what point do they get nervous? And at what point do they need to feel like, I need to get out here? This is my do or die. Well, as they start to exit the market, that's where I start thinking, okay, well, as they're exiting, those masses are exiting, I want to start looking to be a buyer. And so I always try to take an approach that way. And then, there's a lot that goes into it, obviously, but at that point, just saying, okay, if I want to be a buyer here, where's my risk, and at what point do I need to get out and say I'm wrong, because I will be wrong, and I am wrong quite a bit, just like every trader out there. But being able to manage your risk is also an equally important part of trading.
Undoubtedly. So earlier you referenced the 618 Fibonacci,
Yes.
and you talked about how you'd like to see a retracement to that level when looking for an opportunity to buy a pullback. How much variance do you give that level? Like, I presume that you're not expecting that the price is going to pull up right on the cent or at that very level. Like, how much variance do you give that level to say whether it's held or not?
That's a great question. Levels are levels. Whether you're using a support level or a Fibonacci or some sort of horizontal resistance or whatever, or channel support resistance, anything technical, I have to look at it as a zone, a zone, and I have to keep it in the context of what chart I'm looking at too. I do consider myself a fairly active day trader, but I also like to swing trade the markets, and I tend to take a lot of positions that I might be in for a day or two, depending on the environment. Like this week, I tend to be a little bit more active just because the market's not giving me opportunities to sit in the market for several days at a time. So, but the reason why I needed to make this point is because it depends what chart you're looking at, and you have to realize that every level, whether it's a fib level or a resistance or whatever it is that you're looking at technically, levels are meant to be broken and they're meant to be probed above and below. So you very rarely stop right on a fib, and that's why I always say that technical analysis is not, you don't look for perfection. There's a lot of imperfections and there's a lot of, error for judgment. You have to gauge for that. So if there's like a 618 retracement, and it's like, let's say we've seen a multi-week run higher in the euro, and it's about ready to come down, or it's been coming down. Well, if I see the 618 it being at, let's just say 111, I would expect that there would be a move below 111, maybe to 110.80, maybe 110.70. But I want to see how the price reacts around that Fibonacci. How buoyant are we? And so that's when you start looking at, what chart are you actually referencing? If I'm a day trader, I might be looking at an hourly chart. I'll be looking for how do those hourly candles respond around that level. If I'm going to take more of a swing or position approach to the market, I start to look at the daily candle. Okay, are we going to close above or below it? And Japanese candlesticks have proved to me to be such a valuable tool in the markets, because a Japanese candlestick and how you read that candlestick is how you read price action, especially for the day. Those daily candles are so important because it can tell you who got caught holding the bag today, in the markets, whether you're trading, an individual stock or you're trading currencies or any instrument for that matter. Those candlesticks can tell you, hey, there were buyers early on in the day. Somebody got caught, buying early in the day, and by the end of the day, we closed at our lows. Those people that bought at the highs are probably going to be really nervous and selling tomorrow. So understanding the anatomy of a candlestick is equally important. So if you factor that in with some of the fib levels that you're dealing with, it can become a very very powerful way of trading, especially when you're trying to time your entries to get in or out of the markets.
Okay, so you talked about the what was it? The close of a candle and sort of the open the following day.
Yeah.
Are they still as important as they might be in like equity markets? Because in FX you're trading pretty much around the clock for what is it, like 6 days a week? Is the open and close, is it still as important?
It is. It really is. I find it extremely valuable. You'll notice that most brokers that you use, whether I know you're in Brisbane, and that's correct, right?
Yes.
You're not, okay, and you're in Brisbane. And I know Australian traders that have their charts queued into their brokers closing at a New York close. So that means your daily candle is probably closing at a 5 p.m., which was just 45 minutes ago. They would have that daily candle close no matter what part of the world they're in. European traders the same way. And the reason why so many brokers in the FX will use a North American close, because it's the very end of the day for the world. So if you talk about, where you live in Australia, whether you're talking, in Australia or New Zealand, you guys really kick off the next calendar day. So North American traders really have the